billion valuation and the revenue growth that they're seeing, that's getting better. So I think the signs of AI adoption and AI impact are continuing. Look, nothing is ever a straight line. There will be bumps along the road. There are companies like Meta, which are spending a lot of money, which have nothing to show for it. So I think that there is going to be, there are going to be bumps along the road as people realize not everybody is going to be a winner. There are going to be losers. So far earlier there was a concern about the software companies, but I think some of the big hyperscalers that are spending money, not everybody is going to earn a return on investment. So right now, it's a generally feel good moment. I think there will be bumps along the road, but in general, the AI adoption continues to be doing very well. So I think the AI trade will continue, but there'll be some hiccups along the way.
Yeah, never a straight line. Thanks very much, Arvind. Appreciate you joining us. Good speaking with you, and it's a pleasure here on CNBC TV 18.
Thank you.
All right, well, let's just quickly run you through what's coming up here in terms of interactions on the program. 8:35, the Borosil Renewable Management will be with us. Mr. Kiruk on the fourth quarter numbers and outlook. Prabal Sen will join us on oil, HPCL, the outlook. Lots to talk about there. 9 o'clock, that conversation happens. 9:20, Manishi Ray Chaudhary. We'll talk markets. 9:30, the management of Keynes Tech will speak to us on their numbers. Vinity Organics will follow at 9:40. IKS Health after that at 9:50 towards the end of the program. Reddington joins us on the quarter gone by. So it's, earnings and earnings and more earnings as we race into the end of this earnings season. So lots of stuff. Nigel.
Time to slip in a short break. We go full tilt on stocks on the other side in our special top 10 segment. For the time being, I'll run you through the list. Bharti Airtel, Oil India, Bharti Hexacom, NLC India, Crompton, all of them will be reacting to positive news flow. You have IKS as well as Zydus that will also be part of the stocks reacting to positive news flow. Tata Motors CV will be reacting negatively. Keynes Technologies could get clunked back. And sugar stocks as well could pull back. We'll tell you more about all of these names on the other side of the snappy break.
Welcome back. Let's talk about stocks. This is CNBC TV 18's list of top stocks for the day. Our entire research team joins in, preps you up with the stocks. Hi guys, good morning. Hi girls, I should say. But let me begin this one with Bharti Airtel. Now there are two sets of news. One is the numbers and the second one is the deal. Now purely on numbers are slightly muted, particularly on the India mobile business, which is 50% of their revenue. So consolidated numbers are in line because the homes business is doing well, Africa is doing well. But the India mobile business, the B2C business has been subdued with a growth at just 0.6% quarter on quarter, lower than street expectations. Year-on-year revenue growth has come down to 8.3%, and this is the lowest I've seen in the last many quarters. The average revenue per user has also dropped by 2 rupees, and numbers are weaker than what Jio reported in Q4. But then is the second part, that is the deal. Now, on expected lines, Bharti Airtel has said that they will be acquiring 16% stake in Airtel Africa from Bharti Enterprises. The term is ICIL, but that is the Sunil Bharti Mittal owned family, which owns has taken Bharti Airtel and Bharti Airtel. So the listed entity will buy 16% stake from the promoter family in Bharti in Airtel Africa. With this, their stake will rise to close to 79%. But the street was fearing that it could be a mix of a share as well as share swap. But Nimesh told us in closing bell yesterday that it will be a share swap. The total deal value is 28,220. For Bharti Airtel, shares will be issued at a premium of 9.5% at 1,923. And more importantly, the company has said it's cashless, leverage neutral, and it will be EPS accretive for the Airtel India entity. And I think that should allay some concerns because the stock in the run-up to this particular set of numbers, ever since that deal expectation came to the market, the stock has been a bit subdued. So numbers miss, but the deal has been announced and it's going to be a complete share swap. So let's see how the stock reacts. Yesterday, in anticipation, I think it went up nearly 2%.
Got that, Rima. Thanks for that. Well, let's hop across to Sudarshan. He's focusing on Tata Motors. Morning, Sudarshan. You're expecting a negative reaction?
Good morning, Nigel. So Tata Motors commercial vehicle had reported earnings for Q4. Earnings looked very good, but the problem is the outlook that company has given both for Q1 FY27 and also for the entire fiscal. So first, talk about the earnings. Revenue has seen a growth of almost 19%, aided by the strong volume growth both on a sequential basis as well as year-on-year. So on a sequential basis, volumes were up 15%. YOY, it was up more than 25%. And EBITDA has seen an increase of 37%. Margin too has jumped and it has come at 12.8% from the level of 11% in the same quarter last year. Now talking about the outlook, company is saying it's expecting high single-digit growth in Q1 FY27 versus more than 25% growth that company had seen in Q4. Now, what's the problem is going to be? The sharp increase in commodity prices. So it believes that commodity headwinds is going to be significantly higher in Q1 and company is not going to pass on the entire raw material increase. Now margin guidance for the entire year is teens versus the earlier guidance of mid-teens. Talking about the international business, reduced fuel availability is creating some issues in Sri Lanka, and so international business also is going to remain under pressure. Talking about the brokerage views, Nomura has downgraded the stock to neutral and target price is 402. So I'm going with red, especially because of the cautious outlook.
All right. So thanks very much for that. Well, Oil India in focus. Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, good set of numbers expected because of higher realizations that we saw in the quarter gone by. Revenues for the company are up 21% on a sequential basis, EBITDA up 39%, margins have improved 400 basis points, leading to a profit growth coming in at almost doubling at 1789 crore rupees versus 800 crore rupees. Interestingly, there is an increase in production as well of oil on a YOY basis, up 6%, and the realizations are up 5% to $74.46 per barrel. So going with green, additionally, the royalty cut tailwinds are something which are positive for the stock as well.
Okay. All right. Thanks a lot for that, Sonal. But coming back to you, Rima, Bharti Hexacom, how are those numbers?
Well, it's a steady set of numbers. So revenues are up 2.3% quarter on quarter. Year on year, it's up 5.5%. The company has maintained margins at 54.4%. Profits, though, are slightly lower on account of higher other expenses and slightly higher exceptional costs. But again, along with Bharti Hexacom too has been an underperformer. But numbers per se are on the steadier side. But let's move on now to NLC India. Vivek joins in to tell us the news.
Well, good morning. Very strong set of numbers as far as Q4 is concerned. Remember, some key projects, especially Katampur, all of these projects have actually been commissioned in FY26, and that's contributed quite significantly to the earnings. The revenues high by almost 31.5%. Strong operating leverage has ensured that EBITDA has jumped up almost a little over 2 times. Margins very strong, over 1,000 basis points expansion. Profitability higher by 2.9 times. So very good numbers. Segmental revenues, when you're looking at it, mining revenues up almost 21%. Thermal power revenues up 35.5%, and one of the few companies that have actually seen strong growth as far as the renewable power generation is concerned, up 20%. The company, however, has gone ahead and cited that they continue to face land availability issues that naively impacting the mining operations there. But overall, a good set of numbers, and important to see when the company does go in for the renewable energy arm IPO as well.
Got it. Okay, thanks for that, Vivek. Well, Upasana, one of the stocks of the day is going to be Kaynes Technology. That's going to be an interesting conversation. You're tracking both of them, Kaynes as well as Crompton. Go ahead.
Good morning, Nigel. Well, first up, let me start with Kaynes. Well, it's a miss across the board as compared to our poll. Now, company has missed its own guidance and even what the street was anticipating. Now, the street was anticipating a strong revenue growth this time around, and it stood just about for Q4 around 1,200 crore versus the guidance of 1,700 crore given by the company in Q4. So overall, if this pans out, a revenue growth of just 26% that the company is given versus our poll of 53%. Coming to the margins also, EBITDA margins down 160 basis points at 15.5% versus our poll of 16.1. PAT is also down, under pressure, down 21% on year-on-year basis. Now, on full-year basis, if we look at the company, FY26 revenue growth stood at just 33%, and the company has missed its own guidance of 51% growth. In terms of EBITDA margins also for FY26, it stood at 15.8% versus the guidance of the company given 17%. So it's a miss on that front as well. Now, when it comes to companies' cash flows and even the working capital cycle, even this is much stretched. So we'll be looking out at what exactly has panned out here. And company's overall OCF has further stretched to negative 600 crore, and company has also missed its guidance here of turning cash flow positive by end of this year. So certainly a stock that we'll be keeping an eye out on, and a lot of questions to ask to the management as well. Now moving on to Crompton, overall an inline set of numbers. Revenue growth strong at 11% on a YoY basis. It is driven across segment, be it ECD, SDA, LDA, all have been firing out guns. Now, EBITDA margin stood at 11.9%, down 110 basis points versus the poll of 11.5. Adjusted PAT up 9%. And now coming to the segmental performance, ECD performance stands in line with the estimates that the street was working with. It has shown a growth of 9% on year-on-year basis, led by price hikes in fans, solar pumps, and even SDAs. Now, revenue in ECD is up about 9%. Margins are down 120 bips at 15.5%. And coming to lighting business, it has reported one of the strongest growth quarters within revenue uptick of 14% is what the management has also indicated. And Butterfly, overall stable performance. So going with green in Crompton, and Keynes certainly a red here.
Thank you very much for that. Vinny is here to tell us how IKS Solutions numbers looked.
Hi, good morning. So in terms of IKS, good numbers that have come in from the company. Growth momentum that has sustained, right? 19% growth in Q4 FY26. For the full year also, they are managing the 20% growth rate as well. Margins, 340 basis point expansion for Q4. Mainly, obviously, the equity acquisition which they made, that's working out for them. Operating leverage is playing out now for the company as well. And overall, they'd spoken about mid-30s range, what they are comfortable in terms of margin. That is what is sustained. Now, is this the peak is something that we have to understand, but 35% margins is the best that we've seen in the last couple of years for the company as well. Profits of the company also are managing to see a good growth. Apart from that, they've given a vision 2030 they've spoken about, right? Where they want to get the EBITDA to 3,000 crores by 2030, currently at 1,000 crores. So almost a 3x jump is what we're seeing. They made a small acquisition that is there of Adani Solutions, which is mainly on AI R&D. It's a very small acquisition, but still pushes them more towards the AI focus that they want to continue on. Good numbers from the company. We could see green on the screen.
All right, and we have the management board joining us a little later. Thanks very much, Vinny, for that. Sugar producers and sugar companies in focus. Manisha is here with details. Manisha, good morning.
Morning, and thank you for that. Well, yes, India, in a notification late last night, has banned sugar exports until September 2026. The exports of raws, whites, and refined sugar, all of that has been banned with immediate effect. The only plus point is that the government says in the notification that they will allow shipments already in export pipeline, which are under specified conditions. Now, India has done that, and this was perhaps anticipated as well, because the crop estimates earlier were at around 32 million tons, which were continuously revised onto the lower side, which now perhaps stand at 27.5 million tons. This has been due to erratic weather, lower yields, etc. Also, concerns that El Nino could disrupt this year's monsoon has been playing onto the regulator's mind. If you look at the closing stock, that also has been much lower. Markets are anticipating that at around 3 million tons. And overall, when you look at the export that was allowed, was at around 15 lakh tons. Out of that, 7 lakh tons has been contracted or exported as well. So this decision basically comes in on 6 to 7 lakh tons of exports. Markets were looking at a positive side of it because the rupee has been depreciating and there were markets which wanted sugar. But this sudden stop at this would perhaps be slightly on the negative side for the sugar industry.
Okay, all right. Thanks a lot for that, Manisha. Well, going across to Ekta, she's here to tell us about Zydus Life. Morning, Ekta.
Well, it's definitely acquisition season for a lot of the pharmaceutical companies. So Zydus is going to be acquiring Sirtio Holdings for $166.4 million in an all-cash deal. It is a US specialty oncology company. It will be via a tender offer followed by a merger of Zara, which is Zydus' arm, into Assertio, and it will eventually be delisted from the Nasdaq. The portfolio includes a cancer drug called Rolvedon, which is basically received a biological license application by the US FDA. So the street seems to be optimistic on that. CY25 sales for this particular company stood at $68.23 million versus $60 million on a year-on-year basis. Zydus is also going to consider a buyback on the 19th of May when they meet to declare their numbers.
Thank you very much for that. Let's do a quick recap of the top stocks with positive news flow are Bharti Airtel, Bharti Hexacom, NLC India, Crompton, IKS, Zydus Life. Stocks with negative news flow are Tata Motors, CV, Keynes and sugar stocks. But that's equities. Let's talk commodities. Manisha is joining in as always. Manisha.
Thank you so much for that. My focus totally today is on the metal as a space, because while we're looking at gold prices trading stable, silver has been holding around that $87, $88 an ounce mark. But it really has been about the base metal prices, which have seen a surge. The tight near-term supply, strong China economic data, decline in inventories on LME and Shanghai as well. And then there have been various reports about ongoing mine closures, operational disruptions, and that sulfuric acid shortage. All of that has been keeping the prices on the higher side. If you look at the U.S. copper, we are not trading too far away from its all-time highs. Aluminum is trading at a 4-year highs. Zinc prices at a 3.5-year highs as well. Platinum at a 2-month highs, palladium prices at 1-month highs as well. So everything that you see in case of metals is trading in the positive in Asian markets right now.
Thank you very much for that. Get into a break. On the other side, the management of Borosil Renewables will join in to talk about Q4 numbers and the way forward.
Welcome back. Hope you're having a good morning. Well, for starters, I think the GIFT 50 is suggesting that we start off in the green, but individual stocks are going to do a thing of their own. Let's welcome Deepan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Deepan. Good morning. Good to see you in. Deepan, you know, there'll be a lot of frontline names that we'll be discussing, but I want to ask you about Keynes Technology, and I'm looking forward to the chat that we'll have with the management. The management assured investors they're going to be achieving the guidance that they set out. No heads up was given. And that's why the numbers come as a bit of a shocker. If the stock is under pressure today, what is your view? Because they've been saying in the past, revenues will move to $1 billion odd. But this sort of numbers actually will warrant a bit of a reaction on the downside.
Yeah, good morning, Nigel, and thank you for having me on your show. So I think investors need to understand that there's going to be some volatility in the earnings depending upon the order flow and the deliveries. But you can take heart from two facts. One is that they have a solid order book position. I think at last I checked almost 2 years, current years, or rather FY26 earnings. And I think the big action in Keynes has to be the OSAT facility and how that's going to play out. I think it's a high risk, high return type of a project, and it will overshadow the existing business also. And that's the key, I think, variable to watch in Keynes Tech. But nonetheless, I think results are decent. The problem is that expectations run a bit higher than what the company can actually deliver. And such corrections, if at all they take place, are good opportunities to enter if you have a 3 to 5 type of a view. Because just as one disappointing result has come this time, one can always expect maybe somewhere down the road, you could have a result which is far better than what the street is expecting. And that would correct this kind of a bad number, which if the street perceives it to be a bit negative.
Is that a, Deepan, morning, is that a general comment or a Kane-specific comment?
No, I think, Prashant, sometimes for these high-flyer stocks, the analyst expectations are really high.
Yeah.
And companies also do not manage the expectations better. And look, these earnings look fine on Excel, but at the ground level, there are many challenges. And sometimes, just one smaller thing like postponement of a delivery or a sharp increase in the raw material cost or some unusual item can cause a kind of a decline or at least lower than expected profits. But underlying business is very good, and top line I think has grown pretty well. And I think it's quite commendable that Keynes at least going into semiconductor manufacturing, which is the need of the hour.
Dipan, what's your read on Bharti Airtel? The numbers are disappointing. Even the dividend that they've paid out, 24 rupees, is slightly lower than analyst expectations. But then there is that Airtel Africa stake increase by nearly 16%, and it's going to be cashless. What's your view?
I think again, same thing that we were fine with the results. 15-16% growth is what you should expect on a mature business like this. And it came with those kind of numbers. Of course, there's an extraordinary expense. But by and large, I think a lot of uncertainties around Bharti Airtel are over and done, especially in terms of AGR dues and stuff like that. And I think that the Airtel acquisition of Africa is very positive. That geography is growing faster than the Indian geography. It makes the entire shareholding pattern and the structure far more simple. And at the end of the day, I think it's amongst the few large cap Nifty companies which can still grow at beyond 15%, because there are very few of such companies. Only disappointment, if you ask me, is the ARPU increase is not as per what we expected. But, I think we remain in hope, and at some point of time, they will be able to nudge that figure higher. But on the whole, I think great set of numbers, interest cost, depreciation costs, all kind of flattening out. So it does show that eventually return ratios also will improve for Bharti Airtel.
Well, it's earnings season, so we get to our first management. Stay with us, and Deepan, lots more questions coming your way. Borosil Renewables is the company. So I think, decent fourth quarter, but for the full year, I think there is still a loss. What will FY27 hold? That's the question. Pradeep Kumar Kheruka is Executive Chairman of the company. Mr. Kheruka, good morning. Good to have you with us here. Prashant this side. So, the Jan to March, of course, we'll talk about some specific numbers and what we can glean from that. But just put out the 27 expectation, if you can, sir, on the top line. What are you expecting? And at a EBITDA level, what are you expecting? What kind of numbers?
See, the operational results for the year have shown up a reasonable margin. It's about nearly over 491 crores EBITDA. And the loss figure that you talked about is after setting off the loss that we had provided for last year from the German subsidiary. But operationally, we have done well. And the next year, we expect there to be a marginal improvement. Now, the way the expansion is coming up, we do expect we are on line to grow by about 60% this year. Meaning we expect installed capacity to be in production or started up within this year. So I can speak for 2028 that the figure should be about 60% higher in terms of turnover, profitability, everything. This, of course, subject to what we know, the uncertainties of everything. But everything seems to be going quite well in terms of demand, in terms of production, and there seems to be nothing on the horizon that should be interrupting us.
So FY27, you say about 500 crores in EBITDA, and for the full year, 26. You're saying marginal growth, single-digit growth in EBITDA in 27, and 28 then will be a big year because of the additional capacity which comes up.
Right.
Got that. Some of the issues you've spoken about, which is the freight cost, and now, of course, there is the power cost as well, right? With what's happening. Could you give us a sense of how that played out and what's playing out now?
The power cost for us is not very bad because we are now significantly on renewable power, and with the renewable power that we now have, the prices are not subject to the power prices nationally otherwise. And the possibilities of natural gas going up do exist. But so far, we've had no curtailment in supply. We've had a marginal bump up in the cost of natural gas, but we were able to pass on some of that to our customers. So we have not really suffered very much from power. And going forward, I'm not sure. This is all very uncertain. On the one side, we see a lot of activity which is geared towards solving the conflict. On the other side, of course, it's dragging on much longer than most of us would have expected. So other than that, I do not see any other major impediment on the horizon. Of course, some raw materials might go up, but that's a little uncertain. That could be because of freight rate and so on. I don't see any major roadblocks coming up at this time.
Good morning, Mr. Kheruka. This is Rima here. So till your expansion comes on board, that's in December of 2026, what would be the volume growth of the company for this 9 months of FY27? Last year, you were at 8%. Will it be similar? Do you do better? Can you push to double digits? And you said that the overall cost is manageable. So can you hold on to EBITDA margins of 30% that you clocked in the quarter gone by?
You see, we can only speak based on the visibility today. Based on today's visibility, it seems that there should not be much change. And growth also about 8% is something that we could try to achieve within the year with further, improvements in operational efficiencies and so on. And with the possibility of getting some extra production from at least one of the furnaces that we are planning to be coming online. So we expect that one furnace we might be able to light up in January, and the second furnace perhaps in March. So next year, of course, we can see 60% more glass coming out.
So this year, it should be similar to last year, about an 8% volume growth. In FY28, when your capacity goes up by 60%, your overall turnover goes up by 60%. You've also sought a shareholder note to raise 750 crore rupees. Are you looking to raise that money? If yes, by when? And what will it be used for?
At the moment, this is an enabling resolution. We are in a dynamic world. You see, the solar business is taking off with even more energy than it was last year. And that's because of the uncertainty of oil supply and so on. People are shifting their focus to solar. And it's a matter of time. The nation is going to move away from LPG for cooking to induction heaters, which are more efficient. They're cheaper than LPG in terms of cost, and they are faster than LPG. So induction cookers are really the best way to go, and these use electricity. And if you think of a billion people cooking on induction instead of LPG, that would add up to a sizable demand. We're looking at data centers. So at the moment, there seems to be no end to the demand for electric power. Everything associated with power, I think, is going to be on a rise.
Yeah.
And fortunately, we have negotiated the headwinds politically. We have sort of emerged unscathed, other than the cost of oil, to which I think that there's no solution.
Everything okay and set in terms of the duties, right? I mean, that's been it's a big mover for you.
That's been a very big mover, and a very timely mover, I might say, because the government has seems to have taken a decision, with a consolidated, concerted decision to improve and to install a full-on manufacturing base in India for the entire solar value chain. And next year, we are seeing some further changes in terms of cells. We are seeing changes in cells coming from the next couple of months, when imported cells will no longer sort of be allowed to be used. And after that, we're looking at polysilicon ingots and things like that. So we are going to become a very strong renewable energy manufacturing power in India.
But there are enough Indian players who are kind of backward integrating, and that's the competition perhaps which we've spoken about in the past as well, Mr. Kheruka. We'll leave it there for now. Thank you very much for joining us. Good speaking with you and good luck with 27. As you say, we'll see some growth, but 28 with more capacities will be the big one. We'll take a break. We're back. Deepan is, of course, with us, and we'll ask him about stocks, more stocks which are in focus yesterday and on results after market hours. Mitesh and Sudarshan also join in with some technical trading ideas. Stay tuned. Welcome back. We've got Hormuz now joining in with the delivery numbers and the stocks which made the moves yesterday. Hormuz, morning.
Morning, Prashant. And MTR Tech was one such name that we have not stopped talking about all through the year now. And it has extended its year-to-date gains after yesterday. The company extended its, raised its guidance for FY27. The stock was up almost 10% yesterday. The volumes were the highest since January of this year. 45 lakh shares were traded. It's 5x its 20-day average. And even on the delivery front, 13% of those shares were marked for delivery. So around 6 lakh shares for delivery. That too was 3x its 20-day average. It was the second most traded stock on the Nifty in the entire broader market scenario on Wednesday. And it ended at a record high as well. And in just the first 4.5 months of the year, the stock is already up 185%. Now, what was the most traded stock on the Nifty 500 yesterday was SAIL. And that stock was up almost 15% yesterday, the biggest single day gain since March of 2020. And it snapped a 3-day losing streak. The premiums on the 190 call option, of course, we don't talk about sales options quite frequently, but was up over 900% on Wednesday. The volumes were the highest since April of 24. Almost 17.5 crore shares were traded. The 20-day average is only 2.5 crore shares, and a third of those were marked for delivery. So 5.5 crore shares for delivery. The 20-day average is just 1 crore. And the stock, though, ended at a 52-week high, but you must remember that the stock is in the F&O ban, so you can't take new positions here. And lastly, possibly the earnings reaction of yesterday was Dixon Technologies. That too ended 10% higher in yesterday's session, the biggest gain in 2 months. It snapped a 4-day losing streak as well. The 11,000 call option was the most traded on Wednesday. Premiums going up by 150%. Volumes here were the highest since October of 24. Close to 30 lakh shares were traded. The 20-day average is around 6.5 lakh shares. And a quarter of those were marked for delivery. So 6.5 lakh shares for delivery. The 20-day average is just around 2 lakh shares. It was the second most traded stock on the Nifty 500 on Wednesday. And the stock, even though it's down around 8% for the year, is still down over 40% from its 52-week highs.
Thank you very much for that, Dipan. MTR Tech, as Hormuz said, we can't stop talking about it now. 180% higher from the start of the year. Q4 numbers were good. Guidance raised from 50% to 80% growth for next year. But still, 180% up this year, 300% plus in the last 1 year. Who want to justify?
You're putting salt on my wound. I have been having 2 companies, MTR Technologies and Paras Defense, on my screen. I have a charting screen in front of me, and every time I'm thinking of buying, I don't end up buying because of valuation, and the stock price keeps going higher and higher. The numbers keep on coming. It's, I think, something which has been missed completely. Fabulous play. At least MTR is a fabulous play on the data center investment theme, and their connection with Bloom Energy is quite amazing. And if you read about what Bloom is doing and what MTAR means to Bloom, then it's a very, very solid investment case, but it's just valuation 100 times I mean, I don't know, in the past, whenever you bought a stock 100 times, it's never worked out for you. And that kind of a thought, holds me back. But nonetheless, I think existing investors can laugh all the way to the bank. They can congratulate themselves. And we remain in hope, I think, at some point of time when the stock is at reasonable valuations, maybe because of a correction, maybe because of significantly higher numbers, it may provide an entry point, but otherwise one of the solid value creators of at least 2026 so far.
Deepan, I'm looking at this note from Philip, I think it's Philip Capital, on MTAR. They say that in FY20, so FY27, FY26 earnings per share is 35 rupees, 27 is 80 rupees, and 28, 80 will become 155. So they're saying they're giving a 50 times multiple on FY28 and they get some, I think 7,500, 7,700 kind of price target on MTAR. So
that's the thing, no, Prashant. We talk about analysts having very high expectations. This is the thing, I mean, how do you justify 7,500 rupees price unless you don't work it backward to a 50 rupee earnings per share? So,
yeah,
it's all about building the expectation. But I think, if you watch the company closely enough, you do get opportunities. I've seen that time and again. If not this time, then this correction, some other correction. One bad quarter also, because these are all capital goods manufacturing companies. One bad quarter may see 30-40% correction in stock price. Those are good entry levels. So I think you just have to wait for the catch to come to you, so to speak in cricketing terms.
Yeah, I'll tell you, you said it's a salt on wounds. We spoke on Bazaar, Arima, I don't know if you remember, this conversation we had at $1,400. And by the way, this was not some eons ago. This was last year. This was in 2025, I think September 2025. And I mean, it just struck out to me at that point. I remember very clearly because they said, well, we are expecting 40-50% kind of growth. I think some crazy numbers next year. And this is just a few months ago. So it's been an incredible kind of move. It's been just discovered, I guess, right? With I guess it was people who knew, but I think a whole set of newer investors have come in. I guess there's institutional participation, etc. as well. And all the hot button right spaces, there's space, there is defense, there is nuclear as well. And of course, I mean, the AI data center, the Bloom partnership that you spoke about. So one of those areas which has done phenomenally well in that sense. Deepan, you said you have a software. Do you have Sterlite Tech on that software in terms of the...
No. Yeah, it's looking interesting. Definitely looking interesting. But, just the track record of the company and a bit of a commoditized type of a product just kind of holds me back. But yes, I think seriously looking at it quite closely, again, a great data center play as well, good export opportunities. And Prashant, now what I'm thinking more and more is that I want to look for businesses which have got export competitiveness. And, rupee at 95 is a certainty. It's going to be there for a long, long time. And that will change the dynamics of many exporting companies. Okay, they may have to cut the price because of rupee depreciation, but they'll become more competitive. And companies which are having 40-50% revenue from exports, I think those are really worth studying quite closely. And even if you see in this particular earnings season, companies which have got an export business, they tend to have done better. That is one investment theme. And secondly, those who derive a lot of revenues from overseas subsidiaries, because when you convert those overseas subsidiaries into INR to consolidate, then that automatically adds to the bottom line. So that's something which we are working on quite closely in this earnings season.
Yeah. The story with Sterlite seems to be they are just pivoting away from telecom to data centers. That is the story. And they are, from what I understand, they're not so much focused on India because the demand will pick up, but demand is not there. It's exports with regards to servicing clients overseas in the US. That's the story. And the optic fiber, I mean, it's more complicated. I mean, you can produce it on the same line with upgrades, but you've got many more, I mean, thousands more threads in that one single optic fiber. So that's the difference between supplying to telecom and supplying to data centers in that sense. But that's why I think a very large foreign investors picked up shares, 100 to 400 this year. Just one more set of names very quickly, Deepan. One is Fractal. There was the lock-in ended yesterday. Stock was down 10%. It's a good company, AI, and they seem to be doing all the right stuff. And the other one is CleanMax, all recently listed names.
Yeah, Prashant, first a disclosure, we have just invested in Fractal Analytics after the result, and you're looking at mark-to-market losses immediately, but very positive on the company. There are going to be only 5 or 6 winners within the software space, and I consider Fractal one of them because of the AI disruption, so very positive. And CleanMax also, I think, very good set of numbers, very aggressive growth in the kind of capacity addition. They have been hit by higher interest and depreciation costs, but that will kind of normalize over time. So both these companies are definitely worth keeping on your radar and tracking them quite closely.
Yeah, Deepan, if you, fair enough, both interesting names and recently listed. If you'll allow it, we'll just like to sort of, go to China for a bit. The Xi-Trump summit is underway, and it's a big one. So what will come out of it, we'll have to see. But this is the report, I think, which CNBC's Elaine Yu sent us a little while back, just summarizing what's been happening on the ground there. Watch this.
So far, they have been hailing the importance of U.S.-China relations. So when their bilateral meeting started at the Great Hall of the People, just 2 kilometers away from where I'm standing outside the Forbidden City, and they struck a positive tone to start things with. President Xi said that China and the U.S. must jointly answer questions of the times, and said he expects 2026 to be a historic and landmark year for U.S.-China relations. Let's listen to what he told Trump.
I always believe that our two countries have more common interests than differences. Success in one is an opportunity for the other. And a stable bilateral relationship is good for the world.
And President Trump also told President Xi, talking about their long relationship, as this is, of course, his second term now. The last time a U.S. president visited China 9 years ago was also by President Trump. And he said, no other presidents have had such a long relationship. And he said he looks forward to doing business again in a reciprocal way. And he also told Xi that he is honored to be his friend. Let's take a listen.
It's an honor to be with you. It's an honor to be your friend. And the relationship between China and the USA is going to be better than ever before.
And it's not just these 2 leaders meeting, of course. We have the CEO, some of the most powerful American tech business executives joining President Trump. We saw them shaking hands with the 2 leaders outside the Great Hall of the People earlier. And we also saw Jensen Huang standing there just behind Marco Rubio earlier. And Elon Musk as well of Tesla also here. And he says that he wants to accomplish many good things while he is here. And NVIDIA CEO also said the meetings went excellent. So we're seeing Trump talking up the business deals that could be in the making, billions or even hundreds of billions of dollars potentially in the works with this delegation here. So we'll be watching what kinds of agreements could come out.
We're all watching for what kind of agreements come out, and there perhaps will be more than just symbolism and photo ops. But we'll get into a break. On the other side, we'll come back with pre-opening. We'll also discuss oil marketing companies. ICICI Securities' Probal Sen joins in next. Welcome back. Counting down to the open. Let's get you a few technical trading ideas. Mitesh Thakkar, Sudarshan Sukhani join us as always. Good morning, gentlemen. Thank you very much for joining in. Sudarshan, let me begin with you. What's the call on the Nifty Bank?
Yeah, good morning. Well, yesterday we did see a low that was made at 23,250, 260 actually, and then a bounce from there. Maybe, and the key word here is maybe, this could be a short-term low, and we've found some support here. It's not yet very clear, but there's a trade on the long side that's worth taking. We know exactly where we want to exit, below 23,250. So with that as a stop loss, look for a small intraday dip towards maybe 23,425 to 450, that small zone, and then go long. Your stops are very clear, but I would take a long trade on the assumption that perhaps yesterday's dip was a low.
Mitesh, would you concur that the low that we had yesterday acts as a firm support?
I'm not very sure of that, to be very honest. I think that the Nifty, broadly is negative. But yesterday was a movement which is slightly counter trend in the sense that after 4 days of decline of about 1,200 points, there will be an attempt to pull back. So in the short term, 1-2 days, maybe yes, you will still have those pullbacks playing out. But till we start getting past 23, 750, 800 zones, I think the broader tone will be still on the negative side. So in that sense, I think I would be looking at more of shorting opportunities once we get closer to about 23, 700, 750, 800.
Let's talk stocks then. Mitesh, what would you go with?
See, on the stock side, I have a few buy calls today, given the fact that one, the GIFT Nifty is slightly on the positive side, and two, I think that pullback might soon play out. So I have a buy on, the first stock which I have is Cipla. Cipla is a buy. Can you allow me for a minute? I think the document is failed to load properly. I just do it.
We'll come back to you for the Cipla rates and the numbers. But Sudarshan, you want to tell us your stocks?
Yes, Grasim is a buy with a stop under 28.90. It's not just for today, it's also a positional buy. Tata Steel is a buy with a stop under 215. I have two short selling ideas because, as I said, we assume that the Nifty has made a low, but you never know. Sammaan Capital is a sell with a stop above 145, and KEI is a sell with a stop above 5,000.
Mitesh, can we come back to you?
Yeah. Cipla is a buy with a stop at 1309 for targets of 1365. Also a buy on Hindalco with a stop at 1049 for targets of 1120. A buy on Manappuram with a stop at 303 for targets of 322. And one sell call, that's Eicher Motors, which I would recommend selling with a stop at 70.50 or just above it, and a target of 6,800 is what I have.
All right, we'll come back to you for more calls at 9:10. For now, let's turn our attention to the oil and gas space because geopolitical tensions continue to keep Brent crude prices at elevated levels. Yesterday, the IEA, the International Energy Agency, turned notably more cautious on the global oil market in their latest report. Back home, the focus is now the impact that we will have on oil marketing companies. Yesterday, HPCL came out with the numbers. The Q4 numbers were good, but the street is worried about the kind of losses they are currently incurring on LPG and auto fuel, and will we see some sort of a government intervention, maybe a fuel price hike? So lots to discuss. Let me invite on the show Probal Sen, oil and gas analyst at ICICI Securities. Probal, morning. Thank you for joining in. So HPCL was the first of the oil marketing companies to report their numbers. Q4 is in hindsight. What do you expect from HPCL and the rest of the OMCs till we have some sort of a government intervention, and your thoughts on what's going on?
I think that's the key word that you mentioned, till the government intervention. At the end of the day, I think there is a clear acknowledgement even by the OMCs that losses are obviously piling up. There are different reports, so I don't want to get into what numbers actually one should assume. We have built in a significant amount of loss for the first quarter. In fact, in our revised estimates, FY27 shows a better loss, because, we have not assumed any pricing action at this point of time. And the dispute resolution, as and when it happens, what we assume in our revised numbers is that by H2 things might normalize, but the revival of profitability in the second half may not be enough to offset the losses in the first half. Again, I reiterate that we have not assumed any price hikes or any huge moderation in prices overall over the next 3 to 6 months. So in that situation, my sense is that profitability for OMCs will definitely be under stress. I think two positives that are relevant to highlight here is that HPCL has been well ahead of its own targets in respect to deleveraging, thanks to the higher profitability, better operational efficiency, the kind of OPEX savings programs that have actually worked and have actually exceeded their initial targets for FY26 as per the management guidance. All of that has meant that debt equity is at now 0.8, among the lowest it has been, despite the kind of capex they have done on the Vizag expansion as well as the Rajasthan refinery, which is, I think, extremely creditable. And that, in an ironic way, does provide some cover for bearing losses for a slightly longer period of time than earlier crisis occasions. If you go back to 2008 financial crisis, the COVID situation, or the beginning of the Russia-Ukraine conflict. So what the government will actually do with respect to its pricing actions or in consultation with the boards of the respective OMCs is something that's uncertain. And therefore, we have turned fairly cautious on the space at this point of time.
What will be the losses in Q1, assuming crude prices stay where they are and there is no intervention?
If there is no intervention and crude prices stay like this and losses continue to be this high, which is close to about more than 10 rupees for petrol and close to 22 rupees for diesel, the losses could be, fairly significant. I have not, published Q1 estimates specifically, so won't be comfortable discussing it. But our FY27 loss estimate as of now stands at 20,000 crores for HPCL.
Got it. Prabal, good morning. On the product side for refiners, what's the environment like? You keep hearing one or the other. I think last night the 7th largest Russian refinery was up in flames. I mean, so generally refining margins seem to be still holding pretty strong, right? Diesel, aviation fuel, etc.
Oh, absolutely. I think the product cracks being this high is one of the reasons why losses are also accelerating, because you've also got, from as per various reports, some sort of a capping in terms of the refinery transfer price to the marketing divisions, as well as the higher export taxes that are in place, to sort of keep exports uncompetitive against domestic sales. But if you look at the theoretical margins, more than about 1.8 million barrels a day of capacity has been knocked out in the Middle East alone as part of the conflict, and as a trickle-down effect as part of the Russia-Ukraine conflict. There's been more refining capacity that has actually been impacted. So various estimates suggest that close to 3 million barrels a day of refining capacity is actually affected over the last 6 months or so, which obviously provides a lot more tightness in the market, quite apart from the flows that have been restricted due to the Strait of Hormuz. So my sense is that margins...
Chennai Petro and MRPL standalone refiners will not make money because they are also capped, what they can make.
Obviously, we don't know the exact levels for each date in terms of what the capping is. But yes, obviously, if product spreads themselves are actually being fixed at a certain level, then they will, I think, excuse me, the numbers suggest that margins will still be higher than historical levels, but they will not be what your Excel sheet suggests, let's say. On a theoretical basis.
You should not price those numbers into well put. Now, for Reliance, though, what does it mean?
I think for Reliance, even with all the restrictions and, whatever has been going on in terms of capping, the fact is, again, that GRMs will probably definitely be higher than what they were for FY25 or so. That would be our sense, number one. Number two, the supply tightness is also spreading to the petrochemical sector, and Reliance has the advantage of building in a strong pipeline of multiple inputs for its petchem. Unlike some of the other refiners who rely on naphtha, Reliance, obviously, as you would know, has a pipeline of ethane, which is anywhere between 35 to 40% of its petchem output, plus the refinery off-gas cracker that it has. So naphtha-based cracking, which is the most unprofitable today, is actually less than 22-23% of its overall portfolio. So if you look at its OTC segment overall, my sense is that numbers can actually continue to recover over the next couple of quarters unless some fresh restrictions are placed or there is a constraint in terms of crude supply itself, which from what we understand at least is not evident as of now, at least over May and June.
Prabal, the other development was the government cutting the royalty rates on production of oil and gas, which is positive for ONGC and Oil India. Share your thoughts on that. You turn cautious, incrementally more cautious on oil marketing companies. Does this development make you incrementally more positive?
On upstream, absolutely. I think what has been remarkable is that as of now, we have again not seen any moves in terms of capping realizations for both these companies. And on top of that, the kind of royalty reductions that have been done specifically for the onshore fields, nominated fields, close to about 6%, savings that will be evident on the on the onshore fields. That will definitely benefit Oil India relatively more than ONGC. ONGC probably has maybe about 20-30% of its production coming through from onshore, compared to close maybe almost 95 to 98% for Oil India. So to that extent, I think the benefit is more for Oil India versus ONGC. Having said that, in terms of valuations, what we really see is that if you do a reverse DCF, I think ONGC's valuation still factor in a less than $70 price deck over the medium term, whereas Oil India, I think, has outperformed, and probably factors in closer to $80, $82. So in terms of preference, we would continue to believe ONGC versus Oil India at this point of time.
All right, Prabal, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate your time here as we take stock of what the call is as far as the entire oil complex is concerned. Well, I think it's 9:10. So Sudarshan and Mitesh are with us with the 9:10 call. Sudarshan, what do you have?
It's Grasim, buy Grasim with a stop under 28.90.
Mitesh, what about you?
Go with the buy on Manappuram for targets of 322 and a stop place below 303.
Which was the stock?
Manappuram.
Manappuram. Got that. Thanks very much, both of you, for those calls. Let's just look at the dollar rupee, and if it's made a new low, we got to 95.80 yesterday, 95.71, 75. So it's a flattish kind of start, and 5 minutes to go for markets open here as well. Bharti is we're going to shine the spotlight on once again. So the stock in the pre-open will come up, but Rima will take us through the details. Rima.
Well, Bharti Airtel has been an underperformer. Year to date, Bharti Airtel is down 13% because the tariff hike were not coming through. Things were slow. And then came the announcement 2 days back that the company will consider reorganizing the shareholders. So immediately, the market jumped on to the expectation that Bharti Airtel will acquire the promoter entity stake in Airtel Africa. And the street was worried because if they had to acquire that 16% stake, because the management had hinted about it in the past, there would be an overall outgo of nearly 28,000 crore rupees. More than, so that's a sizable amount. So the street was worried. In fact, over the last couple of days, yesterday itself, the stock had hit a fresh 52-week low of 1740. But I think today the street is taking a more positive view because on that deal, on expected lines, Bharti Airtel, the listed entity, has acquired a 16% stake in Airtel Africa. That's the Africa business from the promoter entity. With this, the listed Airtel stake in Airtel Africa goes up to 79%. But this is going to happen via a share swap. Bharti Airtel will issue some preferential issue, and that's going to come in at a 9.5% premium to where the stock closed yesterday, above the 1900 rupee mark. So the street is overall, sanguine about it. They're saying it's fine, and the company themselves are saying that it will be an EPS accretive transaction from year one. So those concerns are allayed, and as I said, the stock has been a rank underperformer, 13% lower from the start of the year. So you are seeing that rebound purely on Q4 numbers. On the India mobile side, it's been a bit subdued, but India mobile is only 50% of their overall revenue. The other 50% is actually doing pretty well, whether it's Africa, whether it's homes, whether it's the B2B business, which is why the consolidated numbers have come in line with expectations. So some rebound visible in Airtel. Even yesterday, stock was actually a little higher by the close. And this morning, I think in pre-opening, it's adding on some more. But Sonal is now joining in. She's here with us in the studio on Oil India.
Well, yes, good set of numbers reported by Oil India, but that is something which was expected because crude oil prices were higher, and that is something that we can see in the numbers as well. Revenue is up 21% on a sequential basis. EBITDA has risen as well to levels of 1,820 crore rupees. Margins have expanded by 300 basis points, and profits have almost doubled to levels of 1,789 crore rupees. Crude oil realizations are higher for them at $74.46 per barrel, which is an increase of 5%. And more importantly, the production has gone higher as well for crude oil by 6% on a YOY basis. Additionally, the tailwind of royalty cut for crude and gas production is something that is positive for Oil India. Crude prices continue to be higher and rupee continues to depreciate. All of these things are fundamentally positive for Oil India.
All right, Sonal, thanks very much for that. Well, a quick recap of stuff which we've covered since the morning at 8 o'clock. Bharti, of course, Oil India, so two names we've discussed just right now, 2.5 and 3.6 respectively. Bharti Hexacom is up about 2.25%. NLC India will come up about 7% higher. Crompton is flattish higher. IKS 4% up in terms of the rate. There is Zydus Life, there is Tata Motors commercial vehicle, there is Keynes, which of course is the casualty of the day with the numbers, the poor performance, 10% lower on Keynes. The recent lows on Keynes were about 3,300 or so, perhaps should get to it by today. I mean, sometime today. Balrampur Chini, Sri Renuka, Dhampur, and the sugar news coming through post-market hours yesterday as well. So sugar exports disallowed, except of course what's already been contracted, as Manisha told us just a while back. We've got market open with the first rates up on your screen. We'll look at those and then look at individual names in a bit. So the first rates are coming up. It's 0.6% pop, almost 0.61 actually. 23,556. The Nifty Bank is up 0.6 as well. The small cap index is up 0.33%. The mid cap index is starting higher. So it's a decent start all told. 150 and we're back at about 23,560. The resistance is 23,800, which was the support earlier. We are ranged, but we get these occasional 100, 150 odd point moves. Let's see if it fizzles out or we're able to hold on to it. The Nifty heat map gives you a quick sense of where we are starting on the Nifty 50 stocks before we move any further. There is TechM, TCS, HCL. Oh boy, it's all... it's 4 IT names and 1 steel. And that's the 5 stocks which are down on the 50 stock index. Cipla, Adani Enterprises, Adani Ports are higher. By the way, if you look at Adani stocks yesterday, Enterprises, Ports, Energy Solutions, Green, they were some of the biggest gainers in trade yesterday. So there is that which is happening. And of course, that big block happened in Enterprises, just as we reported a little while back. Rima.
Well, Bharti Hexacom are the two stocks in the green. So Bharti Airtel has opened up with a gain of 1.3%. So adding on to the rally that we had yesterday, 18.20 on Bharti Airtel right now. Cipla is your top gainer. It's a 7% move. Came out with numbers yesterday. Initially, profits plunged. Then the street did that one-time adjustment. And the stock is rallying in how? Very large volume, 7.5% on Cipla. Clearly the top gainer by a margin. Adani Group stocks are higher. Adani Enterprises, Adani Ports, seeing buying. Power Grid in the green. HDFC Life, Tata Consumer, Coal India, L&T. So lots of stocks on the way up, but as Prashant pointed out, on the way down, it's all IT. And these stocks continue to slide. This week, in the last 4 trading sessions, Tech Mahindra, TCS and HCL Tech have fallen between 5 and 7% respectively. So no respite. It's fresh 52-week lows on TCS today. It's fresh 52-week lows on HCL Tech and Infosys. In fact, they are at 3-year lows, not just 52-week lows, but the slide continues. And this is despite that 1.2%. Earlier there was always a positive correlation. Every time Nasdaq did well, and we would say there would be a rub-off impact on Indian IT. And now somehow it's the reverse. Nasdaq was up 1.2% yesterday. But Indian IT is under pressure.
Well, Rima, a few stocks on the broader markets that deserve special mention. Care Ratings, they delivered a big net profit of close to around 53 crores. That compares with around 43 crores on a year-on-year basis. And I think there was some margin expansion as well. Came in at around 46.5%. That compares with around 43%. So big up move is what you're seeing in Care in initial trade. I think the stock is up close to around 8%. It's flying away. Volume's not very, very high, but that stock is up and about in trade. Another stock that's catching your attention is Balaji Amines. Just take a look at that stock. Bursting away. Stock is up close to around, I think, 15%. Volume's fairly decent as well for the first 2 minutes of trade. You have the profitability that jumped up, I think, by more than 50%. And the margins were up close to around 480 basis points. So big move is what you're seeing on Balaji Amines. That stock is flying away as we speak. Bagel Projects, they won a 200 to 300 crore 400 kV transmission line order from Power Grid. So that's why that stock is up close to around 7%. Sagar Cements, well, those numbers look quite good. At least they delivered double-digit margins. Remember, it's been a big rank underperformer. On a low base, they have delivered good numbers. Con-call schedule later today. Let's see what the commentary is out there. Some kind of tinkering with regard to the debt is going to be important. Otherwise, valuations attractive and margins expansion on that front as well. MTAR Tech, it has rallied, but it says it's good for more because that stock is well up and about in today's trading session. Big move is what you're seeing on that name. I think on the downside, the reaction that is calling for attention is Keynes Technologies. You can't get out. There are pending sell orders, stock down 10%. Zaggle is down close to around 7%. We'll speak to the management in the next 70 minutes or so. Interarc, I think that's another management that came out with the set of numbers. It's scheduled for some time during the course of the day. So both those two down 7 to around 8%. Net, Nifty is up 140 points. You'll want it to build onto the gains. The breadth of the market is positive as well. The bulls will say, let's pack up. But we've got a full day session to get through.
No, you're absolutely right. It's 140 odd point gains. So it's a pretty good session at this point in time. I think we'll just look at the, maybe a few more names before we go any further. Is, by the way, pretty 5:1 in terms of advances to decline ratio at this stage. MTAR continues to, power away. It's another 6% pop at 7,200 MTAR Tech, and we were talking about this one a little while back. The Adani Group stocks are all up between 2, 3, 4%, depending on what you want to look at. I can count enterprises. There is green. There is ports as well, which are all higher right now. RR Kabil has had a decent run last few days. I mean, actually, not more than a decent run. So from late April levels of 1,400, stocks at about $2,000. So it's a pretty sharp run up that we've seen on RR Kabil. Sharda Cropchem reported numbers a little while yesterday, actually, on the last hour. Stocks up about 1.5%. Metropolis is up 5%. Just a few other names, right? Whether you're seeing this kind of price action play through. Newland Laboratories has been such a amazing sort of wealth creator. So absolutely bit of an interruption from the highs in November last year. It got to about 12,700 or so, which was the low. That was the low in March of 2000 this year. And from there is rallied right back to almost back to 17,000 kind of levels. E2E is the other one, which is up about 3.5% right now. So there is enough and more, which is playing out. Quality Power is down 9%. So that is, one name. Apart from Keynes, Quality is the other one, which is down sharply. Maybe a TVS Motor is down, which is down about 2.5% right now. So yeah, that's where there is some pressure. Otherwise, I mean, it's a pretty decent session. We have Manishi Chaudhary with us with Emo Capital Partners. Manishi, good to have you with us here. Thanks for joining in. If you will, there is, if you've looked, you obviously track Bloom Energy in the US, right? And I'm sort of linking that back to the listed player here, which is MTAR Tech. And Bloom is, no, you don't track it, Manishi?
Not really.
Not really. Okay. No. Okay. So yeah, I mean, Bloom provides power to data centers, and MTAR provides fuel cells to Bloom. So that's the connection. And of course, I mean, with everything which is happening in the US, this explosion of demand for power for data centers. I mean, I think MTAR is getting lots and lots of orders. So it's done phenomenally well. So tell us what's on your radar, because money is being made. It's just that it's a narrow set. Moves are very, very sharp. And as earlier guest was remarking, every day you look at names like this, it's up another 5%, 6%. So it's very tough to buy. It becomes very tough to buy in that sense. Manishi.
You asked me, I'll go back to your original question, Prashant. What's on my mind? As far as India, or for that matter, any other market is concerned, there's just one thing that investors need to keep on their minds. And that's what I'm focused on. And that's number one, earnings, number two, earnings, number three, earnings. And that is, unfortunately, the biggest disappointment for India right now. That's the big elephant in the room. And there's earnings estimates which are being downgraded every day across sectors in India. And that's the big difference between the other emerging markets, the large emerging markets, and India. You look at the North Asian markets like Korea and Taiwan, people mistakenly say that it's only an AI story. No, they're not. There are earnings estimate upgrades happening across sectors because the AI boom is now percolating down to individual earnings. I mean, the average householder's earnings over there, which is in turn driving consumption sentiment. So look at Korean banks' earnings estimates, look at Taiwanese financials' earnings estimates, look at Korean retail earnings estimate. And that is, you know what bothers me? You know, everyone laments that FIIs are selling India. They're not selling India without a reason. They're not really finding the large frontline stocks where they can make money and where, you know, there's a positive earnings framework supporting the valuations. And I think, you know, apart from the currency, which has been in the doldrums, this is one of the biggest headwinds for the Indian market right now.
All right. Hi, Manishi. Good morning. Good to see you again. Manishi, but we've gone through a period of underperformance, and there'll be various themes, right, that have started to look up. What would be top of your list out there?
Remember that when I talk about India, these sectors, I'm really talking about maybe a 3-year time frame, not really over the next 1 or 2 quarters. I personally think that the best strategy for Indian investors is to diversify a significant chunk of their portfolio outside India, particularly the Asian emerging markets. So that would be my advice, number one. Within India, we do like the private banks, we do like industrials, we do like consumer discretionaries. For the industrials, at some point of time, I think there would be some kind of a compounding effect of private investments coming back. The Middle East will have to be rebuilt, and we have large companies which have experience and expertise over there. We like consumer discretionaries because, you know, I mean, at some point of time, you know, once we are through with this present round of inflationary concerns, consumer spending would come back. That's still about 60% of the Indian economy. And there are various segments within the consumer space which can be played, not just the four-wheelers, but also some of the diagnostic chains, some of the food delivery companies, some of the new e-commerce companies, and so on. You know, but those are the 3 main segments I would look at. I'm also looking closely at the base metals, you know, like the steel and zinc. They are the only ones which have had some kind of earnings upgrades. The valuations are still very reasonable over there. So that really summarizes my point of view about India. But remember, to make significant returns on these sectors, one would have to wait for maybe 1 year or maybe 1 to 3 years.
So have you brought down your weightage of India in the overall emerging market portfolio right now?
I currently have a neutral stance on India. The Indian weight in MSCI Asia ex Japan is slightly less than 15%. So it's around 14 to 14.5. And that is where my weight in my model portfolio stands. The biggest overweights are Korea, Taiwan, and Hong Kong, China.
But you're saying it will take at least 1 to 3 years before the Indian markets can start generating any sort of a return. And we've already gone through a near 2-year period of low returns, muted returns, lackluster markets. Should one be Yeah.
You know, you're right. I mean, I guess your question is that, you know, aren't we there already where the Indian markets can bounce back? You know, I would be a little more enthusiastic about the Indian markets if the earnings environment improves. It looks like fiscal 27 would also be a single-digit earnings growth year. You know, and we have had that in fiscal 26. We started fiscal 27 with the mid-teens kind of earnings growth expectations. If you go back about 6 to 9 months, it was about 15 to 16%. Today, it's down to about 9.3%. So this is going to be another single-digit earnings growth year. I would also be looking closely at the currency. We have a balance of payments problem. We have a situation where the current account deficit is no longer being neutralized by FDI and foreign portfolio investments. FDI, net FDI, has been close to 0 and possibly negative this year. You know, so these are the issues that need to be sorted out before we have a degree of enthusiasm on the part of the foreign institutions about investing in India. Bit of a chicken and egg situation here, but clearly these are the variables one would have to very closely look at.
Okay. All right. Manishi, we appreciate you joining in. Thanks for giving us your brief comments on the Indian markets, the global setup as well. Have a good day ahead, and we catch up soon.
Thank you very much.
Time to focus on the stock of the morning. Kaynes Technology, they have disappointed on all fronts in the past quarter. Revenue, margins, profitability, all of them below street estimates. To help us out with what went on in the past quarter, what's the way ahead, we're joined by Mr. Muthukumar Narayan Swamy, the Managing Director of the company. Hi, sir. Good morning. Good to speak to you. But investors are really waiting to hear from you. I'll tell you why. We spoke, with the management of Kaynes towards the end of March 2026. And you all had mentioned guidance is on track. Now the operating cash flows are negative. Revenue has missed the mark as well. Don't you think you all should have given investors a bit of a heads up if there was any kind of issue, particularly towards the last 10 days of March? Why such a big miss, and why couldn't you all alert your investors?
Thank you, Prashant. Thank you for taking me into the call and really appreciate your time early in the morning. Yes, I think during the last call, during the middle of March, we did communicate, and we were looking for two major government contracts where we completed the manufacturing to go. But because of the last minute delay on the contract, we could not go immediately. But nevertheless, I wanted to reiterate with you all, for a full year, we have grown by 33%, and our bottom line has grown by 39%, which gives a very, very strong fundamental performance. The organization has been formed with a fundamentally strong product. Yes.
Sir, we have the numbers, sir, with regard to what you have delivered. The question is, when you all were guiding for the cash flows to turn positive and the revenue number to match the guidance, why didn't that happen, sir? It couldn't be a problem of just the last 10 days. You all would have known right on March 20th that this sort of an issue, those contracts haven't come in, or there is some revenue that is deferred. So the clarification is on that front. And also, what is the way ahead now? Will the cash flows turn positive? Point number one. What kind of revenue guidance will you be targeting for FY27 with margins? Please go ahead.
Thank you for giving this opportunity to explain our position. If you see the market here, the market against India's growth of about 8%, the electronic business is growing at about 15 to 16%. And we are sure in Kaynes that we will be outgrowing the market, and we'll be almost double of the market growth in electronic industry in our peers. So we will be able to get into a FY27 revenue, which is almost double of the market growth in this area. Well, the actual guidance depends. The factory is ready to deliver. The products are up and running, but it all depends on the consumption. In the last quarter, the market situation, particularly post the Middle East war, has created some uncertainties. That was the reason. But going forward with all the OEMs outlook, we are very, very pretty strong on this. In our revenue, which will be doubling the market growth. The actual numbers depends on the consumption of the customer. As long as the cash flow is concerned, I wanted to tell you, there were two businesses with us. One is the electronic EMS business, and second is a product addition called metering business. If you look at the standalone Kaynes Technology India Limited, we were positive against about 65 crores of last year. This year, we are at about 255 crores. And our receivables on this segment has substantially improved in terms of the number of days. The net working capital on EMS business has come down to 55 days when compared to 64 days last year. However, the metering business, which is a strategic acquisition for Kaynes in order to get into the product segment, which is 25% of the revenue, the business model itself is of a payment over a staggered term. We are working with the agencies to make sure that how we can do it, these things in a much better way. And we are pretty confident in next 3 quarters, we will be able to come back with a better situation than what we have. But I wanted to you to look at our standalone EMS business, which has created substantial delivery in terms of reduced net working capital.
Yeah, Mr. Swamy, hi, morning. This is Prashant here now. This is my colleague Nigel earlier. Just a quick word on because we had Sirma management with us 2 days back. And they also kind of talked about what they classify the smart meter business in their industrial segment, and they said that they are now going to go very slow and be very cautious on the meter business, smart meter business, because they say there are receivables issue. I mean, actually, and they very explicitly said, I mean, the business is not what it looked like. The opportunity is not what it looked like 2 years back. So they're going to be very selective in terms of who they work with and all that. So is this, and we've heard reports, right, from various states coming through that there are these protests, and generally, I mean, there seems to be a pushback. And that, I'm assuming, will flow through to SEBs and SEBs in terms of who they purchase from, and then they give you orders. So it's like a full cycle. So is it a temporary issue, or you think you will have to scale back?
Okay. Every organization has their own strategies and their own growth plan. Keynes, which is strong in the manufacturing field, are moving towards a product company. Thereby, we are adding products to our services. We could claim proudly that we are the only company which has got meter manufacturing, meter installation, and of course, meter services also in terms of the software. So we feel that this is one of the strategic acquisition for us. If you ask about the timeline on this business, yes, we are pretty sure that this has helped us to add up to our bottom line because we are selling the products now. But at the same time, we are working on various methodologies to see that in next 3 quarters, how we can convert this into the reversal of the trend. But you can rest assured that this is the business model which is giving on this, and we have taken over this, and we are pretty confident of coming out of this. Of course, we have a very clear strategy to see that how we can mitigate this risk associated with this, but we are pretty confident on this.
Just one more question from my side. What is the revenue growth in FY27 going to be? What is the revenue growth in FY28? If you can just give us those 2 numbers. Growth for the next 2 years. To your mind, internally, what are you looking at?
While we are, Keynes is a very, very aspirational company and looking at the multiple.
So just give us the aspirational number, sir. Internally, what is the aspiration?
See, the industry is looking to grow at about 15 to 16%. We are doubling of that growth. That's what I can share. With the high volatile situation that's around this industry and in India, what is going through, and we are poised to grow in an every growing segment, be it electric vehicle segment or defense segment or industrial business. But at this point in time, rather than telling the number, I would say that we are pretty confident because we have a capacities available, technology available, product available. We'll be outgrowing the market and we are doubling of the market growth.
So I can put out a flash saying Keynes is telling us that revenue will grow 30% in 27 and 30% in 28. I would not be wrong.
You are an awesome, and then you are able to interpret the numbers, what I say. Go ahead.
Okay, got it.
Morning, this is Reema here. What was the loss in revenue on account of those 2 government projects which got delayed? And has that come on board? Because you also said consumer demand was soft.
See, it's all in the last minute of when we do the bidding, when the product is ready and the product is already tested and approved. Many of the allocations happens at the point of time. We were very optimistic about how we can grow into this and then got it. But unfortunately, what happened is there was delay in this. I don't want to go into which company, which product at this point of time, but we are pretty confident that it is not a lost business or it is only a delayed business and it is not a denied business.
Okay, so that's still not come through then. And you also said that consumer demand has been soft. Is that persisting?
See, consumer demand is soft is one, but if you see the Keynes presence is not in one vertical. We are present in multiple verticals, and we will be able to overcome the softening, the market softness in the consumer by the other segments where we can grow. And that's why I always put it up saying that the market volatility, keeping it aside, we will be outgrowing the market and we are double of the market growth. That will be our penetration into the market.
Okay. And on margins, you ended Q4 with 15.8% margins. What can we roughly assume margins to be, given all the puts and takes?
Keynes as an organization continues to focus. When the market is volatile, the internal makes us a difference from with our peers. We'll be continuing to expand the market like what we have done last year. And going forward, we'll be, how we have delivered the results when compared to the previous year to this year. We'll continue in the same path of expanding our margins.
17% margins, because you'd spoken about it the last time. So by the end of FY27, you get back to 17%?
I don't want to again mention the percentage, but if you see the growth, what we have got, we'll be going ahead in the same number.
You know, sir, the EMS market, you're mentioning it will grow at 15%, but I think it will grow at 20-25%, right? That's what the street is working with. So in that case, your EMS business should grow at around 35 to 40%. Fair to assume?
I think you are right. I just wanted to little give here. Even the metering business, we were doing the EMS part of it earlier. So the entire revenue, what you are seeing as a metering business today after consolidation, more than 50 to 60% were the EMS business that we have been doing earlier.
Okay.
So it is not that the entire growth has come from this business. We already have been owning this business. just for bringing it to this. So the EMS business is growing at about 30%. You're right.
Yeah, so then you'll be outpacing that, right? So 30% will be conservative. You should be growing at 35 to 40%. The reason I ask you this, sir, is because earlier the management of Keynes, when you all joined us, you all had said that in the coming year you'll do around 5,500 to 6,000 crores of EMS business. OSAT revenues could be around 1,000 crores, and the bare PCB revenues could be around 500 crores in FY27. All these numbers look more or less in line?
Sir, I don't want to again go into this. The bare PCB revenue, if at all we are going to consume internally for our own manufacturing, it will be completely it's a game changer. It will add up to the bottom line. So I would always maybe not a conservatively, but I always put it up in such a way that we'll be outgrowing the market. If the market is growing at 15%, yes, we'll be doubling the growth.
And that $1 billion target by FY28, that's still in line for the following year?
I think 28, 29, I think we are on target and we are, but you know, the dollar, it's a very tricky numbers today because of the depreciation that happened. But of course, in terms of Indian rupees, what we have communicated here.
Okay, all right. The order book, sir, let's focus on that. The book to bill ratio, that's around 2.3x odd. That's the lowest you have seen all the way since listing. Your order inflow in the past quarter was only around 530 crores, which is sharply down, right? Were there cancellations or is there some kind of deferment or just some simple delays which will actually start coming back? And last quarter was a bit of an aberration.
I said it is not a denied order, it's only a delayed order. And we have the products ready, we have the testings done, and it's a question of launching.
And delay from where, sir? Which segment?
As I said, two of the contract projects with the specific with the government business, what we were looking at, there's a little delay in terms of the approving and then clearing the project.
The meter business, that's the meter side.
Yeah, you are right.
So again, just to in 27, what is as Nigel said? I mean, I gave the numbers. So order inflow growth is 25%. Average order inflow growth used to be 50%. So in FY27, what over 26 in terms of ordering, what kind of growth can we expect? I mean, of course, as far as you can see, it's not all in your control, and we may see delays. But what do you see?
I would say that our order book on hand is almost the same or on the same levels of what we had started with last year. That are a little more than that, I would say. So we have a lot of pipeline orders that's available. But I want to be a little cautious in the first quarter to see that how market is reacting to the volatility, and then we'll be able to give a right number by end of the first quarter. We are talking to all our customers to see that how the market is. To mitigate, if at all there is going to be any market drop, we are also looking at outside the country to see that how we can expand, not only in this business, also in the metering business. And of course, you know that in third and fourth quarter, I think we'll also get our PCBs and OSAT facility up in operation full swing. We are currently working on a strategy, whether it is going to be for internal consumptions or how much we are going to do outside. All these things will decide on how the end of the year number is going to be.
Sir, and one final question. Based on the visibility that you have, when do you think you can turn operating cash flow positive?
As I said, as far as the Keynes Technology India Limited, the parent company, we're already cash positive. In terms of the metering business, you all need to appreciate that the business model itself is like that. But by end of the third quarter, we'll be reversing the trend and we'll be getting into the, I can't say positive, but at least we'll neutral.
Okay. All right. So final question. If I look at it, your operating cash flows are negative. Your working capital cycle is getting a little bit elongated. What is the cash in your books, and how will you fund this growth? Because you're not throwing up any, operating cash flows.
As an operating cash flow, we are working on both the sides. One is reducing the inventory from our side, working with our supplier base to expand the time. And of course, we are also working on collections from the customer. Yes, metering business as an operation for us because it's a business model that we acquired. It has given us a different results in terms of moving up in terms of our profitability, in terms of our gross margin, in terms of our converting us into a product company, which makes the organization very, very strong in terms of our confidence in launching more and more products. So we have a mitigation plan to come out of this, and you will see in the coming quarters how we are going to be positive on this.
Okay, all right. Sir, will you be looking at raising any kind of cash? Any kind of money from the market?
I think not in the immediate next 2 to 3 quarters.
And cash in books is 800 crores, right?
Just to clarify, the dollar, because a rate of depreciation has been so sharp, what was the dollar rupee when you gave that $1 billion guidance first, sir?
We are at 82.5 or something, sir.
I mean, 82.5 and we are at 90, almost 96 now, right? So maybe you want to quantify a rupee value guidance and not leave it to the dollar rupee.
I know that even Indian GDP is measured in the dollars, but we will keep our options and we'll keep our hopes positively.
Yeah, no, absolutely. Thank you very much. Good speaking with you and good luck executing. We will catch up again.
Thank you very much and thanks for taking me into the call. Really appreciate it. Have a great day.
Thank you. You too. Well, I think we just want to focus on Keynes, of course. I think it's picked up a little bit, maybe, but dropped quite sharply. 34.83 and 17% lower right now. Zydus Life is what we want to focus on. And Ekta is here with details. I think the stock's up. Ekta, take it away.
Well, yes, Zydus has joined Sun Pharma in terms of making an acquisition in the US in the past recent few weeks, but obviously the size differs. Nonetheless, they will be acquiring Assertio Holdings for around $23.5 per share, which equals to $166.4 million in an all-cash deal. Now, Assertio is basically a US specialty oncology company, and it has one of its portfolio includes an oncology drug, which is basically called Rolvedon, which the market is quite positive on. They've already received a biological license application or BLA from the US FDA for this particular drug. Now, separately, this acquisition is going to be via a tender offer, followed by a merger of Zara, which is Zydus's arm, into Assertio. Assertio will be the only surviving entity, and eventually it will be delisted from the NASDAQ. CY's 25 sales have been positive for the company, $68.23 million versus $60 million on a year-on-year basis. So overall, analysts are working with the fact that it is going to be an EPS accretive acquisition, possibly in the first year, and eventually it should add around 4 to 5% of EPS. Zydus Life is also going to consider a buyback on the 19th of May when they meet to for their Q4 numbers. So that is another trigger which the street will be watching out for.
All right. Ekta, thank you very much for that. That's an exclusive story which is breaking at the bottom of the screen. Let's stay with this for and get you more details. So TVS Group is set to buy a near 10% stake in Jana Small Finance Bank. And TVS Group is likely to pay between 450 to 500 crores. We put this, Nimesh had put this out on D Street Chatter, I think 2 or 3 days back. And I think this is now starting to come through. Stock starting to move up as we speak. Jana Small Finance Bank has got a fair number of, I mean, if you look at the shareholding pattern of Jana, it's got lots of institutions. It's got, I think PE investors. It's got some HNIs. I mean, it's a fairly distributed shareholding as far as the company is concerned already. It's not as if, it's a change of ownership from one concentrated set of individuals to, a group like TVS, but it is coming through. I mean, TVS Group now looking to pick up 10%, just under 10%, 9.99% stake in Jana Small Finance Bank. That is the news which is coming in. RBI approval will be needed, and I think there was a bit about that as well. Capital raised to aid expansion and future growth plans. So this, I'm assuming, is a pref issue. Money goes into the company. And that's the preferential issue. So money goes into the company, which is essentially going to be used as growth capital. And I just want to look at the, the RBI approval. There was a bit about the RBI approval as well. So board is going to consider the fundraise soon. And, we, of course, have written to both TVS and Jana. And we are awaiting response. 18th of May is when the board is going to consider the fundraising proposal, which is 4 days from now.
Now, the stock is up 30% in the last 1 month, so that's the reason why it's not flying away.
Yeah, No, and also, it's a very, as I said, it's a very, very distributed shareholding. And I think what Nimesh had reported was this 10%, and perhaps there's another 5% coming up as well. So maybe, the plan perhaps is to go up to about 15%. So we'll see if there is more to this, but what we can confirm and what we are picking up, and this is an exclusive, is there is just under a 10% stake, which is in play on this one. So that is the picture on Jana Small Finance Bank. We will have, our team join us with more in a bit. Well, I think let's move on to the next management. Vinati Organics reported a mixed set of fourth quarter numbers. Revenues and EBITDA were under pressure. We have Vinati Saraf, Mutreja, Managing Director at the company, joining in. Vinity, good to have you with us here. Good morning. Thanks for being here. Revenue growth has been flat, Vinity. Can you give us a breakup of the performance category-wise, ATBS, IBB, IB, etc.?
Yes, absolutely. Couple of reasons for the flat revenue growth. Starting with ATBS, we did complete the expansion this year in October. However, from the demand side, there was a bit of a slowdown starting October itself, which fortunately has picked up in April. Hence, on ATBS volumes, as per projections, maybe we were down by just about 5% or 10%. Again, I'm going to insist on volumes because bit of the reason, a small reason also why revenues are flattish is because overall this year, the RMC cost was lower than last year, the raw material price per kg. And that also means our realization was slightly lower, even though there was volume growth coming to products like antioxidants, where we saw a 25% volume growth. IB was flat. IBB was also flat. We were expecting some revenue from the subsidiary, where we have realized that since we went for a new process, we are going to have to re-engineer that process, and that will take another 6 months. So we lost about 5% of expected revenue on that regard also.
Hi, thank you very much, Vinity, for joining in. So for FY26, could you tell us what was the volume growth? What was the impact on account of lower realizations? And for FY27, what is your own expectations for volume growth across the various products?
Sure. For FY27, now that the ATBS expansion is in full, is ready, and also the demand is picking up, I expect about at least 20% volume growth in ATBS itself. I expect revenues coming from the subsidiary starting October 26. Also, antioxidants, the market is looking good. I'm expecting another 15% of revenue growth there. Yes, IBB and IB, butyl phenols, we are already running at full capacity. Net, this should result in a 15% volume growth for FY27.
Okay. And margins for you, you've pretty much said over the 3 years, the 26 to 27 kind of margin band is what you're looking to sustain. Now, in Q4, you did better at 29%. Would you look to raise your margin guidance at least for FY27?
No, again, this margin is a misnomer because when the RMC prices are low and my price falls, the margin looks better because it's a percentage of the revenue, right? And that is why you're seeing the 3 basis point increase from 26 to 29. I don't know what the RMCs is going to look like over the next 1 year. I don't know what the rupee is going to look like over the next 1 year. So I will stick to 26 to 27% EBITDA margin.
And generally, when crude prices are higher, ATBS does, what is the impact, directionally, if you could help us? And has there been any impact on account of the West Asia crisis? And if you could quantify that.
Well, generally as a, broad thumb rule, yes, when crude prices are higher, ATBS demand goes up. And we are seeing very positive signs for the demand starting April, which also means when crude prices are high, my input prices rise. But thankfully, I'm in a position where I can pass on that price increase in most of my products.
Okay, we leave the conversation here. Vinity, thank you very much for joining in. The rupee, by the way, is trending lower. It's now 95.82 against the dollar at a record low. We opened at the 95.71 or 73, and from there we've slipped a little bit more. Get into a break. On the other side, we'll come back and connect with the management of IKS Health on their Q4 numbers. Stay tuned. Welcome back. Let's invite the management of IKS Health on our show. They reported a strong set of Q4 numbers. Margins expanded by 340 basis points, aided by the equity acquisition. Nithya Balasubramaniam, Group CFO at IKS Health, is now joining in. Nithya, thank you very much for joining in. The margin performance is what the street likes. You had spoken about a mid-30s kind of a margin range. Is 35% what you've clocked in Q4 the floor? Is that the sustainable? Is there headroom to increase it?
I think we've always said that we would be able to sustain margins in the early to mid-30s range. And of course, we did get to that range a little earlier than we had promised the street. So we're, of course, happy about where we are. But I think going forward from now, we would like to maintain our guidance of that early to mid-30s range for IKS. Because as we do see additional operating leverage come through as we scale up our business, we also are looking forward to making the right investments when it comes to our R&D investments, particularly in our AI solutions.
How much do you all typically spend on AI R&D, and how much do you want to increase it to?
So in Q4, it actually amounted to about 5% of revenues. We haven't given a specific guidance on what it's going to look like going forward, but I think you should anticipate that growing right alongside revenue.
And on account of AI, even your contracts that you have with customers moving from input-based to outcome-based metrics and pricing? And if yes, where do you stand right now in that transition?
So IKS has actually been very unique in its business model. We've always had outcome-based pricing. Most of our contracts, we actually make our money based on a take rate, which is X percentage of the customer's net patient revenue. So from that perspective, our pricing model and business model has been rather resilient to the sort of some of the pricing impact that some of the other IT players and BPO players might be seeing.
Nithya, hi, morning. It's a strange thing to do in the middle of the earnings season and the earnings conversation. But for our viewers, right, could you just simply, briefly tell us the business model as it stands right now for IKS?
So what we do in the market is we actually help provider organizations in the US, specifically physician clinics, delegate their what we call chores, which are essentially administrative tasks, which span all the administrative tasks in the front office, the mid office, as well as the back office. So IKS offers them a platform to which they can delegate all of these administrative chores. The way we price our products and services is also, as I mentioned earlier, outcome-based. If you look at our revenues today, about 60% of our revenues, the pricing construct is such that we get a take rate on the net patient revenue of our customer. The remaining about 30%, we actually price it similar to SaaS-based pricing, which is a flat dollar per physician per month. And the remaining is different various pricing constructs. So I think traditionally, even if you go back a decade or so, our pricing model has always been consistently about driving outcomes for the customer and therefore making money based on the outcomes that we're able to drive for our customers.
So you're saying 70% is outcome-based. So if the physician clinic does not make money or footfalls fall, your revenues will fall as well. Your earnings will fall. Yeah?
Risk and reward are commensurate. If patient footfalls goes up, so do the money we make. And if there are challenges and therefore patient footfalls go down, we're also exposed to that risk.
Got it. Got it. Your client count has dropped from over 700 in the fourth quarter of FY25. You're about 600 plus now in the last quarter. Is this deliberate reduction? Is this deliberate pruning in that sense? What's happened? And this is a slightly longer time frame.
Entirely intentional. You might remember that we acquired this entity called Equity Solutions in October of 2023.
Yes.
And when we acquired them, we inherited about 800 plus customers. And since then, we have actually been proactively cutting the tail of some of the very small customers where we don't see potential for us to be able to continue to grow and make them substantial. And that's the tail cutting. The impact of the tail cutting is what you're seeing in the number of customers.
Will that continue? So now you're at 600. Will you continue to cut the tail or it's done?
We're almost there, maybe about a couple of quarters, but I think we're almost there.
How is AI changing the kind of contracts that you have with the hospitals and, I mean, with your end customers? Are they asking you in any way? I get that it's outcome-based, 70%, 30% is SaaS-based, but are those contracts changing? And if yes, can you tell us how it's changing, and internally, the kind of savings that you can rake in on account of AI and productivity?
So I think AI is, of course, very exciting to talk about, and I think the pace of transformation is quite very different from what we have seen before. But IKS traditionally has been able to leverage technology and take benefit of that operating leverage onto a P&L. So even if you go back several years, you'll always see meaningful non-linearity between revenue growth and employee growth, which is driven by the technology that we have been able to deploy. So more recently, our conversations very different with our customers, not really. I think our outcome-based pricing and the fact that we are accountable for the outcomes that the customer actually cares about is why we have been able to continuously deploy technology and take benefit of it onto our P&L. But of course, over a longer run, we've always seen some amount of benefits, some amount of those benefits being passed along to the customer. We do believe that that'll happen with this new wave of technology as well. We are not seeing any meaningful near-term impact, but I think over a period of time, you will see that impact.
Even on the SaaS-based part of your business?
I think it's true in both parts of the business.
In FY27, will you do 20% growth again?
So one, we're looking forward to the TrueBridge acquisition, closing the TrueBridge acquisition that we announced. It is a pretty substantial acquisition. So I think all the guidance, etc., everything will, of course, have to be updated once that acquisition closes. And when we announce the acquisition, what we put out there for the market is what we're calling our True North. We are talking about in the FY30 timeframe being able to triple our EBITDA. From the current run rate of about 1,000 crores, we are hoping to be at 3,000 crores. And in the same time frame, we also hope to be able to pare down the debt we'll be assuming quite substantially. Our current net debt position at the end of the last fiscal was about $26 million. And we hope to be able to pare down the debt to similar levels by FY30. So that's the guidance we've put out there.
And this 3,000 crore by FY30, how much of it is on account of TrueBridge?
So this is the guidance I'm giving you is for the pro forma combined entity.
Correct. Okay.
So FY23 to 25, you tripled the top line. Not to triple, I mean maybe 2.5 times top line. And now 26, there's another big acquisition. That was the acquisition then, and there's this acquisition now. So you jump again over the, this is slightly longer, but over the next 3 years to FY30, you said, right? Triple EBITDA.
That's correct.
Okay.
And leverage? You said the focus is also on bringing down leverage. So once you close it, what will the leverage look like and when will you pare it down? Because you did spend some time to bring it down even earlier.
That is true. So our leverage does go up to about 3x of EBITDA once the acquisition goes through and we draw down the debt. I think our confidence stems from our experience with equity, our ability to be able to transform the business model and drive meaningful cash generation. When we acquired equity, again, we had assumed about $120 million of debt, which we were able to pare down to quite insignificant levels in 2 years. So we hope to be able to bring to bear that experience with TrueBridge acquisition as well.
So in 2 years, you can bring it down, net debt to EBITDA from 3x down to sub 1x? I mean, give us some...
I think I'll stick to the guidance that we gave along with the EBITDA, which is that by FY30, we should be able to pare down net debt levels to the levels that we enjoy today, which is about, I think, net debt is about $26 million.
Unfair question, Nithya, but if I were to ask you to be an analyst on your own company, as you would have done in your earlier avatar, because the shares come up, I mean, it's sold off hard and it's come up to where it is. But, the listing happened at about 1900 and, years in 2000, I think December 24, right? So what's going to be for shareholders? What's going to be the inflection point in your opinion? You're doing the acquisitions, numbers are coming, margins are holding as well. For shareholders, what should they watch out for? What's going to be the inflection point?
See, I think I genuinely won't be able to comment about the share price, and as management, I think our responsibility is to make sure that we deliver on the growth that we are promising and be able to continuously expand the returns to the shareholders, which I think we have been able to do since our listing. And if you look at the True North guidance that we did, that I just mentioned with TrueBridge in the mix, I think that should be substantial shareholder value creation. And I think shareholders should, of course, hold us accountable for these numbers that we have committed to. And I think what I'm hoping will continue to unlock value for them is as we achieve the synergies and the targets that we have set out for ourselves.
Okay. All right. We'll leave you to it, not pushing forward. I understand you can say what you can say, but not more. Thank you very much for joining us. Good speaking with you. And we will keep getting an update from you. Markets, by the way, have sold off quite hard. We've cut the gains in half, 150 points and now 70 points. So that's what I'm talking about. Yeah. So from the highs, which is basically about 30 minutes back, we are back at about 23,480. Shilpa Raut is with us. Shilpa, what trades are you advising?
Good morning, Prashant, Breman. Thank you for having me on the show. If it's about the view on indices, we see that 23,200 acting as a good support and Bank Nifty by 53,000. So as long as holding these levels, we are good to see some sort of respite or short bounce happening towards 25,000, 23,000, and for Bank Nifty 54,500. So this is the setup for indices. Talking about stocks, I have a buy on ONGC. ONGC also has given a good breakout, running above 300-year short bounce. At levels of 315, you can go long here with a stop 285. The other one would be a buy in NMDC. NMDC also a good breakout above 90. So keep a stop loss of 89 and levels of 95 to 98.
Got it. Okay, all right, Shilpa. Thanks a lot for joining and giving us that view. Well, today things will get even more exciting because we'll have the Sensex weekly expiry that will play out, particularly in the final hour of trade. Expect some volatility on that front. Let's pull up a few strikes for you, though. In today's trading session, even though the markets are higher, even we were up more, on the Sensex itself, when we were up close to 250, 300 points, the call premiums actually are seeing a bit of a decline. And if you look at it in today's trading session as well, the call premium is down by close to around 45%. So directionally, you've got it correct. But the premium has come down from around 209 all the way to around 117 rupees, or telling you call writers are at play. If you look at the put side, though, there is some hope because there is writing being seen at lower levels. The 74,500 put, the premium at the start of today was around 240 rupees. That's come down to around 130 rupees. So if we just punch that in, those writers, they are playing that 74,250 level on the Sensex will actually get defended. At lower levels as well, there is some writing being seen. 74,000 put, a little bit of a mix of activity because the premium has come down from around 110 to around that 35 rupee odd mark. So there's a mix of activity. In case things go horribly wrong from here, then those put buyers will make money. But otherwise, the smarter money looks like they're writing that particular strike. It appears the structure is still more or less weakish because the Sensex is trading way below both the 50, which is the first reference point on the upside, as that graphic place is telling you. And then we'll be looking at the blue line, which is the 20 DMA. So we're close to around 1,500 points away from those levels. Keep an eye out on that. For the time being, the call writers, they look like they were going to defend the 75,250 odd mark, while on the downside, the put writers, they are hoping that this level of around 74,250 does hold out. Sensex weekly expiry, keep an eye out, particularly towards the end of trade. Well, we'll slip into a short break. On the other side, we'll turn our attention back to commodities. Manisha Gupta will be joining in.
Welcome back. Let's talk commodities now. Manisha is joining in as always. Manisha.
Well, thank you so much for that. I'm looking at sugar today because, one, we have a notification that came in late last night, and that is making an impact not just on the sugar prices in India, but in the global markets as well. India, remember, is the second largest producer, consumer of sugar after Brazil, and those numbers do really have an impact. This is after the Indian government has put out a notification suggesting that they are banning exports till September 2026 for raws, for white, and for refined sugar as well. And this is happening with an immediate effect. There is a caution, though, where it says that they will allow all shipments which are already in export pipeline under specified conditions therein. So why is India banning export of sugar? Well, that is the question we're answering for you right now. We are looking at crop estimates lower than anticipated at 27.5 million tons. Earlier estimates, because of the sowing numbers were so great, were at around 33 million tons as well. But in the last 3 or 4 months, we have had various associations continue to revise it on the lower side. This is on the back of erratic weather, that unseasonal rainfall that we saw, and also because of the lower yields in Karnataka and Maharashtra has made the overall crop numbers suffer. And then for this season as well, there are El Niño concerns, and that could disrupt the year's monsoon and, of course, the sowing going ahead when it comes to cane. Apart from that, it also is about the closing stock. So when we started this year, it was at around 5 to 8 lakh tons is what the market believed. But now it seems much lower than that. And overall, 15 lakh tons of sugar export is what the government has allowed. But from that as well, it is only about 7 to 8 lakh tons that has been contracted or exported. So you have 6.5 to 7 lakh tons still remaining. And the markets believe that that is what is really going to get impacted. The reaction of this notification from India has been seen in the international markets, where you saw the New York raw sugar prices gained up by 2% and the London white sugar prices gained up by 3% as well. So when you look at the overall Indian exports, and this is what we've done in last couple of years. So this year it was about 8 lakh tons is what we've done till time. That's an estimated figure that we are working with. Last year was 7.7 lakh tons. Government had allowed 10, but India was able to export only 7.7. And year before that, it was nil. The exports for sugar were banned at that point in time. And since then, the last couple of seasons, it has been quota that the Indian government has been giving to the mills there. Also, when you look at the FRP prices there, now I'm coming to the fact that it is not positive for the sugar industry. This is what we've seen in sense of fair and remunerative price increase for cane. This is the price that the sugar mills have to give to farmers for cane. Now, as you can see, in the last many years, it has constantly gone higher. So in the last 4 or 5 years, we've come from 290 to 355 rupees a quintal. But when it comes to the sugar MSP, that has not seen a hike since 2018. In 2017 is the first time that the Indian government allowed that or introduced that. And at that point in time, it was at 29. In 2019, 31 is what was increased to. And 2019 to 2026, there has been no hike in this number. One more thing is about the sugar deficit in the global markets, the reason that you've seen the international sugar prices gain up. So there are reports from Data Growth suggesting that 3.7 million tons of a global deficit is what we are looking at, while 550,000 tons is the number coming in from StoneX. Closure of Strait of Hormuz has curbed around 6% of global sugar trade. But importantly, because of the higher crude oil prices and ethanol being more profitable, a lot of sugar seems to be going in that direction, supporting prices.
Thank you very much for that. The mid-cap index is in the red and lots of stocks under pressure. So Keynes is one, but Zaggle prepaid 17% lower despite good numbers. Interarch, again, an earnings reaction over here, stock down by 13%. And you've got cuts coming through in many of the other sugar names like Dwarikesh, Andhra, Uttam Sugar, some of the smaller ones, and Sterlite Tech, after the record rally, is seeing some profit booking today. But while all eyes globally are on Trump and Xi Jinping, there's a BRICS summit which gets underway in New Delhi today. Foreign ministers are expected to discuss issues pertaining to tensions in West Asia and the global energy crisis. So External Affairs Minister Jaishankar will meet foreign ministers from Russia, Iran, South Africa and Brazil. Chinese foreign minister is going to skip the summit on account of President Trump's visit to his own country. We'll keep tracking this for you. For now, it's a break. On the other side, the management of Reddington will join in to talk about Q4 numbers. Stay tuned. Welcome back. Let's talk about Redington. Stock is up 3.5%. Steady set of Q4 numbers. Revenue growth stands at 25%. Margins have been stable, slightly lower quarter on quarter and on a year-on-year basis. And at the bottom line, you can see a slide, but that's on account of an exceptional loss of 152 crore on account of an impairment in Turkey. V.S. Hariharan, Managing Director, Group CEO at Redington Group, is now joining in. Thank you very much, Rima here. Now, you've mentioned that West Asia conflict had a temporary consequential effect on operations in the month of March. Can you quantify the revenue and EBITDA impact on account of this?
Thank you for having here, Rima. I just want to correct some facts before I talk about the Middle East crisis. So the impairment that you talked about was an exceptional item, just as much as we had an exceptional item last year on divestment of Paynet. So year on year, actually, both on revenues and profits for the quarter, we have had a very good growth, 25% on revenue and 16% on profit. This is despite the crisis, the West Asia crisis, and that has affected largely UAE, to some extent Saudi Arabia. And for the month of March, we saw a degrowth of about 25% versus our budget plans. So we fell short by about 25%. That had an impact. And we expect once the crisis is over, that to recover fairly fast.
Okay. And March, I presume, is 1/3 of the overall quarter, or is it on account of year end? There is a spike. I mean, how significant is that 25% budget shortfall? Could you put it in revenues and margins, EBITDA?
In a typical quarter in Middle East, we would do about in a typical month, we would do about 400 million. So if you quantify, let's say 25% of 400 million is about 100 million shortfall, and an equivalent gross margin shortfall of about 4.5% to 5%. The good news there was we got a little bit more mix towards Software Solutions Group, which is at a higher margin. So that helped. But the hardware part of the business was what was stressed because of supply chain disruptions, not being able to bring in the product, not being able to ship out product, etc. We had to resort to more air shipments versus sea. The Straits of Hormuz was closed, but I think we did well. All in all, our warehouse operations, our local teams all jumped into action. We also had some data center attacks where we had to migrate and transition some of our customers from one data center in the Middle East to other geographies. But I think once this recovers, we do see a spring back potentially fast enough.
Yeah. So a $125 million impact is what we've seen in Q4. I suspect that has continued even in April and the 1st of May, that kind of a run rate, lower?
This quarter, we do expect to see a 25% on that part of the business. But if you put it in perspective, Redington is very diversified, many geographies, many business units. India has grown the last quarter 50%. And even some of the Middle East countries like GCCL, we call them, GCC countries and Levant, has also grown very well. The last quarter, despite the crisis, we grew at 51%. That includes countries like Qatar, Kuwait, etc. So it kind of compensates for some of the shortfall there.
Of course, it's just that the investor attention, everyone's attention is squarely on Middle East, which is why the persistence to ask about the impact on the company's financials. Even on cost side, there has been an increase, a spike in costs. You outlined it, you had to do some air shipments, for instance. So do you think it's difficult for the company's EBITDA margins to get back to 2% plus? In Q4, as per our calculation, you were at 1.8%.
That's not really correct. It is more closer to 2%. I'm not sure what basis are you using for the calculation. It's closer to 2%. But we believe, see, the UAE part of the business is about 15% of the business, and you're talking about a 25% impact there. That's not necessarily impacting the whole thing. And we did have increase in costs. It's true. It's on account of war-related insurance, war-related premiums on freight costs, etc. And that was like a 0.2% impact on costs. And some of these will get passed on to partners and customers. The real impact is the revenue that drives some of the lowering of gross margins, and that's a direct impact. We did have one-offs as well on some AR provisions we took in Saudi for the quarter, but we expect to recover from those. These are provisions one takes because your collections are a little bit slower than planned.
Okay. So you said 25% top line growth for FY26. What is your own estimate based on the visibility right now of EBITDA margins in FY27 versus FY26?
See, outside of one-off data center deals and the big deals we do, our plan is to be around 2.2 to 2.3% EBITDA. So that's what we always strive to do. So our goal is to be somewhere between the 2 to 2.2 range for sure in FY27 is our goal and plan. And that's how we are working towards it in terms of...
And if you take into account the data center side of it, what would EBITDA look like?
We don't know yet. It depends on how much we want appropriate deals on data centers. So we talked about just a little while back that we've done about 1,500 crores worth of deals in the last year. And clearly, the growth in the data center in India is going from 1.5 gigawatts to 7.5. So there's a lot of deals available from neo cloud operators. But we look at each deal closely, more from a return on capital employed perspective. The gross margins are definitely on these deals much lower than the typical gross margins. So I couldn't really say. It depends on the quantum of the deals we want to take on, and we are beginning to now clearly call out how much the volume of the data center deals, so that we know that the core part of the business outside of data center continues to be in that 2 to 2.2% EBIT, while the other deals will be taken on as incremental profit.
Okay. And data center, is it the 1,000 to 1,500 crore of data center? Was it the order wins, or is it the revenue that accrued in Q4?
It's the revenue that accrued in the year. Yeah, for the quarter.
How much lower are the margins? You said gross margins on data center is lower.
Yeah, it's very difficult to say. It's quite, it depends on deal by deal. So we cannot quantify a specific number, but it can be less than half of the normal gross margins.
Just coming back to the Turkey business, and we've been looking at Redington for the last couple of quarters, and the Turkey business has gone through its own challenges. I mean, the country has depreciation, inflation. I remember a couple of quarters back, there was a provision that you had to take for some of your customers. There is now that, the brand, on the brand side as well, you've had to write down some of the value of that. Do you think in hindsight, the Turkey business was a bad bet for you?
See, this was taken nearly 20 years back, and clearly we've had ups and downs. But looking at the last 2 years, we've had many challenges. The interest rates have gone up from 10+% to 50+%. Now it's come down, but it's still between 40 and 45. The inflation rates used to be like 65. It's come down to 40. It is definitely a challenging environment, but one would not have seen that challenges will get compounded so much. But we've had our good times as well. We did divest a nice, interesting business that we built on PayNet, and that got divested last year in Q4, if you remember that. So that was a good bet. Overall, we have now got a business which is half the size of the business that we had, very focused on US dollar, no lira business because the borrowing rates are high in the lira business. And we believe that we will do a good job of sustaining this. And you can see Turkey now beginning to jump onto the cloud bandwagon as well. So there are two parts of the Turkey business, one focused on software and cloud, and one focused on hardware. And we do see some good uptick and growth on the software side. And we are just hoping and praying that we'll continue to navigate the tough environment, and this business will come of shape to contribute as well.
Thank you, Mr. Hariharan, for joining in. Always a pleasure chatting with you.
Thanks, Rima.
Thank you. Well, the Nifty's now climbed above the 23,500 mark, led by strength in pharma, metals, couple of the PSUs. The Nifty CPSE index is also up nearly 1%, but on the flip side, IT is struggling. The Nifty IT index has moved to the day's low with a fall of 2%. That brings us to a close on this edition of Bazaar. Thank you very much for watching from the entire team.
Cipla is the top gainer on the Nifty, up over 7% as the street reacts to encouraging commentary from its earnings conference call. The company is eyeing over $1 billion in sales from North America, excluding Lanreotide. Brokerages Citi and JP Morgan also upgrade the stock.
Keynes Technology is down close to 15% as it misses the revenue guidance for FY26. The management tells CNBC TV that two major government contracts were delayed in the fourth quarter. It also expects growth in terms of revenue at around 30% in FY27.
Zydus Life announces it will acquire US-based oncology specialist company Assertio Holdings for $166 million. The company also says its board will consider a buyback of equity on the 19th of May.
HPL slumps after earnings-led rally yesterday. Brokerages turned cautious, flagged that currency and procurement cost pressures may result in sustained losses going forward.
And a number of stocks also reacting to fourth quarter numbers. Balaji Amines surges 20% on a strong fourth quarter. NLC India and Metropolis also rally on strong results. Zaggle Prepaid, on the other hand, slumps over 15% in today's trading session following its fourth quarter numbers.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Ekta. And as we speak, Ekta, markets holding on to the green, but barely so. The breadth of the market, a number of stocks that were advancing were way more than what we have right now. But at least we're holding in the green. It'll be an interesting trading session because the last couple of days, in fact, we've seen the bulls are trying to fight back, but at higher levels, there is supply that's creeping in.
Hi, Nigel. Yes, absolutely. You know, for the markets at this point in time, we're managing to hold up. So let's see whether we manage to sustain. But let's talk about certain companies which are in focus. Zaggle Prepaid is under tremendous pressure in today's trading session. After reporting its fourth quarter numbers, we have Raj P. Narayanam, who's the founder and executive chairman at Zaggle Prepaid. Ocean Services now joining in to discuss the quarter gone by. Hi, sir. Thanks very much for taking the time out. Well, you know, just wanted to start by discussing the guidance because the quarter didn't look too bad in terms of what you all reported. But what is FY27 looking like when it comes to your guidance? You're guiding for, I think, around 25 to 30% standalone revenue growth, 40% consolidated growth. Where does that stand? Are you seeing any kind of headwinds to that?
Thank you, Ekta. Thank you for having me on the show. So, but to be very candid, we have, we would want to, under promise and over deliver. And that's how, if you look at our 3 years of journey being in the listed market, we have never, ever, gone below our guidance. It has always been a little bit above than, what we have told. And we hope, this is going to be, a bumper year for us. The green shoots are already there. And I think, as we progress into quarters, we will only be, probably be upping our guidance than where we are right now.
Okay. All right. Hi, sir. Good morning. Good to see you in. A bumper year ahead, but it's a bumpy start to the year. Just take a look at the stock. It's down close to around 15%. Let's reiterate a couple of numbers then. One is in terms of your revenue growth, I believe we're looking at, 40% consolidated and standalone, a little lower than that. So could you clarify on that? And what are you factoring in with regard to margins? I'm aware that DICE acquisition is going to be coming into your fold. What could the broad band be in terms of the margin guidance from here on?
So, in terms of revenue guidance, as I have already given, 40% on consolidated, basis and about 25 to 30% on standalone basis is what it is, and in fact, DICE, because we are taking the entire cost onto our, P&L. That's why we have not given, an EBITDA guidance. But I think, maybe another quarter or so, we will be able to give you with much more clarity.
Okay. Just wanted to understand what your plan is on the inorganic front. You've set aside around $25 million, we understand, for acquisitions in FY27. Plus, you're looking at an international foray. So you're looking at maybe acquisitions in the US?
Yeah, so, our long-term plan. Okay, so this short-term pain we have to bear. And I'm sure that somebody is going to make a lot of money, on a stock in the coming, quarters and years. The way we are looking at it is that, in this year, within this financial year, we will be starting operations in UAE in spite of the war etc. We are very, very confident on that. And similarly, we have already started talking to, few investment bankers on a few bankers on, possible acquisitions in the US, because US, we don't want to go green shoot. We want to, go there and, basically nibble on, a couple of seconds. And then from there, move forward to, a large play.
Okay, all right. Give us some more clarity with regard to this DICE acquisition, though. How many employees are you going to be taking on board? How does it increase your strength? Because it appears that that could bring down your consolidated margins. So give us some color in terms of the financials, number of employees that come on board.
Yeah. So, I want to tell you that it's one of the best acquisitions what we have done. Okay, it's about, 100 plus people, fully trained on AI. We are looking at number of contracts which we are signing up on a constant basis. In fact, as we speak, we are signing a contract. So, those kind of things by bringing in the DICE software is going to really get us much bigger, larger, enterprise contracts with AI capability. So, I am extremely bullish, not just for, saying it, but overall looking at the way we are capturing the market, we will be the single largest spend management player in India.
But
and
you're not in a position.
Also become the same.
Sure, but you're not in a position to give EBITDA guidance based on the DICE acquisition, which is now an asset purchase. Is that
Correct.
what we should read correctly?
Yeah, that is how you should read it, because, give us a quarter and, we'll come back to you with what is the guidance. But overall, if you see, fantastic trajectory, great execution, ruthless execution is how I would say. And very, very bullish overall.
Okay. So bullish have been using numerous times. So for the street to get bullish, they'll be looking at your operating cash flows. Now, on a standalone basis, I think it was negative 6 crores, right, for the past year. And on a consolidated basis, it was negative 50 crores. Give us a trajectory on the cash flows. Will you be cash flow positive, operating cash flow positive in FY27 on both consolidated as well as on the standalone basis?
Yeah, Nigel, but you have to look at the company, in a company which is in spend management, which is on AI, and you look at standalone basis, we have been able to bring it down to just about, we have, if you really look at it, we have just, about broken even. Okay, 6 crores is a very small amount on a 1900 crore, or 1853 crore revenue. And, the other two companies which we have acquired are, just acquired in the last quarter or so. So, I am very bullish that we will be, or I wouldn't use the word bullish, and, very fairly confident that we will be able to, break even and some positive cash flow.
Okay. Just reverting back to the numbers and the margin picture, your Propel segment, the margins fell quite sharply there. There was a correction of around 600 basis points in terms of margins within that segment.
No, average, if you look at it, you should see about 6% is what is the margin. And, there are some commissions which we have not accounted for, in this quarter, which will get accounted for in the coming quarter. So that's the only difference. So it is fairly in and around 6% is the margin, which is what we have gathered.
Yeah. So what were the earlier margins for the Propel segment? It used to be 10%. It's come down to 5 to 6%.
Yeah. So it is going to come down to about 6%, overall on forward-going basis. And, it used to be 2-3 years back, it used to be about 10%. And, what we are looking at is our core focus is to improve our cash flow, build better products, gain more moat in the segment we are, and become a very, very large, player in this game. And, to be very candid, short-term pain, should not affect our long-term, goal, which is of, $1 billion and, at about 14-15% EBITDA margin. So for that, we have to maybe go through a little bit of, pain, and we are absolutely okay with that.
All right, final question, sir, from my end. You mentioned you're bullish, you've got a story in place, and you believe things will improve from here on. If that's the case, I've observed in difficult times, the promoter entity has gone ahead and done some creeping. Do you think the promoter entity will use this opportunity as a good time? It's down, stock is down 15%. It's come up drastically from the top.
No.
I think you're at around 44%. Few quarters ago, it was 40%. I'm guessing there was some dilution. What is your view over here? Do you think the promoters maybe will gradually want to take their holding to around 50%?
100%, that much I can guarantee you that, that's the whole plan. I've been asking my compliance officer if I can go and purchase, because at this price, I would love to buy, personally, I would love to buy. And she said, we are under that window. So we have to, window is closed for us, and that opens on, I think, 18th of, May. And we are going to do purchases.
We'll have to keep an eye on that. Then 18th of May is when the cooling off period, goes. So we'll see how much, the promoter entry will do. Very quickly, so on the receivables, could you break it up for us between Save, Propel as well as Zoya? Which segment, which one of these actually saw the biggest spike up in terms of receivable days?
It is always, Propel, which is a little bit larger, play, because, quarter ending, everybody wants to buy and we have to stock and, sell the, last 10 days of the quarter are always a little bit very, very hectic for us. And that's when, receivables go a little bit up and we report as of March 31st. And that is the reason you see that. But over a period of time, it's fully normalized.
Okay. All right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that Zaggle prepaid, it's extremely weak in what is a resilient market, you'd have to say, at this point in time. So down around 16 to 17% for Zaggle prepaid. Some concerns coming in with regards to the EBITDA. We'll take a short break, but up next we'll be talking to the management of Bagmani Prime Office REIT on their Dalal Street debut. Stay tuned.
Welcome back. Well, let's focus on Bagmani Prime Office REITs. It listed today with some gains, I think 3-4% higher in comparison to the issue price. The IPO was partly an OFS as well as proceeds from the fresh issue. To understand what's the way ahead, we're now joined by the CFO, Akshay Shah, who joins us to discuss the outlook for the company. Hi, Akshay. Good morning. Good to see you in, and congratulations to you and the entire team. Let's get a couple of details going then. What is the project addition pipeline that you have in store? And if you could tell us geographically, how will it be looking? Will it be primarily Bengaluru addition?
Thank you very much, first of all, for having us today on our listing day. So yes, today the REIT is Bangalore-based in the core micro markets that we are present, which are the best performing micro markets, not just in the country, but in the world over the last 5 years. And what we see under development, so there's a million square feet of under development, and there are 2 hotels which are under development. And there is a further pipeline of 2 million square feet, which we intend to complete over the next 3.5 to 4 years. So apart from that, the portfolio, which is already part of the REIT, the sponsor has a 47 million square feet of ROFO assets, which could be offered to REIT subsequently, and which entails portfolio not just in Bangalore, but it comprises of portfolio in Chennai and Delhi as well.
All right. It has a portfolio in Chennai and Delhi as well. Akshay, just wanted to understand that Google contributes to around close to 19% of your gross contracted rentals at this point in time. What is the lease expiry profile of Google? When does the bulk of it expire?
So we've had a very interesting and special relationship with Google, who's our top tenant. And they have taken multiple buildings with us over the last, they first started with us in 2015-16, and they've consistently grown with us. And in fact, one of our marquee buildings, which is a 1.7 million square feet building, which is also their headquarters in India for DeepMind, they leased it out from us 4 years back. Right, so we've not given specific expiries of our occupiers, but generally for all our tenants, between 4 to 8% of our portfolio expires year on year over the next 3 to 4 years.
Okay, Akshay, interesting time, right? Suddenly there is a lot of talk about work from home. I mean, if it takes me back 5-6 years, what an interesting time. We had studios out of home, managing family and office. Interesting times. But for your business, that could be a bit of a hurdle, right? What's your comment on that? Because suddenly that fear is growing on a day-to-day basis.
Yeah. No, so we've seen what work from home does, right? And when work from home started, people thought that they could run their companies from home. But eventually they figured that, that's not the right way to build leadership, to build teams, and build a cohesive environment. So, I mean, work from home could happen temporarily here and there. But in the long term, we see people being in office, the businesses which are building great businesses out of their offices, they want their employees to be at office. Right? And we've seen that even in COVID. So in our portfolio, interestingly, majority of our occupiers are GCCs. And hardly any GCCs gave up any space at the time of COVID. Right? So we've seen a strong resilience from the GCC fraternity of our occupiers.
Okay, so work from home is not really a fear for you at this point in time, but any which way, let's see how long that would even last if it comes about. But the committed occupancy that you all have guided for, I understand, is around 98.8%. Just tell us how much of this is genuine demand, how much of this is possibly locked in contracts?
Yeah, so this is not a guided number. It's a factual number. So we are today at a committed occupancy of 98.8%. Right? So this is all contracted. Today, 98.8% of our area is committed, and which is by far much higher than all our listed peers.
Okay, all right. Also, if you could help us out, what will the growth be in the distributable income, say in FY27, FY28?
So we've given our numbers in our prospectus. Starting FY27 going in, the distribution is expected to be around 2,095 crores, which is likely to grow year on year. On an average, the CAGR expected is around 7% over the next 4 years.
Okay. All right, Akshay, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Bagmani REIT. That stock is up around 3% in today's trading session. Just watch out for the markets because there is some kind of profit booking which has taken place at the top. So we have the Nifty, which is just about higher by around 40 odd points. The mid-cap index has now slipped into the red, along with the bank Nifty, which is down around 130 odd points as well. So there is profit booking which is now coming in. But let's talk about an exclusive. Ritu is picking up some exclusive inputs related to the TVS Group and Jana Small Finance Bank. Ritu is here with these exclusive details. Ritu, take it away.
Well, Nimesh had first told us about this right here on the D Street Chatter, and now we understand from sources that the TVS Group is looking to acquire a strategic stake in Bangalore-based Jana Small Finance Bank. Now, we understand the group is looking to acquire about 9.99% stake in the bank through a preferential allotment. The transaction will, of course, be priced in line with SEBI's norms on pricing, and that would amount to the TVS Group infusing roughly between 450 to 500 crore rupees into Jana. Now, that 9.99% number is significant because that keeps the investment just below the 10% regulatory threshold. For banks, up to 5% stake acquisition does not really require prior RBI approval, but anything beyond that needs RBI stamp. Now, corporate shareholding is also capped at 10%, so exceptions are made on a case-to-case basis, but here, that's why the 9.99% stake is important. We're also given to understand this could be announced pretty soon. We've been given to understand that the board will take this up at its May 18th meeting for fundraising, which it has already notified to the exchanges. Once approved by the board, of course, the proposal will be sent to RBI for its final approval. Now, the capital raise is expected to support their next phase of expansion and growth, but keep in mind the bank is still adequately capitalized. Their capital adequacy ratio at 19.4% for FY26. Pretty quickly, to give you a picture of the shareholding, it is pretty diversified for Jana. The promoters hold about 22% stake through Jana Holdings, Jana Capital, and Jana Urban Foundation. But the other key investors are TPG Asia, which has more than 8% stake in the bank. And then you have North Haven, which is backed by Morgan Stanley Private Equity, with about a 3% stake, in Harbour West Partners with about 2.3%. Now, Jana Small Finance Bank has not offered any comment on the story, and the response from TVS is still awaited.
Thanks a lot, Ritu, for that. Well, the stock has already had a big run of 25 to 30%. That explains why today you're not seeing any big reaction. But we'll keep an eye out, as Ritu was saying. Nimesh, as well as now Ritu, both of them have been on top of this. So we'll keep getting you updates. For the time being, stock more or less flattish. But what's taken a bit of a turn is in terms of the markets on the whole. The crisscross line should come up for you on the screen. I recall at the start of today, the number of stocks advancing were more than 2,000 stocks. That's come down to around 1,100 stocks. Telling you the number of stocks declining has outweighed the number of stocks advancing. And the Nifty Bank is now down close to around 100 points. That explains why we're seeing some kind of jitters in terms of the headline index as well. 600 points lower from the highs of the day. Let's take that break, come back. We'll continue to focus on the markets and stocks that are bobbing around.
Welcome back. Well, yes, for the Nifty, 23,477, so just about higher by around 60 odd points. Mid-cap index is absolutely flattened out, along with the Bank Nifty, which is in the red, so down 70 odd points for the Bank Nifty. But let's talk about a couple of stocks which are managing to hold up at this point. Zydus is one particular stock. It is in focus because it will be acquiring Assertio Holdings for around $166.4 million in the US. It is a US specialty oncology company. The acquisition is going to be via tender offer followed by a merger of Zara, which is Zydus's arm, into Assertio. And Assertio will eventually be the only surviving entity and eventually be delisted from the Nasdaq. The portfolio includes one particular drug, which is called Rolvedon. It's a cancer drug. It is US FDA approved. It is a biologic. So the street is quite hopeful in terms of what that could bring to the table eventually. For the entity as a whole, CY25 sales were higher, so $68 million as compared to $60 million year on year. Additionally, Zydus is in focus because they will be considering a buyback on the 19th of May, which is when they release their Q4 numbers. So that's the reason why you're seeing Zydus Life up 5% today.
All right, Ekta, just one word, with regard to, as you pointed out, Zydus is higher. A few other names as well. NLC India, these stocks started off in the green, but they're building onto gains, and these are result reactions. So sharp spike up is what you're seeing out there. Care, that's the other stock that's up close to around 8% as we speak. So that as well is building onto those gains. And the amines companies, Balaji Amines, good set of numbers. The stock is locked up 20%. And Alkyl Amines, the other stock that's already had a big run, that as well continues its good run. I think if I recall correctly, Pankaj Tibrewal had mentioned this point, that some of these stocks, they could really see a big spurt. And I've seen a couple of these stocks reacting in that manner from the chemical space. But let's turn our attention to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta of moneycontrol.com joins us to talk about a stock he's tracking. Jitendra?
Hi, thanks. We like Mishra Dhatu Nigam. It is entering a phase where years of investment in capacity expansion, backward integration and capability enhancements are now beginning to translate into stronger earnings visibility. Midani, if you look at it, is a niche and monopolistic business which manufactures specialty steel, superalloys and titanium alloys used across high-end applications like we know defense, aerospace, atomic energy and space application. Over the last 5 decades, the company has developed more than 500 grades of advanced alloys, creating significant moat and a very high entry barrier for others. The next leg of growth is likely to be driven by higher value addition. Midani has commissioned a dedicated titanium melting shop and titanium plant with a capacity of 250 to 300 per tons of annual production. The production mix is also shifting towards high value applications, including advanced grade superalloys, nuclear application and space grade titanium products. Importantly, Midani has an order book of close to 2,600 crore, which provide very strong revenue visibility for the next 18 to 24 months. Another important trigger is its recent award of international certification, which will help company to get access to global aerospace OEMs basically. Overall, at around 35 times its FY28 estimated earnings, the stock appears reasonably valued.
Thanks a lot, Jitendra, for joining in and giving us that quick update. For the time being, we'll wrap up on this edition of Chartbusters, but you stay with us. The team of Trading Hour is waiting for you on the other side.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Patakia. Joining me as always is Ritu Singh. And true to script, the markets opened higher, extended their gains, and now have given up most of those. It's turning out to be yet another choppy start to the trading session. Today, of course, is the Sensex weekly expiry as well, and that also has to be factored out. But of course, it's around about a 200-point odd fall from the day's high, and the principal culprit behind that, as has been the case, is the Nifty Bank. That too has seen a drop of over 600 points from the day's high, and it has now moved into the red. At the lowest point of the day is the Nifty Bank, looking to defend that 53,000 level on the downside. And not a very good, it was a good start, but well, the start has not sustained, Ritu.
Well, the start has been choppy, Hormas, and it's not just the Bank Nifty. Even the IT pack has been, seeing quite a bit of pressure in trade today. Now down about 686 points. So the IT pack is exerting pressure. The banking pack is exerting pressure, and therefore you're seeing what you're seeing. But all of that aside, the frontline index Nifty is still holding up with gains of about 20 points, but it has been volatile up and down there. For the Sensex, it's still in the red, down about 46 points as we speak. But the market breadth, that tells you that there is some anxiety. There's about 1.6 stocks. I mean, more stocks are declining than they're advancing on the National Stock Exchange as we speak. In terms of sectorally, what is doing slightly better is a pharma pack, the metal pack, and the energy pack is holding up. But the IT realty packs, they are the big draggers. But let's go across to Hormas, who's walked over to the wall to put the spotlight on the top movers in the market.
Well, it's a day of extremes today, as at least for the first couple of hours of the trading session. The index is choppy, yes, it has given up its gains and so on and so forth. But you look at the earnings reactions and the reactions in the newsmakers as well, they are on the extremes. The good results have done very well. The not so good results have been smashed. You look at the positive result reactions first. You take a look at Balaji Amines. The stock is locked in a 20% upper circuit in today's session. The last time it was locked in a 20% circuit was all the way back in 2015. NLC India is the other one. Again, very strong results. All of its businesses growing between 20 to 30% this quarter, and 18.5% higher, the top gainer on the Nifty 500 in today's trading session. And of course, Cipla, of course, came out with results during market hours yesterday, but there have been at least 6 upgrades that the stock has received earlier today, and as a result of which the stock is up 6.5% in today's trading session. Now take a look at the negative result reactions. Kaynes Tech is down 18%. Nearing its 52-week lows, which was near the 3,300 level. So 18% lower on Kaynes Tech. It was an earnings miss across the board. Margin contraction for Zaggle. We spoke to the management earlier. They said they want to hike stake in the company, but the street is not impressed. 17.5% lower. This is the biggest single-day fall that the stock has seen since its listing. InterArc Building Products is also being smashed. 15% lower on the stock. Now among the top losers on the small cap index. And DCM Shriram too, a negative earnings reaction, 4.5% lower. We spoke about Cipla as an earnings reaction as well, the multiple upgrades that it received. But take a look at HPCL on the flip side. The stock has received multiple downgrades as well. Of course, before we get to that, to look at the stocks that are at record highs, even in a choppy market like this, BSC is up 3%. It's crossed the mark of 4,000 for the first time, and its market cap has now crossed the 1.5 lakh crore mark as well. And following suit is MCX. That too is at record highs, 2.5% higher here as well. Vedanta, after the demerger, continues to move higher. Its settlement price was around about 279, 280. It's now at 330, and Hindalco too following suit from Vedanta as well. And of course, the one stock that I wanted to mention, MTAR Tech, the stock was up almost 150% already on a year-to-date basis. After the management increased its guidance for FY27, the stock ended higher yesterday and is extending those gains in today's session as well. And with this, the stock has now more than tripled in value in just the first 4.5 months of the year, Ritu.
All right, Hormas, thanks very much for running us through that list. Now, let's move on to Quality Power Electrical. Their shares are trading down today. This is after posting a muted fourth quarter numbers. Let's go across to our guest now. Bharan Nidharan Pandian, who's the Joint Managing Director, is here to get us more on their fourth quarter numbers and the way ahead. So thanks very much for joining us here. Let me start with this order you've secured, of about 152 crores. It's an international order. Actually, we'll get to that in just a bit. But Tell us about the quarter gone by, how it's been, and what we should look forward to for FY27.
Ritu, this has been our best quarter till date. It is just it is adjustments for hyperinflation as per Ind AS 29. 25.7 crores of profits from our subsidiary Turkey, NDOX, has been restated as an adjustment. This is a non-monetary, non-cash adjustment. With that, our margins stand at about 27%, which is against a guidance of 20%. Our EBITDA has gone in from 110 crores last year to almost 236 crores without the adjustment. With the adjustment, without the adjustment, about 260 crores. We bet our own guidance of 20%, then 22 to almost 26% right now. It is just that the adjustments and the monetary indices show that. I would say it's more closer to your Duckworth law that is showing in. Otherwise, the margins and the year has been fantastic for us.
Well, just to break up that revenue figure for clarity, 947 crores, that's up 180% over the previous year. How much of this was organic and how much was really inorganic? And the organic growth rate that you'd guide for, for this new fiscal?
I think organically we grew over 150% ourselves. Even the acquisition that we had, Meru, last year, we also grew 150% there. We increased the margin last quarter from to almost 20%, beating the guidance of 15% that we had set in. So almost all through across, even NDOX, where in the Indian balance sheet, we show about 11% margins. Actually, on the Turkish balance sheet, where we don't do these kind of adjustments, we are at about 32% margins. In spite of a 150% growth rate, despite all the challenges we have, I think 26% margin we have still been able to sail through. Even this quarter, we had a one-off adjustment because of the new wage code in India. So with that, I think we are at an all-time high at a margin level.
Mr. Pandian, good morning. Thank you for joining in. You mentioned about what happened in FY26, what led to your numbers and so on. What happens in FY27 now with everything that is in place, with everything that's happening on ground right now? Are you in a state to give us a guidance on your FY27 numbers, both on the top line and the margin front? How much would you grow this year?
So at this moment, we have still not given a public guidance at our side, but we've blocked almost 900 crores of order last quarter alone. We went from about 830 crores in order book to 1400 crores after having a 300 crore quarter. We anticipate another $50 million of orders in the battery storage business. We are also launching our own power converters, 1725 kilowatt, very soon, most probably by the end of the year. Our battery storage factory initially is coming up in Turkey, and then we'll replicate the same factory in India. We have also proceeded to about a 765 kV instrument transformers in India from our Meru angle. All in all, we are seeing a lot of growth. We have guided to a S-shaped curve, but I think the order book will show very soon how much we'll close this year at.
Fair enough, Mr. Pandian, but you can always give us a number if that is the case.
The last public numbers I gave in your own channel was about 20%. I think we should beat it.
You should beat 20%. So 25, 30?
Let's talk as and when we are closer to the bridge. But I think we guided this year at 800, and I think we went at almost 1,000. So I think we will try to surprise the market.
And what about margins?
Margins, so we have combined margins. I think all the traditional businesses will continue to do well. The new businesses where we are continuing to invest will have a lower margin. I think from an Indian standpoint, we should be closer to more than 25%. I think Meru also, we should be comfortable guiding more than 15%. The traditional power quality businesses will continue to be north of 25% in EBIT. The battery storage, we are looking at it. It's a first business. We have got about 290 crores of orders in the first phase. We are expecting, as I said, another $50 million of order by the end of the year. By then, we would be the India's largest battery energy manufacturer, for non-battery energy, the power converter manufacturer. In our first year, this is a product coming in from our own R&D. We've been spending over the last 3-4 years. I believe we should scale up very soon once we get the power electronic components in prices, because most of the power electronic prices depends on volume. We are using the European market to be able to build up the volume. As soon as we get the price levels under control because of the volume, we will launch in India.
Okay, Mr. Pandian, if you could briefly tell us about the Sangli facility. The start has been delayed, and what has that meant in terms of cost overruns? And also, the raw material shortages, the labor constraints that you had spoken about earlier. Is there any resolution on that front?
The initial guidance was to start it in September, but we tried to push it till June, till we had a problem on force majeure on some of the construction activities. We had labor going in because of the gas shortage at the site, but most of the things have resumed. We believe we should be able to kickstart by end of July, August. Other than that, I think there is no other problems there. Yes, there has been shortages across board, but we have been effectively managing it. If you see some of our inventories, we have gone overboard, buying resins, buying insulators, buying bushings. I believe, I think stockpiling is the only way forward, what we say to ensure that we meet our guidelines.
Okay, Mr. Pandian, very briefly, 1,400 crore order book. How much of it will convert into revenues this year and the next?
I would like to have everything. If possible, let's work on it. I think we will get far more orders. We got into the American market. We got a large order from a data center, one of the big three. We did Microsoft last year. Now we are expecting few more data center orders from the US. I believe we'll have good news in the first quarter itself.
All right, we'll wait to hear more from you and have you back in the first quarter when that does happen. Mr. Pandian, thanks very much for your time here today. We appreciate it.
Thank you, Raghu.
Okay, let's slip into a short break. Up next, we're going to focus on the bond market with Manisha Gupta. Welcome back. As promised, let's shift focus to the bond markets, and Manisha Gupta is joining in to take us through all of the action. Manisha, what's interesting today?
Well, it continues to be very confusing and a very cautious bond market as we are looking at it. This has been the case since the PM's appeal to cut down on energy consumption and not buy gold as well. Well, if you look at how the last 24 hours have been in sense of trading therein, we've seen papers maturing up to 4 years actually being the most actively traded. And then you have insurance companies which were seen yesterday selling papers maturing in 2030. You had pension funds also buying 10-year bonds in there. So that is what we saw into the markets there. The uncertainty due to the US and Iran war still continues to be or continues to rule the international markets therein. The strength in US dollar index, the rupee hitting yet another record lows. It's something that the markets are taking cognizance of. The focus in the meanwhile clearly seems to be shifting to the US and China meeting and the kind of statement that the markets can start to expect in next 3 or 4 hours coming in from that region. In the meanwhile, you have bond issuances, which saw a big gain, by the way. Between Tuesday and Wednesday, you saw a leg up coming in. Tuesday was 12.3 billion. Wednesday was 85 billion. So a big jump in number there. Total private issuances, today's private issuances, when you look at that, mostly seems to be from Globe Capital Market. They're looking to raise nearly 3 billion. And then you have Globe FinCap Limited. They are looking to raise 2 billion as well. In the meanwhile, liquidity concerns and markets clearly are reading between the lines here because the OMCs also in last 2 days were seen raising funds via commercial papers, especially yesterday, that was Tuesday. So whether it was about HPCL, IOC, ONGC, Petro Editions, they were all in the market there. NABARD also is looking to raise nearly 70 billion, and this is happening via the reissue of July 2029 bonds. This is expected to happen on Friday. In the meanwhile, it is SEBI's proposal that came in yesterday, overhauling the framework for governing municipal bonds. So 4 or 5 points that seem strong in the paper release and what SEBI is proposing. This actually is out in public until 3rd of June for feedback. So one thing is about refinancing through bond issuances, enabling also pooled financing structures for the municipalities, also incentives to attract retail investors. There's a big paragraph onto this one. And then capping use of bond proceeds for working capital is set at around 25%. The rest needs to go for infrastructure development itself. And then enabling municipalities to issue environment, social, governance and green-linked debt securities is what the paper talks about. Municipal corporations, when you look at the overall number till time, and this is a number that is from 22nd of March, tells you that they have raised 45 billion through 31 municipal bond issuances till time.
Manisha, thank you for that update there on the bond markets, all the action summarized. Take a short break. On the other side, corporate conversations continue. Amit Agarwal, the Executive Director and Group CFO at DCM Shriram, joins in to discuss the quarter gone by and the road ahead. Stay tuned. Welcome back. Continuing our corporate conversations then, we are now being joined by the management of DCM Shriram. Amit Agarwal, the Executive Director and Group CFO at the company, is joining in. Amit, good morning. Thank you for joining in. The first question, of course, is the latest overnight development that we witnessed with regards to the ban on exports of sugar. Although sugar exports are a very small part of your business, yes, but what sort of an impact do you see, and are you expecting any further government intervention with regards to this?
See, I would say that, as you rightly said, that sugar exports, government had allowed about 2 million tons of export, and only about 0.8 million tons got exported. And that was because the exports price are much lower than what the domestic prices are. So fundamentally, I don't see any significant impact. Also, the demand and supply in the current season are almost matching, and we are sitting at very low inventory of about 4.5 million tons. I think it's coming because of that. So I really don't think it'll be a significant impact either on prices or otherwise. It's more of a sentimental value.
Also, Amit, in that case, of course, the sentiments, yes, but on to business then. There has been this forecast of El Nino this time around, of a tepid or a subpar monsoon, and this comes after we have had 5 to 6 consecutive years of very good rains for the country during the monsoons. How do you see this impacting production this time around with regards to this?
See, currently it's the beginning of the season. I would say the season hasn't even begun for a lot of our agri businesses. So we'll have to see how it pans out. Yes, if it is a severe El Nino,
or as you said, subpar, then there will be impact on businesses. We'll have to see how the agrarian economy goes on that basis. It's too early to comment.
Okay, too early to comment on how the monsoon pans out. But Amit, what kind of margin and volume growth should we expect, especially in the sugar segment? And if you could clarify for us, your sugar export contribution is what, about 3% of revenues, or has it come down more?
Sugar is insignificant in terms of sugar exports. It is insignificant in terms of our total volumes. Yeah, because majority of the exports
got that.
happen from Maharashtra.
Yeah. If you could give us an outlook on margin and volumes.
Sugar, I would say next year we do expect the volumes to be a little better in terms of production, because current year we've seen the total volumes of production coming down, given that the overall cane availability was lower. So we are working towards improving the cane availability. However, it's a function of climate, varietal balance, crop economics. So there's a lot of factors, and it's not something overnight where volumes come down and they go up the way next year. But do expect some improvement in volumes next year.
Okay. I also wanted to get a sense on your outlook for the chemicals business. I think last time we spoke, you also flagged that what's happening in West Asia could impact the business there, chemical prices and the demand. After that, are you already seeing, some disruption in export orders there, or what's really happening on the ground?
So our chemicals business is largely domestic, but however, it is not, it is exposed to what happens globally as well. Currently, the impact is not very significant till the month of May, definitely. What we're seeing is that because energy prices have gone up, so about 9 to 10% cost of production has gone up. But then they are supported by prices. However, the situation is very volatile. Yes, there is impact, as I said, on energy prices. There is impact on chlorine consumption because the chlorine consumers have a problem in their feedstock, and therefore they may buy less chlorine going forward. So there are challenges. I think it's something which one has to see every day how it pans out, because the war is changing almost like every day.
Amit, since you have mentioned for the caustic soda segment, at least the volume growth has been healthy, but this time around, do you expect that trend to continue? And for your overall business this time around, which segment are you expecting the growth to be led from?
So on chemicals, I would like to point out that about 2 years back, almost 100% of my revenue was coming from the caustic soda business, that revenue stream. In Q4, 66% came from that business or that revenue stream. So the investment that we have done over last 3-4 years, which got commissioned in last 1 to 2 years, are adding significantly to the revenue and therefore strengthening the business and the value chain that we are capturing. So if you also see our numbers for the full year as a whole, our revenues in chemicals went up by about 38% and earnings went up by about 50%. So I think it is now, even if there's a West Asia crisis, because we have multiple revenue streams and we are capturing the value chain, I would say some part of the impact would definitely be hedged because of the strategy that we have had for this business.
Okay, got that. If you could leave us with what's the latest on that MOU you had signed with Bayer India, what sort of benefits you see accruing from that, and overall your capex plans for the new fiscal as we started.
Yeah. First, I would like to answer the second question. In last 5 years, we've invested close to about 6,500 crores on acquisitions as well as on the organic growth. Now, that all has got completed in last 1.5 years, and we'll see the impacts coming in going forward. As on date, we have a pipeline of about 1,000 to 1,500 crores of investment. We are investing in about 115 megawatt of renewable energy. We are investing in chlorine downstream. We are investing in aluminum extrusion. We have recently done a joint venture in a polymer compounding, where we want to scale up with high-tech products. So I think there is a lot happening on ground to see and make sure that the business grows despite what happens in geopolitics or overall economic environment. And our balance sheet is pretty strong to ensure that we can continue to invest in growth.
What about Fenestra, Amit? Your margins there dropped to 10% from 14. You had guided for 14 this time around as well. But what led to that drop in margins, and do they normalize as we go into the new year?
So, see, there are 2-3 things that have happened. One, if we see the full year, Fenestra input materials are PVC, glass, aluminium. All of them have gone up in the range of 15 to 20%, and aluminium is like almost, I think, 50 to 60% increase in the prices. Now, all of that cannot be passed on to the customer. So that is one reason. Second is that we are getting into newer platforms, which have also now grown in scale. One is aluminium windows, then it is facades. They have lower margins. And third, we are also getting into more of projects platform, which is, projects, institutional clients, where the volumes are higher. So, the margin profile will change. And I think it's important to mention here that we have achieved a milestone of crossing 1,000 crores of turnover. We ended with about 1,100 crores in this financial year for this business. So I feel we are healthy. I would also like to point out here that if you look at some of the other established building materials players, the margins are in the range of around 12%. And we expect in next 1 to 2 years, once we have stabilized this, high growth and new platforms, we should be in the range of around the same 12 to 13%.
All right, Amit, we'll leave it at that. Thank you very much for your time here today. We appreciate it. Thanks very much. Let's move on. Sudarshan joins us now to bring us the latest trends from the F&O space. Sudarshan.
Things are happening in the market and it's happening thick and fast. So it's just in the last 2 minutes we have seen a sharp recovery in the market. The Nifty just 2 minutes ago was hovering around 23,400. Now it's back about 23,500. But if you talk about since morning, one thing that we have noticed is like it's failing to hold any recovery. And two major culprits are banks and IT. Both Nifty Bank has seen a sharp downtick from days high. Similar, all the IT names remain under pressure over the last few days. And today also, either you take a look in amongst mid-cap names or the large-cap names, majority of the IT names are in the trade. So broad range for Nifty is from 23,000 to 23,900. If you talk about the indicators, first one is crude. It remains above the level of 100. And currently it's trading around $105 to $106 per barrel. I'm talking about the Brent crude. Second one is the rupee. Again, it's back to the record low. It's now approaching the level of 96 against the US dollar. And if you talk about the volatility index, it's in the red. It's still below 20. So we'll have to track. If it again goes above 20, it will be a concern for us. Now in the options data for Nifty on the call side, two major active options are 23,500 and 23,600. On the put side, 23,500 and 23,400 are the most active. So it looks like that Nifty in all probability will hold the levels above 23,400. So support I have taken Nifty for 23,200 and resistance would be 23,700. For Nifty Bank, support would be 53,000 and resistance would be 55,000. Some of the stocks that have been reacting to news flow or the earnings, first one is Zydus has been saying fresh longs. Its board is going to consider share buyback. Second one, all the indices names, BSE, MCX, all these names have been buzzing, and SEBI has just come out with a consultation paper related to ease of doing business for both equity derivative segment and also for commodity segment, and that's the reason both these names are sharply higher. BSE has been saying fresh longs. Vedanta over the last few days has been moving higher, and today also it's been saying fresh longs, and on the fresh short side, PG Electroplast and HPCL.
PG Electroplast, unsurprising after Keynes Tech's results. Of course, PG Electroplast is yet to come out with numbers, so that's going to be the one to watch out for, especially after the earnings miss from Keynes. Sudarshan, thank you for that. A couple of names that Sudarshan highlighted. BSE, of course, now at the highest point of the day. We highlighted this at the beginning of our show as well. Continuing to do well for itself, now up 54% this year and 20% in the last 1 month. Zydus, of course, 5.5% higher, set to consider its third share buyback in the last 4 years. Good time to get in a quick chart check as well from Sachitanand Uttekar of Trade Bulls. Sachitanand, good morning. Thank you for joining in. Well, this trend that the index has had of not managing to hold on to any form of gain, do you see this happening today as well? We are back nearing the highs of the day now at 23,560. But do you see any resistance at 23,500, 23,600? And do you believe that these gains will be given up? And of course, your stock recommendations for the morning as well.
Good morning, Hormoz. Hormoz, the week, the way it commenced with the gap down, opening. This particular indication itself says that going forward, we may see the Nifty, spiraling downwards towards that 23,150, 23,000 gap area support. If you look at the last 4 trading sessions, yes, we have already seen a severe downside which unfolded in the Nifty. But if you look at yesterday's trading session itself, we did see a kind of a spinning top formation indicating indecisiveness in the immediate term. So if you look at the overall construct, the Nifty is still trending below its 5-day exponential moving average, which we believe that could provide the necessary resistance for the index. And on the higher side, we may see some exhaustion near to this particular level of 23,600. So ideally, we are recommending, building fresh short positions on a pullback near this particular zone itself. One should keep a stop loss at 23,640 on closing basis, and eventually we see that the Nifty will, scale lower towards 23,150. 23,000 kind of a zone in the coming week. If you look at both the major indices, Nifty IT and Nifty Bank, both are trending lower. Especially if you look at Nifty IT, we have already seen a fresh breakdown from a head and shoulder formation, which is again indicating a further downside of close to around 10 to 12%. So we are not expecting any major rally in the index as of now. But the pullback is something which looks, temporary, and we may see the Nifty, again scaling lower towards 23,150, 23,000 zone.
Okay, got that. Sachidanand, would you like to call out any particular stocks?
On the short side, I think IT is something wherein the concentration should be there. If you look at the performance of persistent systems. Now, even here, we have observed a fresh breakdown from a head and shoulder formation. The pattern target is placed somewhere close to around 4,200. But from a trading perspective, we may see an immediate swing towards 4,450. Hence, we are recommending fresh short positions here, keeping a stop loss at 4,720. With the pullback, I think the ideal zone would be somewhere close to around 4650, wherein some fresh shorts can be deployed. The stop loss should be maintained on closing basis above 4,720 for a pattern target of around 4,200. The other stock which is on our radar is Dr. Reddy's. Now, if you look at the monthly charts, we have seen a very healthy consolidation. Recently, we saw the decline getting arrested near its 200-day exponential moving average support, which is placed somewhere close to around 1260. An inverse hammer formation is a rare observation, indicating that there could be a good, continuation of the up move. So here we are expecting that there could be, good outperformance in this particular counter. And hence, we are recommending building fresh long positions in Dr. Reddy. One should keep a stop loss at 1255 on closing basis and review the positions on a major breakout level, which is close to around 1340, followed by 1420 as a pattern target.
All right, Sachidanand, thank you so much for sparing time joining us today with your views on the index, your stock recommendations, a short on persistent systems, along on Dr. Reddy's doing well in an otherwise volatile market. Speaking of the market now, it's now at 23,600 at the highs of the day, 200 points higher on the index. Now it's a very, very sharp up move. It's almost a V-shape up move that you've seen over the last 20 odd minutes on the index. You take a look at the Nifty Bank and the Nifty IT, the two indices that were dragging the index lower at the start of the show. There would have been a recovery in those indices as well to take the market higher in this trading session. Take a short break. On the other side, we continue our conversation on the markets with V. Srivatsa from UTI AMC. Welcome back. Well, the market may be at the highs of the day. What's at the lows of the day is Keynes Tech. There is no recovery whatsoever. A very little recovery that came in earlier in the day has been sold into very swiftly. 18% lower still on the stock. Upasna is here with more on this. Upasna.
Well, it's a clear miss across the board. The company has missed its own guidance and even missed the lower street expectation. Now, if we look at the Q4 revenue number, it stands around 1200 crore, while the company had guided for a 1700 crore, which adds up to a revenue growth of just about 26% that the company's reported versus the expectation of nearly about 53%. Now, EBITDA margin is down 160 basis points at 15.5% versus our estimate of 16%. PAT is also down 21%, taking a hit in Q4. Now, if we look at the numbers on a full year basis, the FY26 revenue growth stood at just 33% versus the guidance of nearly 51%. So a clear miss on a full year basis. In terms of EBITDA margin also, it's a miss on a full year basis, as the company had guided for 17% margins, but they've come in at somewhere around 15.8%. In terms of operating cash flow, which was a key concern in several quarters, especially attributing to the company's smart meter business, the operating cash flow for the full year stands negative 600 crore, which has certainly alerted the street on this big number. The company has also missed this guidance, as they had guided last month itself that they will turn cash flow positive by end of this year. So quite a bit of a gap up there. Now, management joined us today morning, and here are some of the important takeaways. They believe that the Q4 was overall impacted as the two major government contracts in the metering business got delayed that the company was expecting in the last 10 days of March. Industry EMS growth, they indicated they are pegging it at somewhere around 15 to 16%, and company expects to grow nearly 2x of the industry growth, with an implied revenue growth of somewhere around 30% for FY27 and FY28. Management has also clarified that the negative OCF is largely attributable to the metering business, which follows a staggered payment model. And lastly, company has guided that its operating cash flow, which is a key concern as highlighted earlier, this will trend towards a neutral figure by end of Q3 FY27. Listen in to what the management has highlighted.
We did communicate, and we were looking for two major government contracts where we completed the manufacturing to go. But because of the last minute delay on the contract, we could not go immediately. For as far as the Keynes Technology India Limited, the parent company, we're already cash positive. In terms of the metering business, you all need to appreciate that the business model itself is like that. But by end of the third quarter, we'll be reversing the trend, and we'll be getting into the, I can't say positive, but at least we'll neutral. The industry is looking to grow at about 15 to 16%. We are doubling of that growth. That's what I can share. With the high volatile situation that's around this industry and in India, what is going through, and we are poised to grow in an every growing segment, be it electric vehicle segment or defense segment or industrial business. But at this point in time, rather than telling the number, I would say that we are pretty confident because we have a capacities available, technology available, product available. We'll be outgrowing the market, and we are doubling of the market growth.
So I can put out a flash saying Keynes is telling us that revenue will grow 30% in 27 and 30% in 28. I would not be wrong.
You are an awesome, and then you are able to interpret the numbers, what I say. Go ahead.
All right, that's Keynes Tech, down more than 18.5% today and about 22% in the last 1 week. But on the other end of the spectrum, you have Balaji Amines that has hit a 20% upper circuit, which is its biggest single-day leap in more than a decade. The rally comes on the back of a very good fourth quarter performance. Let's go across to Sonal Bhutra for the highlights of that one. Sonal.
Well, good set of numbers reported by the company in Q4 despite the West Asia crisis, because remember, company had indicated that some of their production was hit because ammonia wasn't available, which is very important for production of amines, the kind of amines that the company makes. Despite that, revenue growth has been strong at 12%, EBITDA is up 58%, their margins have grown by almost a 700 basis points uptick at 23.9%, profits accordingly are up 58% as well. However, if we look at FY26 numbers, it is not very inspiring. Revenue growth has been at 1.5%. EBITDA is flat. Yes, margins have improved, but absolute EBITDA continues to be flat for the company. Profits are up just 6%. But as I said, despite the concerns that we saw in the quarter gone by because of ammonia supply hit, the company continued to do well. They also indicated that supplies have improved in the month of April. The stock is up 45% year to date, up 21% this month itself, and has continued its up move after strong set of quarter four numbers. On the back of this, even alkyl amines is higher in trade because one of their peers has done really well. The conference call is at 4 p.m. today, so we'll get more details in terms of outlook, pricing, supply concerns as well. For now, a surprising uptick on Balaji Amines on the back of quarter four results, which were impacted by supply concerns.
Well, one goes up, the rest follow. Balaji Amines, and look at alkyl amines, Indo amines, all of them doing double-digit gains in today's session. Sonal, thank you for that update there. NLC India is the other one, the top gainer on the Nifty 500 today. Vivek is here with more on this. Vivek.
Well, NLC India, a clear outperformer today. What's actually aided the very strong performance has been the fact that FY26 has been a year of strong commissioning. Some of the key plants that were delayed for many years together have now come on stream. At least part of that has come on stream. Plants like Ghatampur, etc., have gone ahead and aided to the contribution as far as this particular quarter and FY26 is concerned. Looking at the numbers themselves, revenues are up by over 30%, profit EBITDA up by almost 2.1 times, so more than doubling on a year-on-year basis. Margins coming in over 1,000 basis points higher, profitably up by almost 3 times. So what did well? Well, first up, look at the segmental revenues. Mining revenues up almost 21%, thermal power revenues up 35.5%, renewable power revenues up by 20%. In terms of commentary, something that the street may not like, the company says that they continue to face availability constraints at Neyveli, impacting the lignite mining operations. They're saying taking sustained measures, including contingency mining, to go ahead and ensure lignite availability and address the constraints that the company is facing. Now, in terms of the key highlights as far as FY26 is concerned, significant coal production improvement is what the company has seen. Coal production of 19.14 metric tons, again over 11% growth on a year-on-year basis. In terms of capacity addition, over 1 gigawatt of capacity addition is what the company managed to go ahead and do for FY26. Now, the key thing to watch out for will be the timing of the launch of the IPO as far as the renewable energy arm is concerned. The company says they have received approval from the Government of India for an alternative mechanism for listing of NIRL through fresh issue of equity shares as well as the divestment of stakes. So the renewable energy arm IPO is going to be a mix of both fresh issue as well as an OFS. So it will be interesting to see what the fresh issue proceeds are used for.
All right, Vivek, thanks very much for bringing us that update. Let's slip into a short break, but up next, we're going to discuss market fundamentals with V. Srivatsa from UTI AMC. Welcome back. The markets have recovered a tad since we started the show, up about 240 points as we speak, 23,655 on the Nifty, and it's about 75,303 on the Sensex. The Bank Nifty is in the green again, trading with gains of about 580 points, 1.1% up on the Bank Nifty. Quickly also pull up the rupee. I think this is a new record low. It's not too far off from 96, 95, 92 on the rupee. That is the level we're currently seeing. So keep an eye out on that one as well as we go ahead and trade today. But we have V. Srivatsa joining in from UTI AMC to discuss market fundamentals and his top sectoral picks. Mr. Srivatsa, thanks very much for your time here today. In terms of your holdings, financial services and information technology, are your biggest holdings HDFC Bank, which has nearly been flat as far as returns for investors are concerned in the last few years. That is your top holding. So let's start with your view on the financial space from the numbers that we've seen so far, especially on the margins. Some big disappointments coming in from the large players like State Bank of India. With HDFC Bank also, it was a decent set. The CD ratios improved, etc. But your overall takeaway in terms of when we start to see a better performance, especially from the likes of these big private banks.
Yeah, hi. Good morning. Now, as far as the financials is concerned, yes, banks have kind of, I would say, a little bit disappointed on the NIM part in this quarter, but we do expect a decent amount of strong recovery in the credit growth, as well as the most important aspect is the credit cost. I think there is no sign of any kind of deterioration. Now, there could be some lag in the NIM recovery, but we do believe that the current valuations at which the private sector large cap banks are trading are quite attractive on a long-term basis, because as you rightly said, they haven't performed well in the last couple of years. So our philosophy as far as the large and mid-cap fund is concerned is both kind of having a value focus and focusing on stocks probably which have delivered well over the longer term, but are struggling in the near term because of certain transient issues. So we remain positive on the private sector banks.
And, is it a similar stance? Are you going to be as brave with the IT pack as well? I mean, given what's playing out globally with the AI trade, there's fears every day. There are obituaries every other day for the IT sector. That's also one of your big holdings.
Yeah, I think in IT sector, what is happening is, globally, there is a very big momentum towards AI. And obviously, anything which is anti-AI, where the impact is going to be the maximum, I think that is getting impacted. So for example, if you look at the US IT service players, they have corrected quite a lot, and some of them are even available below 10 B. The same weakness is kind of percolating. Now, if I look at the IT pack, I think, one aspect is that there is a near-term weakness, largely on account of macro issues. The companies haven't called out any specific impact of AI. That's definitely impacting, but still the growth rates are, on an average of 3 to 5% for the sector, which is not a very bad outcome given at the valuation that they are trading. Now, probably what the market is implying, looking at the momentum and the downfall, is that AI will completely finish off IT over the next 10 to 15 years. So, this will be a kind of a terminal decline business. We are not in that camp. I think we believe that there would be opportunities for IT companies to deploy the AI services when it becomes mainstream, and that would be a very big opportunity. But yes, in the near term, earnings momentum do look weak, but the valuations have corrected to very attractive levels. All the large cap companies are available at 5 to 6% free cash flow yields with very strong governance, and we have not seen a very sharp deterioration in the near term earnings. So that makes us quite positive on IT. Having said that, yes, it may take some time to play out, but we are willing to be patient in these names, and hopefully AI will turn out to actually be a beneficiary in the medium term for the IT service companies.
Well, those who are, since you spoke of patience, those who are patient with BSE have been very handsomely rewarded with the stock now at record highs, now crossing 4,000. But with the capital market space, Mr. Srivatsa, where does your stance lie? because in your top holdings you mentioned financial services and so on, but does capital markets form a part of that too? Considering especially the run-up that you have seen in names like BSE and MCX within this space, how do you want to play this theme? You want to play it through the exchanges like the BSE, the MCXs, or you want to play it through the asset managers / wealth managers or the broking firms like the Motilal Oswals or the Grows?
Yeah, so our presence are more skewed towards the AMCs rather than the exchanges. We have some exposures in both, but it's more overweight on the AMCs. I think that's where we believe the valuations comfort is higher there. And obviously, it's a structural growth because we are seeing regular huge amount of inflows into the AMCs funds. So that's something where we are more positive on. Exchanges, I think the valuations are extremely high, and still the jury is not out whether some kind of a legislation will come. So we are still a little bit circumspect of getting into exchanges at these levels. The other part of financial services where we are quite positive on is life insurance. I think there we have a kind of a decent exposure or a decent overweight. There we believe that the worst of regulation is behind, and more importantly, given the GST cuts, I think the sector is headed for a better levels of growth. And with the implementation of IFRS next year, you would probably see a better, profitability, or you will get a true sense of their profitability, which can still lead to a decent amount of re-rating in these stocks. So within the whole financial services, I would say life insurance is something that, is our largest active weight, and that's where we are betting on.
Short but insightful conversation, Mr. Srivatsa. Thank you so much for sparing time and joining us today in what has been an absolutely crazy recovery for the markets now over the last 20-30 minutes. The index is now at 23,700 as we speak. So almost a 300-point gain now on the index, and that is a 300-point recovery that you are seeing from the lows of the day in just the last, 650 odd minutes. But what has also plunged to the lows of the day is the currency. 95.96 now is where the rupee lies, and nearing a new record low, closing in on that 96 mark as well. Take a short break, back with more on the other side.
Welcome back. Don't take your eye off the markets. I mean, it's a sharp recovery in the last hour. It's near a 250-point gain or so, that we are seeing. It's now up about 260 points, 23,673. We briefly crossed 23,700. We're now about 23,672. So, it looks like a bit of a recovery leg here in the last hour or so. We'll have to see how that pans out. But let's get you the macro signal of the day, and it's the banking sector, which has wrapped up the fourth quarter with what looks like a solid report card. There's strong credit growth, there's cleaner balance sheet, there's healthy profitability, although there is pressure on the margins, which was clearly visible in the quarter. First, on profitability, private banks continue to deliver more consistent earnings growth this quarter, though PSU banks still posted a fairly resilient performance overall. Among these public sector banks, you had Punjab National Bank and Bank of Baroda that stood out with double-digit profit growth, while SBI and Canara Bank saw some pressure from weaker treasury income. Among the private peers, ICICI Bank and Kotak Mahindra Bank, they were the standout performers, and Axis Bank's earnings, of course, remember, were weighed down by higher provisioning, while IndusInd, of course, saw a sharp rebound of the weak base from the last quarter on account of the disruption that it had seen. The clearest sector-wise signal this quarter, that came in the net interest income or the core income growth. NII growth has actually slowed across much of the system as higher deposit costs and tighter liquidity conditions began squeezing the spreads. So several public sector banks reported either flat or negative core income growth year on year, including PNB and Union Bank. Private banks held up relatively better, but even there, growth was in single digits. Now, even with tighter liquidity conditions, loan growth has been very healthy. Axis Bank led the pack with advances growth of more than 18% year on year, while SBI, Bank of Baroda, ICICI Bank, Kotak Mahindra Bank, all of them posted strong mid-teen growth. The fourth quarter also showed some signs of improvement when it comes to deposit mobilization, which was a big worry of last year, and this especially among the private banks. Kotak Mahindra Bank, HDFC Bank, and Axis Bank, all of them reported healthy deposit growth. Union Bank, however, lagged its peers, while IndusInd remained a clear outlier with contraction both in loans and in deposits. Now, margins, they painted a more mixed picture this quarter. 5 banks of the top 10 that we've collated saw sequential compression in margins, while 5 reported expansion. So SBI was a big disappointment. Union Bank, IndusInd Bank, they saw the sharpest pressure, while on the other hand, Kotak Mahindra Bank stood out with margin expansion of 13 basis points. Bank of Baroda, Canara Bank, HDFC, and ICICI also managed some improvement. Overall, though, private banks maintained a clear margin advantage over the PSU lenders. And finally, asset quality, that I think was the best news of the quarter, an improvement across the board. PSU banks in particular have seen a remarkably clean balance sheet. SBI's gross NPA is now down to the lowest in 2 decades. Canara Bank, Bank of Baroda, both below 2% as well. Private banks, however, still lead on underwriting quality. HDFC Bank and Kotak Mahindra Bank, no surprises there, maintaining the lowest bad loan ratios in this sector. So that's as far as the fourth quarter wrap for the banking sector is concerned. But we'll also wrap up trading hour on that note. From Hormaz and me, it's a goodbye. But stay tuned, Halftime Report will be up next.
Stocks trade steady as Trump and Xi rallies kick off. IT and realty are the big drags, while metals and healthcare eke out gains. Midcap underperforms.
Bharti Airtel opts for a share swap to acquire stake in its African arm in an EPS accretive deal that dispels fears of a big cash outflow. Its Q4 results, however, reveal the slowest growth in many quarters for the India mobile business.
Cipla projects a quarterly run rate of $250 million in the US for FY27 on the back of a slew of product launches. It also sees margins perking up in second half after a weak first half. Most analysts upgrade the stock, sparking a rally.
Sugar stocks take a knock after the government banned sugar exports till September 2026. This comes on likelihood of a lower crop this season due to erratic weather. The move is expected to rein in domestic sugar prices.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Bhutra as well as Vinny Motiwala. Well, it is turning out to be a day where we are seeing an intraday recovery come through for the markets. So we have the Nifty, which is surged to 23,663. The high point of the day was 23,700. But there is a bigger recovery which is taking place in the rupee. In fact, the rupee hit an intraday low of around 95.9697. And now it's rallied all the way to levels of around 95.75 just in the past half an hour to 45 minutes. There is some amount of data coming in from Bloomberg that maybe there could be some tax tweaking which could take place with regards to the bond markets, foreign holdings in the bond markets. So just watch out for that. That could be one of the reasons why we're seeing this kind of appreciation come through. We also have the WPI data for the month of April, which has come through, and that's come in at an over 8% figure. 8.3% is what it surged to versus 3.88% on a month-on-month basis. The street was working with figures of anywhere between 5 to 6%, so it's come in much higher than what at least the street was anticipating. We have Aditi Nair, who is the chief economist at ICRA, now joining in to discuss this. Aditi, hi, welcome to the show. Well, we have two pieces of information to ask you. So I'm just going to first ask you about the WPI data, which is coming at around 8.3%. It is obviously the highest that we've seen in many, many months. But was it expected? What is the trajectory now that you expect for the WPI?
In terms of the WPI, we'd actually projected it to come in at 5% in this month. And it's obviously come in much, much higher than that. This is the kind of scale of difference between the forecast and the number is really quite large. I have a feeling that we'll have to look at some of the, mineral categories, some of the fuel categories. That's probably where the difference lies. So for instance, in natural gas, we had taken a very large jump this month. It's not an item with a very large weight, but given the kind of movements that we've seen on the natural gas pricing side, perhaps this is one of the reasons that there has been such a large deviation between the expectations and the actual number. And it could be some other categories like this. So for instance, on crude oil, we had looked at the last couple of months' numbers after the West Asia crisis started and based our expectation around that. But maybe, some change in the way the actual numbers are calculated. Earlier, it used to be quite similar to the Indian basket, which is fixed weight. Now, of course, what we're actually buying would not be in line with the weights in the Indian basket, but realistically looking at where the supplies are available right now. It could be some technical factors like this. So we'll have to really look at the detailed breakup to understand why there is such a large deviation.
It's largely because of fuel and power. This is as per the table that is given by PIB. On a month-on-month basis, fuel and power inflation is up 18.2%. That is the number, and 24.7% if we talk about it overall as well. Aditi, in that case, fuel and power continues to be a matter of concern. What numbers are you factoring in from here on? Could it be higher than 8% because there's no visibility as to when this war would end?
No, you're absolutely right. So, for instance, if you look at fuel and power, Within that, one of the components is electricity, where there hasn't been too much change. So, for instance, this year, the tariff orders that have come through so far, there isn't too much of a change. Even the daily averages that we look at, it's not supportive of this. The other factor is coal, and the third is the mineral oil. So, probably it's the mineral oils index, even without the increase in retail prices of diesel and petrol. It's the other components which are priced, market priced. That's where probably the jump has happened. So, this is what we would need to look at. Now, without having seen today's data, we thought that the May number was going to be higher than the April number. And I suppose that will continue to be the case. So we'll have to relook at the trajectory now to understand for how many months it would remain above 8%. But given the fact that there's really no visibility for when the war is going to end and how soon commodity prices are going to return to normal, it is going to be difficult to project things like the WPI, which are very much, very heavily weighted towards internationally traded commodities. And of course, the INR depreciation is another factor that exacerbates the landed price of imported commodities. So that's another factor that we'll have to keep in mind.
Absolutely, the INR depreciation, that's what I wanted to understand as well, right? Because when you see it hitting new lows, what are we keeping an eye out on now, even from the central bank side, RBI side? Inflation, you said you cannot judge the numbers. So what is the central bank, maybe the decision that maybe we could keep an eye out on now?
I mean, we'll have to make projections, even though obviously data is limited and, visibility is not there into what geopolitics will look like next week or next month. We will be making our forecasts based on the information which is available. And, we'll obviously have to rework, given the fact that there has been such a big gap this month. We'll have to relook at our forecasts for the next few months. So, if we've come in at 8.3% for April, I would imagine May will be higher than that. But will it be, around 9% or higher than that? We'll have to kind of really take a look. Now, in terms of the central bank, we do have the MPC review next month. There is still a few weeks between now and the MPC review, and the world could change. We don't know how things will really end up being. But my sense is that at least this time around, since the CPI inflation was much more benign than what had been expected, and that's not really showing an impact of the West Asia crisis too much so far. Maybe we could still end up with a pause in the June policy review. And it will be a very policy by policy kind of decision, given the kind of flux which exists right now.
Okay, yes, absolutely. Definitely moving parts, Aditi, because there's a Bloomberg report right now which is saying that government is considering reducing taxes on foreign holdings in debt. Have you looked at that space at all? When you talk to clients, what do they say from the foreign investment point of view when it comes to debt holdings at this point? What kind of tax changes should we possibly expect? And what do you think that would possibly do to the rupee?
I don't want to speculate on what may or may not come in this space, but I think as far as the rupee is concerned, we do have a challenging situation between the uncertainty on the global side and what is happening as far as FIIs are concerned, and also the overall balance of payments. So, for instance, last year we probably ended up with a current account deficit of 0.9% of GDP. And this year, if we now work with the assumption that crude oil price will average $95 per barrel for the full year, which means that it will remain where it is for the next few months and then eventually drop down to $80 per barrel after the war sort of settles. Then at $95 per barrel average for the full year, we are still looking at a current account deficit which is going to be a little higher than 2% of GDP for FY27. And that's like more than double of the level that we had last year. So it is going to be a challenging situation for the balance of payments. We will need to find ways to attract more financial flows to be able to offset the current account deficit, which is expected to be, 2% of GDP at present.
Okay, take that point. Aditi, thank you so much for joining us, your insights. It's a developing situation. So, of course, a lot of these forecasts depend on a lot of changes that keep happening. Thank you for your thoughts today. With that, let's move on and talk about a lot of stock-specific action that's happening in the broader markets. Vivek is here to tell us about all the buzzing stocks. Vivek.
Well, thank you so much for that. A very volatile trading session, especially in the first hour. But in the last half hour or so, we've seen significant recovery from the intraday lows. In terms of individual stocks, mostly earnings reaction, what we're tracking, NLC India, power company doing very, very well, almost 18% higher, expanded capacity base, going ahead and aiding earnings. Zydus Life Sciences, the other name, one of the company's arms has gone ahead and said that they will be acquiring a US-based firm, and along with that, a buyback is lending support to the stock price today. Siemens India is in focus. The company's parent has gone ahead and said that they've seen almost a 21% top-line growth in India. That bodes quite well for Siemens. That stock doing very well in the session. Cipla, the street clearly likes the extremely aggressive guidance that the company has given in terms of the US sales. Almost $1 billion is what the company is targeting, higher by 6.5%. And Bharti Airtel, one of the top outperformers of the day, steady Q4, and along with that, the Airtel Africa consolidation done at extremely attractive valuations is something that the street clearly likes. On the other hand, quite a few laggards as well, none bigger than Keynes Technologies. So many worries, emerging guidance miss, working capital constraints, all of this taking the stock down by almost 19%. TVS Motors, while growth guidance was good, margin worries is something that the street didn't like, down almost 3%. Zadel Prepaid, again, the company refrained from giving margin guidance for FY27, down almost 20% today. LIC Housing Finance, while profitability was good, loan growth is what the street was anticipating, seeing profit booking down 3%. And lastly, Tube Investments or TI India, margins contracted quite significantly, something the street didn't like, down almost 5% in the session today.
Okay. Vivek, thank you so much for joining in and taking us through the stocks that are moving around in the trading session. You have some con call highlights also coming in from Bharti Airtel. So let's watch out for that. They're confident about the growth and long-term opportunity in Africa. We'll keep an eye out on that. But on that note, time for a short break. After the break, we'll connect with the management of Knowledge Realty Trust to discuss their Q4 numbers. Stay tuned.
Welcome back. You're still tuned into Halftime Report. It's time for a corporate conversation now. Let's welcome the first management on the show. Swatwa and Blackstone-backed Knowledge Realty Trust is joining us now. The company reported a good set of Q4 numbers. The revenue saw an uptick of 12%. Their net operating income grew, and so did the distribution. We are now joined by Shirish Godbole, the CEO of the company, to break down the numbers, the outlook going forward, and what are the plans next for the REIT. Shirish, good afternoon. Thank you so much for joining in.
Thank you for having us.
So it's
for having me, I should say. Yeah.
The first full year after your listing. Give us a sense of what FY27 will look like in terms of your pipeline addition, especially the distribution income, around 6 rupees per unit right now. How will you grow it from here on?
Yeah. So thank you again. So as you said, it was a stellar 26 for us. Very excited that that start was very good for us. Revenues were up. NOI was up, as we discussed, as you mentioned. So 16%, 18% numbers there. 3.5 million square feet of leasing, 92% occupancy right now, and a fair amount of debt that we refinanced and got ourselves down to a 7.22% rate. So we're very well positioned there as well. So very successful year as we saw the previous one. Looking forward, honestly, it's more of the same. We're very excited to have this base, but, with 3.5 million square feet done last year, we hope that we can achieve similar numbers going forward. As a policy, we don't provide, specific guidance, but, the markets are looking good. We're positioned very well. With that kind of leasing, it'll translate to better revenues, better NOI, and a better distribution than where we are this year. It'll be up for sure. Like I said, we don't provide specific guidance, but we'll be doing much better.
Let's narrow it down. Will it be high double digits? I'm asking because you are talking about there's a potential of embedded growth of around 25% in terms of mark-to-market rental potential.
Yeah.
Will that be the driver for growth? How much can you take it up? And what about volumes? Leasing 3.5 years. What is up next?
So the numbers will be up. Honestly, it's hard to say single, double digit, etc. But it'll be, a reasonable number up, which would make everybody happy. Let's put it that way. And there are various drivers, right? We have the 25%, but remember, that is Sonal over a period of time, right? So it doesn't happen like tomorrow. So a bunch of that is in Mumbai. So Mumbai has shorter leases. So the average life that we have in Mumbai is about 3.5 years. So the good news is a lot of that appreciation over the next 3.5 years will happen. But as of just this year, it's a piece of the growth, but not all of the growth from the rental escalations we have. We have 1.2 million square feet under development right now, which will be delivered in the second and the third quarter. So that is going to get delivered. It'll get leased up. So that'll be good. We have 1.4 million square feet in addition that we've just started. So that gets delivered 3 years out. But, that is something to look forward to as we look at next year. And then, acquisitions. We are on the prowl with the support of Blackstone and Satwa, as you just mentioned, and those sponsors. Clearly, we see everything that goes around as an opportunity. The right time, the right accretive number, we can make an acquisition, we will. But, definitely expect some acquisitions this year. So when you combine all of that, I think it's a fairly healthy growth and looking forward to that for FY27.
Absolutely. Shirish, what about your occupancies? They've remained at 92%. Good. But you have Bangalore that is there. You have, obviously, the Satwa Global City, you have Exora that comes in as well. So how do they also come up to those levels? What is the average occupancy that we're keeping an eye out on in FY27? What will it mean from here on?
Thank you, Vinny. We obviously will go up. I think, again, no specific guidance, but we're looking at 3.5 million square feet or something similar again, which will definitely take us up towards 94, 95% as we look at next year. And that, is going to be across the board, right? Hyderabad, which is in high-tech cities, already 99% leased, so really can't take it much up from there. Mumbai today is at 89%, and we will definitely look to take that up much further. And Bangalore, as you mentioned, is at 87%, and we are easily seeing that go into the 90s as well, right? So when you put all that together, I think a 94, 95% occupancy looks quite doable for us in FY27. So we're excited about that and what it means for the DPU and the distributions.
Okay, so average occupancy of around 94 to 95% is what you're guiding for in FY27.
I'm not guiding for it, but I'm hoping to achieve it.
You're optimistic about that figure, I would say. All right, Shirish, I just want to circle back to the acquisition bit that you spoke about. You said that FY27, you're going to look at inorganic growth. Just give us a few more details. What is the corpus that you're looking at? Which are the geographies that you're looking at? And how aggressive are you going to be considering the premiums you are seeing in the market?
No, I think it's a very good question, Ekta. It is an aggressive market. And so, we are going to do the right thing. So we're disciplined. We will not just make an acquisition for the heck of making an acquisition. We're obviously focused on our numbers and whether it's accretive to us or not. But I think it has to fit with our overall portfolio, right? What we have is Class A assets in, honestly, Class A locations. So I think that is the most important thing for us, right? So we're not looking to make a small acquisition here and there. But if it fits within sort of what those broad parameters are, a Class A asset, off scale, in the right market, we will aggressively go after it, but, with discipline.
Okay, so would that Chennai be a market? Because a lot of peers have done that, be it Embassy, be it Mindspace. And at the same time, we've been talking about this AI boom. We are talking about GCC boom. How big is that a part of your portfolio? Or is the AI boom impacting occupancies in any way?
Yeah, of course. The GCC and AI boom are actually positively affecting all office markets in India. And it's a very, very good story. People worry a little bit about AI, but we actually look at AI and the implications it has had so far for the office market very positively. So what's happened is the AI boom has led to a real demand from the GCCs, from the global capability centers. And, you would be surprised, but India is sort of moving up the value chain. We were in the office market at call centers. Then we were back office. Then I would say we were medium office or mid office. Today, I think we're part of the business. Whether it's sales, whether it's BFSI, whether it's pharmacy and innovation, cybersecurity, AI implementation across the board, engineering, inventions, absolutely front edge, right? And that requires high-end talent, English-speaking talent at a reasonable cost, and that's all available in India, which is therefore real positive. And what has that led to? What that has led to is a demand for Class A space. So, when you have this kind of talent, wanting creativity, wanting sort of thoughtfulness, collaboration, it needs to be an institutional grade Class A space, which kind of plays to our strength. And so if you look at India today, the vacancy rates in Class A space versus vacancies in the other space, you will see Class A is actually highly in demand and plays well to what we have. And so therefore, we're excited about FY27 and looking forward, and not that worried, if you want to say, about the AI impact. Today, what we're seeing is, if anything, AI is replacing or doing tasks more than replacing jobs. And so that has actually helped productivity. And so with the 31% front office in our portfolio, we're finding front office productivity go up, and GCCs with 45% of our space, growing, combined with that front office and very low single-digit ITES exposure, our portfolio is pretty well positioned sort of going forward. So that's what excites us.
Okay. Shirish, thank you so much for joining us on the show, helping us understand where the business is going to go from here on, what's good, doing well, what's trending as well. So thank you so much for joining and coming to the studios. But on that note, we're going to slip into a very short break. After the break, we'll come back and we'll have Rajesh Palve of Axis Securities, who will be talking some trading strategies. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. Nifty as of now is up almost 280, more than 280 points in the trading session. 23,690, around 23,700 mark. Day's highest point is what the Nifty is trading at. Broader end of the market, a bit of an underperformance versus what the Nifty is doing today. But this has come up and the markets have come up since 11 a.m. So we'll watch out for that. But what's happening in the world of F&O? Let's go across to Sudarshan, who's here to take us through all those details. Good afternoon, Sudarshan.
Good afternoon, Vinny. So what a recovery we have seen in the last few minutes, and that came after there was a report on Bloomberg that government is considering allowing investments in bonds for foreigners, and that has led to a sharp recovery in all the major private banks and also PSU banks. So at this point, HDFC Bank is the top contributor not only to the Nifty but also to Nifty Bank. So recovery in banks, but one sector that remains a drag. There is no recovery, almost zero recovery in one segment, that is the IT, and that remains a drag. So Nifty till this point continues to hold the levels about 23,500. It's approaching the level of 23,700. Major buying or say resistance will come for Nifty only when it crosses the level of 23,870. That's around that level. It's your 50 DMA. Now indicators. Rupee also has seen a sharp recovery. At one point, it had hit the low of 95.96. From that level, it has come down to 95.67, and currently it's hovering around 95.70 to 72. Crude continues to hold the levels above 105. So that remains a concern for the market. As far as the volatility index is concerned, it remains below 20. Now, Nifty options data. On the call side, 23,500 and 23,600 remain active. In the last few minutes, another call option that has become very active is 23,700. On the put side, 23,500 and 23,400 are the most active put options. So range, short range would be 23,400 to 23,900. That's the reason support for Nifty I have taken 23,200, and resistance, first resistance would be 23,872. That's your 50 DMA. For Nifty Bank, support would be 53,000 and resistance would be 55,000. Some of the stocks that are in focus, Cipla continues to see short covering after the positive analyst call, and also the earnings are almost in line with expectations. Solar Industries amongst all the defense names has been seeing fresh longs, and the fresh short side, Tube Investments is the name, and currently down almost 5%.
Okay, all right. Thanks very much for that, Sudarshan. So that's what's taking place in the F&O space. Just want to point out that Idea Forge is also doing exceptionally well. That stock is up around 9% today, and in fact, it's rallied 38% in the month of May already, and it's up 79% this year. So Idea Forge continues to really forge ahead. So that stock is up 9% today. Well, we do have Rajesh Palvia of Axis Securities joining in on the show to discuss the technicals of the market. Rajesh, hi, welcome to the show. Well, the markets have seen a good surge. The Nifty is back at the high point of the day. What would your intraday call be?
Yeah, hi, good afternoon. So, looking at the recovery from the lower level, we were in oversold trajectory for Nifty in last couple of trading session on the near-term perspective. Nifty almost took support from the 50% retracement of the entire rally which we have witnessed in the April month. Nifty has formed a base at around 23,300, 200 trajectory. Even in the today's recovery, the major put base is added at 23,300, 400, even 23,500 strike. So which shows that, put base concentration is, keeping this downside restricted at 23,400, 23,500 level for near-term perspective. Though call writers have shifted their position at 24,000 strikes. So I think this upward trajectory is now open as we are holding about 23,600. So I think the next upward trajectory for Nifty we may see in the near-term perspective towards 23,850 to 24,000 level. The condition is 23,600 needs to be protected on a closing basis. So if that happens, so I think we may see a 23,850 to 24,000 target for Nifty on the near term. Bank Nifty has shown a very smart recovery from the oversold trajectory, and the kind of recovery which we have seen in most of the PSU as well as in the private banking space. I think here, if Bank Nifty crosses about 54,500 mark, I think we may see short covering action to trigger in Bank Nifty, and then extension of this pullback towards 55,000, 55,200 we may see in the near-term perspective. So at this juncture, those who are already on the long side of trade for Bank Nifty can hold the position, trail stop loss at 53,800 and hold the position. Looking at the recovery, we believe that there would be a breakout in the Bank Nifty also. On the stocks front, I think pharma space is looking attractive. Many pharma stocks have done well. Zydus Life managed to give breakout on the daily, weekly time frame, and the kind of data setup on the derivative front is also suggesting us that this stock has potential to extend gain. So after a long consolidation, there is a breakout on weekly chart. So we are projecting target of 1040, 1050 for Zydus Life. Buy and accumulate would be strategy. On the downside, 955 needs to keep as a stop loss. And from the banking space, I think one can look to buy Kotak Bank. Here we have seen, very stable structure for Kotak Bank, despite of market was volatile in last couple of trading session. And now looking at the buying interest on the Kotak Bank, now it is negotiating with its multiple supply zone on daily, weekly chart. Stock is holding about 20-day, 50-day moving average. So we believe that, Kotak Bank can extend its gain, projecting target of 405 to 410. On the downside, 370 needs to keep as a stop loss.
Okay, Rajesh, thank you so much for joining us. Banking pack really leading the rally that we're seeing from the lows today. So that's the technical check and some picks for you. Time for a break now. On the other side, Manisha Gupta will connect with Sudhakar Desai of Imami Agrotech. The focus will be on India's edible oil sector. Stay tuned for that conversation.
Welcome back. Joining us now on the show is Sudhakar Desai. He's CEO at Imami Agrotech and he's also the president at IVPA. Mr. Desai, thank you so much for joining in. Let's begin with the PM's austerity appeal to the nation on consuming less edible oil to reduce import dependence. As an industry voice, how would you want to react to that?
We certainly, on behalf of IVPA, welcome this well thought out move. While it appears like a simple thing, but if you really see it, the way I see it is, it's a call for a national resilience, not only of economic policies, but also trying to drive the economy towards right behavior of consumption. So I think from Make in India, now the call is more towards demand side discipline, and calibrated consumption. Why? It is much beyond just a lower consumption of edible oil is because we import primarily 5, 6 topmost items. The fuel import bill is nearly about $135 billion. And the next is gold, which is 72 billion. And third, fourth or fifth is 20 billion at edible oil. So I think the move towards conserving foreign exchange and also rebalance current account deficit seems to be the call at the moment. And I think it is. I also look at it as a very advanced advisory, just for a preparedness, just in case there are supply chain disruptions, and we've already seen impact, a little inflationary impact on foreign exchange driven, or whether we say because the crude oil has gone to $114 all the way from $70, I think many things like laminates and packing material, chemicals, coal, energy. So many things have happened, including a slight shortage in gas supplies. So I think it is much beyond just a general call. Geopolitical context being what it is like a food, energy, and currency triangle, which is being addressed here through our Prime Minister's intention to advise the nation with disciplined approach to consumption in gold, which is discretionary spending. We've already seen action of duty increase to 15%, which will also have some impact on reduction of the bill from $72 billion to lower level.
Point taken. After we have seen a hike in import duty for gold and silver, the rumors are floating around in the industry that the edible oil could be the next one looking at a duty tinkering there. What are your thoughts on that?
No, I would not like to comment on rumors and concerns. There will always be an industry driven with speculation. What we've been saying as IVPA is that for the stability of the industry and the balancing between farmer and consumer prices, dynamic duty policy makes it more proactive, more stable. So at the moment, I think if we consider objectively all the inflationary measures in sum total, 12 to 13% in FX and about nearly about 15-20% in international C&F prices of edible oils of palm and everything, and of course rescued by mustard domestic crops. I think high prices are good for the farm oilseed economy, especially the long-term vision being to grow self-sufficiency this is on a longer term or a medium term basis. Government has done what needs to be done in terms of oilseed mission and oil palm. It is now up to the industry and associations, everybody, to take this proactively to increase domestic supplies. So while it is a good thing, high prices or slightly have put mustard seed prices on a higher level, soybean prices on a higher level. But if you overall consider duty increase, I don't think is necessary, if at all, for a relief measures, because the HoReCa is struggling a bit, as we know. A token 5% reduction in duty would be the right thing to do right now.
All right, so duty reduction perhaps is going to be a better thing to do. Mr. Desai, even if the PM's appeal is taken seriously, our edible oil dependence is 65% of our requirement. With everything in place, with all the push that if you think industry can manage, do you believe that a 5% reduction at least in dependence is achievable at this juncture?
Yes, I think we have done some models as IVPA into the future, along with the Agri Department. So we all arrived at a potential opportunity for reduction of import dependency from about 60 to 47, 48% in the next 7-8 years, in case we continue to focus on the mustard seeds, ensuring that the MSP is delivered. That means the prices are supported at MSP, soybeans and groundnut and also oil palm. It is possible to achieve 60% to like 47, 48%. But for that, we need a rapid, accelerated growth in the domestic crops. But on the contrary, I would also say that India needs to buy oil, edible oil. When we talk about the per capita consumption, it's a mix of high consuming population and the low consuming population. 23, 24 kgs is the world average. India's average is about 19. Keeping all this in view, in case currently the per capita consumption even grows and stabilizes around 2021, that's a good call to start with, and then continuously increase domestic production. Otherwise, import supply chain disruptions have not been there. I think every country that has some surplus of edible oil would look towards India for exports.
Mr. Desai, my final question then, and since India imports mostly of its edible oil, the biofuel mandate in other countries, the depreciating rupee, would you say that we are vulnerable perhaps to a lot of global cues, including the rupee depreciation and imported inflation?
The rupee depreciation has really put, apart from the fuel and related product increase, rupee depreciation has put imports, made it costlier. The global increase in prices is also related to fuel, partially because of higher insurance and freight costs, but mainly because about 25-30% biofuel, edible oil going into biofuel, especially in US, in Brazil, Argentina, and mainly in Indonesia. But even then, even if biofuel mandates in Indonesia happen, additionally about 1.5 million tons will go into biofuel. But I think for India, there will always be edible oil supplies. Palm oil being the price stabilizer will continue to be cheaper for India to meet the entire HoReCa sector and applications demand. But otherwise, a combination of soya, sun, and our own domestic crops, I think we don't have any major supply disruptions as yet.
Mr. Desai, thank you so much for joining us with your thoughts. Manisha, thank you so much for taking us through this conversation. Important to understand what's happening with imports of some of the most important commodities into the country as well. HAL's numbers at the bottom of your screen, it looks like a beat as far as the revenue and margins are concerned. 300 basis points beat on the margins at 36.3% versus a poll of 33%. Net profit also has, it's a 1,000 crore beat, 4,184 crore rupees versus almost a 3,200 crore rupee poll. The revenue is also higher by around 800 crore rupees versus the poll. So it's definitely a big beat and the stock had surged to the day's high. We'll get Upasana in just a bit to understand what the internals look like. But for now, it's a strong set versus CNBC TV 18 poll. The internals are something that we'll be tracking very closely. For now, we'll slip into a short break. When we come back, we'll connect with the management of OneSource Specialty Pharma. Stay tuned for that conversation.
Welcome back. Well, for the markets is doing very well now. So we have the Nifty above 23,700. It's climbed to a fresh high for the day. Even the mid-cap index is up around 1% and the bank Nifty is up a cool 875 odd points. So there's a huge reversal in terms of sentiment which has taken place intraday for the markets. But let's now focus on another earnings conversation. OneSource Specialty has seen a sequential recovery in its Q4 numbers. Following the semaglutide launch in India, we have with us the MD and CEO Neeraj Sharma, who's joining in to break down the quarter gone by. Mr. Sharma, thanks very much for taking the time out. Well, it is a Q-on-Q recovery this quarter. How much of it was in fact led by the semaglutide launch in India?
So I think, Ekta, one thing we are really happy about is that this recovery has been thanks to a performance actually by all our businesses. Not only semaglutide, also our base business. Semaglutide specifically, obviously, as you know, that it was launched only at the fag end of the quarter once the patent expired. So while it has contributed, the contribution has been minimal, and we really start seeing contribution going forward in this quarter and beyond.
Okay, so just on that point, what is the impact of semaglutide approvals in Canada for key partners such as Dr. Reddy's on the business?
So I can tell you, Ekta, that this was a highly anticipated approval, as you know, across the industry, not just for Dr. Reddy's or for us, because this was really the first time a generic peptide was getting approved by a major agency like Health Canada or US FDA before that. So the approvals are really very, very positive news for the companies involved, but also for us. And as I said, for the patients who would really get the benefit of access to semaglutide, thanks to the access and thanks to the pricing of generics. So we see really the market of semaglutide expanding in Canada significantly, which is obviously positive for all the companies who will be in the chain to supply that.
So in that case, Mr. Sharma, how much have volumes ramped up for the company, considering that DR has received semaglutide approval and there are launches slated in other markets as well?
So it's a significant ramp up. I mean, it is not just Dr. Reddy who got approval. Even the second approval, which has come in Canada, is also our partner. So we will be supplying both the companies who have got the approvals, and in fact, as we speak, we are currently already supplying for them to launch. And this is a significant ramp up, and right, that this is thanks to the robust visibility of demand which we have for our customers. We have gone ahead and expanded our capacity, and in fact, the first additional line, which is part of our $100 million capacity expansion, is already installed, and as we speak, it is getting under qualification, and will be ready for starting to supply from next quarter onwards. And then one more additional line, which will be coming in towards the end of the year. So while we close FY27, we will have actually 3 filling lines along with their end-to-end assembly capacity and capability, which will be ready. So all this is basis the significant volume ramp up which our customers are forecasting. In Canada for sure, but also beyond Canada, in all the emerging markets which are also have opened and where approvals are expected over the next few months.
Waiting by for those approvals, but so if you could also tell us, how are you placed in terms of margins and what are you guiding for given the current West Asia crisis?
So I can tell you, our business, we have what the guidance which we have given for FY28, which is, top line of $400 billion with a 40% EBITDA. This is basis the mix of all our businesses, drug device combinations, biologics, injectables, and soft gelatin. All will be strong. Very specifically, to your question on on the war right now, and obviously it's not in anybody's interest. It increases the cost of input material, whether it is fuel, whether it is gas, whether it is freight, which gets impacted. So it's not favoring anyone. Only thing I would say is that for OneSource, because all our contracts are actually on ex works basis, so we supply the product to our customers at our factory gates. So it's not really directly impacting us, but it certainly impacts our customers, and which is not, as I said, in anybody's interest. So we really are hoping that this war ends soon, and it can return to business as usual.
All right, Mr. Sharma, on that guidance for FY28 of 40,000 crores organic, 50,000 crores inorganic, what is making you confident on achieving it?
So it's again all around business growth, Ekta. It's certainly our drug device combination business, which is getting obviously the support from all the new launches, whether it is in the largest market of semaglutide globally, which is Canada, coming after US, whether it is Brazil, which is the second largest market today outside of North America. So these markets and number of markets, other emerging markets which will open up, that will be the key driver for our DDC into FY28. But even others, as I said, our biologics business will be a meaningful contributor to FY28, and our base businesses, both soft gelatin and injectables, where in soft gelatin we have the new capacity which came online last year, and we are in the process of filling that capacity. Our injectables business, which we are in for last 20 years, we are adding some new capabilities, which are again pretty unique in the industry, whether in the areas of PFS or in lyophilization. So all this together, which are actually going to be supported by the significant capacity expansion which we have undertaken for our drug device combination business. So all these are coming together to support the guidance which we have given, both in terms of revenue as well as the EBITDA.
Mr. Sharma, then what about FY27? What are you guiding for?
So we have said, right, we have FY27 for us, while we're not giving any specific guidance, but we've also said that you will see a sequential quarter-on-quarter improvement, which would be predicated as the capacity ramps up, as the demand, continues to get serviced. You will see a sequential quarter-on-quarter improvement.
Okay. Well, Mr. Sharma, you have mentioned that, your guidance in FY28 will possibly have a component of M&A on the upper end of the guidance that you've provided. Any kind of M&A that we can expect going into FY27?
So this is, as any smart company, as a CDMO, we would all love to be as close as possible to our customers. So we are always evaluating opportunities to be able to get bigger, better to service our customers.
Okay, all right, Mr. Sharma, thank you so much for joining us with your thoughts and the outlook on the business going forward. That's the word coming in from OneSource Specialty. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and talk about some specific stocks. Stay tuned for that. Welcome back. Above that 23,650 mark comfortably. Now do remember 23,800 is a resistance, so we'll watch out for those levels. Pharma continues to do well. Big surge in Bank Nifty as well. Mid caps too doing well, but underperforming the market. So that's the kind of move we are seeing in Indian markets today. But with that, we'll take your leave on this edition of Halftime Report. Do stay tuned. All the market action up ahead on Business Lunch. A sharp recovery in the currency sees stocks surge to the highs of the day. The Nifty hits 23,700 as all sectors except IT gain. Large caps are currently outperforming the broader market indices. The rupee sees a strong reversal of its declines earlier in the day after a report suggests that the government may cut taxes on bond investments by foreigners. The report fuels expectations of further tax relief to draw foreign investors. Bharti Airtel opts for a share swap to acquire stake in its African arm, dispelling fears of a big cash outflow. And while its fourth quarter results reveal a slowdown in the India mobile business, the telecom company aims to drive up growth, and Chairman Sunil Bharti Mittal promises buybacks or big dividends ahead. And India's wholesale price index for April at 8.3% is sharply higher than expectations of most forecasters of 5.5% to 6.5%. A jump in mineral oil prices is primarily responsible for the rise, even as electricity prices have cooled.
US President Donald Trump and China's Xi Jinping conclude a high-stakes meeting in Beijing. The Chinese president calls for both sides to be partners and not rivals, and also warns of a potential conflict on disagreements over Taiwan. President Trump, who has attended with 30 business CEOs, said that the talks were great. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia, and what a day this has been. A complete turnaround in the last couple of hours for the markets, for a recovery that refused to sustain at higher levels is now at the highest point of the day for the index. 23,700 now on the Nifty, and that is courtesy of a very, very sharp recovery that you have seen in the currency against the US dollar. And that is also on the back of a report that came in that India is planning to cut taxes on bond investments by foreigners. That report led to a very sharp appreciation in the currency, which was at one point on the verge of testing levels of 96, is now back to 95, 75 levels. And there has been a cool off in the bond yields as well, and that has had an impact on the banking names, and the banking names have led the index higher. The Nifty Bank at one point, which was down almost 600, 650 points from the day's high, had moved into the negative territory, was down over 200 points, is now at almost 1,000-point recovery that you have seen from the day's low for the Nifty Bank. 850 points higher now, 1.5% worth of gains on the Nifty Bank, led by HDFC Bank, of course, the primary contributor to the recovery on the Nifty and on the Nifty Bank as well. And of course, the other banks too contributing in equal proportion, but 3% higher on HDFC Bank. PSU banks also contributing with the appreciation or with an improvement or a cooling off in the bond yields. Bank of Baroda, Indian Bank, all of them playing their part as well in this recovery. Now, one stock that I would want to highlight, though, is Bharti Airtel. Comments coming in from Sunil Bharti Mittal from the earnings call, and the fact that he said that he wishes to see Bharti Telecom hold around 51% stake in the company. They currently hold around 40.5%, so promising that, or they will be looking at stake increases in the future, 4.5% higher on Bharti Airtel. And the ambition also is to own more of Airtel Africa in the next few years, promising more dividends, buybacks as well for shareholders. So good going for Bharti Airtel as well. So now the market has seen a big recovery at the highest point of the day, led by the banking names. Of course, there has been no let-off in the sell-off in the IT names. They continue to remain lower. But President Donald Trump and Chinese President Xi Jinping met for 2 hours and 15 minutes at the start of their highly anticipated two-day summit. Chinese President said that the two countries should be partners and not rivals, while Trump said that the US delegation looked forward to discussing reciprocal trade. Meanwhile, Xi Jinping also warned Trump that mishandling the Beijing-claimed island of Taiwan would cause clashes and even conflicts, putting the entire relationship in great jeopardy. Now, post the meeting, the President Trump told the reporters that he had great talks with China. Now, Donald Trump also praised his relationship with Chinese President Xi Jinping and said that he expects to have a fantastic future with China. Listen to what he had to say.
We've had a fantastic relationship. We've gotten along. When there were difficulties, we worked it out. I would call you and you would call me. And whenever we had a problem, people don't know, whenever we had a problem, we worked it out very quickly. We're going to have a fantastic future together. Such respect for China, the job you've done. You're a great leader. I say it to everybody. You're a great leader. Sometimes people don't like me saying it, but I say it anyway because it's true. I only say the truth. And I just want to say on behalf of all of the great delegation that we have the greatest businessmen, the biggest, and I guess the best in the world. We have amazing people, and they're all with me. Every single one of them, we asked the top 30 in the world, every single one of them said yes. And I didn't want the second or the third in the company. I wanted only the top. And they're here today to pay respects to you and to China.
Let's also listen into what President Xi Jinping had to say about his meeting with the US President.
I'm very pleased to meet with you in Beijing. This is your second visit after several years. Our meeting today can be described as the focus of global attention. The world is undergoing accelerated changes unseen in a century. The international landscape is changing rapidly. The world has reached a new crossroads. Whether China and the United States can move beyond the so-called Thucydides trap and set a new example in bilateral relations between major powers, whether we can work together to address global challenges, injecting stability to the world, and whether we can improve the well-being of our peoples and the shared future of humanity, building a good future for our bilateral relations.
CNBC's Elaine Yu now joins in with the latest updates. Elaine.
President Trump and President Xi had wrapped up their bilateral meeting, which lasted 2 hours and 15 minutes, which was longer than expected. The Chinese president said that the two countries should be partners, not rivals, whereas President Trump said that it is an honor to be here and an honor to be Xi's friends. Now, the Chinese president had some strong words on Taiwan, saying it is the most important issue in China-U.S. relations, and if handled poorly, the two countries will clash or even go into conflict. And President Xi said the U.S. side must handle the Taiwan question with, quote, utmost caution. So we'll see what happens to the arms packages to Taiwan that Congress has approved, but is still awaiting Trump's formal notification. Now, on businesses, the tone is a bit warmer. President Xi said China's door of opening up will only grow wider. And joining Trump, of course, is some of the most prominent American tech and business executives, such as Apple's Tim Cook, Tesla's Elon Musk, Boeing's Kelly Ortberg, and also the last-minute inclusion of NVIDIA's Jensen Huang. And President Trump that they are all in China to pay respect to the country and to the Chinese president. And it's interesting to see NVIDIA now joining, as the U.S. has green-lighted its H200 chips by NVIDIA to China with some conditions, but no single delivery has been made. This is according to both Reuters and the Secretary of Commerce, Howard Lutnick, as well, saying that it is because of difficulty securing permission from the Chinese government, which is keen to promote its own domestic alternative. So we'll be watching for any breakthroughs on that front.
Elaine Yu, thank you for that update there. Let's now listen to Sean Rain, the founder and MD of China Market Research Group, and Stephen Roach on what they believe will be the outcome of this historic meeting.
I expect that both sides are going to talk about partnerships and, evading the Euclides trap, because they want to reduce some of the tension that has been apparent for the last year, because America is facing massive inflation, China is facing massive deflation, and it's really because of the political struggle between the two countries. But here's the thing, Ben. What can the Americans offer China right now that the Chinese want? There really isn't a lot. Right? Will China buy NVIDIA chips? Well, the H200 chips are not the best ones. So why would the Chinese want to buy inferior ones? Because at the end of the day, if you were sitting in the CEO suite of a private Chinese company, or in the SOE, or in the government, can you trust the United States? The problem is Trump has no credibility in China. So if Chinese were to buy NVIDIA chips and be built AI on the American tech stack, what happens if 1 year, 2 years from now, Trump or the next president decides to reimpose export controls and restrictions on Chinese buying American technology? So I think the best we can hope for, Ben, is platitudes, nice statements from both sides. And so far, that's what we're seeing. But I don't expect a lot in terms of business above some Boeings and some soybeans being sold to the Chinese.
Now, Stephen Roach, the senior fellow at Yale Law School, says that China might have to live with the levels of tariffs imposed by the U.S. Listening to his views.
I think both sides want stability, whatever that means. They don't want to rock the boat. This idea of a board of trade, I think, is interesting, but highly premature. I think, they certainly want to defer any subsequent actions on tariffs. But, keep in mind, these two leaders have a terrible track record in summits of the past. In 2017, they both met, once in Mar-a-Lago, once in Beijing. They had a great bromance and declared their undying friendship. I think they've learned to live with the level of tariffs they're at right now. They certainly wouldn't be adverse to it. I think what they want most of all on the trade front is no signs of any further increases down the road. They'd be delighted to take some rollback in in tariffs that are being imposed upon them right now. China denies the arms shipments, but they cannot deny the fact that they purchase over 90% of Iranian oil exports, which certainly supports the funding of the war effort, especially at higher oil prices for Iran.
Take a short break. Back with more on the other side. Stay tuned. Welcome back. You know, there are plenty of stocks that are reacting to results. HAL, of course, is one of them that came out with numbers just a few minutes ago. But take a look at the reactions that have been on the extreme end. The positive earnings reactions have been on the extreme, as have been the negative ones. Look at Balaji Amines. Balaji Amines is up 20%. The last time the stock was up 20% was back in 2015. So numbers reported yesterday after market hours. NLC India too, among the top gainers on the broader markets today, almost 16% higher. At one point was up almost 18% as well. And of course, Cipla came out with numbers after market during market hours yesterday, but the stock has received almost 6 upgrades in today's trade after their results, and as a result of which the stock is doing very well today. But take a look at the numbers on the flip side. Kaynes Tech is now down 20%, and that is after the company missed its numbers on all fronts, missed its guidance as well. And Zaggle too, the worst performer on the small cap index, 20% lower, the biggest single day fall since its listing. The one getting smashed is InterArc Building Products, 15% lower here as well. So the earnings reactions have been on the extreme end, be it the good side or the bad side. And DCM Shriram too, not having a very good day today after its results, 4.5% lower. In fact, we did speak to the management of Kaynes Tech on their numbers and of course on the road ahead for the company, what led to this performance during the quarter. Hear out what they had to say.
Communicate, and we were looking for 2 major government contracts where we completed the manufacturing to go, but because of the last minute delay on the contract, we could not go immediately. For as far as the Kaynes Technology India Limited, the parent company, we're already cash positive. In terms of the metering business, you all need to appreciate that the business model itself is like that, but by end of the third quarter, we'll be reversing the trend and we'll be getting into the, I can't say positive, but at least we'll neutral. The industry is looking to grow at about 15 to 16%. We are doubling of that growth. That's what I can share. With the high volatile situation that's around this industry and in India, what is going through, and we are poised to grow in an every growing segment, be it electric vehicle segment or defense segment or industrial business. But at this point in time, rather than telling the number, I would say that we are pretty confident because we have a capacities available, technology available, product available. We'll be outgrowing the market and we are doubling of the market.
So I can put out a flash saying Kaynes is telling us that revenue will grow 30% in 27 and 30% in 28. I would not be wrong.
You are an awesome, and then you are able to interpret the numbers, what I say. Go ahead.
Now, the government has barred sugar exports until the end of September this year with immediate effect. Manisha is here with more details on this. Manisha.
Well, thank you so much for that. I'm looking at sugar today because, one, we have a notification that came in late last night, and that is making an impact not just on the sugar prices in India, but in the global markets as well. India, remember, is the second largest producer, consumer of sugar after Brazil, and those numbers do really have an impact. This is after the Indian government has put out a notification suggesting that they are banning exports till September 2026 for raws, for white, and for refined sugar as well. And this is happening with an immediate effect. There is a caution, though, where it says that they will allow all shipments which are already in export pipeline under specified conditions therein. So why is India banning export of sugar? Well, that is the question we're answering for you right now. We are looking at crop estimates lower than anticipated at 27.5 million tons. Earlier estimates, because of the sowing numbers were so great, were at around 32, 33 million tons as well. But in the last 3 or 4 months, we have had various associations continue to revise it on the lower side. This is on the back of erratic weather, that unseasonal rainfall that we saw, and also because of the lower yields in Karnataka and Maharashtra has made the overall crop number suffer. And then for this season as well, there are El Nino concerns, and that could disrupt the year's monsoon and, of course, the sowing going ahead when it comes to cane. Apart from that, it also is about the closing stock. So when we started this year, it was at around 5 to 8 lakh tons is what the market believed. But now it seems much lower than that. And overall, 15 lakh tons of sugar export is what the government has allowed. But from that as well, it is only about 7 to 8 lakh tons that has been contracted or exported. So you have 6.5 to 7 lakh tons still remaining. And the markets believe that that is what is really going to get impacted. The reaction of this notification from India has been seen in the international markets, where you saw the New York raw sugar prices gained up by 2% and the London white sugar prices gained up by 3% as well. So when you look at the overall Indian exports, and this is what we've done in last couple of years. So this year it was about 8 lakh tons is what we've done till time. That's an estimated figure that we are working with. Last year was 7.7 lakh tons. Government had allowed 10, but India was able to export only 7.7. And year before that, it was nil. The exports for sugar were banned at that point in time. And since then, the last couple of seasons, it has been quota that the Indian government has been giving to the mills there. Also, when you look at the FRP prices there, now I'm coming to the fact that it is not positive for the sugar industry. This is what we've seen in sense of fair and remunerative price increase for cane. This is the price that the sugar mills have to give to farmers for cane. Now, as you can see, in the last many years, it has constantly gone higher. So in the last 4 or 5 years, we've come from 290 to 355 rupees a quintal. But when it comes to the sugar MSP, that has not seen a hike since 2018. In 2017 is the first time that the Indian government allowed that or introduced that. And at that point in time, it was at 29. In 2019, 31 is what was increased to. And 2019 to 2026, there has been no hike in this number. One more thing is about the sugar deficit in the global markets, the reason that you've seen the international sugar prices gain up. So there are reports from Data Growth suggesting that 3.7 million tons of a global deficit is what we are looking at, while 550,000 tons is the number coming in from StoneX. Closure of Strait of Hormuz has curbed around 6% of global sugar trade, but importantly, because of the higher crude oil prices and ethanol being more profitable, a lot of sugar seems to be going in that direction, supporting prices.
Manisha, thank you for those updates there. On to a CNBC TV18 exclusive where Ritu is picking up some inputs related to the TVS Group and Jana Small Finance Bank. Ritu, take it away.
That's right. Nimesh had told us about this first on D Street Chatter right here. And now we've picked up from sources that the TVS Group is looking to acquire a strategic stake in Jana Small Finance Bank of up to 9.99% stake. And this would be through a preferential allotment, with the pricing, of course, in line with SEBI's preferential issue norms. And that would amount to the TVS Group infusing anywhere between 450 to 500 crore rupees roughly into Jana. Now, that 9.99% number is significant because that keeps the investment just below that 10% regulatory threshold. Because remember, for banks, corporates can acquire up to 5% without any prior approval, but anything beyond that needs the explicit regulatory nod first. Corporate shareholding is also capped at 10%. Of course, exceptions are made on a case-to-case basis, and therefore that cap is important. Now, the timing of this could be pretty soon. We've been given to understand that Jana's board is going to take up this fundraise proposal in its May 18th meeting, which has already been notified to exchanges. And once the board approval is in place, the proposal will formally be sent to RBI for its clearance. Now, the capital raise, of course, is going to support expansion and growth for the bank, but keep in mind their capital adequacy is pretty healthy, already at 19.4% for FY26. A quick view, for the viewers in terms of shareholding for Jana, it is pretty diversified. The promoters hold about 22% stake. There are other private equity players as well. TPG, for instance, more than 8% stake, and then you have North Haven and Harbour West Partners that also hold about 2 to 3% stake in the bank.
Ritu, thank you for those updates there. Now, India is hosting the BRICS Foreign Ministers meeting chaired by External Affairs Minister S. Jaishankar. The foreign ministers of the member countries will discuss views on global and regional issues of mutual interest. The escalating crisis in West Asia and its impact on the global energy supply chain are expected to dominate deliberations. Jaishankar opened the meeting in New Delhi with a focus on global stability and the importance of diplomacy over coercion.
Excellencies, we meet at a time of considerable flux in international relations. Ongoing conflicts, economic uncertainties, and challenges in trade and technology and climate are shaping the global landscape. There is a growing expectation, particularly from emerging markets and developing countries, that BRICS will play a constructive and stabilizing role. Economic resilience is also key. Reliable supply chains and diversified markets are its essential components. We must focus on both. Peace and security remain central to the global order. Recent conflicts only underline the importance of dialogue and diplomacy. There is also a deeply shared interest in strengthening cooperation against terrorism.
Let's now go across to Abhimanyu, who is joining in from the Bharat Mandapam in New Delhi. Abhimanyu.
Well, India has opposed all sanctions imposed by any country which have been imposed unilaterally and not in accordance with the UN-led world order. India has also called for dialogue and diplomacy to end the current conflict in West Asia and also several other conflicts which are prevailing in different parts of the world. India has urged all BRICS members to oppose terrorism, including cross-border terrorism. Also, EAM Jaishankar, while addressing the BRICS foreign ministers meeting, indicated that there is an urgent need for the world to get together to resolve all pending issues pertaining to climate change and also to ensure economic resilience, digital access, particularly for developing countries and least developed countries in a world which is getting fragmented due to sanctions which are being imposed by several countries. He also indicated that continuing tensions, risks to maritime traffic and disruptions to energy infrastructure highlight the situation's fragility, particularly in West Asia. He called for safe and unimpeded maritime flows through international waterways, including through the Red Sea and the Strait of Hormuz, even as he called for more resilient supply chains and freer trade through international waterways. So deliberations, of course, are going to continue in course of the day and are going to continue till tomorrow. It remains to be seen whether there would be some significant outcome which would emerge from the meeting, in which several foreign ministers from different countries, including Russia and Iran, are also taking part. Also, he indicated that sanctions are disproportionately affecting developing countries and they cannot be used to substitute dialogue, nor pressure can replace diplomacy. So in a clear-worded statement which has been made by India's External Affairs Minister, he has set the tone for the talks which are going to take place over a course of 2 days, and several foreign ministers and different representatives from BRICS member countries are going to put forth their views.
Abhimanyu, thank you for those updates there. Take a short break. Back with more on the other side. Stay tuned. Welcome back. Now, the U.S. Senate confirmed Kevin Warsh as the next Fed chair, handing him the reins at a critical moment marked by persistent inflation, rising oil prices, and pressure to cut interest rates. Take a look at this report.
The ayes are 54, the nays are 45. The nomination is confirmed.
The Senate on Wednesday approved Kevin Warsh as chair of the U.S. Federal Reserve, putting the 56-year-old lawyer and financier at the helm as the U.S. central bank grapples with climbing inflation that may make it hard to push through the interest rate cuts President Donald Trump has demanded. Warsh will take the leadership baton from Jerome Powell, whose term as Fed chair ends on Friday. He joins a central bank engaged in a debate over the possibility of hiking interest rates amid a spike in oil prices from the Iran war. Warsh's swearing in to the 4-year Fed chair term now awaits final White House signatures on paperwork sent by the Senate. A White House official said Trump, currently in China for meetings with President Xi Jinping, quote, intends to sign paperwork as soon as possible to restore confidence in Fed decision-making. Warsh is expected to be in place to chair the Fed's next meeting on June 16th and 17th.
That's all we have on this edition of Business Lunch from me and the team. Thank you so much for watching. Midcap Radar on the other side.
Afternoon, welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. What a surge. We are above that 23,700 mark. The bank Nifty is contributing to a lot of these gains. Metals are doing really well. Midcaps too are doing well, but you know, in a market like this, we will call them underperformers because they're up just 0.8%. Nevertheless, a green-looking screen. The question is whether this stays on. The stability of such levels is what we'll watch out for.
Good afternoon, Sonal. Absolutely right. Earnings coming in thick and fast. Like you mentioned, banking leading the recovery. And the other sector that's doing very well is pharma pack, led by Cipla and a whole host of other names like Zydus. All of these stocks seeing almost double-digit gains in what is essentially quite a strong market and a strong recovery that we saw intraday. But a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. A recovery in the rupee sees surge near the day's highest point. The Nifty hits 23,700 as all sectors except IT gain. Large caps are currently outperforming key indices.
Cain's tech slumps over 15% as it misses revenue guidance for FY26. The management tells CNBC TV 18 that 2 major government contracts were delayed in the fourth quarter. It also expects to grow revenues at 30% in FY27.
Shares of NLC India zoom in trade as the company's profit nearly triples to over 1,300 crore rupees. The margin also sees a healthy expansion to over 35%.
Zydus Life Sciences announces it will acquire US-based oncology specialist Assertio Holdings for $166 million. The company also says its board will consider a buyback of equity on the 19th of May. The stock surges over 5%.
And shares of Zaggle Prepaid Ocean slump over 18% in trade today as the company's margin misses street estimates and are likely to be under pressure in Q1 FY27.
Okay, those are the top headlines that we are tracking. We'll discuss a lot of these individual names in just a bit. But for now, pharma stocks are doing really well. We do have the metal pack, which has made a comeback as well. And across the board, it is a green-looking screen, barring the small cap index. That should come up for you on the screen. While the mid caps are higher in trade, we do not see that enthusiasm in the small caps as well. So the Nifty small cap index, that is the one which is in the red. Yes, it has recovered, but by a big margin, it is, underperforming the markets as we speak. But this is our segment Mid-Cap Movers. We have Upasna to take us through the mid-caps that are moving around in trade. Upasna.
Well, certainly, Nifty Mid-Cap Index certainly up nearly about 1%. So let us look at the top gainers first in today's trading session. First up is certainly PNB Guilds, one of the key volume buzzers. Volumes as high as 38 times the daily average, up nearly about 15%. Next up is Godrej Industries, up nearly about 10%. Indore Mines is also one of the key volume buzzers today. MTAR Tech, the result rally continues here, and the company has also bagged order worth nearly about 2,200 crores. So we can certainly see the stock surging on the back of that. Bajel Projects also in focus on the back of the order win, which is in the range of 200 to 300 crores, up more than 10%. Now let us look at some of the key stocks that are on our radar on the back of Q4 results. Coming first is the Cain's Tech, certainly remain in focus since the start of the day. It's a miss across the board, and the company has also missed its own guidance and even the street expectations, down nearly about 19% there. Interact Building also down nearly about 14% on the back of its weak Q4. DCM Shriram, again, it's been a weak quarter for the company. Zaggle Prepared overall has reported a good set of numbers, but it has missed the EBITDA margin guidance given by the company. Now, on the flip side, let us look at some of the top losers in today's trading session. Heading is the HFCL, down nearly about 4%, Office down nearly about 6%, Persistent Systems also is taking a hit, followed by Sharda Copchem and Dhampur Sugar down nearly about 6 to 9%.
Well, thank you so much, Upasna, for giving us a neat wrap-up of all of the top movers in the session today. But moving on, Ajit Mishra of Relicare Bowling joins us now on the show. Ajit, good afternoon. Thank you so much for joining us. What a rally we've seen, especially as far as the benchmark indices are concerned. 2 days ago, we were down in the dumps, but recovery yesterday and today we've built onto those gains. Do you feel this upside can continue?
Yeah, good afternoon, Vivek. So definitely, Vivek, because day before yesterday, we were seeing that the range that we were trading in 23,800, 24,500, we saw a decisive breakdown. Nifty almost filled the gap that we have on the daily chart, close to around 23,262, something that we made a low yesterday. And today we are, witnessing a strong rebound, barring IT. All the key sectors are participating in the move. So it's definitely a welcome comeback. But for sustaining this move, 23,800, 900, which was earlier acting as a support, might act as a resistance. So we need to see whether we manage to cross this barrier or not. Otherwise, profit taking may re-emerge. But at the same time, like sectors like banking, pharma, healthcare, metals, and energy is something that wherein we see strength. So instead of focusing more on the index, especially for the overnight trades, stock-specific approach is something that one should continue with.
So what would your stock-specific approach be, Ajit?
Considering the overall buoyancy in this pharma and healthcare basket, Zydus Life, wherein we have seen a fresh breakout in today's session with noticeable surge in the volume. So we anticipate this momentum to further continue. 1070 is what we are eyeing as an immediate target with stop at 960. One can go long in Zydus Life. Then we have metal counter, Tata Steel leading from the front. The stock is at the record highs. Nominal consolidation that we have witnessed in the recent past. Stock is still holding the short-term averages well. So all indications are in the favor that this overall momentum or rebound to extend further. So 240 is what we are eyeing positionally in Tata Steel. With stop at 212, one can accumulate Tata Steel at current levels.
Okay, thank you so much, Ajit, for joining us, giving us a view on the markets as well as your individual trading calls for the day. Well, we'll now slip into a short break. We'll get to the management of Interarch Building Solutions on the other side. Stay tuned. Welcome back to Midcap Radar. Well, individual stocks continue to move quite sharply, the kind of results they're delivering. As far as Interarch Building Solutions is concerned, last time the management met us, they told us FY26, they will see close to 30% revenue growth. So while you're talking about a 30% revenue growth for FY26, Q4 saw just an 8% uptick and margins remain quite flat. Now, to discuss this and more, we are joined by Mr. Arvind Nanda, Managing Director of Interarch Building Solutions. Well, Mr. Nanda, good afternoon and thank you so much for joining us. As far as FY26 guidance is concerned, across most of the parameters, especially the top line, is something that you have achieved of 30%. EBITDA margins is something, it appears as though the street is not very happy. You've given us a guidance of FY27 top line growth of 15%, FY28 top line, the absolute number at close to 2,500 crore. Are you on track to achieve both of this?
Yeah, thank you. I think we are very happy with the results we have got. Instead of 12-13%, we were predicting, we have got 30%. And EBITDA is more or less what we predicted. And for the next 2 years, we are very much on track. In fact, next year, instead of 2,000 that we had predicted 2 years ago, we should be doing nearly 2,200. And then we'll move up to 2,500 going forward. We might revise 27, 28, but that really depends. It depends on our other facilities like Gujarat and Andhra Pradesh coming online this year. But that will only happen by the end of the year. Otherwise, we are very happy with our results. We have crossed all our predictions. We have crossed all our margins. EBITDA is a little lesser than what we thought for a couple of reasons. We've had a one-time hit for the labor code, which we have made full provision for. That is there. Then we've also spent some money on export certifications for US and Canada, which is now on stream. As you noticed in our board meeting also, we have got a JV also now going on for some specialized 100% export unit with a Canadian firm. and a pre-engineered building MOU with them. The export orders are already picking up. So we had to get all those certifications done, and certain professional charges related to heavy structure steels like high-rise and data centers, which we had to take outside help. So that has given us sort of a one-time hit of 4 to 5 crores in the current year. That is why the EBITDA seems a little less, but otherwise we are very well on our track for whatever we have predicted for next 2-3 years, with our plants going to come online in July and August as predicted in Gujarat and in Andhra Pradesh for heavy sectors, heavy structure.
Okay, so Q2 is when a bulk of your capacity will come on stream. Mr. Nanda, you indicated that EBITDA was impacted because of a couple of reasons that you spoke about right now. What is the outlook going forward in this case? Because steel prices are rising, but you are talking about strong revenue growth. But will that flow down to your EBITDA as well? What kind of growth are you looking at here?
Steel prices are passed through, and it's a cyclical thing. It doesn't only go up. Now, next 3-4 months, in fact, the steel prices will start moving down. That's the trend. May, June, July, August, they normally move downward, and we are already seeing that trend. They were a little extra high in January, February, March. But over a 12-month period, we find that it negates any trend as such of going up and down. And we always price it in. We always have margins to price in when we are bidding for the orders as soon as we know the prices are going up. So steel price, while can have a little bit of an effect on a quarterly basis, but on an annual basis, no, because it is ultimately a cyclical thing. So I think our EBITDA margins will be what we have predicted and what we have had. We are trying to improve them, but because we are trying to export, do 2 new lines like exports and heavy structure, so a little bit of extra expense goes into these before the sales actually happen. We have a very good order book, as you might have seen. We've announced an order book of 1,700 crores, which has to be completed in the next 9 months. Then we got another order on May 12th, as you are showing, of 102 crores. That is in addition. So we are very confident that we will meet all our expectations. And I think the market was expecting something else for the last quarter. But we were very clear what we were going to do in last quarter, and we have crossed it. In fact, in the last investor meet, we had told them that we will do 1,850 this year, but we've actually done over 1,890. And EBITDA margins have remained the same in spite of these hits. A little bit of change in taxation also. So PBT is a little, PAT is a little lesser. But otherwise, we are completely on our track. I don't know, I am not a master of stock markets to see. But as a company, we are very thrilled to be doing what we are doing. And the response we are seeing in the market for our product, for our company, and the heavy structures and the exports is very, very exciting for us in the coming 2 to 3 years.
Right. Mr. Nanda, the street is clearly listening to what you have to say. They're clearly enthused by the guidance. A sharp recovery is what the stock price is factoring in currently. Now, you've spoken about the steel price contracts and how over the year it will get negated. What particular aspect I want to, just ask you before we move on to other questions. As far as your contracts are concerned, are these fixed price contracts, or do you have clauses in them that allow you to go ahead and increase your prices in case raw material prices for you goes up? So that is the first question. And FY27, what is the order inflow target that you have?
The steel prices, most of the time we take fixed price contracts. But if it's a longer project, let's say if it's like a 9-10 month delivery, then even the client wants a variable pricing because he can also benefit. You must remember the steel prices move both ways. So sometimes the steel prices are high, the client will say, look, let's do a variable pricing because prices will actually go down by the time you are buying. So it's both ways for longer term orders. Otherwise, we take a flat fixed price and we predict. With our 25 years of experience, we are reasonably well equipped to predict to a great extent what the pricing will be when we will be buying the steel for that. We are in touch with all the steel companies. Many of them give us a longer term pricing also. Unofficially, we tie up with them that for next 3 to 4 months pricing. So steel pricing is something that we can easily look at. The order intake that we want to have in the next, this thing should be around, I would say, 600 crores, 550 to 600 crores, building up to 600 crores a quarter should be our intake. So that is our turnover that we are planning to have. Because in pre-engineered building, you must remember that nobody gives you very long-term orders. 9 months or 10 months is a very long-term order. So whatever we take, we have to more or less complete in a quarter, previous orders. So we are predicting like 1,700 crores in 9 months. So that means nearly 560, 70 crores a quarter we will have to execute in the quarter. And I think going forward, we will probably jack it up to about 600 crores a quarter because heavy structures will also come into play. So we have to take our order book depending on our capacity to deliver. But that is moving up. That is going up quite dramatically.
Right. Mr. Nanda, got that close to 600 crores of execution on a quarterly basis is what you're targeting. Now, yesterday you've gone ahead and announced two very interesting tie-ups or JVs, as you could call it, with ER Steel in Canada. You're saying that you're going to go ahead and target the North American market. A lot of questions come in there. Number one, where will the manufacturing facility be? Will it be here or will you be setting up over there? What will be your holding? What will be the partner's holding? And do you have any orders in place that has gone ahead and made you sign this contract? And give us some financial targets, sir.
This is a completely new item for India. In India, this item doesn't sell. It's called Open Web Joist System, but it is extremely popular in America for their buildings. So this is in great short supply, it seems, in North America. And this company we had contacted last year, ER Steel, for our exports, and they had visited us and our people have visited them. So while we were building up a market for exports of pre-engineered buildings, which was our standard item, they also felt that we are a right partner for them to manufacture and engineer the open web joist system also. So they have tied up with us as a 50-50 joint venture. Manufacturing, design, engineering will be done by us in India. That will be our responsibility. The sales and execution of buildings, if any, will be done by them in Canada and US, of course. Both the countries are covered by them. So that is how the responsibility is divided. It will be a completely new plant because it's a completely different item. In technical sense, it's a different item. So our responsibility remains in India and their responsibility remains in Canada and US. So it's 50-50. We are predicting that maybe in 3 years' time, because it will take a year or so to set it up, but in 3 years, we should build up to the capacity of the plant, which is about 15 to 18,000 tons, which could come up to, say, in 2030, 31. Okay. About 500 crores.
Take that point, Mr. Nanda. The street likes what you're saying. The stock has recovered around 6% from the lows of the day. Confident commentary coming in from the management, and the street is taking note of that. The stock, though, is down around 17% in last 1 week. But yes, it has recovered from today's low. We'll slip into a short break. When we come back, we'll get you more on the markets, talk about some specific stocks. Stay tuned for that. Welcome back. You're still tuned into Mid-Cap Radar. The index is higher, the Nifty, that is above that 23,700 mark, comfortably there, and a lot of moving parts in the markets. It is at the day's high. Nifty Bank is supporting it a lot. So overall, looks like it looks like good going for the bulls for sure. But let's talk about some important update. And well, LRS, or the liberalized remittance scheme limit of $250,000 may temporarily be reduced overall or for select categories. Ritu is joining us with more details on this one. Ritu?
Well, after that gold and silver duty hike, policymakers are evaluating more measures to manage dollar outflows and support the balance of payments because of the conflict in West Asia dragging on and the risks building up. And one of the many items that are under discussion that we here at CNBC TV 18 have been reporting on, we understand there are two active options that are under consideration. One is tightening the LRS limit for non-essential outward remittances. And the second is making Indian government bonds more attractive for foreign investors through tax changes. Now, on LRS, currently, Indians can send up to $250,000 abroad each year, but a large part of these outflows, about 75 to 77%, is non-essential. So that's your foreign travel, gifts, property purchases, equity investments, etc. And international travel alone accounts for more than half of these outward remittances. Now, our sources indicate policymakers can consider tightening these limits to reduce the pressure on dollar outflows. We already have a 2013 playbook where the RBI had done exactly this. And if we do a similar cut from $250,000 to $75,000 and remove the non-essential remittances, we could look at saving $20 billion plus from flowing out of the country. So this is a big measure. The second big area is easier tax for foreign investment and government bonds. Remember, a concessional 5% tax rate for foreign investors that buy Indian government bonds was there. It expired in 2023, and the rate then reverted to 20%. We now understand that there is a view building that a stable, lower tax rate could help attract long-term global capital into Indian bonds, especially as India enters global bond indices. The other options include a special NRI deposit scheme, which is also part of the broader discussion. It's been done many times before, but attracting these flows can be tougher this time around, given the much higher US interest rates. So the focus is on, tax savings and LRS cuts.
Okay, it'll be important to track. Thank you so much for joining us with those details. Of course, it's a possibility. It hasn't happened yet, but important to take note of what could be the possible measures. Let's get stock specific now. Bharti Airtel opts for a share swap to acquire stake in its African arm, dispelling fears of a big cash outflow. And while its Q4 results revealed a slowdown in India mobile business, the telco aims to drive up growth, and Chairman Sunil Bharti Mittal promises buybacks ahead. Listen into a slice of the word coming in from Sunil Bharti Mittal.
We are looking for a very small, controlled financial services business at the moment. If it starts to yield great results and you come back and encourage us to do more, we'll do more. Otherwise, what are we saying? We want to give small ticket lending to our own customer base who we understand deeply well. And we have demonstrated over the last year and a half, 2 years, that lending that we do is significantly superior to the best in class in the industry. And even people like Bajaj Finance and many others come to us to do the LSP program because we identify customers who pay significantly better than the industry benchmark. So there is a clear method behind what we are doing, and the total amount that we are looking at allocating in the next 5 years, we have stated 20,000 crores, of which 14,000 has to come from Airtel. It looks like it will be probably significantly less than that. This Africa exchange of shares that was announced yesterday is akin to acquiring another company of a large size. A $3 billion transaction means you're making an acquisition, and you're making an acquisition of a business that you know deeply well, a business in which all of us are working day and night, adding value. We need to own more of it. And if some other block comes from any other investor to Airtel's attention, we will probably, in the next several years, get to that point of owning more of Africa so that we can get more income flowing back to the mothership, Bharti Airtel, and reward our shareholders even more. And then after giving allocation to all this, if we are still left with more money, as I mentioned, we'll do more dividends, we'll do buyback programs, but we'll never become like IT companies who have done nothing but just taken money out as dividends and buybacks, and they become a shadow of themselves.
Well, that is the word coming in from Sunil Bharti Mittal. Strong words, especially in terms of how he goes ahead and views IT companies. Well, in terms of individual stocks, what is it that they're tracking? Have a look at some of the cable and wires companies. Names like Polycab, that particular stock has now moved to the day's highest point. The other wire and cable company is KEI. That stock too has moved quite sharply to the day's highest points. In terms of some of the stocks that have seen significant selling pressure in the last few trading sessions is the jewelry names. So if you look at names like Titan, that particular stock too has recovered quite sharply and today now moved to the day's highest point. But one of the largest defense PSU names, Hindustan Aeronautics, just came out with its results some time ago. Ria joins in with the key highlights.
Well, yes, we have seen a very good quarter this time around for HAL. Overall, it has been above the estimates that we were working with. The revenue has seen an increase of around 2% on a year-on-year basis compared to an estimate of a 4% decline. And this is likely due to execution being faster than what was estimated. EBITDA has declined by around 4%, but that is compared to an estimated decline of around 17% for the company. Margins have come down to around 36%, but the estimate was around 34%. Margins and net profit has also increased by around 6% compared to an estimate of nearly a 20% decline. This time around, the provisions have declined by nearly 88% compared to the previous year and 50% sequentially as well to just 166 crores. So that has aided the profitability significantly. Material costs have come in higher at around 46% in this year, and other income has also jumped up by nearly 80% compared to the previous year. Even if you look at the full year performance for the company, it has been quite a good set this time around, above the estimates that we were working with, but still lower than the guidance that the company had given. The revenue has crossed around 33,000 crores for the full year, up around 7% versus the company's provisional update of around 4% increase, but still lower than the guidance of 8 to 10% growth for the year. And margins have come in at around 29.5% this time around, lower than the guidance of 31.5% that the company had given this time around. And net profit has seen a healthy increase of around 9% compared to the previous year. Even for the full year, the provisions have declined by around 48%, and that has aided the profitability overall for the company. And overall, the other income has also increased by roughly 44%. The order book remains quite healthy at 2.54 lakh crores as said in the provisional update by the company. And going ahead in the earnings call, we will be watching out for any management commentary on the execution pickup and also the status of the LCA Mark 1A aircraft deliveries.
Well, thank you so much, Ria, for joining us and giving us all of the details as far as the results of Hindustan Aeronautics is concerned. Street likes this stock up by almost 2%. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me, as always, Vinny Motiwala. On the show today, we'll take up all the queries that have been sent by you via SMSs, via social media and other mediums as well. And to answer all those queries, we are joined by Harshvardhan Rungta, CFP Rungta Securities, and Aditya Agrawal, co-founder of Wealthy.in, to answer all those individual queries. Gentlemen, good afternoon. Thank you so much for tuning in. And I think this is one of our favorite episodes as well, because they answer specific queries and that helps the viewers with their investment decisions as well. Harshvardhan, let me start with the first one with you. A. Kumar is writing to us from Chennai. He's planning to invest 5,000 rupees for a period of 10 years. He wants to know the top mutual funds that offer international exposure. There's so much talks about that right now, and of course I know both of you will talk about the limits and what's happening with macros when it comes to foreign exposure as well. But what's your take here, Harshvardhan?
Hi Sonal, very good afternoon. So well, it is a topic which has been discussed time and again, specifically because there are restrictions as to how much an industry can invest overseas. So there is a $7 billion overall mutual fund industry limit which has been breached long ago. And each individual AMC also has a $1 billion sub-limit. Now, what happens is, over time, when an AMC faces some kind of redemptions, they have certain limits which open up to accept fresh money. Now, invariably, you will see that few AMCs will open up for taking lump sum investments for a short period of time. Some will open and accept SIPs over a period of time. So there is a lot happening in this industry where there is no consistency in terms of, if you subscribe for an SIP right now, all you know that after a year or so, the AMC may stop accepting the SIP any further. Nevertheless, there are a couple of options that are available. So in this particular case, Mr. Kumar has just mentioned that he wants to invest internationally. Well, the first step that you will need to take is to understand, or rather shortlist, which region do you want to invest into, which country that you want to invest into. Do you want to get into a thematic or a sector fund for that matter? For example, you'll have several options available which will focus, say, probably investing in the US markets. There's another option available to invest into emerging markets. There is one that invests into Europe. There is one that invests only into Asian countries. There is one which invests only in technology companies of the US. So I think the first step would be to identify which region, which country, or is there a theme or sector that they want to invest into, and then you can shortlist. Now I can name a few for sure. One is that if he wants to invest in the US market, Franklin Templeton is accepting money in the US Opportunities Fund, both as lump sum and SIP. Edelweiss Mutual Fund is accepting only SIP, restricted to 5,000 rupees per PAN per day. And that is open across the different schemes that they have. They have emerging markets, Asian, Europe, US, technology. So these options are available. So I guess Mr. Kumar should first actually identify which country or region he wants to invest into, and there are several options that he can consider. Of course, there are restrictions in terms of lump sums or SIP, but that can be figured out once you know where you want to invest.
Absolutely, Harshvardhan, point taken. First, identify where you want to invest in, what themes, categories, maybe which region as well. That's key to note before you actually jump into which kind of mutual funds or lump sum or SIP. Aditya, good afternoon. What's your take on this as well, and what is your advice for Mr. A. Kumar? 5,000 rupees, 10 years time period. What would you like to say?
So my advice is very close to what Mr. Rungta said. But I would just say that, 10 years horizon, international funds, it's very difficult to predict what will keep taking money. So it's something that can, you will always have to probably look for which other fund is open unless we see a limit getting enhanced. So while it's an interesting idea to diversify internationally, I just believe that it's just difficult to ensure that that allocation to international money is continued. But otherwise, the options that Mr. Rungta said, they are top notch.
Okay, absolutely. Point taken there, Aditya, as well as Harshvardhan, for international funds. But let's move on then to the next query. We have Ravi, who's writing to us from Bangalore, and he has invested in Capital Mind Flexi Cap Fund along with Helios Flexi Cap Fund. He says that he's happy with the performance so far. He wants to know how, if he should actually build 50-50 position in each of these Flexi Cap funds. Harshvardhan, what's your thought coming in on this query as well? How should he go about it? Both the names are Flexi Cap funds and much more recent versus, which we've had in the past. These are much more recent funds that have come in. So what's your story here and what's your take?
This is a very interesting question because, Mr. Ravi says that he has picked the newest of the flexi-cap funds. Both Capital Mind and Helios are very new into the retail mutual fund distribution. So both of these organizations have been known to manage institutional money and offer PMS services. And they're good at it, no doubt. But managing retail money through mutual funds is a very different mindset altogether. Retail investors are not as sticky as probably institutional investors would be. Managing money under PMS and managing a mutual fund retail investor portfolios are very different. So nevertheless, he also says that he's been experiencing good returns and he's happy with both of them. The question is, how much should get allocated towards Capital Mind and how much should Helios? I think both are new in the industry, both are very new in terms of their schemes. And if you're happy with both, I think the common sense would be to simply just invest equally between the two. And there is no reason for him to right now allocate more to say one and less to the other. So I think just maintain that confidence that you have in the fund house as of now and the fund managers, allocate equally to both of them. And probably when they become 1 year or 2 years or 3 years old, that time you may want to see the consistency of returns, not the point-to-point returns. Look at the consistency of returns that they're given in different market cycles and then decide whom should you allocate more or less to. So I think it's a little too early right now. Probably after a year, a 2 year or a 3 year, he'll have a better view on the allocation part.
What about you, Aditya? What's your advice on these two fresh funds? The new funds, actually, new MCs, and there has been an equal investment here?
So equal investment makes sense simply because, these two AMCs and these two flexi cap funds also very clearly follow a slightly different style. Even if you look at the stock overlap, it's not more than 20-30%. So clearly these are two different flavors. And, as we all know, winners rotate. So if I am having these two flexi cap funds in my portfolio, 50-50 makes sense. And as he said, Capital Mind is more a rules-based quantitative kind of approach. And Helios is more kind of, a momentum factor, which they sort of consider. And they, for example, that's where they're also very heavy on new age as well. So these are two very different fund management styles. And, 50-50, if he has chosen these two funds and is comfortable with their recent experience, then, 50-50 is the right split.
It is the right split. Let's go across to the next query. Kaveri writes to us from Kolkata. She wants to know if this is the right time to buy Nifty Midcap 150 Index Fund as well as any contra fund. Aditya, what's your take here? Flows in the midcap category have anyway been increasing. Do you think it's a secular trend from here on?
So it's hard to say, because as we all know, right, that markets have cycles. Sometimes midcap will be winner, sometimes small cap will be the winner. But mid-cap as a part of your portfolio totally makes sense, especially for your long-term goals. But instead of index, because index, what we all know that index is an average. So what has happened in mid-cap index or in the mid-cap space is that while index has fallen X, there are certain stocks which have fallen much more than what the index has seen. And while the valuations are much lower at the index level compared to 10-year averages, for certain specific stocks, it's even lower. So it's a good time to build a sort of your, if you've been waiting on sidelines to start your mid-cap SIP or to build your mid-cap portfolio, it's a good time. But my personal suggestion will be to choose active funds here, whether it's a mid-cap fund from Invesco, Nippon or Kotak Mahindra, simply because, there is, in mid-caps, there's always a better opportunity. Fund managers have a better view of, what stocks, because, mid-cap space is not as well matured as, let's say, a large cap space. So that will be my suggestion on, build mid-cap, but through an active fund.
Can look at investing in mid-cap, but through an active fund. That's what Aditya's take is. Harshvardhan, what's your take on this one? She's looking to buy Nifty Midcap 150 Index Fund, as well as she wants to know on contra funds as well. Your thoughts on both of this? Or would you also say active funds is something much more exciting?
Honestly speaking, if you ask me, I would, in my personal capacity, split my investments in the mid-cap segment between active and passive both. However, coming to Kaveri's question, which is very specific, she has, for whatever reasons, identified an index fund and she finds comfort there. So keeping that in mind, because she's already done that, I would suggest index fund is fine. You can most certainly go ahead and doing this, though there is a lot of merit in picking up active funds as well. However, purely considering what she has already shortlisted, I don't want to disturb that balance for her. Now, coming to the mid-cap space, it's a very interesting space to invest into because the definition of mid-cap and the companies that qualify as a mid-cap now has changed drastically over in the last couple of years. So currently you will see companies with a market cap of 35,000 crores to about 1 lakh crores fall into the mid-cap category. So you have very good quality companies available in the mid-cap space to invest into. So now that also could be could form a big portion of your core portfolio. So as far as mid-cap investing is concerned, I don't think there is any doubt on that part. Now coming to the contra fund that she asked about, the contra fund, the investment objective is to basically invest into undervalued stocks or take a contrarian bet into the market so that when the sentiments turn, you will make exponential profits. Now that's the concept of contra funds and value funds. Now my suggestion is if she is picking up an mid-cap index fund and a contra fund only, then there is something that needs to be thought about, because contra fund could be the third or the fourth scheme in your portfolio, not one of the two schemes that you have. So one could be a mid-cap fund is fine, but if the second fund you have to choose, if contra is the only second fund, then I rather suggest she goes for a flexi cap or a multi-cap fund. And contra fund or value funds can be added as a third or fourth scheme into a portfolio, not the second scheme.
Okay, absolutely. Point taken there, Harshvardhan. But let's move on then to the next query. We have this query coming in from Avinash, who's writing to us from Noida. He says that he's been holding ICICI Prudential Tax Saver, that's the ELS fund, at an average price of around 532 rupees. He says over a period of time, obviously, it's performed well for him, and his capital has almost doubled. However, now, given the changes that have come, on the ELS tax saving schemes, the benefits there as well, and the taxation changes there, he stopped his SIP. So now what should he do with this? Should he continue to hold this investment for the long term and just let it be there? Or advisable maybe to redeem and reallocate into some other funds, into some other categories, or opportunities if there are any? Where should he look at it as well? Aditya, let me take this to you first.
Sure. So it's a great question, actually. I've been personally also going through the same issue of what to do with the ELSS funds. So the way at least I solved it for myself is that we have this 1.25 lakh LTCG tax gain exemption, right? So I leveraged that to first say that, okay, maybe that's an opportunity for me to redeem out of my ELSS. Secondly, I also felt that there was a gap in my portfolio. So I could clearly see that I was light on mid and small in my overall equity portfolio. So I redeemed that ELSS and actually reinvested towards a mid and small. So it's totally dependent on what you have in your current portfolio. If you're missing out on a certain category of allocation that is important for you to drive growth of your portfolio, then probably it's not a bad idea to shave off that gain, take that exemption and then reinvest it towards a particular fund or a particular category that is no longer in your portfolio. So it's a personal choice depending on what you currently are missing in your portfolio.
So Harshvardhan, since the time we have been talking about ELSS and how maybe it is not something that one should look at, since new tax regime is something that everyone's looking at as well. Do you think this category makes sense at all, or as Aditya said, it is a very personal choice?
So, well, Sonal, this is interesting because, see, let's look at investing into two parts. The first one being there was an eligibility of tax exemption based on certain investments in a particular scheme. So you were taking advantage of that, investing money into the ELSS, taking certain tax benefits on it. Now, assuming that tax benefits have gone away, now for this particular case, Avinash has his investments which have been into the ELSS fund. He's getting good returns on this. Now the lock-in period is over because the 3-year time period is done with. Now he has a choice to either treat it as a regular scheme investing into equities, or he has a choice to move this and fill the gap, as Aditya said. Now, if there is a glaring gap in his portfolio, which means that he's missing out on something very clearly in his portfolio, then most certainly he should use this opportunity to get out of this scheme and fill that gap so that his portfolio is well aligned and balanced. In case there is no such requirement of any rebalancing required, then treat this scheme as a flexi cap fund for yourself. Treat it like a scheme that is investing into equities, and you're anyways getting exposure to the market. So what if you're not getting tax benefits? The only downside will be that the fresh investments that he does into this scheme will again get locked in for 3 years. So if he does not want to get his fresh investments locked in, then for sure he should not invest further. But whatever has been already invested can most certainly remain there and treat it like a flexi cap fund rather than moving it around only because ELSS benefits are no more available. So to summarize, Move and remove out of this only if there is a gap in your portfolio. If not, let it be as it is. The fresh investments you need to very carefully think, because if you make any fresh investment, whether or not you take tax benefits, it get locked in for 3 years.
Okay, take that point. For now, we have to take a quick break. We have a lot more queries pending on the other side, so we'll do that after this short break. Welcome back to MF Corner on CNBC TV 18. We still have with us Harshvardhan Rungta, CFP Rungta Securities, as well as Aditya Agarwal, co-founder of Wealthy Inn. Let's keep it going with the queries then, gentlemen. This next query we have is coming in from Sri Vallabh Deshpande, who's writing to us from Telangana. He wants recommendations on mutual funds for someone who's planning to start investing in their early 30s. Harshvardhan, let me take this to you first. What is your thought? What mutual fund should they look at it? Early 30s, normally you say start in your 20s, but start investing at some point of time, even in 30s is fine. Which funds would you look at?
So Vinny, I'd like to answer this in another context. So, the question that has come, what he's put up is saying, which mutual fund scheme should a 30-year-old invest into? So, well, that's exactly the wrong thing to do, is to just ask a generalized question and try and mimic a portfolio. See, let's understand, two individuals who are same age, in the same company, earning the same income, may have different requirements from the financial plan. Let me put it like this. So there is one person who's age 30. He has no responsibility on himself, and his only target is to save for retirement. So a portfolio that will be constructed for this person will be very different. Then there is his colleague who is 30 years old, again, the same salary bracket, everything remaining same. However, the colleague has a responsibility of getting his sister married in the next 2 years. So his portfolio will be very different from person A who has to save only for retirement. So my suggestion is that any individual going into planning for their own finances has unique circumstances which they need to take care of. Do not just mimic somebody else just because somebody, your colleague or your friend over a coffee has said that he's invested into XYZ schemes. Doesn't mean that applies to you, because your risk profile could be different, your goals could be different, your time horizon could be different. So a personalized financial plan would be better than a generic, a portfolio with X number of schemes named. So I'll refrain from giving any scheme names, but my suggestion is I would request the viewer to actually get into his own requirements, list out the things that he needs, the time horizon, the risk that he can take, and then customize a portfolio for yourself.
Okay, take that point. What about you, Aditya? I know it's personal finance, a risk, goal, everything will be very different. But what would you suggest here?
So I would say, so while obviously, what Harshvardhan said, totally agree with it. I made that same mistake as an investor. In fact, that's one of the reasons why I ended up being in the profession that I am. But still, I would still sort of say that when you are constructing a portfolio, whether it is, and I'm taking a horizon of at least 3 years and more. So there are 3 or 4 large categories of mutual funds that you can consider. So one is, of course, your flexi cap. Second is your maybe large and mid. Third is your mid, and fourth is your small, and fifth is multi-asset. So if you are considering to build an active mutual fund portfolio, these are the 5 categories that you can consider to diversify your money. And if it's your first SIP, and it's tied to a long-term goal, of course, the first starting point has to be a flexi cap fund. Now, there are very good flexi cap funds. We just discussed two names that a gentleman has chosen, Capital Mind and Helios. There is, we obviously all know that HDFC flexi cap, Invesco flexi cap, these are funds with long history and have done really well. Similarly, while I would refrain from giving any specific fund names on other categories, but I think the idea remains the same, that we should start by understanding that what all categories are right for my portfolio and for which goal. So if it's a long-term goal, a combination of flexi, mid, small, multi-asset, is something that is what we have typically seen work well for investors when they are starting to build their portfolio in early 30s.
Okay, all right, let's go across to the next query. KS Rao is writing to us from Madhya Pradesh. He's invested a sum of 10,000 rupees in SBI PSU fund and wants to start an SIP in this fund. Sectoral one, what do you have to say, Aditya, here?
So again, same thing, right? So I think one of the favorite questions that I get any party is that which is the best fund to buy these days. So, typically we start from the point of which fund, looking at most recent returns or, whatever theme is in vogue. So I would sort of not recommend someone to say that, okay, if it's their only SIP that they are doing, then it should be, let's say, in a sectoral fund, because, we go through cycles. Sometimes in some thematic, sometimes pharma will do well, sometimes PSU theme will do well. So it can be a very highly concentrated and risky strategy if we are going with just one fund in this scheme. However, if I have a portfolio where my, where my flexi caps are present, where my large and mid are present, and then I'm thinking of starting a PSU focused SIP. See, PSU focused SIP, any SIP is, typically 7 to 10 year horizon. So in 7 to 10 year horizon, whether PSU's theme will continue to remain relevant or not, it's very hard to predict. So I would, sort of not, recommend like a 10-year horizon SIP in a PSU theme, which we don't know how will it play out as the country progresses.
Harshvardhan, what's your take on this as well? He has invested a sum of 10,000 in that SBI PSU fund. So should he and wants to start an SIP in this fund as well? What should he do?
So, if I restrict my reply to specifically what he's asked, so he's simply asking, I'm already invested in PSU fund, should I increase and put more money into this or not? So if that is a very specific question, a very specific answer, within the PSU equity funds, SBI PSU fund is good, and most certainly he can invest further sums if he wishes through via SIP. Now, whether to invest in PSU or not, that he should very carefully listen to what Aditya has said. But assuming that he's made up his mind to invest, then SBI PSU fund is a good fund to invest into.
Okay, take that point, Harshvardhan and Aditya. Thank you so much for joining us today with your thoughts and answering all those queries individually. But with that, it's a wrap on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Most of the indices are trading with a tinge of green. Now, you just saw on our screens a few minutes ago when Donald Trump met Xi Jinping.
I think oil is at about $105, $106 a barrel. So the first rates are coming up. It's 0.6%.
In our revenue, which will be doubling the market growth. The actual numbers depends on the consumption of the customer.
They will be acquiring Assertio Holdings for around $23.5 per share.
Banning exports till September 2026 for raws, for white and for refined sugar as well.
In and around 6% is the margin, which is what we have got.
The TVS Group is looking to acquire a strategic stake in Bangalore-based Jana Small Finance Bank.
And true to script, the markets opened higher, extended their gain.
Revenue growth has been strong at 12%. EBITDA is up 58%.
Revenues are up by over 30%. Profit EBITDA up by almost 2.1 times.
So it's come in much higher than what at least the street was anticipating.
What a surge. We are above that 23,700 mark. The Bank Nifty is contributing to a lot of these gains.
Well, that was the day so far. 1 hour to go. You're watching Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel, and markets are surging. We're up 1.5% on the benchmark indices. The Nifty's at 23,750. And the big news that prompted this surge and recovery in the market is India. There was a Bloomberg report that India is considering a reduction in the taxes paid by foreign investors on India's bonds. But we should pull up the rupee as well, because initially the rupee reacted positively, but the appreciation on the currency is not holding. There you have it, 95.82 against the dollar. So it's lower than the peak, the absolute low that it hit. But as you can see, it's come off from the lows as well.
Well, that's right, Reema. You know, today's session actually is directly opposite of what we have seen in the past. You know, in the past, we were seeing that the Nifty is consolidating and the mid caps, you know, they were doing very well, mid and small caps. Today, if you look at the breadth of the market, it's still pretty much even Steven. But otherwise, on the large cap names, we've seen a big rally. So the Nifty is up close to 350 points right now. The Nifty Bank is up close to around 900 points approximately. And you'll have to see this is still a bit of a relief rally that's taking place, because till the currency stabilizes, well, you'll still be hoping that the FI flows come in, but that Indian rupee moving towards 96 odd, we're due for some measures. Hopefully we hear about that soon, because that's what's causing some kind of uncertainty, Reema.
Yeah, indeed. As of now, we seem to be getting a policy signal, but that doesn't mean immediate rupee inflows into our markets, 95.82. But the strength in the market is holding on, and the Nifty Bank in particular, lots of big movers. You've got Cipla right on top, 8.5%. Adani Group stocks led by Adani Enterprises, 7.5%. Bharti Airtel, we'll discuss that in greater detail. On the banking end of trade, you've got HDFC Bank leading gains. This is a stock which has been an underperformer. It's down more than 20% from the start of the year. But today, it's rebounded quite sharply. That's HDFC Bank. Eternal, too, has had a rough last 3 trading sessions. Today, it's higher by 3.2%, but still for the week, it's down more than 4%. And then you've got other names like Dr. Reddy's, Max, JSW Steel, M&M, ONGC, also higher in trade. But let's find out what the trade should be in the last hour of trade. Mitesh is now joining in for some trading ideas. Mitesh, what's your view on the markets right now? What have you made of the day so far?
So my sense is that I think, the indices have done that pullback, and the level which I had highlighted was close to about 23,750 to about 23,800. We are right there. So if people have long, I think, I would suggest reduce them till we start getting past and closing about 23,800. You have a 40-50 point kind of risk on missing out on this up move, but I think that's worth thing, because in case we fail to do that, we might go back to about 23,500, 400. So that is the outlook on the Nifty.
Stocks?
Yeah. On the stock side, metals are doing well. We had earlier Hindalco as a trade in the morning. I think right now traders can look at possibly in the copper It's come off the highs, but the setup is quite positive. So keep a stop at about 592, targets of around 625 to about 630. And the other one is ICICI Lombard, which is a buy with a stop of 1820, targets of 1885.
Hindustan Copper, ICICI Lombard. Let's talk about Bharti Airtel. There was a conference call today at 12 o'clock. So we spoke about the numbers. The India business was weak. The company has announced its plans to acquire an additional 16% stake in the Airtel business from the promoter entity via a share swap. Now, in the conference call, and I bucketed this on various topics. So the first one on ARPU. Gopal Vittal said that they're not quite happy with the ARPU performance in the current quarter. He said it's partly on account of the West Asia crisis. But looking ahead, FY27, the company is determined on doubling down on ARPUs, accelerating or increase. But, when you hear and listen to the conference call, the takeaway is not that there is an imminent tariff increase. What they are focusing on is more premiumization and converting their prepaid customers into postpaid, which is generally helps in increasing the ARPUs without any tariff increase. He also said that, we would be cautious about hiking tariffs at the lower end, the entry level, the 199 rupee plan at a time like this. And Gopal Vittal went on to talk about the structural problem with India's ARPUs. He's saying that India is perhaps one of those few countries where, despite consuming more and more data, it's not that your ARPUs go up. The ARPUs get capped at a particular point, whether it's 350 rupees or 400 rupees, right? Typically, there should be a progressive increase. You consume more, you pay more. So he says India is one of those countries, and this is a structural problem with the architecture of the pricing in India, where the rich are paying less than what they should be, and the poor are paying perhaps what they ought to right now. A lot of quizzing happened on capital allocation. One, of course, was the Airtel Africa. But if you remember, even earlier this year, the company had announced an NBFC foray. And at that time, the street was worried. So the investor community was trying to get a sense of what their capital allocation plans are. And it's a 4-point program in priority, and it's very clear. First is going to be on the core business, investing in their core business. Second is going to be on deleveraging. Third, they spent a lot of time talking about the adjacencies. So, example, they see a lot of opportunity in India's growing data center business, in the NBFC business, and even cloud. And finally, the fourth one, and this is the order of priority, will be progressively increasing the dividend. So this year's dividend was better than last year. Next year's will be better than this year. And then perhaps a buyback. But, after many quarters, Nigel, even Sunil Bharti Mittal joined in the call. He's usually absent from this. So that was a bit of a surprise. So let's do one thing. Let's listen in to what Sunil Bharti Mittal had to say about the Africa purchase, on the cash utilization, the capital allocation plans, the NBFCs.
We are looking for a very small, controlled financial services business at the moment. If it starts to yield great results and you come back and encourage us to do more, we'll do more. Otherwise, what are we saying? We want to give small ticket lending to our own customer base who we understand deeply well. And we have demonstrated over the last year and a half, 2 years, that lending that we do is significantly superior to the best in class in the industry. And even people like Bajaj Finance and many others come to us to do the LSP program because we identify customers who pay significantly better than the industry benchmark. So there is a clear method behind what we are doing, and the total amount that we are looking at allocating in the next 5 years, we have stated 20,000 crores, of which 14,000 has to come from Airtel. It looks like it will be probably significantly less than that. This Africa exchange of shares that was announced yesterday is akin to acquiring another company of a large size. A $3 billion transaction means you're making an acquisition. And you're making an acquisition of a business that you know deeply well, a business in which all of us are working day and night, adding value. We need to own more of it. And if some other block comes from any other investor to Airtel's attention, we will probably, in the next several years, get to that point of owning more of Africa so that we can get more income flowing back to the mothership, Bharti Airtel, and reward our shareholders even more. And then after giving allocation to all this, if we are still left with more money, as I mentioned, we'll do more dividends, we'll do buyback programs, but we'll never become like IT companies who have done nothing but just taken money out as dividends and buybacks, and they become a shadow of themselves.
Well, that's Sunil Bharti Mittal clearly laying out the capital allocation priorities for the company. The first one is invest in the core business that they understand and expand that pie rather than just going down the road of returning money via buybacks and dividends. That will happen. but that's clearly not the focus area. Devin Choksi is now joining in. Devin, you want to comment on Bharti Airtel, what they had to say about ARPUs, the performance, and the fact that they're doubling down on their investments. And there's always that, that side remark on the IT services business and how that's played out over the last couple of years in India.
Yeah, Rima, good afternoon. Well, a few key takeaways, of course, from this particular con call. The profit dip, I think, is a one-off kind of a thing. If you normalize, probably, I think, 10,000 crore plus kind of a profit the company has made is against, I think, 3,100 kind of one-off item that they have written off. So that way, I think it is quite settled as far as the performance on operating side is concerned. And yes, I agree to that part that I think 300 rupee ARPU is a target in sight as far as I think the current financial year is concerned, from 257 that they have reported in this quarter. So should that be the situation, probably I think their earning along with the efficiency is not ruled out. I think definitely for positive way of looking at it. And I think the larger part of the story which is being told about is Africa. But I believe that I think increasing the stake over there is fine, absolutely. Along with that, I think the currency fluctuations, which keeps on taking its toll once in between, like Nigerian currency, I think taking a toll at this point of time. That could be slightly, I think, a balance sheet impact coming in respective quarters. But otherwise, I believe that I think the business of the company probably, I think, is remaining more steadier and I think highly cash flow generating. That is more important.
Okay, all right. Let's talk about the smaller one, Vodafone Idea. Devin, I recall when the rolls were happening, the stock was, I think, 950 or 960 rupees or thereabouts. And there was indicating that there was some positive rolls. Now, if you look at it, the stock, I think, is up in the last 2 weeks by 25% approximately, around 9.5 rupees to around 13 rupees, more than 25% actually. There is some news about promoter coming in, putting in money, maybe some investor as well, basically doing an issuance. What would you think? Take money off the table or, ride on it for more? Because we've seen this in the past. The stock has done 14, 15 rupees even after the follow-through issue that they did at around 11 rupees. And from that 15 rupees, it saw a sharp correction. So it's a trading bet, take money off, or you would advise investors to stay invested?
Well, Nigel, stay invested would be the right approach because few reasons. Of course, I think it will demand significantly large amount of capital for them to also ramp up the infrastructure, which probably up till now I think they've been deprived of. But more importantly, they are the indirect beneficiary of the entire ARPU increase game, which is happening right now. Reliance probably, I think, would, or Jio for that matter, Jio probably, I think, would be in the vicinity of around 220 to 230 ARPU. Bharti is at premium. They want to, I think, move in the direction of 300 ARPU. Vodafone Idea is a significantly lower at this point of time on the ARPU side, I think, which is 150, 60, which could possibly link up to 170, 80, I think, given the kind of strength that you are experiencing in the marketplace. So they are indirect beneficiary for sure. At the same time, I think if the promoter is putting in the capital and the kind of breather that they have got on the AGR dues, certainly it means that I think tactically, I think this particular idea could move a little bit in a forward direction. And market may probably, I think, want to stay invested into this particular thing. So I firmly believe that I think for this company to report, I think, as a quantum profit, they'll have to be significantly investing. And as such, I think the balance sheet ratios will not be so exciting. But at the same time, I think the market wants some turnaround story. So that is the one which we are talking about.
Vodafone Idea on Saturday, their board will meet and they will consider a fundraise. The question is, will it be the promoters? Kumar Mangalam Birla has already come on board as the non-executive chairperson of the company very recently, just earlier this month. And now you've got this fundraise. So should we tie the two together? Is that a signal or will it be an external fundraise? But in any case, any equity fundraise will be positive for Vodafone Idea, which is looking to raise money also via the bank route, but has been struggling. But let's talk about Pharma. Pharma's right on top, particularly Cipla, 8% up. You've got news on Zydus Life. Ekta's joining in to explain the move.
Well, yes, I'm going to talk about Zydus, which is in focus because they will be acquiring the US-listed Assertio Holdings in an all-cash deal for $166.4 million. It is a US specialty oncology company. CY 25 sales stood at $68.23 million. The acquisition will be via tender offer followed by a merger of Zydus' arm into Assertio. Eventually, it will be delisted from the NASDAQ. And the deal multiple is estimated at around 2.4 times EV to sales. The portfolio includes a cancer drug, Rolvedon, which is basically expected to, have IP protection till 2039. Market size around $1 billion. The analysts say that this particular drug could capture around 15 to 20% market share. The acquisition could also help scale up Zydus' other specialty oncology products, and overall, it should be helpful in terms of making strides in the oncology space. It's likely to be EPS accretive by 4 to 5%. Remember that Zydus is also considering a buyback on the 19th of May, so that stock is in focus. Cipla is one of the top gainers on the Nifty today. That is because the India-Africa business did well, so it offset the weakness from North America. And they do get some amount of growth from the licensed products, say, for example, from Eli Lilly's obesity drug, which they licensed in India as well. Now, the guidance, they're estimating margins of 18.5% to 20%, and US business should hit around $1 billion is what they've said for FY27. So the US run rate should increase from $155 million in this quarter to $250 million going forward. Brokerages seem to be positive. JPM has upgraded the stock to overweight. Citi has a buy, target price is raised. HSBC has a hold.
Okay, thank you very much for that, Devin. Cipla, buy the move or it's run up too much in one day?
No, I think it may have run up. I agree that I think a lot of confidence is also coming in because of the launches that I think they are probably having in the pipeline and could give them significantly large amount of upside. If FY26 was one of kind of a situation, I think due to the Middle East, I think in the profits, I believe FY27 could possibly be showing relatively much smarter and healthier growth. I think it's probably one of the most defensive company in pharma, if I may have to call it as, because I think the downside in the stock price, I think, is definitely protected. And the upside, I think, given the kind of strength of distribution and the product that they have and the new launches that they are talking about, I believe that I think a relatively much safer company to bet on. So yeah, maybe market has reacted today positively. Maybe some price correction. It's a good to go again and add into the portfolio.
All right, Devin, I request you to stay with us. I wanted your view on Keynes. Remember, that's the management that joined us in the final few days of the March quarter. And they had said that they were confident about meeting their guidance. However, the company's gone ahead and missed their guidance in quarter 4. Though the management spoke to us here earlier today on CNBC TV18, and they said they expect their revenue growth to be twice the industry growth in FY27. Let's hear out that bite and then get Devin's opinion on this one.
We did communicate, and we were looking for 2 major government contracts where we completed the manufacturing to go. But because of the last minute delay on the contract, we could not go immediately. For as far as the Keynes Technology India Limited, the parent company, we're already cash positive. In terms of the metering business, you all need to appreciate that the business model itself is like that. But by end of the 3rd quarter, we'll be reversing the trend and we'll be getting into the, I can't say positive, but at least we'll neutral. The industry is looking to grow at about 15 to 16%. We are doubling of that growth. That's what I can share. With the high volatile situation that's around this industry and in India, what is going through, and we are poised to grow in an every growing segment, be it electric vehicle segment or defense segment or industrial business. But at this point in time, rather than telling the number, I would say that we are pretty confident because we have a capacities available, technology available, product available. We'll be outgrowing the market and we are doubling of the market.
So I can put out a flash saying Keynes is telling us that revenue will grow 30% in 27 and 30% in 28. I would not be wrong.
You are an awesome, and then you are able to interpret the numbers, what I say. Go ahead.
All right, Devin, what's your view on Keynes? You know, they're talking about industry growing by 15%, but the industry is growing at least 22 to 25%. So if they have to do 2x, then they have to grow at 40-45%. But the problem is deeper. The order inflow was lower than expected. It was only, I think, it was down around 60 to 70% on a sequential basis as well as on a year-on-year basis, but they're sitting on a good order book. So you'll pardon them for that. the operating cash flows came in at a negative 600 crores. And that's the worry, because they assured the street that they'll get that problem fixed. What's your view? Will you view this metering business and all as one-off, and that's why, they couldn't move into the black with regard to cash flows? And then that's why you'll say, okay, the stock has come down. Or would you say, just stay away, let them deliver, then you'll get in?
Yeah, I think that would be a better approach. I think let them deliver. Simply because I think currently the valuations, even though today it has corrected sharply, I think, but the valuations are never cheap. I think these EMS businesses, I think they run at an expensive valuation, and they practically do not assume any kind of margin of error in their stock price. So from that perspective, if you look at it, I think the stock has justifiably corrected given the kind of fall in the operating numbers. However, I would like to believe, even though I think they may not grow at 30-40%, but I would like to believe that I think they hold the strength to grow between 20 to 25%. And if they sustain at that level of growth, probably I think they deserve to be looked at a lower levels. So as of now, I think we find that many of the EMS businesses are, I think, expensively traded, and we don't want to immediately jump into it. This year is likely to be even challenging on the margin front as well for most of these companies. And that's where we would like to wait for the opportunity to buy this kind of companies into the portfolios.
All right, Deven, thanks a lot for that. Not jumping in, investors are jumping out today. The stock is down close to around 19% in today's trading session. I believe there were various references to our interview here on CNBC TV 18 as well earlier today. Stock down close to around 19%. Let's focus on the F&O action then. And one positive actually today is after around 4 to 5 trading sessions, finally the Nifty has made a higher high. So that's pretty good. We have come off a little bit from the top, but we're still holding at around 23,700. And if you pull up a chart, that'll tell you the picture out there. On a day-to-day basis, we were making lower highs, and that trend has actually broken today. So the Nifty is now at around 23,700. Good. The India VIX, that was showing signs that it could move to around 20 odd. That would not be very, very great, because remember, the VIX is the fear index. It gives you a sense in terms of volatility in the system. That's cooling off by 4%. I like that. So that's something that's moved according to the plan from a bullish perspective. And the Nifty Bank actually on the way down was a big underperformer. It's still trading way below, some of those daily moving averages. But today's session, it's clear. It's come for a bit of a short covering bounce because the index is up 800 points and you have the open interest that is lower. And after a while, we're seeing the put writers, they're coming back into play. And that's why the PCR has moved back up to around 1.2x or thereabouts. We were highlighting this yesterday itself, that there is a reason that we could see a bit of a bounce because the PCR had come down to around 0.65. That was on Tuesday, I beg your pardon, on expiry day. Now, today, the put writers, they have come back into play. 23,400 put. The premium's down to around, I think, 72 rupees from around 193 rupees. 23,500 put as well. The premium has come down to around 90 bucks from around 240 rupees. So the put writers, they are back into play. They'll want to defend the recent low. On the call side, though, there's a mix of activity. Now, the strike that comes up for you on the screen is 23,750 call. So I've got the direction right, and the premium has moved up. At the start of today, it was around 100 rupees. That's moved to around 175 rupees. But at the low of today, it was around 72 rupees or thereabouts. So there was a sense of call buying earlier today. But now it appears that it's writing at those particular levels because the Nifty is going to face very, very stiff resistance at around the 20 DMA. That's close to around the 24,000 odd mark. So just keep an eye out on that screen. 24,000, that's what the 20 DMA is at. You're having a relief rally today, but that's going to be a resistance mark. And the key reason the Nifty Bank actually has popped up is because HDFC Bank, that saw a bit of a correction. It's clearly coming for a big short covering bounce. Stock up 3%, open interest down by close to around, I think, 20% or thereabouts. Crumpton Greaves as well, there was some shorting that was seen in the system. There's very speculation on this particular counter, but that as well has come in for a bit of a short covering bounce with the stock up close to 2%. And you'll argue about some of these exchanges, BSE as well as MCX. They have moved one way, but there is a good amount of delivery-based buying and there is some long build-up as well. So there is fresh buying that we're seeing on MCX with the stock up 4% and open interest up as well. Net, a good relief rally is what we're seeing, but the 20 DMA is something that the bears will want to defend. On the downside, the 23,200 mark now becomes a bit of a reference zone on the downside. Well, we'll slip into a short break. On the other side, though, we have Surendra Goel of Citi who's waiting for us. Stay tuned for that chat. Welcome back. Markets still holding up with a gain of close to around 300 points. The Nifty Bank is up close to around 800 points. The problem is the advance and decline ratio is yet again getting closer to each other and at higher levels at around the 23,750 mark. The Nifty seems to be hitting a bit of a resistance zone. The good news is higher highs have been made today. On that note, let's welcome Surendra Goel, Head India Research at Citi, who joins us on the show. Hi, Surendra. Good afternoon. Good to see you in. Well, Surendra, before we get to talk about markets, what are you making of the macro setup? You know, fuel prices have moved up. The rupee is weakening as well as of now. And there are fears that maybe, in fact, we're seeing a hotter than expected summer. And maybe the monsoon may not be as good, which in turn will result in food inflation. What are you making of the macro setup here in India?
Yeah, hi, good afternoon. Thanks for having me on the show. So obviously the macro setup has turned more challenging. Okay, and a lot will depend on the resolution in the Middle East situation, because oil prices are obviously a big part of what we are talking about, the currency, etc. Everything is a function of that. And of course, El Nino and hotter summer, rainfall, etc. All of that will also pose some near-term challenges to inflation. We just put out a detailed note on that, and India, over a period of time, the dependence has come down as far as the rains are concerned, and to that extent, the impact may be less. Also, the last couple of years, monsoons were pretty good. But again, that's again another unknown that is there. So obviously, the macro situation has been tougher in the last couple of months, and a lot will depend on the resolution of the Middle East situation, and that's what really the markets are looking out for.
Do you expect the rupee, though, to stay at these levels at 95, 96? Or do you expect, I mean, what are you telling your clients when they ask you about the currency and ask you to share your expectations? What's the advice? Because a lot hinges on the way the currency moves from here on.
Yeah. So firstly, that's a question for the economist. But I'll anyway kind of broadly answer that. Like day to day, obviously, these variables are very difficult to call. But I think what is a challenge is the setup, as I said, like if oil prices continue to remain higher, then there is going to be pressure. So to that extent, it comes back to the point that I had mentioned earlier, that I think a resolution is what the street is watching out for. And I think what happens towards that is what is going to be important as far as the rupee view is concerned. For like in terms of forecasts, very specific forecasts, like we have obviously seen a very rapid depreciation driven by the global factors. So to that extent, I think like really no point trying to say what it's going to do tomorrow or next week. I think what is important here is that the key variable we know, and I think one needs to keep a watch out for that.
So let me ask you, Surinder, on the IT, the tech sector, a sector which is close to your heart. You've looked at it very closely. Now, of course, you look at the other sectors, but in the early days, you had a laser focus on tech. What is your assessment?
Yeah, so we have been cautious on the IT services space for like, say, last 4 years or so. Okay, and it started with very high valuations like 4 years back. We are coming out of COVID, growth rates were strong, valuations were very high. And we just thought that the growth rate that the market was extrapolating was not sustainable. And then over a period of time, obviously valuations did correct. But in the last couple of years, the additional issue to deal with has been AI and the impact of it. Still early days there, but that's what obviously a lot of concerns are around. And then on top of that, the industry has become more fragmented and competitive in the last 5-10 years. A lot of the smaller players who, say 5 years back or 7 years back, did not participate much, say in the $50 million deal category, today they are very competitive. So clearly the market has gotten more fragmented. And then on top of that, you have the GCC boom post-COVID, where GCCs have been growing faster, and one has to keep in mind that they play into the same enterprise IT spend budget. So you have multiple factors, with obviously the biggest one being competitive intensity and impact of AI. And on top of that, the narrative has been pretty challenged as well, because we are seeing announcements from both the AI services companies regularly, like every week, every 10 days, we see an announcement. And that kind of creates more uncertainty. And what investors are really struggling with is questions like, what is the medium-term growth rate of the sector, what is the terminal growth that one should be building into valuation models. And that is where you have seen the sector really underperform quite substantially in the last few years. And then you have global peers who are trading significantly lower in terms of valuations compared to the Indian names. So that also kind of creates some concern that the global names are substantially cheaper. So are the current multiples justify, or there is a risk that they could still go down despite the significant correction that we have seen over the last few years?
So still cautious in IT?
Yes, we are still cautious. In India's strategy, we still have an underweight on IT services.
Okay, got it. Surendra, what have you made of the earnings season so far? Because ultimately, it all boils down to earnings, right? Q4 results, what do you make of it? And given that Q1 is going to be challenged, if I dare so say, even the first half of this fiscal actually could be a very subdued one. We'll have monsoon season, you'll have the impact of higher input cost as well, and there is uncertainty all around. What are you penciling in terms of earnings for this year?
Right. So on earnings, so far, this quarter has turned out to be broadly in line. We just looked at it earlier this week with roughly 55% of BSE 100 companies having reported at that time. And EBITDA growth was around 9% year over year, which was in line with our expectations for the same set of companies. So I would say broadly in line. Of course, there are sectoral divergences. We have seen some strength on the consumer side. We have seen some challenges in other sectors, etc. But broadly at an aggregate level, so far earnings have come in line with expectations at almost kind of just about double digit or closer to double digit kind of a growth rate. You are right. I think this quarter, the impact was really only for 1 month, and that too, given that it was early days, the impact would have been very limited. So we really need to watch out for the June quarter earnings. That is when you could see the impact of the current geopolitical situation reflect in the numbers. As of now, the bottom-up estimates for earnings are still in, say, low to mid-teens. That's the growth rate that the team expects. But obviously, there are risks which are difficult to price in or quantify. If we go back to the last couple of periods where oil has been $100 plus on a sustained basis, we saw earnings growth moderate to mid to high single digits. So clearly there is a downside risk as far as earnings are concerned. But again, I would highlight that the market has been nervous around this factor for a while. And to that extent, while the earnings weakness could potentially happen, but I think what is more important is watching out for the resolution of the Middle East uncertainty. Because the moment that happens, and the next few months, the market will start looking at FY28 earnings, kind of realizing that FY27 did have some factors which may not necessarily be recurring in nature. So that's how I would really think about earnings, how they play out, and how should one look at earnings from a market outlook perspective.
Sorry, coming back to IT. This week itself, IT has lost about 7%, and particularly zooming in on AI. Do you think the launch of these enterprise services platforms in companies by OpenAI and Claude are seriously going to dent the IT businesses, Indian IT companies? That includes even a GCC, for instance. How big a risk do you think this week's developments are?
Yes, it's too early to have a very clear view on some of these developments. I think even at this point of time, even clients have not really used them as much. So to that extent, it's difficult for anybody to have a strong view on how much the impact could be. But the way we think about it, I think it definitely increases the fragmentation in an already competitive market. If you think about it, today there are so many relevant players and market growth has been pretty muted. So that itself was already a challenge, and then you have a new set of players entering who will definitely try to be aggressive and capture some part of the market. So I think the competitive intensity goes up further, and to that extent, it's an additional headwind to deal with. Quantifying it at this stage is very difficult, given that it's very, very early days of whatever has been announced.
Okay, all right, Surendra, always good to hear your thoughts. Thanks a lot for stopping by. Wishing you a good remainder of the day, and we look forward to chatting up with you soon. You've been underweight IT space, and you're saying you'd rather stick to that call. And top of mind is going to be the cooling off or some kind of pullback with regard to this war that's underway in the Middle East. Thanks for joining in. But let's turn our attention then to one of the top stories of the day. And our colleague Ritu is picking up some details on some possible balance of payments measures that could be on the cards, given the weakness that we've seen in the Indian rupee. Ritu, over to you.
Nigel, good afternoon. After that gold and silver duty hike, policymakers are evaluating more measures to manage those dollar outflows and support the balance of payments because of the West Asia conflict dragging on and risks building up. Now, of the many items under discussion that we here have been reporting on, we understand that there are two active options that are under consideration. The first is on the Liberalized Remittance Scheme, or LRS. That's the RBI framework which allows Indian residents to send up to $250,000 abroad every year. Now, a large chunk of these outflows, somewhere between 75 to 77%, go towards what policymakers classify as non-essential spending. So, your foreign travel, gifts, property purchases, equity investment, and international travel alone, by the way, accounts for more than half of all our outward remittances. Now, sources tell us that policymakers are evaluating whether to tighten this limit, and there is a playbook for exactly this, because in 2013, during the tantrum, taper tantrum, the RBI cut the LRS limit from $200,000 at the time to $75,000 to ease pressure on the rupee, and a similar move today, our sources indicate, can potentially keep more than $20 billion from leaving the country. So that's a big one to watch out for. The second one, of course, is, as we reported earlier, the easier tax on foreign investment and government bonds. Now, remember, a concessional 5% tax rate for foreign investors that are buying Indian government bonds was there. It expired in 2023 and then reverted to 20%. We now understand there is a view that, a lower tax rate can help attract long-term global capital into Indian bonds, especially as we're entering global bond indices. Other options, including the special NRI deposit schemes that have been used before, they're also part of the discussion, but that looks tougher at this time because attracting these flows, will mean that banks have to offer much higher rates, given the higher rates in the US as well.
Thank you very much for that. We will get into a break. That's the big story. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few trading ideas. Stay tuned. Welcome back. Let's talk about the last trade today. I'm sure they're a happy lot with the kind of up move, though we've slipped a bit from the day's high. That intraday move will come up the last 10 minutes. Today is also the BSE Sensex weekly expiry. Nimesh is now joining in to get us an insight. Nimesh, what's the street excited about?
I remind it looks like it's a short covering rally. It's not like it's buying across the board, or for that matter, even today, in fact, in a good market, the breadth is not that strong. A lot of mid-cap names are actually down in today's market. So the rally is largely led by short covering. I guess in anticipation that the government will announce something, some measures with regards to some relief on the for the FPIs on equities on the tax side. That's been the big reason why you've seen a very sharp short covering rally in today's market. You're very close to that very crucial resistance of 24,300 on the upside. If that gets taken out, I guess there could be further short covering rally in the very near future. So that's the overall feedback. Despite the IT index down 1%, the markets are rallying. So that's one leg which is pulling the markets down. The index is down 1%, but a lot of individual names within IT are down 4-5%. So that leg is clearly seeing selling pressure. As I said, the breadth is quite neutral, and there are many stocks which are reacting negatively as well in the broader markets to the earnings. So Interarch is down 11-12%. Sharda Cropchem is locked at 20% down circuit in today's market. So clearly not everything is buzzing in today's market. As I said, the big anticipation is that government will announce something, some sort of a relief for the FPI investors. So that's the big reason why we're seeing this up move today. So need to watch and see. But I guess today there is selling from the larger FIs, and the breadth is also not that strong in today's market.
Got it. Okay. All right. Nimesh, thanks for that. In fact, Interarch actually has come off a little bit from the lows. The promoter entity were up their guidance for the coming year. So I think it cut its loss a little bit, but it's still down close to around 10% approximately. What about other individual stocks you're tracking?
So the first stock on my list today is Aditya Birla Capital. That's been up in today's market. Actually, it's almost at 52-week high. And there has been buying as well, but the street is anticipating some corporate development. A potential fundraise is something which the street is anticipating very soon. It could be a combination of both a preferential as well as a QIP. So watch out for that in AB Capital going forward. The second name is Bharti Airtel. For second day running, it's been buzzing in trade. Even yesterday, it was a big move and on large volumes. My sense is that one domestic PM is an active buyer, and hence you're seeing that big move of late in Bharti Airtel. And the last is IIFL Finance. It's been in the news for whatever reasons. Even yesterday saw a big rally and then sold off. There was a large block as well yesterday. Even today, the volumes on the higher side. Looks like the selling pressure from a leading long-only fund is largely over with today's supply. So watch out for large delivery volumes for second day running in IIFL Finance.
Got it. Okay. All right. Thanks a lot for that, Nimesh. Let's hop across to Mitesh. Mitesh, welcome back on the show. Guess what? The markets have come off a little bit from the top yet again. So you'll have to say it's just a relief rally, at least as of now. Is the structure still weak? What would your trade be on the Nifty, as well as fill us in with a fresh couple of calls?
Yeah. So, Nigel, I think as I said earlier as well, I think, this is a market which will have to cross this 23,750-800 zone, and we got a high of 23,777. At the beginning, they should also advise to take profits on the long positions, because once you cross it, I think there will be a lot of strength. But this is an important level. There's the moving average over there, there's a gap area over there, and the first retracement. Looking at all these things, I think, that's the level to watch out for. In case we don't, and I'm assuming that since we have not crossed it yet, I think the market should do some consolidation between 23,800 to about 23,350 thereabouts, and that will be the trading range for next few days. And therefore, trading would be more of stock-specific basis. I have BTST on Indus Tower with a stop at about 418. Look for targets of 428 to about 430. And JSW Steel, slightly off the day's high, but the structure is positive. And disclaimer, I also have given a call on sister channel Money Control. So I'm sure there will be people who would have taken the stock as well. But around the same levels, I'll give a call. So 1297 BTST with the stop at 1288 for targets of 1315.
Okay, all right. I'll be speaking to the management, and we'll have them tomorrow morning on Bazaar as well. They come out with this set of numbers. JSW Steel expected to report an improved performance on a valuation parameter. It's a relatively more expensive stock from the Ferris pack, but keep in mind their execution has been rather good, and the return ratios as well a little bit better than some of their peers. So that's why they're commanding those sort of valuations. We'll keep an eye out. I think in the next 60 minutes the numbers should come out. Siemens India, that's the stock that's gaining in trade on the back of strong results from the parent entity. The management on the earnings call has also indicated that the growth in India has beat expectations. Vinny joins us to fill us in with a quick analysis on that one that's popped up 4.5%. Vinny?
Hi, afternoon. So like you said, right, we had the important con call highlights that came in from Siemens AG. That's the parent company. What did they say about India now? 2-3 points they made. They said the India revenue grew by 21% on a year-on-year basis during this March-ended quarter. Analysts were expecting 6-7% growth in that India story. So now
we're seeing such a strong growth that's come in here. Apart from that, they spoke about acquisitions. They said they're positive on the India story. They said we look at acquisitions. If there is any opportunity, they would be happy to look at it as well. And they find a lot of opportunities that is there in India. They also highlighted the previous acquisition that they'd done of CNS, which was in somewhere around in 2020. That was on low voltage acquisition. So they said they're open to more opportunities, more deals that could come in around the sectors as well. Now, Incred, overall, when you look at it, they said this low voltage, they said this market in India is highly competitive, limited commodity price pass-through that comes in, and restricted addressable market that is there. But because of all this, they believe that they prefer Siemens India versus Siemens Energy. I beg your pardon. They prefer Siemens Energy versus Siemens India as of now. But Siemens India, at least strong commentary that's come in there, and that is why the stock is buzzing.
Got it. Okay. All right. Thanks a lot for that, Vinny. Well, time for an earnings roundup then for the fourth quarter. Balaji Amines, that stock has popped up in trade. NLC India as well is zooming ahead, while HL, I think, the numbers were a beat, but I think that stock has come off a little bit. Vivek joins us to help us out with a quick detail on all these numbers. Vivek?
Well, that's right. Very strong reactions that we are seeing to a lot of earnings that came in overnight, as well as HAL that came in just a couple of hours ago. When you're looking at Balaji Amines, even though the revenues were higher by just around 12%, EBITDA up very strong, almost 58 basis points higher, over 700 basis points jump as far as EBITDA margins is concerned. Profitability higher by 60%. Company saw some shortage of ammonia during March, which actually went ahead and improved in April. Now coming to NLC India on an expanded base, higher capacity, strong execution, as well as good commissioning that the company saw in the second half of FY26. The results went up very well. Revenues higher by 31.5%. EBITDA up almost over 2 times. Profit margins jumped up over 1,000 basis points, and the profitability higher by 3 times. Remember, the company also has indicated that as far as the NLC India renewable arm IPO is concerned, they have received the approval from the Government of India. It's going to have both a fresh issue as well as an offer for sale of shares. And lastly, coming to HAL, well, numbers optically look to be a beat. Revenues higher by 2% versus an estimate of a 4% decline. EBITDA down 4% versus an estimate of close to 17% decline. Profitability higher by 6%. Margins down 235 basis points versus at 36% versus an estimate of 34%. But internals do indicate that a lot of the EBITDA improvement could be on account of provision write back. It will be interesting to see the internals there, and that also could give some indication as to why the stock was cooled off after the immediate pop it saw, so post the results.
Got it. Thanks, Vivek, for that. Well, Zaggle Prepaid, in fact, has hit a lower circuit after reporting the fourth quarter numbers. Let's go across and listen in to what their executive chairman had to say to us earlier today on their new acquisition as well as the guidance going ahead.
So, I want to tell you that it's one of the best acquisitions what we have done. Okay, it's about 100 plus people, fully trained on AI. We are looking at number of contracts which we are signing up on a constant basis, which we have not accounted for, in this quarter, which will get accounted for in the coming quarter. So that's the only difference. So it is fairly in and around 6% is the margin, which is what we have gathered.
Sudeep Bandupadhyay, market expert, joins us on the show. Hi, Sudeep. Sudeep, what do you make of this one, Zaggle? I did that interview actually earlier today. And the management also, I probed them. I said, you all have always been interested in increasing your shareholding in your own listed company. It is at around 44%. And he went candidly and told me that he's checked with his company secretary and the cooling off period is on 18th. So from then on, there could be some action. But the stock is down close to 20%. The street doesn't like the negative operating cash flows, which was around 50 crores. They've done that acquisition DICE, which in turn will reduce margins. And then no guidance on margins. So that's why street didn't like it. What's your take?
Well, Nigel, when you are quoting at such a high valuation, the margin of error is absolutely not there. And that's exactly what happened with Zaggle Prepaid. The stock was moving up continuously, and even before the results came out, the stock was continuously moving up. So the margin, coming at where it came was definitely a disappointment. Inability of them to give a guidance, till Q2 of FY27, which is what the company disclosed, was also a bit of a disappointment. So naturally, the market has beaten the stock down. I will be a little wary buying into the stock, taking opportunity of this correction. I'm sure management is very confident, and I heard them that they want to buy and they want to increase their shareholding. It's very good sign. But at this stage, I'm not that confident of going and recommending a buy.
What about Keynes Technology, Sudeep? Is this a stock that you hold? There were so many people bullish on Keynes Technology, and the company is delivering well. It's just that it's fallen short of very elevated expectations, and plus it's expensive. Would you give the company 1-2 quarters before you buy in, or today's the dip to buy?
Well, I will give it 1 or 2 quarters. Look, I think the problem is pretty similar. When some of these stocks are quoting at a valuation which is absolutely stratospheric, the margin of error is absolutely not there. And whenever there is a little bit of disappointment, you will get to see the kind of correction and disappointment which we are witnessing in some of these counters. EMS is a space where pretty much all the companies quote at a very, very high valuation. So obviously, the moment there is a disappointment, the correction is also very, very sharp. But having said that, we do believe in the EMS space. We do believe there is a long-term potential. We do believe that from an investor with a long-term view, it may be a worthwhile space to look into. We do like Sirma and we do like Dixon. At this stage, we will not recommend Keynes.
Got it. MTAR Tech, what do you do with a stock like this when it goes up one way? It's just moved from strength to strength, and this morning as well, it's won a big order. I think in this week, the stock is up 27%. In this month, it is up close to around 45%. Wow, for all those shareholders who have the stock, they'll be very happy. But what should they do? Take some profits? And for a new investor, when does he get in?
Well, I kind of tend to agree with you, Nigel. I think if I was, unfortunately, I'm not. If I was an investor, I would have taken some profit. And if I had to buy this stock, I would have waited in the sidelines and waited for some kind of event to give some correction and an opportunity to enter. There is absolutely no doubt that the company is going to do well going forward. There is absolutely no doubt about their order book and continuous opportunity of gaining new orders. Yeah, all that is given, but the valuation and the way it has gone up scares us a bit, and I won't recommend a buy at this stage.
Okay, got it. I'll tell you what, Sudeep, we will have a couple of more questions for you. For the time being, we'll slip into a short break. We'll come back. We'll post a couple of questions to Sudeep. We'll also wind down the markets, which as we speak, have come off the top, but still, the screen is green. Stay with us.
Welcome back. 5 minutes to go. The Nifty is hovering around 23,700, not at the day's high. The high today was 23,777, but still ending with a smart gain of 300 points in the Nifty. Sensex up nearly 800 points. Sudeep, a lot of other stocks were in focus. So whether it's NLC India, Vivek was just talking about it. MTAR Tech has been on a tear. The stock is up 200% year to date, 400% in the last 1 year. Idea Forge is seeing buying. For Bajal projects, there is news. Any stock that you'd like to highlight on the mid-cap end of trade, which you're interested in?
Well, I think one stock which stood out today was Zydus. I think their acquisition in the oncology space definitely strengthens the company. What is interesting is they also talked about buyback, which they will decide in the coming days. So overall, I do like pharma and the way the pharma industry is, Indian pharma is shaping up, and I do like Zydus Life. I think many of these companies are restructuring, and working their way to get into a different orbit. And I am pretty confident that Indian pharma is getting in a space where Indian IT was 20 years back. So the quantum leap is going to come very soon.
Okay, all right. Sudeep, you have been positive on Vedanta, right, in the past, and I think you like the aluminium piece. Now it's a bit of a bonanza that's come in there for shareholders. And I'll tell you why. The stock, on the last day was somewhere around 750, 770 rupees, I think so, on Vedanta. We here at CNBC TV had explained the stock, I think, around 720 as well, 1 week before it went through that demerger process. Now, those shareholders, they're already sitting on a stock which is worth 340 rupees. And that is only the holding company of Hindustan Zinc. What would your advice be on Vedanta Limited? Listed at 290, went down, I think, to around 270. In a matter of 10 sessions, 270 has become 340. And it doesn't have any big core business, but it's the holding company. Your take?
Well, look at what is happening to Hindustan Zinc, what is happening to zinc, what is happening to silver. I mean, it's like hitting a lottery. So as far as Hindustan Zinc is concerned, zinc is touching all-time high, silver is all-time high. The duty imposed by Government of India on gold and silver imports again helps the realization of silver. Hindustan Zinc, 50% profit comes from silver. So I think it's a Goldilocks situation for Hindustan Zinc, which in turn kind of benefits Vedanta Limited, the holding company. And there's absolutely no wonder why Vedanta also went up. Of course, the real excitement will be when all the other companies get listed. Let's see what happens to aluminum piece, because in between, aluminum also has gone up, and I think that's going to be a fantastic listing. There will be some benefit as far as the oil and gas part is concerned as well. So a lot of interesting things happening, and I think the sum of parts, when we actually see all the companies listed, it is going to be significantly higher than that 720, 750 levels, which Vedanta had reached prior to the demerger.
Got that. Sudeep, do you own, or any of your clients own, any IT stock?
Well, some of our clients do own Persistent and Coforge. We have been advising them to get out of the large cap IT companies, and most of them have been come out of that. But Persistent, Coforge, and some amount of Tata Technologies also are there in the portfolios.
And the call on these three is to continue hold on despite the weakness that we keep seeing in the names.
For the time being, you're absolutely right, because these are specialized technology companies catering to niche segments. And we believe the segments which they're catering to have significant potential. Coforge is also trying to pivot towards AI in a big way through acquisitions. Persistent, Tata Technologies, again, are a niche player. So we are still hopeful of their growth post this period of turbulence.
Always a pleasure hearing your thoughts, Sudeep. Thanks a lot for stopping by and giving us all of those views. By the way, keep an eye out on the bottom of your screen. The NI growth for Hudcos looks pretty okay. And that's why the stock has moved to the high point of the day. So we're up close to around, I think the stock is up close to 2%. Well, for the markets on the whole, it was a pretty good trading session. Some green, the bulls will take. You have close to 300 stocks that are advancing in today's trading session. And from the Nifty pack itself, there were a lot of large outsized winners. Leading the pack was Adani Enterprises. The stock was up close to 9%. Beautiful move out there. Cipla was up close to around 8%. So big move out there as well. Bharti Airtel, extremely positive commentary, and that stock in fact was up close to around 5% in trade today. Eternal was another name that was up close to around 3%. And giving Cipla a company on the upside with a gain of close to around 3% was in fact Dr. Reddy's in trade today. HDFC Bank, that one got its act together, and that did bulk of the heavy lifting in today's trading session. So with that one moving up, that definitely helped the Nifty, one of the top gainers on the upside. On the losing end from the Nifty, well, there were a few stocks. Tech. Infosys, Tech Mahindra, HCL Tech, all those stocks in fact were declining in today's trading session. You also had TCS as well that was under pressure in trade today. Well, the other stocks that lost out from the broader markets were some of those earnings disappointments. Interarc, the stock did come off a little bit from the lows because the management here on CNBC TV 18 sounded quite optimistic about the future, but the earnings reaction was negative. Interarc should come up for you. Stock was down 12%. Zaggle, there was no way out. The stock was down 20%. The street didn't like the negative operating cash flows. On Keynes, the street didn't like it at all. That in fact they promised at the end of March that they'll be meeting their guidance. It was very, very far from it. And remember, it's an F&O stock, so that's why it fell more than 20% in trade today. The other couple of names that did do well were Zydus Life, stock up and about. Solar Industries, the stock continues to re-rate, big move up there. And MCX as well was up close to around 5% in today's trading session. Giving it company on the upside was Siemens. Net, a good trading session for the bulls. The biggest positive today was that the Nifty made a higher high after close to around 5 trading sessions, as was the case with the Nifty Bank. But you'll want the breadth of the market to be a little bit better than 1:1 on a day that the Nifty puts on a triple century. Well, on that note, we'll wrap up on this edition of Closing Bell. You stay with us. Markets Forward comes up next.
Markets extend gains for a second straight session. Nifty closes above 23,650. Broad-based buying lifts most sectoral indices, while IT remains a sole laggard. Meanwhile, the rupee slides to a record low of 95.96 against the dollar.
Earnings-led action continues on the Lal Street. Bharti Airtel's Q4 numbers signal a slowdown in the India mobile business, but the telco looks to revive growth. Kaynes Tech misses its FY26 revenue guidance, while Cipla sets its sights on crossing the $1 billion sales mark in North America.
United States and China vow constructive, strategic and stable ties as Donald Trump meets Xi Jinping in Beijing. Trump heaps praises on Xi, who says equal consultation is the way forward. White House says President Xi expressed interest in purchasing more American oil to reduce dependence on the farmers.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear you up for the next trading day. I'm Ekta Batra, and with me is my colleague Ritu Singh. Well, it turned out to be a session where we did manage to recoup a lot of the intraday weakness that we saw. So we had the Nifty, which ended close to the high point of the day. It ended at around 23,689, and the mid-cap index did well with a gain of around 1%. Advanced decline ratio in positive terrain, along with the Bank Nifty, which gained over 650 odd points. So overall, a good day of trade. The rupee also managed to recover on an intraday basis.
A good day of trade indeed. Hi, Ekta. And the rally being led by the pharmaceutical sector that did particularly well in today's trade. IT, of course, was the laggard. But apart from that, almost all sectoral indices ended up in the green after what was a fairly volatile day. There was a fair bit of recovery that we saw in the second half. So apart from pharma, metal space, financial services, banks, they all saw some recovery in the last couple of hours. But over the next few minutes here, we've got you covered with all of the big news, the key developments, the top corporate voices and events to track ahead as well. So, let's get to it. Here's the lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Hormaz Fatakia, from Airtel to Kaynes Technology and HAL. Earnings will take center stage today. We also decode the key numbers in just a bit. And last and not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So that's the setup for you. Let's kick it off with Hormaz Fatakia, who's walked over to the wall to get us the top movers and shakers.
You know, it was a day of two halves, if you could call it that, because of the first half of the session, around about till 11 o'clock, there was absolutely no sign of the market sustaining at higher levels. But after 11 o'clock, the only thing that the market did was sustain at higher levels. And with closing at the day's high, the bulls will be happy with that. And now, of course, the big contribution from this recovery came from the banks. And HDFC Bank was the primary contributor to this recovery, 2.5% higher on the stock as well. It was a significant recovery from the lows of the day as well. That is something that needs to be taken into account. Bank of Baroda, Bank of India, Indian Bank, the latest inclusion to the MSCI, that too played their part in this recovery. Of course, while banks played a part in the recovery, there was absolutely no relief for the IT names. They continued their sell-off. The IT index is down 7.5% now this week. Persistent Systems was down 4.5%. LTM, Infosys, Tech Mahindra, all of them contributing to the losses in today's session, or so you could say, kept the gains in check. Had the IT index participated today, the index could have been a lot higher than where it eventually ended. You take a look at the result reactions though. They are the ones that have been on the extremes. Balaji Amines was up 20%, and the last time the stock was up 20% was in 2015. Saregama ended 15% higher. NLC India ended 14%. Kaplan Point had a good day, ending with gains of around 10% after its results. Now take a look at the negative earnings reactions as well. Kaynes Tech ended 20% lower, as did Zaggle, and Interarc was also one stock that was smashed down 12%. Quality Power too ended with losses of 10% after its results. So negative earnings reactions too were on the extreme. Take a look at the newsmakers. Sharda Cropchem also is a result reaction, ending 20% lower in today's session. Cipla, of course, after the multiple upgrades that the stock received on some positive management commentary, ending 8% higher. Zydus Life, multiple news flows here. ending 5.5% higher, and PNB gilts after the news report of the government possibly considering a cut in bond taxation also had a 16% advance on the back of that report. And lastly, stocks that did very well and continued to move higher at record highs now. MTAR Tech is now up 200% this year, another 12% added in today's session. RR Kabel recovered from the lows of the day, as did Sterlite Tech, and BSC, the market cap now crossing 1.5 crore and also at a record high in today's session. Back to you guys.
All right, Hormuz, thanks very much for that. Let's get to the top story this evening then. Bharti Airtel has opted for a share swap to acquire stake in its African arm, dispelling fears of a big cash outflow. While its Q4 results reveal a slowdown in India mobile business, the telco aims to drive up growth. Reema's here with the key takeaways from the telco's earnings call.
So some interesting takeaways coming on ARPU, the Bharti management acknowledging that ARPUs in the current quarter were a bit disappointing, partly on account of the West Asia crisis, and they're doubling down on improving and accelerating ARPUs from here on. But the way they're going about it is not necessarily a tariff increase, especially at the entry level. He said at a time like this, we would be cautious of increasing prices. They are looking at premiumization and conversion of prepaid to postpaid, which is generally higher ARPUs. But you know, in the call, Gopal Vittal also highlighted a structural problem with India's ARPUs. He says India is one of those countries in which the ARPUs are capped. Basically, with increasing data consumption is not that the ARPUs go up. So we're a country in which the rich pay far less than what they should be for mobile data consumption, but the poor pay what they ought to or what they should be. So, he was just saying that, the structural problem, this is the structural problem with India's ARPU. In the call, they were also quizzed a lot about capital allocation, and he said that there are 4 key ways in which we will prioritize capital allocation. The first one will be investment in core business. That's basically the India business, the Africa business. Second, deleveraging. Third, and he spent a lot of time, Gopal Vittal, talking about the adjacencies. So whether it's data center, the NBFC, the cloud business, and then progressively on dividend and, returning cash via the buyback. But after many, many quarters or years, I must say, I saw Sunil Bharti Mittal on the Bharti Airtel conference call. So listen in to what he had to say.
We are looking for a very small, controlled financial services business at the moment. If it starts to yield great results and you come back and encourage us to do more, we'll do more. Otherwise, what are we saying? We want to give small ticket lending to our own customer base who we understand deeply well. And we have demonstrated over the last 1.5 to 2 years that lending that we do is significantly superior to the best in class in the industry. And even people like Bajaj Finance and many others come to us to do the LSP program because we identify customers who pay significantly better than the industry benchmark. So there is a clear method behind what we are doing, and the total amount that we are looking at allocating in the next 5 years, we have stated 20,000 crores, of which 14,000 has to come from Airtel. It looks like it will be probably significantly less than that.
All right, let's bring in our guests on the show. We are now joined by Sudeep Bandyopadhyay of IndiTrade Capital and Richard Jain of Motilal Oswal Financial Services. Gentlemen, thanks very much for your time here. Sudeep, to start with you, your view on this telecom space, what you made of Airtel's commentary and the earnings, and also what's happening on Vodafone with Kumar Mangalam Birla coming back on board, talks with the lenders on potential capital infusion and whatnot.
Well, definitely an interesting space to watch as things stand now. Unfortunately, the ARPUs haven't moved up the way the market expected it to move up. And we all knew it, that the ARPUs haven't moved up. Having said that, I think there is significant scope for ARPUs to move up for all the 3 players, whether it's Bharti Airtel, Jio, as well as Voda Idea. With Voda Idea really languishing around 150, 60 levels, there is a significant scope for their ARPUs to move up. Also, Mr. Kumar Mangalam Birla coming back as chairman, non-executive chairman, as far as the signal is concerned, it's an excellent signal to the market. Let's wait and watch and see what they announce as far as capital raise is concerned. If there is a further commitment coming in from the Birla Group, I think that will be excellent for Vodafone, and the kind of longevity and sustainability of Vodafone. There will be no more questions if that happens. We'll have to wait and watch and see. Even otherwise, I think Vodafone Idea at these level, the kind of changes which is happening does look a better bet than what it was a few months back.
Okay, all right, Richard, but would the technicals tell you the same, that maybe Vodafone Idea looks like a better bet than it did some time ago, and your call on Bharti as well?
Yeah, I think the momentum has been shifting now on the positive side as far as Vodafone Idea goes. Because after a long period of time, the price up moves have been supported by good volumes, indicating a buying interest, coming in again in the stock. Previously, last time when we witnessed such pullback move in the month of November, December, 2025, we saw that the stock resisted around the 12 and a half mark, from where the stock corrected up to 8 rupees. Now that level has been surpassed. I think we should see a continued momentum probably towards 14 and a half odd kind of levels. But yes, Bharti interest looks more interesting because of the risk reward ratio that has after the recent corrective phase. The prices have already seen a correction from that high of around 2200 to 1750, and downside seems to be limited from current levels, as these are the long-term support levels for Bharti. So in terms of risk reward perspective, one has to take a positional trade within the segment, then Bharti should be preferred.
Okay, all right. So Bharti would be preferred. But the entire pharmaceutical space was in focus. Zydus was in focus because they will be acquiring a US listed company, Assertio Holdings, in an all cash deal for $166.4 million. It is a US specialty oncology company. CY25 sales stood at around $68.23 million. The acquisition will be via a tender offer followed by merger of Zydus's arm into Assertio, and it will eventually be delisted from the Nasdaq. The portfolio includes a cancer drug called Rolvedon, which is US FDA approved. So the cancer drug has IP protection till 2039, market size $1 billion. Analysts say it can capture 15 to 20% of market share. Acquisition might help scale up Zydus's oncology drug as well in its portfolio, and would basically help them get inroads into the specialty oncology space. It's likely to be EPS accretive by 4 to 5%. Remember that they're also going to consider a buyback on the 19th of May, so that would be another key factor to watch out for. Cipla is in focus. It was up 5% today. It was on the back of commentary coming in from the numbers. In fact, it ended with a gain of around 8% odd. India and Africa basically offset the US decline. We had North America, remember, which was down 26%. And also guidance is that the EBITDA margins would be at around 18.5 to 20%. And the US should probably hit $1 billion in terms of sales. So the quarterly run rate should increase to around $250 million versus $155 million. Brokerage is positive. JPM has upgraded the stock. Citi has a buy. They've raised the target price. HSBC has a hold on the counter. So that's on Cipla. Sudeep, Richard, would you have a call on a couple of these pharmaceutical stocks, how they did technically? Because they seem to be far more resilient as compared to the market. So what would your call be?
In fact, the entire sectoral index has given a breakout. If you look at the Nifty Pharma index, last 1.5 to 2 years, it was just consolidating in the range, which seemed to be a time-based corrective phase. And this week itself, we have seen a good follow-up move from this couple of years of consolidation. I think the sector as a whole should do well going forward. Within this space, the names which you just took within that, I think Zydus Life Science looks quite interesting on mid to longer term charts. The stock has already gone through a decent time-wise as well as price-wise correction in last 1.5 to 2 years. And the risk-reward ratio seems quite favorable over current levels for a good trended up move. Cipla, I think we have seen some short covering move in last couple of sessions. We have seen one unwinding of open interest in the future segment. So after that short covering, whether we would see fresh buying in the counter, that needs to be seen. So I think the follow-up move would be important to watch out in Cipla.
Okay, and Sudeep, any call on, pharma stocks? It was a top sectoral gainer for the day, and, Cipla Zydus doing exceptionally well. And also, on the other hand, the IT pack, that was the big loser of the day. Any calls on these?
Well, as far as pharma is concerned, I did like what Zydus has been doing. I think the acquisition of the onco specialized company definitely will give them a leg up in US oncology market. Also, the buyback is an interesting announcement. Let's see what exactly the contours of the same are. But we do like Zydus at current levels. That's definitely one. As far as IT is concerned, I think my view continues to remain the same, that we are yet to see most of the AI related just begin. Every week is being announced and coming from the AI players and AI majors. And this is, probably somewhere we are 10-20% of the development we have seen. We still to see 70-80% more. So it's better to wait and watch and see who can cope up with the developments and who can kind of take benefit of the AI. It's still not clear. So it's better to avoid overall IT.
Okay, avoid IT is the call. But hold on, gentlemen. Let's look at more numbers because it was an earnings-heavy day. HAL, Keynes Tech, they all reported their fourth quarter numbers, and Devyani is joining us with a wrap of those.
Well, let me start with Zaggle. Now, this was a margin miss. Management had guided for anywhere between 10 and 11% for EBITDA margins, but the actual margins came in at 9.7% for the full year FY26. In fact, in quarter 4, they were even lesser at 9.4%. Revenue came in at 618 crores, up 50% since last year, while reported EBITDA came in at 58 crores, up 64%, and PAT was up 30.5%. Next up is Keynes. Now, this was a miss across the board. Revenue, EBITDA margin, and PAT were all below CNBC TV18's poll. Revenue came in at 1,242 crores, up 26%, while EBITDA was up 15%, with margins dropping to 15.5% this time around. And PAT, as a result, was down 21% at 91 crores. Next is HAL. Now, HAL had a good set. In fact, it was above what the street had estimated. Revenue was up 2% year on year against an estimate of 4% decline. Now, that was on the back of better execution or rather faster execution than was expected. EBITDA was down 4% versus an estimate of 17% decline, while margins were down 235 basis points year on year to 36% versus an estimate of 34% margins. As a result, net profit was up 6% versus an estimate of a 19% decline. Now, last up is NLC India. Now, that was a strong set. Now, revenue was up 31.5% to 5,042 crores, with EBITDA coming in at 1,774 crores, up 2.1 times since last year, with margins expanding to 35% this time around. Net profit, as a result, was up 2.9 times to 1,394 crores. All in all, a strong set from the company.
Okay, all right, Devyani, thanks very much for that. Sudeep, any of these companies that you've looked at from the broader markets and you like?
Well, NLC numbers were pretty good, definitely. And understandably, there's a tailwind behind the sector now. So definitely it has been in our radar and we will continue to keep it. As far as the companies which declared results and were beaten down, I was pretty disappointed, honestly, with Zaggle Prepaid. There were a lot of expectations around the company. In fact, even recently, the company was continuously on upper circuit and moving up. But the margin of error at such high valuation isn't there. And I think the moment the disappointment on the margin front was disclosed, I think the market punished it. And that's why we have seen it where it has to come today. I won't recommend taking the opportunity of this fall and buying. Let us understand before we take a final call on this stock.
Okay, Ruchit, quickly on Keynes, that was also a big laggard today. The street clearly didn't like the guidance in the earnings. Do you see a buying opportunity there?
Not really, because even when the markets were doing good, the stock was showing a relative underperformance. The recent pullback in the month of April was not supported by good volumes. And now on the post numbers, what you've seen that the down move has been supported by very high volumes. So the stock going up without volumes, correcting with high volumes, these are clearly signs of underperformance that can continue going ahead.
Okay, all right, Ruchit, as well as Sudeep, we're going to thank you on that note. Thanks very much for joining in, taking us through all of those stocks in focus today. We'll take a short break, but we'll be back with all of the key market events to watch out for.
Welcome back. Here's our top global story for the day. Chinese President Xi Jinping welcomed his American counterpart President Trump at the Great Hall of the People, where he was greeted by a large military entourage and dozens of children waving flags. Trump was joined by a huge delegation from his administration that included U.S. Secretary of State Marco Rubio, U.S. Trade Representative Jamieson Greer, and War Secretary Pete Hegseth. Top corporate names, including Tesla CEO Elon Musk and NVIDIA CEO Jensen Huang, were also in attendance. Both of the leaders also likely discussed the war in Iran, the contentious Taiwan issue, artificial intelligence, and trade between the two nations. President Xi assured that China's door will open only wider to American businesses. He added that American firms will have broader prospects in the country. Meanwhile, President Trump described the bilateral talks with the Chinese president as great. He lauded the relationship between the two countries, calling it better than ever.
All right, and before we wrap, here's the key market events to watch out for. Ria is standing by.
Well, let's go through the key events to watch out for in tomorrow's trading session. In terms of economic data, we have the industrial production data coming out of the US that will be key to watch. And in India, the trade balance data as well as the foreign forex reserves data will be closely tracked as well. In India, the earnings season continues. We have Adani Enterprises, Balrampur Chini Mills, Cochin Shipyard, Hindustan Copper, NCC, NHPC, Power Grid Corporation, SAIL as well as Tata Steel, which will be reporting their results tomorrow. In other events, Trump will be visiting China on his visit will continue until the 15th of May. The BRICS foreign ministers meeting in Delhi also continues until the 15th of May, and the Prime Minister of India will also be visiting the UAE, Netherlands, Sweden, Norway as well as Italy between May 15th to May 20th. And also finally, Fed Reserve head Jerome Powell's term will officially end tomorrow as well.
All right, Ria, thanks very much for that. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates.
非常崇敬乔治华盛顿总统，那么这些人
当时就向美国捐赠了一个石碑，就是为了纪念华盛顿总统。目前这个石碑已经镶嵌在华盛顿纪念碑里面，石碑上刻有当时的一名中国官员形容这一名伟大的将军和政治家，他们把他称为人中豪杰。
And across the centuries, this mutual esteem grew into a relationship that reflected the tremendous talent and potential of our two people. Chinese workers helped lay the railroad tracks that connected our Atlantic coast to the Pacific. American travelers to China helped spread literacy and modern medicine. And at the request of China's ambassador, it was President Theodore Roosevelt who provided the funds to establish President Xi's alma mater, Tsinghua University.
在过去几百年当中，这种相互的尊敬已经成为了一段全新的关系。这段关系可以说反映出我们两国人民之间巨大的潜力以及我们的努力和智慧。中国工人当初帮助美国建设了我们的铁路路轨，连通了美国的大西岸和太平洋沿海地区。美国当时早期出访中国的美国人也帮助中国提升了识字率，并且引入了现代医学，并且应时任中国驻华大使的请求，罗斯福总统也专门提供了资金，成立了习主席的母校清华大学。
As allies in World War II, President Franklin Roosevelt's mentions of the brave people of China, that's what they were, drew loud cheers in his speeches in the United States, and everybody loved what he had to say, just as many Chinese now love basketball and blue jeans. Chinese restaurants in America today outnumber the 5 largest fast food chains in the United States, all combined. That's a pretty big statement.
那么，作为二战期间的盟国，罗斯福总统在美国的多次演讲当中提到了勇敢的中国人民。正如当前许多中国人非常喜欢篮球和穿蓝色的牛仔裤，在美国目前的中餐厅的数量要比美国前5大快餐连锁店的总的店面还要多。
This bond of commerce and respect that stretches back 250 years is the foundation for a future that benefits both of our nations. The American and Chinese people share much in common. We value hard work. We value courage and achievement. We love our families and we love our countries. Together, we have the chance to draw on these values to create a future of greater prosperity, cooperation, and happiness, and peace for our children. We love our children. This region and the world, it's a special world with the two of us united and together.
那么，至于商业当中的纽带以及我们的相互尊重，可以说追溯到250年前，是我们将要构建的未来的基础。这一未来将会惠及我们两国的人民。美国人民和中国人民有许多的共同点，我们都崇尚劳动，我们都崇尚勇气和成就，我们都非常爱我们的家庭，我们也爱我们的国家。我们两国一道，我们将有机会基于我们共同的价值观，创造出一个更加繁荣、基于合作、幸福、和平的未来，为我们的子孙、为本地区以及全世界造福。
Thank you again, President Xi, for this beautiful welcome. And tonight it is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th. And we look forward to it. And I'd now like to raise a glass and propose a toast to the rich and enduring ties between the American and Chinese people. It's a very special relationship, and I want to thank you again. This has been an amazing period of time. Thank you, President Xi.
那么再一次感谢习主席，感谢这一美好的欢。
Well, that was President Trump speaking at the state banquet, inviting President Xi to the White House in September 24th to be specific. I'm Shireen Bhan. The headlines that we're tracking for you this evening, we bring you all the latest from the Beijing summit. The U.S. and China vow constructive, strategic and stable ties as President Trump meets Xi Jinping in Beijing. Trump heaps praises on Xi, who says equal consultation is the way forward. The White House says President Xi expressed interest in purchasing more American oil to reduce dependence on the Strait of Hormuz. Beijing draws the red line on Taiwan. President Xi emphasizes that Taiwan is the most important issue in the U.S.-China relationship and could lead to a conflict if handled poorly. Also tells American CEOs that the country's doors are wide open to the outside world and will only open wider. Taiwan reacts to Xi's warning, calls China the sole risk to regional peace and stability. The market extends gains for day two. The Nifty closes above 23,650. Broad-based buying today lifts most sectoral indices. IT remains the sole laggard. The rupee touches a record low of 95.96 against the dollar. The government bans sugar exports till the 30th of September with immediate effect and concerns over lower yields due to erratic weather. The ban will not apply to shipments to the United States and Europe under quota arrangements. Sugar stocks plunge in trade. Wholesale inflation jumps to its highest level in 42 months in April. This is surging energy costs push fuel and manufacturing costs higher. The government is yet to hike petrol and diesel prices despite OMCs incurring losses worth a claimed 1,000 crores a day. The union government may look at more measures to keep the current account deficit and balance of payments under control. This includes a targeted reduction in the maximum amount a resident Indian can remit abroad, concessional tax for foreign bond investors, and mobilizing funds from the Indian diaspora through a special deposit scheme could also be on the cards. That's a CNBC TV 18 analysis. Sunil Mittal lays out his 10-year vision of the promoter entity regaining 50% stake in Airtel as he gradually prepares to hand over the business to the next generation. Also eyes increasing Airtel's stake in its Africa unit. The suspense over the next Kerala Chief Minister is over. Congress chooses 61-year-old V.D. Satishan over K.C. Venugopal. Satishan was the leader of the opposition in the outgoing assembly, will be sworn in on Monday. Well, the top story that we are tracking this evening, the United States and China, the world's two superpowers, are setting their ties afresh months after trade warfare, technological restrictions and geopolitical friction. Now, China's President Xi Jinping welcomed his American counterpart at the Great Hall of the People, where he was greeted by a large military entourage and dozens of children waving flags. Trump was joined by a huge delegation from his administration, including the U.S. Secretary of State Marco Rubio, Trade Representative Jameson Greer, and War Secretary Pete Hegseth. Top corporate honchos, including Tesla CEO Elon Musk, NVIDIA's Jensen Huang, were also in attendance. Now, this is President Trump's first official visit to China in nearly a decade. Bilateral talks between both leaders lasted over 2 hours, after which the two presidents took a tour of the Temple of Heaven. Both the leaders are likely to have discussed the war in Iran, the contentious Taiwan issue, artificial intelligence, and trade between the two nations. President Xi also met with U.S. business leaders, where he assured them that China's doors will only open wider to American businesses, adding that American firms will have broader prospects in the country. She also expressed hope that both superpowers should avoid conflict and wondered if the U.S. and China could transcend the Thucydides trap. For context, the Thucydides trap refers to an idea that when a rising power threatens to displace an established power, the result is often war. Chinese state media also reported that President Xi hinted that U.S. and China could come into conflict if the issue of Taiwan is mishandled. Meanwhile, President Trump described the bilateral talks with the Chinese president as great. He lauded the relationship between both countries, calling it better than ever. He even reiterated that both China and the U.S. were going to have a fantastic future together. CNBC's Iman Havez joins us now to take us through what transpired today.
This was the handshake between President Donald Trump and Xi Jinping at the Great Hall of the People earlier today. This was the moment that the president flew halfway around the world for, is that warm greeting and hand pat in addition to the handshake there between the two leaders. They underwent a series of meetings, a bilateral meeting. Also, the president accompanied on this trip by a robust delegation of CEOs, some real American corporate firepower on this trip as well. The president in that bilateral meeting reaching for some superlatives to describe how important he sees this summit as. Here's what he said earlier today.
For those that say this is maybe the biggest summit ever, they can never remember anything like it. I can say in the United States, people aren't talking about anything else. But it's an honor to be with you. It's an honor to be your friend. And the relationship between China and the USA is going to be better than ever before. Thank you very much.
President Trump asked me to come to China with him.
Why are you going to sell more chips to China?
Well, this is an incredible opportunity for me to represent the United States, of course, and to come support President Trump in one of the most important summits in human history. And the two presidents, President Xi and President Trump, have such a wonderful relationship. This is an incredible opportunity for us to rely on the relationships to build a much, much better partnership.
Xi Jinping, with some potentially stern language for the president, warning him on the issue of Taiwan, saying that if the issue is not handled properly by the United States, it could risk confrontation and conflict between the United States and China. So that was an interesting warning. And then that warning about the Thucydides trap, which I think is an interesting one. The idea that a rising power and an established power always in history end up in conflict, and can the United States and China avoid that dynamic? That was an interesting comment by Xi Jinping as well, saying that is one of the great questions of history that hangs over this summit.
Our colleague Iman Have is there reporting from Beijing. As we pointed out, President Trump extending an invitation to President Xi. September 24th is when President Xi is expected to be in the White House. On to the day's market action. The Sensex and the Nifty closed in the green today for the second straight session. The Nifty ending above 23,650. Bharti Airtel, HDFC Bank, ICICI Bank and Cipla led the up move today. 1% higher on the Nifty, the Sensex up 1% as well, and the Nifty Midcap Index and the Nifty Bank also closing about 1% higher. The Nifty IT index was the only one that ended lower today. But the rupee has extended its losses, hitting another record low of 95.96 to the dollar. The currency also failed to hold on to its early gains despite reports that the government is considering a significant cut in taxes paid by foreign investors on local bonds. And staying with steps that the government is taking, it has banned sugar exports till the 30th of September with immediate effect, and concerns about lower yields due to erratic weather seem to have weighed on that decision. The ban will not apply to shipments to the US and Europe under quota arrangements. Sugar stocks plunged in trade today after that announcement. Manisha standing by with more on the impact this will have, as well as why we've seen the government move on this front. Manisha.
Well, yes, India has banned with immediate effect the export of sugar of various varieties, whether it is about raw or white or refined sugar. This is done until September 2026. India, though, will continue to allow that sugar to be exported, which already is an export pipeline under specified conditions. Now, India has taken this step, one, because we are looking at a lower crop this time around. The initial estimates were much higher at 30 and 31 million tons, but we do understand after various revisions that we stand at 27.5 million tons of sugar. Closing stock, government is very comfortable with 5 and 6 million tons, but what we have in hand perhaps is 3.5 million tons, which is 1.5 to 2 months of monthly of consumption, and that really is slightly worrying. And then you have an El Nino year, and the next season also is slightly under threat, so this is a step taken in that direction. Out of the 15 lakh tons that the government did allow to be exported, 6 to 7 lakh tons has been done, 6 to 7 is remaining, so this impact would come in for this one. If you look at the overall international markets, they have reacted in positive for this. You are looking at 2% of a jump up in New York raw sugar prices. London white sugar also gained up by nearly 3%. We are looking at a global deficit this time around because, one, there is lower sugar availability, and then more sugar is going towards ethanol. So Data Agro feels that 3.1 million tons of a deficit is what we are working with for this season. You have StoneX talking about 550,000 tons of a deficit as well.
Manisha, many thanks. Now let's talk about inflation. India's wholesale price inflation rising to a 42-month high of 8.3% in April. This is more than doubled from 3.8% in the previous month. Now the rise can be attributed to a spike in crude oil prices. The spike also marks the highest wholesale price inflation since 2022. Inflation in crude, petroleum and natural gas jumped to more than 67% from 36% in March. Inflation in fuel and power also climbed to nearly 25% from just over 1% a month ago. And remember, this is without having seen a pass-through as far as petrol and diesel prices are concerned. Now, the union government may look at more measures to keep the current account deficit and the balance of payments under control. This may include a targeted reduction in the maximum amount a resident Indian can remit abroad and concessional tax for foreign bond investors. Ritu joins us now with the analysis on the likely measures the government may choose to take. Ritu.
Well, after that gold and silver duty hike, policymakers are evaluating more measures to manage dollar outflows and support the balance of payments as the conflict in West Asia drags on and the risks build up. But of the many items under discussion that we here have been reporting on, we understand that there are two active options under consideration. The first is on the liberalized remittance scheme. That's the RBI framework, which allows Indian residents to send up to $250,000 abroad every year. Now, a large chunk of these outflows, somewhere between 75 to 77%, go towards what policymakers classify as non-essential spending. So foreign travel, gifts, property purchases, equity investments, etc. International travel alone, by the way, accounts for more than half of all of our outward remittances under LRS. Now, sources tell us policymakers are evaluating whether to tighten these limits, and there's a playbook for exactly this. In 2013, the RBI had cut the LRS limit from $200,000 to $75,000 to ease pressure on the rupee, and today, a similar move, our sources indicate, can potentially keep more than $22 billion from leaving the country. So that's a big one. The second big area is easier tax for foreign investment and government bonds. This is also being considered. Remember, a concessional 5% tax rate for foreign investors buying Indian government bonds existed. It expired in 2023 and the rate then reverted to 20%. And we now understand that there is a view that a stable lower tax rate could help attract long-term global capital into Indian bonds. Other options, including the special NRI deposit scheme that has been used several times in the past, that is also part of the broader discussion, although attracting these kind of flows will be tougher this time around, given the much higher US interest rate.
All right, Ritu, many thanks for joining us. So that's a CNBC TV 18 analysis of the likely measures. Of course, we have to wait for official confirmation. Coming up, the two-day BRICS summit kicks off in New Delhi with the Gulf crisis taking center stage. Iranian foreign minister slams the US, accuses it of bullying, urges the BRICS nations to speak out against Washington's actions. Well, here's the latest from West Asia. Tensions in the Strait of Hormuz escalate while the US and Iran continue to be locked in a stalemate. Crude prices remain elevated after reports of more attacks on oil tankers in the region. A vessel anchored near UAE's Fujairah port has been reportedly seized and is heading towards Iranian territorial waters. The United Kingdom Maritime Trade Operation said that the vessel was boarded by unauthorized personnel. This comes after India confirmed that an Indian-flagged vessel came under attack off the coast of Oman. The ship's crew was rescued by Omani authorities. A ministry spokesperson has called the attack unacceptable. Meanwhile, two India-bound vessels carrying LPG from the Persian Gulf appear to have transited the Strait of Hormuz. Both vessels switched off the transponders as they crossed the waterway. Meanwhile, Prime Minister Netanyahu confirmed that he visited UAE during the strikes in Iran. His office called the trip a secret visit during which Netanyahu met the UAE's president. However, the UAE has rejected the claims as baseless. Iran's Foreign Minister Sayed Abbas Araghchi claimed Tehran security services were aware of the visit long ago. Without mentioning the UAE, he also warned that those colluding with Israel will be held accountable. Now, the two-day BRICS summit kicked off in New Delhi with the crisis in West Asia taking centre stage. Prime Minister Modi on Thursday met with Iranian Foreign Minister Abbas Araghchi, urged the bloc to condemn violations of international law by the US and Israel. Addressing the BRICS summit, Araghchi also called for coordinated action to, and I quote, stop warmongering and end impunity for those who breach the UN Charter, end of quote. Meanwhile, External Affairs Minister S. Jaishankar, addressing the blockade in the Strait of Hormuz, called for safe and unimpeded maritime flows through the strait. He also acknowledged that international relations are in a considerable flux, adding that there is a growing expectation for the BRICS to play a constructive and stabilizing role. The call for the BRICS to back Global South cooperation has also gained momentum. Speaking to Network 18, Thailand's foreign minister said that the BRICS reflects a fragmented world that needs inclusive global governance. He further warned of a global spillover due to the West Asia conflict and called for an immediate end to the crisis.
We meet at a time of considerable flux in international relations, ongoing conflicts, economic uncertainties, and challenges in trade and technology and climate are shaping the global landscape. There is a growing expectation, particularly from emerging markets and developing countries, that BRICS will play a constructive and stabilizing role.
Iran, therefore, calls upon BRICS member states and all responsible members of the international community to explicitly condemn violations of international law by the United States and Israel, including their illegal aggression against Iran, a member of BRICS, prevent the politicization of international institutions, and take concrete action to halt warmongering and to bring an end to the impunity of those who violate the UN Charter.
Our colleague Abhimanyu joins us now with more. Abhimanyu, what are you picking up on the outcomes of the BRICS summit?
Well, the first session has already been concluded, which was followed by all leaders who had congregated for the BRICS foreign ministers meeting India's Prime Minister. Currently, the second session is underway, which would be followed by a third session tomorrow morning. Now, it remains to be seen whether there would be any outcome document which would emerge out of the entire meeting. However, the address which was initiated by the chair of the summit, India's External Affairs Minister, Dr. S. Jaishankar, he had called for an unimpeded access to world's waterways. He had called for economic resilience, and he had called for clearer and more open supply chains to ensure that there is no discrimination against developing countries with respect to levy of any unilateral coercive sanctions. Now, he has also urged the international community via BRICS to condemn cross-border terrorism and all forms of terrorism. He has called for diplomacy and dialogue to resolve all ongoing conflicts, including the ones in West Asia as well as several parts of the world. Now, India has also called for the fact that unilateral sanctions go against the very grain of the UN Charter and should be condemned, should be done away with. He also indicated that they disproportionately affect developing countries and cannot substitute dialogue, and nor can pressure replace diplomacy. So very clear words which were marked by India's External Affairs Minister, even as trade wars continue to remain and prevail in certain parts of the world, and also remarks which were made by Iran's minister indicated the fact that he has condemned several actions of the United States. He has also exhorted several BRICS members to stand with Iran. Now it remains to be seen whether there's going to be any open show of support from several other BRICS members as far as Iran's remarks are concerned. Also, Iran's foreign minister had accused the US of bullying and had called for condemnation. And on the other hand, India has called for multilateralism as well as availability of digital access to all developing countries. So different issues have been pointed out, ranging from geopolitics to end of wars, as well as provision of digital access to developing countries. So a litany of issues which have been pointed out today, and the meetings are going to continue till tomorrow. It remains to be seen what is going to be any outcome document or any degree of concurrence which all the leaders who have congregated are possibly going to achieve.
All right, Abhimanyu, many thanks for joining us. Bharti Enterprises Chairman Sunil Mittal has said he expects the promoter group to gradually hand over the reins to the next generation over the coming decade. Speaking at an earnings call, Mittal added he plans to restore promoter holding in Airtel to above 50% through Bharti Telecom. He also eyes increasing Airtel's stake in its Africa unit.
This Africa exchange of shares that was announced yesterday is akin to acquiring another company of a large size. A $3 billion transaction means you're making an acquisition, and you're making an acquisition of a business that you know deeply well, a business in which all of us are working day and night, adding value. We need to own more of it. And if some other block comes from any other investor to Airtel's attention, we will probably, in the next several years, get to that point of owning more of Africa so that we can get more income flowing back to the mothership, Bharti Airtel. And then after giving allocation to all this, if we are still left with more money, as I mentioned, we'll do more dividends, we'll do buyback programs, but we'll never become like IT companies who have done nothing but just taken money out as dividends and buybacks, and they become a shadow of themselves.
Well, that's Sunil Mittal. Now, the suspense over the next Kerala Chief Minister is over. The Congress has chosen 61-year-old V.D. Satishan over K.C. Venugopal. Satishan was the leader of the opposition in the outgoing assembly. He will be sworn in on Monday. Neetu Raghukumar joins us now from Trivandrum. Neetu, what tipped the scales in Satishan's favour?
Congress has finally announced their Chief Minister candidate after 11 days since the results was announced. V.D. Satishan, the opposition leader, has been elected as the Chief Minister of the Congress. It was a tough fight between opposition leader V.D. Satishan, K.C. Venugopal and senior leader Ramesh Chennithala. But finally, it is in favour of V.D. Satishan. Most of the MLAs stood with K.C. Venugopal is what we understood. And Ramesh Chennithala was expecting that his senior position, being senior to both these leaders, and also the fact that he was also working in the past 5 years. In the previous term, he was the opposition leader. So Ramesh Chennithala thought all this would work in his favour. K.C. Venugopal thought that having the maximum number of MLAs would work in his favour. But V.D. Satishan had the support of the alliance partners. Most of them said that we need to understand what is happening on the ground. We also understand that senior leaders of the Congress, including V. Sudhiran, A.K. Antony, have all communicated the situation on the ground. So this is what finally led to V.D. Satishan being appointed as the Chief Minister. The swearing in will be on Monday is what we are understanding. The alliance partners, the ministers from the alliance will also be swearing in. We'll have more clarity on who all will be swearing in, or whether the entire cabinet will swear in on Monday. But the swearing in is on Monday is what we are understanding. So V.D. Satishan is the new Chief Minister of Kerala.
Yes, the suspense finally over. It is V.D. Satishan. And Neetu, many thanks for joining us. And that wraps up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Bloomberg India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
I think the musical performance was uplifting. It was up, and it was bright, and it was lively. Markets, though, have been a bit, what should I say? I mean, the notes have been sort of dark and a little unsettling, and especially public markets. But we've got people here, true titans, and thanks all of you for being here, part of the panel. And these are people who sort of see businesses. I mean, we talk about public markets all the time. But, in public markets, businesses are already many years old, and they've matured, and they've attained a certain sort of size, scale, in whatever businesses they're in, whatever categories they're in. But these are people who see businesses far, ahead of, far before they list, in their infancy, when they're starting to build out. So they're in that sense, the risk takers. And I think that their capital is very important if we need to sort of fuel this new investment cycle. And of course, domestic capital base has become very large, even compared to 10, 15 years ago. So once again, thank you very much for being part of the panel. Manish, I want to start with you. Is the music a little dull and unsettling? And I don't know, or is the music slowing down? If I were to borrow from the phrase from a famous movie.
Is it the music we were hearing right before we started?
The music in markets.
That music was excellent.
That was excellent.
No, first, Prashant, Sharon, thanks for having us. Pleasure being here. Listen, I think the difference between private and public markets is just, what we do is public market guys are on edge every day. Frankly, I don't know what the markets did today. Did it go up or go down? I know it went down, but Sharon, I sure would give me all the facts, thank you. But my point is, it shouldn't matter to us to a certain extent, right? Because we play what I would call is the long game. Not better, not worse, just different. Our lives are relatively simple. We make 3 or 4 investments, maybe 5, 6, at least on the private equity side where we function. Both control and non-control, and it is patient long-term capital. The only things which change when I look at a 25 versus a 26, as I was talking about outside, last year we had buoyancy, right? There was madness in the markets. The public markets were on fire. Sponsor-to-sponsor sales were going up. Strategics were looking at acquisitions. In times like this, remember, our capital is, unlike Rishabh and that's his permanent capital. We are fiduciaries for other investors, and all we can do is be responsible providers of that capital. And hence, in years like last year, we stepped back on new investments given the valuations, but really accelerated divestments and money back to. So last year, to give you a sense, our normal ratio of new investments to exit is about 1 to 1. A little bit more on the exit side. Last year, it was 3.5 to 1. We returned almost $2 billion to our investors. Vishal itself, we had one exit of $1.2 billion. So
I believe that was the most.
But I'm saying that was last year. Yeah. This year, the public markets, as you know, and Sharon reminds us today, it's not a time for the faint-hearted, right? So what do? Your playbook changes. Your level of divestments will go down. Our DPI will not look as good in 26 and 27. But hopefully, the 20 companies we were looking at acquiring, but always was beyond our reach last year, now will become closer to reach. Now, remember, private markets take time to react vis-a-vis public. We are still 3, 6, 9 months behind. The public markets have corrected, intensively so. The private markets will get there, but the mood is getting pessimistic. I think all of us, from a deployment perspective, would want this pessimism to remain. But remember, our life is about both making good investments, but more importantly, getting exits. So this year, we will probably have a ratio where we'll deploy more money than take out. But at the end of the day, it's a cycle. It's yings and yangs in life. And you have a 10-year window, not a 10-day or a 10-hour window.
That's very well put, Manish. And I think what you said, so private markets will mark to market in that sense in about 3 to 6 months. That's the lead lag between public and private markets. Just one more question. In public markets, we talk about all the time, so much anxiety and hand-wringing about why foreign capital is staying away. Actually, why is it actively selling. And Gopal and I were talking about it just outside. What is your sense, Manish? What is the, I've heard lack of AI, taxation, I mean, just valuations, perhaps earnings growth has slowed down. What are the really...
Two very different pools of capital. You have the global investors, for which India is far less relevant today. For multiple reasons. When you have increasing interest rate climate in the US, which people expect, money will flow back. When there's uncertainty, you go towards gold, you go towards markets which are more shorter. Your overall portfolio, you want to de-risk. Even our largest investors and global investors have a paucity of capital. They haven't got the distribution in the last 2 or 3 years as they were expecting. China was weak. So if you have an Asia allocation and China has not returned capital, which was the most amount of private equity, things are... So their new deployment goes down in public and private markets. So at least in the public markets, they're withdrawing capital. The domestic pool, I would say, I would disagree. There is a degree of nervousness. Most of us who think we're good public, we get it wrong. You always sell when the market is falling. You buy when the market is peak. You should do the reverse as usual. So, but I think the overall flows, and again, Sharon will correct me, I'm sure, but the overall flows into the public markets for domestic capital is increasing month on month because of the SIPs. That's the amount of, so if you look at it 10 years ago and you had to price an IPO, we would fly to Singapore and meet with a Fidelity or a Capital or one of those guys. Today, you go to BKC and you meet SBI, HDFC, ICICI mutual funds, and that's how you fix your pricing. That hasn't changed. The level of buoyancy and what they can afford and then negotiating leverage on you when you're doing an IPO also enhances. So I think it's a tempering. I think the tempering is a good thing. And hopefully for us, it'll mean a chance to deploy more capital.
Absolutely. Gopal, you want to comment on the same question in terms of why is foreign capital a little nervous at this point?
You know, first of all, it depends on which music you've been listening to, right? In private markets had a record year last year, even though public markets, there's a liquidation trade in public markets. But in private markets, we saw well over 50 billion, close to $60 billion being invested. And if you look at the source capital of the 60 billion, more than 50%, close to 60-70% is foreign capital. So foreign investors in private markets continue to buy, while foreign markets and public markets. So this nuance is very important. And I know it's being very simplistic, but if you conflate, say, private markets with a longer term view of the market, then investors with a longer term view of the market, investors like us, I've been investing in India professionally for 35 years. I made my first private investment 31 years ago. India has been a structural bull market for 35 years. And every 4 or 5 years, there is something that happens that gives you a window to buy. And the reason that happens is because we have a twin deficit problem. So whenever the world sneezes, we catch a cold. We should have solved this by now, but we still have a structural vulnerability, right? So every time in the last 35 years, the shock that we get every 4 or 5 years has been a good time to buy. And I think people who see this pattern recognize this pattern. And which is why in private markets, you continue to see investment activity funded by foreign capital, even within public markets, as Manish was saying. While we might be seeing a liquidation by foreign investors, as far as domestic institutional investors. And for a minute, again, while being simplistic, conflate them closer to where India is, and foreign investors have choices, they have other things to look at, they've been buying, yes. But that still leaves a question, why are foreign investors in public markets liquidating, yes.
To raise a private fund, there should be no problem. Foreign money, if you were to raise a...
Well, 10 years ago, if you wanted to raise a private fund, you only had foreign money.
Yeah.
But what's changed about India is India has become a large economy.
Yeah.
Private equity works in large economies. In large economies, private equity works with both domestic capital and foreign capital. When we started, nearly 100% of our external capital used to come from foreign investors. And now there is so much domestic capital. So it depends on who you're talking to. But I would say that if there is, for new time managers, I think it's much easier to raise capital. Yes, raising money from foreign investors is difficult for everybody except Manish Kejriwal. But in general, I would say there's still a lot of appetite for India, for the Indian story. And there is a growing appetite because India is a savings factory of the world. We are 4% of global GDP. We are 7% of global savings. There isn't enough global Indian savings that is making its way into alternatives. That is changing. And as that changes, this is going to inflate the alternative sector and make it possible for people to raise larger and larger amounts of capital.
Actually, so many public market investors have become not private equity investors, but maybe VCs and so on and so forth. They've all going back and back to and maybe that's competition for you guys when you go in for deals, etc. You talked about raising money and how to price an IPO, but perhaps competition for deals also has perhaps gone up because of, I guess, a lot of large, all kinds of investors who are now looking for businesses in their infancy as they're starting out, etc. So that point is taken. Rishabh, just what's your perspective? And I mean, as Manish said, it's permanent capital. So maybe there's a...
Yeah, so, firstly, thanks for having me and pleasure being here today. I think, from our perspective at Sharp Ventures, which is our family office, we are quite focused and, we do a whole bunch of very early stage and then we do some opportunistic mid-stage and late stage. So I think it's flexible capital that we have, but I want to just say that the word family office is a bit abused in the country, and there are not too many real institutions here which are truly family offices, where it's about governance, it's about strategy, it's about discipline, and it's about allocation. Usually most family offices just think about just how to make alpha without depth of thought process. So I think, there's all sorts of capital out there, but I think true long-term capital, when there's enough capital to deploy, I think strategically some of that thought process is missing in the country. So you do get chunks who go into a bunch of funds and top quartile funds, like a Kedara, Gaja, Chris, whatever, the big boys, and then there's a bunch of mid-market and early stage funds. At least, our journey started in 2014. We did like 14 funds in the last, too many funds, but in the last 10, 11 years. And, unfortunately, the DPI, TVPI, it's not been great in the early stage ecosystem, right? And then we had our learnings and then we said that, guys, let's just do what we can underwrite. We can only underwrite consumer, so let's focus on consumer. And I think that's what we've done. And I think for us personally, that's what's been super exciting because, the journey, the next decade will be defined by the 400 million aspirational Indian consumer who will pay and with their wallet, and that aspiration is what we are after. And hopefully if we chase the right entrepreneurs who are betting on the right categories and the right brands, I think those ones will be the winners of tomorrow.
Fair enough. Krishna?
He's being a little modest. His direct investing included a small company called Nykaa, which he put in 10 crores, which I think when he exited was more than 1,400 crores. So he makes the rest of us look like a little foolish. So it's not only permanent capital, it's smart permanent capital. And you should talk about family offices to Harsh uncle and give it, not your dad, Harsh Goenka. And, talk about how good family offices can be.
He has a very different view on family offices. But I think that's a different view altogether that he has, where he thinks that family offices just chill and play golf and go on vacations. I think that too, but I think that's different because those are just investors who just sit and watch. Here, I think, when it's value adding is what you want to do, and you want to truly help entrepreneurs in their journeys and not just be just be passive investors. So I think that's a different pool of capital, and I think that's also needed, by the way, in the country. But that's not who we are.
We Work India presents CNBC TV 18, The Titans, co-presented by PhonePe. presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Krishna, you want to comment on at TVS, what's happening, and what are you doing, focused on which areas, and what kind of, Rishabh mentioned consumer, financial services are the two sort of bedrocks as far as India is concerned in terms of finding ideas. It has been for the last 20, 25 years. Just give us an overview of what's been happening at TVS.
Yeah, we are now in our fourth fund. And interestingly, we've always been a rupee fund. We've raised money in India, invested in India. So taken a lot of pride in doing that. In the fourth fund, I think one of the things that we're seeing is also we are institutionalizing our fund. This was started by Gopal, and now you see more people coming in. So like you see in the market as well, families are institutionalizing in terms of family. Gopal Srivasan, yes.
Don't give me all the credit.
So you see families also putting an institutional setup in family offices, structures and formats in place. And you will see in the market in the next 20 years, significant money is going to move in across generations. You're going to see that quite a bit. There are reports about lakhs of crores going to move in. The second thing that you'll see in the market happening is the PF and NPS money and possibly insurance money, close to 107 lakh crores. A percentage of that will get unleashed into the market. With all that, I think the domestic pool is going to increase quite a bit. And therefore, I think we are quite excited about that. We have, in the first fund, been agnostic of the sector. We've been everywhere. And last fund, we were very sharp, largely in financial services. This fund, we are now into financial services, end-to-end distribution, wealth, insurance, and enterprise technology, and also industrials. And one of the reasons we're moving into industrials is a lot of our LPs from family offices have backgrounds in manufacturing. TVS family also has a lot of background in manufacturing. Plus, we see a lot of opportunities today. People think India has jumped from agriculture to services and the manufacturing is lost, but seems to be coming back in some places with a big bang. In some cases, I think slowly coming back. So I think that seems three areas of our focus. And we've invested a lot in people and capability capital. We're looking forward to that.
I missed manufacturing when I said financial services and consumer. I just want to ask Manish the AI question, right? I mean, you spoke about Vishal Megamart. I think it was your single largest sort of transaction, exit in terms of the amount of money that you made on that single deal. I mean, at one level, does it matter how you make money? Vishal Megamart is a fantastic company, well-run company. You went in early, you made a ton of money there. But at the same time, you look at what's happening around the world. And you and I were at an event yesterday where we got sort of presented that anecdote. The three companies, SK Hynix, TSMC, and Samsung, the amount of FII money in these three companies is about $1 trillion. FII stock of money in India is about $750 billion. So it's just, the numbers are insane. So my question is, does it really matter if it's a huge super cycle, maybe the biggest of our generation or two, and it seems to be, in a way, passing us by. I don't know. What's your sense?
Tough question. When you look at AI, you look at it from an investment lens, and you do it from a portfolio lens, right? The numbers globally are crazy. We, at least us, humbly speaking, I can't speak on anyone else or as a country, don't have the wherewithal or the skill set to play the game that the big boys are playing, whether the hyperscalers, whether it's the Amazons and the Googles of the world, whether it's an infra play or an LLM play. What we have learned in 15 years of existence, and with Temasek earlier, is humility. The markets and companies will make you humble. So don't ever go, if that's your guardrail, play within your guardrails, do stuff that you understand well. For us, it is consumer, it is financial services. It's tech services, not technology. We don't claim to know what the guys at Samsung can do. And yes, a bit of pharma and healthcare services, whether it's diagnostic labs. The moment you step outside your guardrail, you do that as a PA investment. You can't do it for the money that we are a fiduciary for other guys. They've given you money to do a certain investment thesis. Suddenly there's a more attractive rabbit running across the train tracks. If you're running after that rabbit, you're going to be hit by the train, right? More likely than not. So you've got to be really disciplined to stay within your guardrails. So to answer your question, AI, our portfolio companies, we encourage them. We have a full team working with them in either ways to enhance revenue or to decrease costs. We're doing both. I'd say we're still learning. We're probably learning more from some portfolio companies like a Purple, and we're transmitting that knowledge to the others and learning a bit more. On the investment side, let's be clear, I'm not investing in any LLMs. I have no strategic advantage, no market. But what we will do is, for example, we bought a controlling stake paying $250 million in a company which is US-based with an India backend, which does data migration. And so it's very boring, old world, but it prepares enterprises to become AI ready. So again, it's not the gold mine that you're running after, because it's very difficult for us to actually find that little thing of gold. But we're investing in the pickles, in the picks and the shovels, which can help others reach the gold mine. And we will then mean a 3 to 4x return. We're not used to Rishabh's 100 or 1,000x returns he did in Nika. We're happy with a 4, 5, 6x or a 3 or 4x. And hence the risk return, you've got to be measured and know what you know and play in that. And the stuff you don't know, just keep far away from.
Gentlemen, thank you very much for joining us. The music in markets, public markets may be a little slow, but I think encouraging thoughts from all of you. Thank you very much, Rishabh, Manish, Gopal, and Krishna. Thank you very much.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Hello and welcome to this special broadcast here on News Center. Now, India has hosting the BRICS foreign ministers this, of course, is a critical meeting. What sets us apart, of course, is the degree of commitment and cooperation that we're seeing in terms of the people who are coming on board. Arakchi is here, Foreign Minister of Russia, Lavrov is here, of course, and this will be a defining moment as far as diplomatic maneuvering by India is concerned. India will be hosting the foreign ministers' meeting as the world grapples with ongoing conflicts, economic uncertainties and trade challenges. External Affairs Minister Dr. S. Jaishankar is chairing this meeting with Russia's Foreign Minister Sergei Lavrov, Iran's Syed Abbas Arakchi, South Africa's Ronald Lamola and other foreign ministers are joining him at the table. Prime Minister Narendra Modi met with Arakchi and Russian Foreign Minister Sergei Lavrov on the sidelines. Arakchi's three-day India visit marks the first high-level diplomatic engagement between New Delhi and Tehran since the West Asia conflict began. Tensions in the Gulf region and the energy crisis triggered by it has taken center stage at the summit. Jaishankar said that peace and security remain central to the global order and that the recent conflicts underline the importance of dialogue and diplomacy. Jaishankar also added that safe and unimpeded maritime flows through the Strait of Hormuz and the Red Sea are vital for global economic well-being. Iranian Foreign Minister Arakchi called upon BRICS members states to condemn international law violations by the United States and Israel. He said, and I quote, "History has shown that empires in decline will stop at nothing to arrest their inevitable fates. A wounded animal will desperately claw and roar on its way down." End of quote. Arakchi also accused the UAE of direct involvement in military attacks against Iran, saying that the country should reconsider its alliance with Israel. The discussions in Delhi will set the agenda for the annual 18th BRICS summit in September. BRICS, which now includes Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, the UAE and Indonesia, represents nearly half of the world's population and around 40% of global GDP. In April this year, India hosted BRICS deputy foreign ministers and special envoys for the Middle East and North Africa meeting. However, that meeting ended without a joint statement as Iran and the UAE were at odds over how to address the West Asia conflict.
Iran, therefore, calls upon BRICS member states and all responsible members of the international community to explicitly condemn violations of international law by the United States and Israel, including their illegal aggression against Iran, a member of BRICS, prevent the politicization of international institutions, and take concrete action to halt warmongering and to bring an end to the impunity of those who violate the UN Charter.
Well, there are many layers to this conversation. To help us unpack and understand the significance of this meeting is with us former Foreign Secretary Shashank, joining us now. Also joining us is with us Mr. Hamid Musavi, Professor of Political Science at the University of Tehran. Gentlemen, thank you for joining us. Mr. Shashank, coming to you first. India hosting the Iranian Foreign Minister for the first time since the conflict began now. And in just a matter of a couple of weeks, we'll also be hosting the Quad. Marco Rubio is expected to fly in. I want to get a sense, is this a diplomatic coup, being able to negotiate simultaneously with both Tehran and Washington, or is it a diplomatic challenge, a diplomatic tightrope walk, having to balance expectations on both sides?
Well, the international scenario is changing so rapidly that we cannot go on the basis of the past experience and try to say that, all right, this is what we feel, our old friendships are there, and we have to somehow do tightrope walking in order to keep those friendships going. No, the point is that India has an important role to play as the chair of the BRICS, that BRICS should continue to play a constructive role in the evolving situation. America, we saw that already had tried to target BRICS as being the main leader for de-dollarization. And President Trump had announced that he would put 500% tariff and the highest tariffs on the BRICS countries because he would not like the American dollar to lose its international value. Now, the point is that, yes, this issue is being discussed because there are some members of the BRICS who have been under sanctions from the United States, so they cannot use dollars. And in case business has to be done with those countries as BRICS members or as otherwise bilateral friendship and trade relations, we have to do in other currencies. So therefore, one is going through de-dollarization, not because we want de-dollarization, but we want our own national currencies to be used more and more, number one. And secondly, we want to do business with countries which have been sanctioned by the USA, because we feel that these are unilateral sanctions, not the UN sanctions. And thirdly, we also want to continue to have good relations with the United States and to see that USA should be able to behave in a manner whereby the relationships with the other major powers, whether China, whether Russia, etc., they continue to be peaceful for the world. Because what we are seeing is that the conflict in Europe between Russia and Ukraine is really a conflict between Russia and USA or Russia and NATO. Similarly, the conflict in Iran is not that much Iran and Israel. Yes, of course, it's there, but it's mostly Iran and USA. And the countries in the Gulf region, they are suffering because of that. India is suffering because of that. Many other developing countries are suffering. So BRICS has to take a view about how the oil and other gas resources can flow to the international community, and some way should be found quickly. So BRICS has a role to play. Now, it's not a matter of declaring things. It's a matter of how do you work out relationships so that the desirable goals are achieved. And we'll wait for the results to come. It's not that easy.
Well, of course, we won't have to wait very long. The meeting will stretch till tomorrow, and that's when we'll begin to get clarity whether any consensus has been formed between the foreign ministers. But speaking of consensus, Mr. Musavi, let me come to you. The first time India is hosting Foreign Minister Arakchi, and he's come all guns blazing. Extremely unhappy with the conduct of the UAE, calling it out for aligning with Israel, calling out the statement that was made by Prime Minister Netanyahu that he visited the UAE, met with the leadership there, suggesting that UAE needs to reconsider its position and that it is an active aggressor as far as the attack on Iran is concerned. Having said that, is there room for consensus? We've seen previous engagements between the two sides not yield much in terms of consensus building. What will it do as far as this BRICS Foreign Minister Summit is concerned?
So Iran and the UAE have actually had a long, good relationship. UAE has been one of Iran's major trade partners. But what happened in this war was a break with that, in the sense that the UAE essentially allowed its territory to be used against Iran. So this wasn't just a misunderstanding between the two sides. The actual fighter jets that were being used to bomb Iran were coming from the UAE and Qatar and some other countries, and this is why Iran targeted these countries. And of course we heard that the UAE has also tried to bomb Iran. So the relationship has become very sour. Now, in the BRICS organization, of course, Iran is legitimately demanding that, since as a member, it has become under the attack, under an illegal attack by the US and Israel, then BRICS should condemn this. And we know that the UAE is most probably going to stand against this and is not going to allow this. Now, regardless of whether BRICS condemns this attack on Iran or not, I think the more important issue is BRICS should become involved in the peacemaking between the two sides. So I think it really has the potential to become a mediator here. Pakistan is currently the mediator, but we know that they don't really have enough weight between Iran on one side and the US on the other. As was mentioned, BRICS has 50% of the world's population, almost half of the world's GDP. So there's a lot of potential, but nevertheless, it doesn't have as much influence as it should in world politics. And one of the primary reasons for that is that it's not really turning that potential into actual power in international relations. I think if it does choose to become more involved in world politics, and this is a test, I think, the war in Iran is a test for BRICS. If it tries to become more involved, then there is a real opportunity to be a more important player, a more major role in world politics. And I think this is something that Iran would welcome, but I think also it really depends on the major player in BRICS in what they decide to do, and then being China, Russia, and India. Russia, we know, is pretty much for this approach, but I think China and India's approach will still have to wait and see.
Well, that's an interesting perspective. But speaking of the Indian position at this point, the biggest conversation, the talking point is energy security. Now, we've seen reports of Iran permitting as many as 10 crude carriers, as far as China crude carriers are concerned, to pass through the Strait of Hormuz. Is that an arrangement that India can look to arrive at, especially with Iran? We've not had a BRICS condemnation yet, but is this something that Iran is prepared to work with to allow energy India security and then subsequently build on India as perhaps a mediator, negotiator between the two sides?
No, the point is that, sorry, please go ahead, Professor.
Go ahead, thank you.
No, I feel that
Mr. Sushant,
Iran,
go ahead, please.
Iran will have to agree, and also the United States, because in China's case, in view of President Trump's visit to China, they were trying to involve China in somehow peacemaking in Iran, because they would like to work out a relationship so that some of the China's sensitive points are taken care of, while China does not give full support to Iran in the its fight with the conflict with the United States and Israel. So one way could be that, yes, if Pakistan and Iran agree, then along the coast, if India can bring its oil shipments and the Americans agree to that, that they would not affect the movement of ships closer to the coastlines of Iran, Pakistan, and India, then perhaps one could work out a relationship that way. The other one would be that the Americans come out with some agreement on Iran, and China helps in that, the Russians help in that. That is regarding the nuclear material, which Iran says in any case that it does not want to use unless it is forced to use. So therefore, I think there is a possibility that one can try to work it out. But there again, we need the understanding of both Iran and America. And India is not in the same position as China, because Chinese have been able to show to the Americans that they can hurt the American interest very badly if Americans try to play any kind of games with China.
Sure. Professor, same question to you again. Is this an Iran has been batting for some form of BRICS condemnation. India, of course, has been slightly shy, not wanting to upset Donald Trump. In the interim, is there a deal to be worked out where Iran and India can perhaps work together in terms of energy security, energy supply?
So there has been some movement of ships for friendly countries such as India and China. So Iran has allowed a few exceptions of ships to pass through every single day, but this hasn't been on a large scale. If we're talking about a large scale allowance of ships to pass through, especially as you mentioned, oil tankers, I think this wouldn't happen with a single condemnation. The main issue for Iran here is that Iran has been placed under a very brutal siege by the United States, a blockade, a complete blockade of the sea of all Iranian ships, that this has been very damaging to the Iranian economy. It has essentially halted all Iranian imports and exports, and this is being implemented by the US Navy. And Iran is saying that it will only open the Strait of Hormuz once the American blockade is lifted. I think if Iran allows some countries to pass through, then this will essentially lead to the collapse of global oil prices, and Iran will lose its leverage. So the only important leverage Iran has right now is to keep oil prices high until the Americans come to the conclusion to lift this blockade. So I don't think that will happen until the Americans lift the blockade, and I don't think that will happen until there is some form of a deal between the two sides. And this is why I was saying that it's very important for the major players in BRICS, such as China and India, to play a more active role as mediators between Iran and the United States, so that this conflict is resolved and the global economy goes back to the route it was going before this conflict began.
Right, Professor. Like we said at the very beginning, many layers to unpack. And let's also not forget one of the biggest layers, of course, is the ongoing meeting between President Trump and President Xi, which is underway in China. I'd like to thank both of our panelists for joining us, Mr. Shashank, Professor Musavi, for joining us. It's time now for a short break. But coming up next, U.S. President Donald Trump is in China for the China Summit. We speak with Jonathan Cheng, China Bureau Chief of the Wall Street Journal, to understand how critical this meeting is for both the countries and if China has the edge over these talks. Stay tuned for a lot more on the other side. Welcome back. Now, no hugs, only handshakes between U.S. President Donald Trump and Chinese President Xi Jinping as both leaders stuck to protocol, avoiding grand gestures. But that did little to dull the pomp-filled welcome for Donald Trump at Beijing's Great Hall of the People. Trump was greeted by Xi on the red carpet, though one thing he had publicly hoped for, in his own words, a big fat hug from Xi, it never came. Instead, Trump was seen occasionally patting Xi on the back. Trump showered praise on Xi, calling him a great leader, and said that ties between the two superpowers were better than ever before. His remarks appeared heavily focused on flattering Xi, while the Chinese president kept his address centered on U.S.-China relations, saying that the two nations should be partners and not rivals. At the end of the nearly 2-hour-long meeting, Donald Trump described the meeting as great, but according to a Chinese Foreign Ministry readout, Xi also issued a sharp warning, saying that if relations are mishandled, the two countries could clash, putting China-US ties into a very dangerous situation. She stressed that Taiwan independence and peace across the Taiwan Strait are incompatible. He added that the peace and stability in the strait remain the greatest common denominator between China and the US, and urged Washington to handle the Taiwan issue with utmost caution. She also raised the question of whether China and the US could avoid so-called Thucydides traps. She further said that China's doors would open wider for American companies deeply involved in China's reforms, as top executives accompanying Trump on this visit. What stood out, however, was the difference in official readouts. China's handout made no mention of Iran or the Strait of Hormuz, while the US version skipped any reference to Taiwan. Meanwhile, speaking with CNBC, US Treasury Secretary Scott Bessent said that no US-China talks can take place without the mention of Taiwan. The White House readout, meanwhile, said that she reiterated China's opposition to the militarization of the strait and any attempt to impose tolls on its use. It also stated that she expressed interest in purchasing more American oil to reduce China's dependence on the strait in the future. Both countries agreed on one point, that Iran can never be allowed to possess a nuclear weapon. Now, Trump concludes his first day in China with a formal state banquet with President Xi. Joining us now to take this conversation forward, to help us decode what this Trump-Xi meeting could actually mean, is with us Jonathan Cheng, China Bureau Chief of Wall Street Journal. Mr. Cheng, thank you so much for joining us. Again, different handouts, different readouts being given by both the delegations. China has one assessment of how things went. The US has a completely different assessment. Let's address them one by one. First, the American position, saying that, look, there appears to be broad consensus between the two sides. Donald Trump saying that even China says that, number one, there need not be any militarization of the Strait of Hormuz, and also going on to say that there is an agreement by China that Iran should not be charging any tolls. Now, given that this has not been seconded by any Chinese administration figure, the first question, is it credible? Can we take it on face value? And if it is this an olive branch being extended by Beijing to Washington by applying pressure on Iran?
Yeah, well, thank you. It's not that unusual for the US and China to put out statements that aren't identical and aren't completely aligned. I think each country will put out a statement that reflects its own priorities and certainly the way it sees the discussion as having taken place. Of course, there is a world in which two people can have a conversation and come away with slightly different takeaways, priorities, and all the rest of it. Look, China does definitely have an interest in having the Strait of Hormuz be open. China is a country that relies quite heavily on imports of energy products, crude oil, of course. Iran makes up about 12% of all of the crude imports that China brings in every year. And so that's significant to China because China is a net importer. So I don't know that that statement that China agrees that there should be no toll, that Iran shouldn't have a nuclear weapon, that necessarily implies that there's going to be any serious pressure coming from China. China is very good sometimes at saying that, yes, we agree to such and such a principle, but whether or not they're willing to then put that into action with consequences is another question. And we haven't heard that even from the Americans yet, never mind from the Chinese, as you pointed out there.
Sure. Speaking of the Chinese position, they're quick to very clearly point out that Taiwan is the biggest issue. It is the biggest red line, very clearly pointing out. In fact, the language used was quite intense, wherein it said that the two countries could clash if this issue is mishandled. So clearly China not making any bones about its position, its stance on Taiwan. What I then want to ask is, will this weigh on Donald Trump's mind? Does he get the idea, the concept of a red line, that there is no negotiation as far as Taiwan is concerned?
Yeah, there's no question that China cares a lot more about this issue than the U.S. does. Certainly, it's a complex issue. There's a long history here. Very intricate sequence of events that brought us from 1949, when the Communist Party took power in Beijing, and the present day. It's been a long time and there's a lot of history there. And so this is something that China and all of its leaders have made clear over time to American presidents. This is the most important issue. and this is something that will not be tolerated. So it wasn't different in terms of the content of what Xi Jinping was saying to Donald Trump today, but it certainly was, as you pointed out, a little bit more pointed in highlighting the downsides, the potential catastrophic consequences. And again, to have it happen at this level from leader to leader, that's a big deal. And, you know, you saw reporters throwing questions at President Trump during their visit to the Temple of Heaven about Taiwan, and President Trump didn't answer those questions. Now, it may simply be that he didn't feel like he wanted to answer, but it did seem to perhaps reflect an asymmetry here where the Chinese know this issue inside and out. They're also extremely focused on it, whereas for Donald Trump, he has many other things on his mind, and Taiwan is somewhere on his list of priorities, but it's not number one. Certainly Iran and the situation there would rank higher in his mind, given everything that's happening now in the Strait of Hormuz.
Sure. Speaking of Donald Trump, he's bringing with him an impressive-looking delegation, an entourage that consists of the likes of Tim Cook, Elon Musk, Jensen Huang. I was just doing some number crunching. Just the market capitalization of the few companies that he mentioned in his post, that capitalization alone is around $20 trillion. So is this an intimidation tactic or perhaps a suggestion from Washington that it's open to striking a deal on the issue of tariffs and trade as well?
Yeah, well, I think it's both of those. It certainly is a show of force because these three men and what they represent in frontier technologies, it's not just in chips or in smartphones. You know, Elon Musk, his business interests span a whole range of different industries, including SpaceX, including XAI, and some of these other areas. And so it really is quite a show of force, but it is also a sign here that American business still does see a lot of promise in China. They wouldn't be there otherwise. They obviously understand that China is the only other country, perhaps, that can stand toe-to-toe with the U.S. when it comes to these frontier technologies, when it comes to artificial intelligence, semiconductors, green energy, electric vehicles, humanoid robots, all of these things that we know are going to help shape the future. China and the U.S., the two countries need each other in a certain sense. And I think when you have Tim Cook, when you have Elon Musk, when you have Jensen Huang all there, it highlights how intricately tied these two countries are, how little room there is for a big split. I think that's also part of the message as well. But you're right, there is also an element here of a show of force.
Sure. And my one final question to you, Mr. Cheng, that Donald Trump, in his closing remarks at the dinner, has invited President Xi on September 24th to come visit the White House in Washington. On the plus side, of course, it indicates that the conversations between the two sides will continue. On the downside, does it suggest that perhaps there wasn't enough room for the two sides to come together to crack a deal, so to speak, and therefore there is a need felt to continue this conversation, whether that's trade, whether that's technology, whether that's Taiwan, perhaps more work that needs to go in?
Well, we need to put this in context. This is the first visit by a U.S. president to China in almost a decade. That's a very long time. And of course, it was President Trump during his first term who was last in Beijing in 2017. And so what we have here is a long gap between U.S. presidents visiting China. But you can't solve all of the problems. You can't resolve all of the issues because they span almost every single aspect of human existence. And so for all of this to be resolved in a day and a half was never going to be realistic. In fact, there was an understanding already coming into this visit that this would be the first of potentially up to 4 engagements between Donald Trump and Xi Jinping this year, because you have this visit now that we're watching. You have this visit in September that may or may not happen. We'll see. I don't know that Xi Jinping has formally accepted that. And then you have 2 more multilateral summits towards the end of this year, where Donald Trump is expected to be in China and where Xi Jinping is expected to be in the US. So consider it an ongoing rolling conversation, perhaps, but certainly for the purposes of stabilizing international relations at a time when there's so much conflict around the world, when there is so much uncertainty around AI and other technologies, perhaps it's a good thing that you have the leaders of the 2 largest economies set to meet 4 times this year. We'll see whether that really materializes or not, but certainly that promise is there.
Well, we still have another day to go as far as the Trump-Xi summit is concerned in China. It will continue. We'll, of course, begin to get a better picture as the day closes tomorrow. Mr. Cheng, thank you so much for joining us, being a part of this conversation. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome. You're tuned into this special episode of Future Female Forward, the Women's Collective, Season 4. And while we talk about equity and the other aspects of how women can be bigger participants of the economy, of course, finances, how they invest and how they are part of the overall economy makes a very important conversation to talk about. This is something that we are going to be discussing on the show today as well. And to join us today and have a conversation, we have with us Avinash Tatwalekar, who is the president at Franklin Templeton Asset Management India Private Limited. Avinash, thank you so much for joining us on the show today. And there's this interesting trip that you took. There's this campaign that Franklin has. Tell us more about that, Change the Soch. You traveled all the way from Kashmir to Kanyakumari.
Firstly, Sonal, thank you for having me on the show. And one slight correction. It wasn't Kashmir to Kanyakumari, it was actually the other way around.
Oh, sorry.
It was Kanyakumari to Kashmir, and it was done with that mind that we wanted to move upwards. So what the campaign was it's called Change the Soch, and it was a investor awareness drive. And the idea was to do investor awareness programs right at the grassroots level in rural India. So we started in Kanyakumari and finished up in Srinagar in 30 days. So did 4,100 kilometers, 21 cities.
Wow.
And 30 days, like I said. So.
Oh, wow. So, you know, something must have prompted this trip. It's a long one. Did you look at some data? Did you find some sort of inequality or inequity which led you to take this long trip?
So I'll tell you where it started, right? So in March 2023, for Women's Day, we had a gathering of all our employees in the Mumbai office, and I asked this what I thought at the time, a very innocent question that, okay, how many of you are investing in mutual funds? And pretty much everybody's hand went up. So I said, how many of you are actually deciding the investments in those funds?
No one.
Barely any, right? And so I was like, okay, well, I mean, so who's doing the investing for you? And it was pretty much any living, breathing male relative in the vicinity, right? So father, brother, cousin, uncle, whoever, right? And I said, why aren't you doing it? So the response was, well, I don't understand it. It's too complicated. I don't have the time. I don't like numbers. And so I mean, coincidentally, the one that said I don't like numbers happened to be in our finance accounting area. And I was like, well, you've got a problem then. If you don't like numbers, we should be worried about that, right? So I think that's where it started. And we started digging a little further, saying that, okay, why is that the case? And then, should we change this? And what happens if we try to change this? And so if you look at microfinance as a sector, right? What has their success been driven by? It has been driven by doing lending activities to the women in rural India.
Okay.
Right? And why is that? Because as decision makers go, women tend to think not just of themselves, but of the community.
That's true.
And the family.
That's true.
Right? Whereas men in general, and I'm generalizing here, not all men are like that, I get it, but tend to be a little more kind of what's in my immediate advantage, whereas women are more broader. So if we saw the success there, we said, okay, we've got to try and change it. So what are the problems here? And so that's where Change the Soch as a tagline came in. We did a series of ads actually that, as we found, was that it's not that women don't understand it. It's not that women don't appreciate it. But a lot of times, even women are biased against advice coming from another woman.
That's so true. That is. That's so much conditioning, actually.
Correct. So that is exactly it. It's conditioning. Why? It's cultural. It's social. It's thinking. Hence, Change the Soch.
Oh, okay. We need to change the conditioning, hence the search. So
Exactly.
it was a reason, it basically happened because of what you saw in a closed door meeting, right? But then you traveled across the city, across the country. Give us some instances which blew your mind as to, oh, this is what women are saying. How did it differ from, say, state to state or region to region? Every aspect or every culture is so different, right? So something that stood out for you.
So a number of things stood out, right? So then first thing, obviously, and this is not something that would be a surprise either to you or to your viewers, is that India is very diverse, right? It is every 50 kilometers, 100 kilometers, everything changes, right? From the topography, the geography, to the culture, to the language, etc., etc. But what really I found was that in the South, in general, where we started, literacy rates are significantly higher.
True.
Right? So we're talking about 90+%. Women's literacy rates are almost just as high. Right? So it's not a literacy problem.
Got it.
Whereas in the North, as you go, the literacy rates drop. Right? So there it is both. It's a literacy and an awareness. Whereas in the South, it's an awareness issue. So I would say that in general, right, a lot of what we were trying to do was to increase awareness around alternative investments, right? And so I found that the stark difference was not so much between kind of the North and South, it was also to a certain extent between urban and rural.
Okay.
So we're most exposed to urban,
Right.
right? Urban, the biggest factor is that you have access. In rural, you don't have access. And so that was very striking. Then there's a couple of other things where I found that women in general in urban areas trust brands, financial institutions, because there's an awareness level. Whereas in the rural areas, it's more about relationships and people. Because if I trust you as a person, then I will be guided by what you say.
They are very close-knit. So it really helps them. There's so many questions to what you said because, when we talk about mutual funds and the contribution coming in from women, even in urban areas, is low compared to men, right? They will still go to somebody or a male member in the society, as you said, you know, in the family, who will take up your investments, do it for you. When you went to those rural areas, were they not willing to do investments or were they just unaware? Because sometimes they're also scared to give their money to somebody who's an outsider, who's not in the vicinity. Was there fear, threat also there in their minds that, okay, if I give my money to somebody, they'll take it away and it's better in my cupboard right now or with my family member?
So there's two things, right? So one is, you know, there's this myth that women don't understand investing. And that is truly a myth. It's not that women don't understand investing. They're doing it all the time, right? So if you think about whether it's rural or urban, right? How many women and mothers run the house?
All of them.
All of them.
Yeah.
What are they doing? They're doing it on a budget. So what are the decisions they're taking? Those are asset allocation decisions.
True.
Right? I'm allocating to education, I'm allocating to food, I'm allocating to clothing. And in spite of all of that, I'm also allocating to saving because they managed to save out of that.
True.
What we're saying is you're already doing it. What you're doing on the saving side, you need to start converting into investing.
True.
Right? So that investing is now restricted to your point, what can I see, feel, touch, understand? And what do I know?
Gold, money,
Gold.
cash.
Right? Cash. Bank accounts now, because Jan Dhan has done an amazing job, so everybody has bank accounts and deposits. And then chit funds.
Yes, that is the biggest one in rural areas. It's so true.
So it's not that, so that's why I don't buy the argument that they're averse to risk, because a chit fund is a massive risk load, right? It's a fact that there's awareness and a lack of awareness that's the biggest problem.
So do you think, so how do you fix that first up? How do institutions like yourself, you did it, we need more participation from institutions coming by. How do we go about fixing this problem? Because maybe a 30-day trip that you took did put it in their minds, but we need a continuous conversation around it, right? How do we go about getting into the rural areas where maybe literacy is also low and so is the awareness?
So I'll tell you what, I think after the second or third stop, so I think I realized very quickly that what we're doing, I mean, it was to a certain extent, we have a hypothesis. And by the third city, we had proof of concept done. So this is needed. This is impactful. So then it becomes a bigger challenge. Okay, now we can't just do this once. It's not one and done. You're going to have to think of a way to continuously engage. Because once, I mean, one of the things that we found is that as you start talking to women about, so in Kanyakumari, we had 500 women farmers. Not one of them had heard of a mutual fund, right? I mean, we pat ourselves as an industry saying mutual funds are here, and we've done it. But the numbers are the numbers, right? I mean, we only have 5-6% penetration. So obviously there's a big chunk of the country. So it's not a surprise. But when you sit in a room and you're looking at 500 women and none of them has heard of it, right? By the end of the session, they felt confident enough to say, okay, what's the next step? So exactly to your point, what do we need to do? We have to increase awareness. And it's not just something that we're saying because the industry needs to grow, etc., etc. It is something that is important from a social structure standpoint. If you look at, I mean, those are the conversations we had. Very few of them have a retirement plan, have a retirement corpus. So right now, India is benefiting. Why? Because our demographic structure is a dividend.
That's true.
Meaning, we are under the age of 30 majority.
True.
What happens when that goes over the edge like most of the other countries in the world?
Japan.
Where is that social net?
We don't have it.
We don't have it.
Doesn't have it, yeah.
So you have to create, this is not about, I think you need to try and solve the problem when it isn't a problem. And that's what has to happen.
So is product placement not a problem? I'm not talking from a mutual fund perspective because a lot of products, there was a study which I read earlier that a lot of products are not constructed in a way which benefits women. A lot of them, a lot of financial products. Do you agree with that thesis?
So I'll tell you what, products are not structured for a gender. Right? Products are structured based on your understanding of investing and your sophistication around it. Let's take just simple things. Mutual funds to AIFs.
That's true.
The difference is not in whether it's male versus female. The difference is in my ability to understand an AIF complicated structure versus a straightforward, simple, transparent mutual fund. So it has nothing to do with gender. It has to do with the fact that, in general, we have tried to as an industry, constantly innovate. And that's what we need to do. But we do need to take a step back, I feel, and create a basket of solutions that are simple, that are straightforward, and are solving certain problems for women. Now,
yes, no,
before
please.
you get there, right, what are we talking about, right? There's not, the issues you would want to solve for are no different than the issues I'm trying to solve for when it comes to financials. But the method in which you go about doing it and the method that I, and I'm saying I as in male versus female, are different. Women in general, we have found, are goal-oriented, which to me is the absolute correct starting point for any investor. Start with what your goal is, right? And then fill in the blanks. Work backwards from there. Your product discussion is the last discussion. Your fund selection is the absolute last thing, because that is just a tool to get you to your goal. So there is no male versus female there. The only difference is women are far more goal-oriented, which means in our current structure, can we create goal-oriented solutions? And how do we do that? So I think the most recent one, the lifestyle funds, right? That SEBI has introduced a new category. Brilliant. Absolutely brilliant. Because then you have a certain target. Now, is it going to fit for everybody? No, it's not.
Really.
But you have multiple options in there, so you can find a fit. If that's not enough, we as an industry and we as a fund house also are looking at things to say, how do we kind of put these solutions together that will help?
That's true. We are reaching, I know we are at 80 lakh crore rupees in terms of AUM. We should be reaching 100 very soon in this fiscal itself. So we need more participation from women for sure. It's quite low right now. When we talk about how women invest versus how men invest, if women are goal-oriented, how do men go about it?
And I'm going to get in trouble with a lot of my friends here for sure, but I think men tend to be a lot more, I would say, target-oriented, return-oriented. And I think some of my friends have already heard me talk about this, but I'll tell you, it's the Saturday night problem. Because when you're sitting among friends on a Saturday night, when you have a conversation, we're not very broad-minded in the sense that we don't have variety of discussion topics. It's either politics or it's the markets.
That is so...
Right?
That is true.
So when you're talking about the markets, what are you going to talk about? You're going to say, well, oh, you know what? I just invested in something, it doubled.
This game, yes.
It doubled, right?
That is so true.
Now, if I don't have anything to contribute, and my answer is, well, I'm doing an SIP in a mutual fund and it's steady Eddie, I don't get invited next Saturday. Right? So that's the challenge. Whereas for women, they're not talking about that. I'm solving for a problem that I want to go on a vacation, or I want to go buy a house, or I'm solving for my child's education. 9 times out of 10, you're not even talking about that.
we spoke about your campaign and you covered it over India and you compared South versus North as well. Is it a global phenomenon as well? You've been across countries. Is it just not an India versus Bharat concept, but it is a global concept where women are a little more hesitant to be a part of the financial industry?
So it's different, right? So in developed markets, it's less of an issue. Because, see, let's go back to what the name of the campaign is. It's Change the Soch. In a lot of the developed markets, that thinking is not requiring a change. Right? So it's not that women don't think they can invest. So the problems there are not as complex as with us. In a lot of the Asian countries, there is some element of that. But it is far more, in my experience, what I've seen is that it's far more problematic for India. Because there is a lot of social, cultural biases, both obvious as well as unconscious, that are just there. And they are. I mean, I'd like to think I'm empathetic and I'm evolved, etc., etc. But I'm sure if you asked my wife, she'd say, well, you know what you said the other day. There would be some element of that. So that is what we have to change. And this is not, I mean, I had a really good meeting yesterday and it was pointed out to me saying that this is a generational change that we have to do. And that is so true, right? Think about your mother's generation compared to your generation. That change has happened to a certain extent. Now, your daughter's generation is going to need to continue evolving that. So that thinking has to change at not just, I mean, women don't need to change their thinking. To a certain extent, what is the change they need to make? Is to get the confidence and conviction that they can do it and they should be doing it.
I have to give kudos to whoever came up with this name, Change the Soch, because it's exactly what we need to do when it comes to every aspect of bringing equity, especially finances. Since I cover finances, I would like to talk more about that. In that case, do you think women need the confidence to invest themselves, manage their finances themselves, or they need more advice? What works best in the conversations that you had with those women?
And I think, I mean, I'll go back to one thing, right? A lot of the investors, and this is more generic, would benefit from advice. And it's not, I have nothing against do-it-yourself. It is do-it-yourself if you have the time and you've gained the expertise and you've spent time understanding it, by all means do it, right? But starting point, you need to have a good starting point. If you can create your own starting point and you've got your goals set up and you've got a plan in place and you don't move away, then do it yourself. The benefit of advice comes in when starting that plan, putting that plan together, and then adhering to that plan, especially when we're going through a period like this, where the markets seem to be just going nowhere. If it's up one day, it's down the next day, and for the last 15 months, it has gone essentially nowhere, right? So then you start, if you're doing it yourself, who are you debating that with? With yourself.
That's not a good debate to have.
It's a hard debate. It's not a good debate. It's a hard debate to have, right?
That's true.
Whereas, if I'm debating it with an advisor, well, one, I have an opportunity to vent my frustration. And then the advisor's job is to make sure that I stay on track and point out what my goal is and what are we trying to achieve and remind you of that. That's all. So I don't think it's a do-it-yourself versus. It's a function of, can you do it yourself? And are you going to be able to resist making the mistakes? And if the answer is yes, by all means.
I'm a part of a lot of these financial groups which are run by women. And I think the first question they all ask about is, which is a very good thing, how do we start our mutual fund investments? They're confused. They ask for advice. And they listen to many people. They have a counter question. They do not really agree with whatever advice they get. So I get what you're saying. It's best to have that conversation or debate with somebody who's giving you that advice, because you just can't go along with it the way it's been given. It has been such a great conversation. So I'll wrap up with another interesting question for you. This is about Change the Soch only. What is the next plan for Franklin here? And one big takeaway from your 30-day trip that you had, and something that you think should change the next time you visit the different cities or maybe the same people again.
Okay, wow. That was 3 questions rolled into one, right? So what is the big takeaway? Right? Is that I think the journey that we started needs to continue and get amplified in scale, in size, in reach. So that is something that, like I said, it's not one and done. That is definitely a big takeaway. What was the other question?
I'm so sorry. I just got too excited after all things that you told me. So you'll continue the journey, but what was one of the other big takeaway that you think needs to be worked on the next time that you meet them?
So the next time, so it's actually not so much the next time I meet them, right? It is making sure that they've moved further along in that journey.
Yeah, how do we
do that, right? So that's exactly what we're working on right now. How do we help them take that next step? Is that working with partners? Is that working with distribution partners? Is that working with our bank partners? Is that working with... Because you can't do this on your own. No individual fund house is going to be doing this on their own. It is going to be a collective that has to work. It is going to be a partnership across. So how do we do that? So we've now put together a plan of saying, okay, what are the different steps that are required, right? If you've all got bank accounts, that means you've all got Aadhaar, right? Do you have a PAN account? You have a PAN now. If you don't have a PAN, then making investments is a challenge. So how do we then help you get there? If once you've done that, how do you get... So it's a series of steps that needs to happen. The end objective is, if we can move that 5-6% penetration to 10%.
That's big.
It's huge.
That's huge.
And if we can move women's participation from below 20% to at least 50%.
That'll be big.
That'll be big. And this, it's not like it's impossible, right? If we move, I mean, you're already seeing B30 is much faster growing.
That is true, but then T30.
Right.
Low growth rates, so of course that will...
So it's low, small numbers right now.
Yeah.
But that growth rate, if it stays at the same level,
it will
become a sizable chunk. And that's what we need to do.
All the best to you for this amazing initiative that you have. And of course, CNBC TV 18 will help you go forward with that in whatever way we can get more women investors. There are a lot of financial products, even by the government, right? So in any way they can be made aware about them and do the process that you've been talking about. Such a pleasure to have you with us on the show today, Avinash. Thank you so much for tuning in.
Thank you very much. Enjoyed it.
With that, we'll take your leave on this edition of Future Female Forward. But stay tuned to CNBC TV 18 for more news and updates.
I'm Shireen Bhan. The headlines that we're tracking for you this evening, we bring you all the latest from the Beijing summit. The US and China vow constructive, strategic and stable ties as President Trump meets Xi Jinping in Beijing. Trump heaps praises on Xi, who says equal consultation is the way forward. The White House says President Xi expressed interest in purchasing more American oil to reduce dependence on the Strait of Hormuz. Beijing draws the red line on Taiwan. President Xi emphasizes that Taiwan is the most important issue in the US-China relationship and could lead to a conflict if handled poorly. Also tells American CEOs that the country's doors are wide open to the outside world and will only open wider. Taiwan reacts to Xi's warning, calls China the sole risk to regional peace and stability. The market extends gains for day two. The Nifty closes above 23,650. Broad-based buying today lifts most sectoral indices. IT remains the sole laggard. The rupee touches a record low of 95.96 against the dollar. The government bans sugar exports till the 30th of September with immediate effect and concerns over lower yields due to erratic weather. The ban will not apply to shipments to the United States and Europe under quota arrangements. Sugar stocks plunge in trade. Wholesale inflation jumps to its highest level in 42 months in April. This is surging energy costs push fuel and manufacturing costs higher. The government is yet to hike petrol and diesel prices despite OMCs incurring losses worth a claimed 1,000 crores a day. The union government may look at more measures to keep the current account deficit and balance of payments under control. This includes a targeted reduction in the maximum amount a resident Indian can remit abroad, concessional tax for foreign bond investors, and mobilizing funds from the Indian diaspora through a special deposit scheme could also be on the cards. That's a CNBC TV 18 analysis. Sunil Mittal lays out his 10-year vision of the promoter entity regaining 50% stake in Airtel as he gradually prepares to hand over the business to the next generation. Also eyes increasing Airtel's stake in its Africa unit. The suspense over the next Kerala Chief Minister is over. Congress chooses 61-year-old V.D. Satishan over K.C. Venugopal. Satishan was the leader of the opposition in the outgoing assembly, will be sworn in on Monday. Well, the top story that we are tracking this evening, the United States and China, the world's two superpowers, are setting their ties afresh months after trade warfare, technological restrictions and geopolitical friction. Now, China's President Xi Jinping welcomed his American counterpart at the Great Hall of the People, where he was greeted by a large military entourage and dozens of children waving flags. Trump was joined by a huge delegation from his administration, including the U.S. Secretary of State Marco Rubio, Trade Representative Jameson Greer, and War Secretary Pete Hegseth. Top corporate honchos, including Tesla CEO Elon Musk, NVIDIA's Jensen Huang, were also in attendance. Now, this is President Trump's first official visit to China in nearly a decade. Bilateral talks between both leaders lasted over 2 hours, after which the two presidents took a tour of the Temple of Heaven. Both the leaders are likely to have discussed the war in Iran, the contentious Taiwan issue, artificial intelligence and trade between the two nations. President Xi also met with U.S. business leaders, where he assured them that China's doors will only open wider to American businesses, adding that American firms will have broader prospects in the country. She also expressed hope that both superpowers should avoid conflict and wondered if the US and China could transcend the Thucydides trap. For context, the Thucydides trap refers to an idea that when a rising power threatens to displace an established power, the result is often war. Chinese state media also reported that President Xi hinted that US and China could come into conflict if the issue of Taiwan is mishandled. Meanwhile, President Trump described the bilateral talks with the Chinese president as great. He lauded the relationship between both countries, calling it better than ever. He even reiterated that both China and the US were going to have a fantastic future together. CNBC's Iman Havez joins us now to take us through what transpired today.
This was the handshake between President Donald Trump and Xi Jinping at the Great Hall of the People earlier today. This was the moment that the president flew halfway around the world for, is that warm greeting and hand pat in addition to the handshake there between the two leaders. They underwent a series of meetings, a bilateral meeting. Also, the president accompanied on this trip by a robust delegation of CEOs, some real American corporate firepower on this trip as well. The president in that bilateral meeting reaching for some superlatives to describe how important he sees this summit as. Here's what he said earlier today.
For those that say this is maybe the biggest summit ever, they can never remember anything like it. I can say in the United States, people aren't talking about anything else. But it's an honor to be with you. It's an honor to be your friend. And the relationship between China and the USA is going to be better than ever before. Thank you very much.
President Trump asked me to come to China with him.
Are you going to sell more chips to China?
Well, this is an incredible opportunity for me to represent the United States, of course, and to come support President Trump in one of the most important summits in human history. And the two presidents, President Xi and President Trump, have such a wonderful relationship. This is an incredible opportunity for us to rely on their relationships to build a much, much better partnership.
Xi Jinping, with some potentially stern language for the president, warning him on the issue of Taiwan, saying that if the issue is not handled properly by the United States, it could risk confrontation and conflict between the United States and China. So that was an interesting warning. And then that warning about the Thucydides trap, which I think is an interesting one. The idea that a rising power and an established power always in history end up in conflict, and can the United States and China avoid that dynamic? That was an interesting comment by Xi Jinping as well, saying that is one of the great questions of history that hangs over this summit.
Our colleague Iman Haveh is there reporting from Beijing. As we pointed out, President Trump extending an invitation to President Xi. September 24th is when President Xi is expected to be in the White House. On to the day's market action. The Sensex and the Nifty closed in the green today for the second straight session. The Nifty ending above 23,650. Bharti Airtel, HDFC Bank, ICICI Bank and Cipla led the up move today. 1% higher on the Nifty, the Sensex up 1% as well, and the Nifty Midcap Index and the Nifty Bank also closing about 1% higher. The Nifty IT Index was the only one that ended lower today. But the rupee has extended its losses, hitting another record low of 95.96 to the dollar. The currency also failed to hold on to its early gains despite reports that the government is considering a significant cut in taxes paid by foreign investors on local bonds. And staying with steps that the government is taking, it has banned sugar exports till the 30th of September with immediate effect, and concerns about lower yields due to erratic weather seem to have weighed on that decision. The ban will not apply to shipments to the US and Europe under quota arrangements. Sugar stocks plunged in trade today after that announcement. Manisha standing by with more on the impact this will have, as well as why we've seen the government move on this front. Manisha.
Well, yes, India has banned with immediate effect the export of sugar of various varieties, whether it is about raw or white or refined sugar. This is done until September 2026. India, though, will continue to allow that sugar to be exported, which already is an export pipeline under specified conditions. Now, India has taken this step, one, because we are looking at a lower crop this time around. The initial estimates were much higher at 30 and 31 million tons, but we do understand after various revisions that we stand at 27.5 million tons of sugar. Closing stock, government is very comfortable with 5 and 6 million tons, but what we have in hand perhaps is 3.5 million tons, which is 1.5 to 2 months of monthly of consumption, and that really is slightly worrying. And then you have an El Nino year, and the next season also is slightly under threat. So this is a step taken in that direction. Out of the 15 lakh tons that the government did allow to be exported, 6 to 7 lakh tons has been done, 6 to 7 is remaining. So this impact would come in for this one. If you look at the overall international markets, they have reacted in positive for this. You are looking at 2% of a jump up in New York raw sugar prices. London white sugar also gained up by nearly 3%. We are looking at a global deficit this time around because, one, there is lower sugar availability, and then more sugar is going towards ethanol. So Data Agro feels that 3.1 million tons of a deficit is what we are working with for this season. You have StoneX talking about 550,000 tons of a deficit as well.
Manisha, many thanks. Now let's talk about inflation. India's wholesale price inflation rising to a 42-month high of 8.3% in April. This is more than double from 3.8% in the previous month. Now the rise can be attributed to a spike in crude oil prices. The spike also marks the highest wholesale price inflation since 2022. Inflation in crude, petroleum and natural gas jumped to more than 67% from 36% in March. Inflation in fuel and power also climbed to nearly 25% from just over 1% a month ago. And remember, this is without having seen a pass-through as far as petrol and diesel prices are concerned. Now, the union government may look at more measures to keep the current account deficit and the balance of payments under control. This may include a targeted reduction in the maximum amount a resident Indian can remit abroad and concessional tax for foreign bond investors. Ritu joins us now with the analysis on the likely measures the government may choose to take. Ritu.
Well, after that gold and silver duty hike, policymakers are evaluating more measures to manage dollar outflows and support the balance of payments as the conflict in West Asia drags on and the risks build up. But of the many items under discussion that we here have been reporting on, we understand that there are two active options under consideration. The first is on the liberalized remittance scheme. That's the RBI framework, which allows Indian residents to send up to $250,000 abroad every year. Now, a large chunk of these outflows, somewhere between 75 to 77%, go towards what policymakers classify as non-essential spending. So foreign travel, gifts, property purchases, equity investments, etc. International travel alone, by the way, accounts for more than half of all of our outward remittances under LRS. Now, sources tell us policymakers are evaluating whether to tighten these limits, and there's a playbook for exactly this. In 2013, the RBI had cut the LRS limit from $200,000 to $75,000 to ease pressure on the rupee, and today, a similar move, our sources indicate, can potentially keep more than $22 billion from leaving the country. So that's a big one. The second big area is easier tax for foreign investment and government bonds. This is also being considered. Remember, a concessional 5% tax rate for foreign investors buying Indian government bonds existed. It expired in 2023 and the rate then reverted to 20%. And we now understand that there is a view that a stable lower tax rate could help attract long-term global capital into Indian bonds. Other options, including the special NRI deposit scheme that has been used several times in the past, that is also part of the broader discussion, although attracting these kind of flows will be tougher this time around, given the much higher US interest rate.
All right, Ritu, many thanks for joining us. So that's a CNBC TV 18 analysis of the likely measures. Of course, we have to wait for official confirmation. Well, the two-day BRICS summit kicks off in New Delhi with the Gulf crisis taking center stage. Iran's foreign minister accusing the U.S. of bullying, urges BRICS nations to speak out against Washington's actions. That and more when we return. Well, here's the latest from West Asia. Tensions in the Strait of Hormuz escalate while the US and Iran continue to be locked in a stalemate. Crude prices remain elevated after reports of more attacks on oil tankers in the region. A vessel anchored near UAE's Fujairah port has been reportedly seized and is heading towards Iranian territorial waters. The United Kingdom Maritime Trade Operation said that the vessel was boarded by unauthorized personnel. This comes after India confirmed that an Indian-flagged vessel came under attack off the coast of Oman. The ship's crew was rescued by Omani authorities. A ministry spokesperson has called the attack unacceptable. Meanwhile, two India-bound vessels carrying LPG from the Persian Gulf appear to have transited the Strait of Hormuz. Both vessels switched off the transponders as they crossed the waterway. Meanwhile, Prime Minister Netanyahu confirmed that he visited UAE during the strikes in Iran. His office called the trip a secret visit during which Netanyahu met the UAE's president. However, the UAE has rejected the claims as baseless. Iran's Foreign Minister Sayed Abbas Araghchi claimed Tehran security services were aware of the visit long ago. Without mentioning the UAE, he also warned that those colluding with Israel will be held accountable. Now, the two-day BRICS summit kicked off in New Delhi with the crisis in West Asia taking centre stage. Prime Minister Modi on Thursday met with Iranian Foreign Minister Abbas Araghchi and Russian Foreign Minister Sergei Lavrov on the sidelines of the summit. Now, during the meeting, Iran's foreign minister has urged the bloc to condemn violations of international law by the US and Israel. Addressing the BRICS summit, Araghchi also called for coordinated action to, and I quote, stop warmongering and end impunity for those who breach the UN Charter, end of quote. Meanwhile, External Affairs Minister S. Jaishankar, addressing the blockade in the Strait of Hormuz, called for safe and unimpeded maritime flows through the strait. He also acknowledged that international relations are in a considerable flux, adding that there is a growing expectation for the BRICS to play a constructive and stabilizing role. The call for the BRICS to back Global South cooperation has also gained momentum. Speaking to Network 18, Thailand's foreign minister said that the BRICS reflects a fragmented world that needs inclusive global governance. He further warned of a global spillover due to the West Asia conflict and called for an immediate end to the crisis.
We meet at a time of considerable flux in international relations, ongoing conflicts, economic uncertainties, and challenges in trade and technology and climate are shaping the global landscape. There is a growing expectation, particularly from emerging markets and developing countries, that BRICS will play a constructive and stabilizing role.
Iran, therefore, calls upon BRICS member states and all responsible members of the international community to explicitly condemn violations of international law by the United States and Israel, including their illegal aggression against Iran, a member of BRICS, prevent the politicization of international institutions, and take concrete action to halt warmongering and to bring an end to the impunity of those who violate the UN Charter.
Our colleague Abhimanyu joins us now with more. Abhimanyu, what are you picking up on the outcomes of the BRICS summit?
Well, the first session has already been concluded, which was followed by all leaders who had congregated for the BRICS foreign ministers meeting India's Prime Minister. Currently, the second session is underway, which would be followed by a third session tomorrow morning. Now, it remains to be seen whether there would be any outcome document which would emerge out of the entire meeting. However, the address which was initiated by the chair of the summit, India's External Affairs Minister, Dr. S. Jaishankar, he had called for an unimpeded access to world's waterways. He had called for economic resilience, and he had called for clearer and more open supply chains to ensure that there is no discrimination against developing countries with respect to levy of any unilateral coercive sanctions. Now, he has also urged the international community via BRICS to condemn cross-border terrorism and all forms of terrorism. He has called for diplomacy and dialogue to resolve all ongoing conflicts, including the ones in West Asia as well as several parts of the world. Now, India has also called for the fact that unilateral sanctions go against the very grain of the UN Charter and should be condemned, should be done away with. He also indicated that they disproportionately affect developing countries and cannot substitute dialogue, and nor can pressure replace diplomacy. So very clear words which were marked by India's External Affairs Minister, even as the trade wars continue to remain and prevail in certain parts of the world, and also remarks which were made by Iran's minister indicated the fact that he has condemned several actions of the United States. He has also exhorted several BRICS members to stand with Iran. Now it remains to be seen whether there's going to be any open show of support from several other BRICS members as far as Iran's remarks are concerned. Also, Iran's foreign minister had accused the US of bullying and had called for condemnation. And on the other hand, India has called for multilateralism as well as availability of digital access to all developing countries. So different issues have been pointed out, ranging from geopolitics to end of wars, as well as provision of digital access to developing countries. So a litany of issues which have been pointed out today, and the meetings are going to continue till tomorrow. It remains to be seen what is going to be any outcome document or any degree of concurrence which all the leaders who have congregated are possibly going to achieve.
All right, Abhimanyu, many thanks for joining us. Bharti Enterprises Chairman Sunil Mittal has said he expects the promoter group to gradually hand over the reins to the next generation over the coming decade. Speaking at an earnings call, Mittal added he plans to restore promoter holding in Airtel to above 50% through Bharti Telecom. He also eyes increasing Airtel's stake in its Africa unit.
This Africa exchange of shares that was announced yesterday is akin to, acquiring another company of a large size. A $3 billion transaction means you're making an acquisition, and you're making an acquisition of a business that you know deeply well, a business in which all of us are working day and night, adding value. We need to own more of it. And if some other block comes from any other investor to Airtel's attention, we will probably, in the next several years, get to that point of owning more of Africa so that we can get more income flowing back to the mothership, Bharti Airtel. And then after giving allocation to all this, if we are still left with more money, as I mentioned, we'll do more dividends, we'll do buyback programs, but we'll never become like IT companies who have done nothing but just taken money out as dividends and buybacks, and they become a shadow of themselves.
Well, that's Sunil Mittal. Now, the suspense over the next Kerala Chief Minister is over. The Congress has chosen 61-year-old V.D. Satishan over K.C. Venugopal. Satishan was the leader of the opposition in the outgoing assembly. He will be sworn in on Monday. Neetu Raghukumar joins us now from Trivandrum. Neetu, what tipped the scales in Satishan's favour?
Congress has finally announced their Chief Minister candidate after 11 days since the results was announced. V.D. Satishan, the opposition leader, has been elected as the Chief Minister of the Congress. It was a tough fight between opposition leader V.D. Satishan, K.C. Venugopal and senior leader Ramesh Chennithala. But finally, it is in favour of V.D. Satishan. Most of the MLAs stood with K.C. Venugopal is what we understood. And Ramesh Chennithala was expecting that his senior position, being senior to both these leaders, and also the fact that he was also working in the past 5 years. In the previous term, he was the opposition leader. So Ramesh Chennithala thought all this would work in his favour. K.C. Venugopal thought that having the maximum number of MLAs would work in his favour. But V.D. Satishan had the support of the alliance partners. Most of them said that we need to understand what is happening on the ground. We also understand that senior leaders of the Congress, including Sudhiran, A.K. Antony, have all communicated the situation on the ground. So this is what finally led to V.D. Satishan being appointed as the Chief Minister. The swearing in will be on Monday is what we are understanding. The alliance partners, the ministers from the alliance will also be swearing in. We'll have more clarity on who all will be swearing in, or whether the entire cabinet will swear in on Monday. But the swearing in is on Monday is what we are understanding. So V.D. Satishan is the new Chief Minister of Kerala.
Yes, the suspense finally over. It is V.D. Satishan. And Neetu, many thanks for joining us. And that wraps up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more. getting a house help is not a new solution.
We had cabs always.
Yeah.
Right? We had Kali Pilis going around.
Yeah.
So then why the Uber, why the Ola? We were the first ones to come up with the on-demand hyper-local concept of providing services in minutes.
What people are coming to Snabbit for?
So we're talking to the couple. I asked them, so what do you use Snabbit for? And the husband goes that, my wife asks me to peel the pomegranate every morning. So I've just started outsourcing it to Snabbit and I probably get 15 minutes extra of sleep. People feel that they might want to just outsource to someone reliable. Snabbit is an answer to that. They make Snabbit a habit.
Outsourcing your chores to Snabbit to keep the marriage equilibrium going. What was that first market experience?
We started in my society, which had 500 flats. I basically went down to the security guard and bribed him to send me a lot of house helps. Only 5 of them showed up on day 1. On day 2, it was just 3 people. One of the biggest learnings on day 2 was that time-based pricing works. Task-based pricing won't work.
$100, 150 rupees an hour is not even minimum wage.
So the expert is paid roughly between 80 to 100 rupees an hour. So think of an expert doing 12 hours. That's roughly around 1,200 rupees a day. 30 days, that's roughly around 36,000. So it's well above minimum wages.
So are there boundaries to what Snabbit can do?
Cokes goes live in Bangalore this month. We didn't do it under the Snabbit brand. We did it under a pseudonym brand.
What was the pseudonym, if I may ask?
It was called Gook.
Gook.
We didn't spend a lot of time. We just took the C and made it a G.
What do you make of these robots that are opening microwaves, pulling stuff out of the dishwasher, literally doing your bed sheets and your bed covers and laying out the bed for you?
Just the way that it's difficult for us to imagine driverless cars in India. At this point in time, it is also very difficult for us to imagine robots entering our homes.
From cleaning to cooking, India's everyday chores have long relied on an informal offline network which is unpredictable, fragmented and hard to scale. But now the $60 billion home services market is getting a tech upgrade. Startups have turned home services into a fast, reliable, on-demand experience for consumers. And one of the companies that we speak to today is doing exactly that. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. What began as a hyper-local play in Powai in Mumbai in 2024 has quickly scaled into a high-frequency platform and today is looking at bringing cleaning and organizing services to your doorstep in minutes. In under 2 years, the company has grown from clocking over 1 million jobs a month and nearly 50,000 a day across 100+ micro markets in 4 cities. Backed by over 60 million in capital, Snabbit is doubling down on its depth-first strategy, driving density, reliability and repeat usage. Now, as competition intensifies and capital flows in, the big question is, can instant home services be India's answer to quick commerce, and could it emerge as the next category disruptor? Joining me to talk about all of that and more is the man who founded Snabbit, Ayush Agarwal, the founder and CEO. Ayush, great to have you join us here on Young Turks Reloaded. Thanks very much for joining us. Getting a house help is not a new solution, neither has it been a problem that hasn't found many answers to. It's been different in different parts of the country. Why do you then believe that this is, in your words, the category creator moment of the decade?
So look at any of the other categories, right, which you interact with on a daily basis. Groceries, intracity logistics, food, travel and entertainment. You'll probably have to press 2-3 buttons on your mobile phone right now to get an answer or to get a ticket to somewhere, get a cab or get a packet of chips. And compare it with how the house help segment operates, right? Completely informal. If you need another house help, it's probably a month-long journey to find someone reliable, only to find out 6 months later that the person leaves. Even during those 6 months, they take multiple leaves, which are erratic in nature. So this category is basically like, for example, we had cabs always, right? We had Kali Pilis going around. So then why the Uber, why the Ola, right? So the answer is that, the category is operated offline. There's a significant wallet share that exists for every urban household. It's just not been digitized. It's not been made convenient. And that's what we are doing. And we're doing it slightly differently. All the effort that was made before Snabbit launched in this category was to either create an agency of sorts, a digital agency of sorts, or to offer subscriptions. I think we were the first ones to come up with the on-demand hyperlocal concept of providing services in minutes. And I think that did not just found great acceptance, did not just find great acceptance from the consumers, but I think it as a platform really worked with the supply side as well.
I want to go back to your time at Zepto, because that's really, when we're talking about category creation, the 10-minute quick commerce category has seen an explosion in the last few years, and Zepto has been part of that. Now, what was it that you took away from the Zepto experience, and did you actually pitch this idea within Zepto?
Yeah, I think so. So obviously, like the fundamentals of business building at rapid pace is what I learned at my previous organization, which was Zepto. So when I decided to start up, it was not about, I think I took 12 hours to come up with what I need to really build, because the experiences that I had faced as a consumer made it very clear to me that this was the problem worth solving. I remember it was November 2023 when I decided that, this is probably going to be what I'm going to be doing. And my last day probably was in January sometime. So Friday was my last day. And I remember Monday when I took a shower and I came out, I was on a WhatsApp group. Adit, who's the founder of Zepto, had connected me to Suvir, who's the founder of Nexus Ventures.
Yes.
They're also obviously large shareholders of Zepto, and I had the privilege of interacting with them while I was there. And he said that, look, this is one of the most high quality investors and you should definitely chat. The next thing I know, 24 hours later, I'm on a Zoom call with him. 48 hours after that, we're doing an IC meeting. I didn't even know it was an IC meeting until afterwards, which by the way, went really badly.
Why?
Because I was not prepared. I just thought that we're discussing the idea, and I show up for a meeting with 20 other people. And I just rambled through some things. And see, the other point is that this category had been written off. For a long time, people believed that nothing can be built here, because my understanding is that the right team, the right business model, and the right capital had not come together. And for large-scale tech disruption, that's a prerequisite. And I think I remember spending a month going to Nexus's office, spending time over there, going back and operating, coming back with learnings before they actually came in and said that let's do this. And I think that was a great journey, because that's when we really got into the trenches, operated. I was the cluster manager, I was the customer support agent, did everything on my own and understood in depth what are we really building, and made those very, very critical pivots in that period of time, which ended up shaping this category for what it is now.
What you said reminds me of the conversation that I had with Albinder at Blinkit, and he said, there's so much attention on 10-minute, but we're not really solving for faster and faster deliveries necessarily. What we're really solving for is convenience, and that seems to be at the heart of your model as well. How have you looked at this issue of convenience and built that into the business model?
So I think for the longest time when we were questioning 10-minute delivery, I think the right question to ask was, who doesn't want it? And the answer is no one. So the fact of the matter is, no one ever said that I don't want things quicker.
Yeah.
So the thing that we have to do as entrepreneurs is go back and understand that does the operating system allow for it?
Yeah.
Just to give you an example, our experts, 98% of our experts travel on foot, right? They traverse an average distance of 300 meters between two jobs. At a speed of 3 kilometers per hour, that's roughly around 10-12 minutes. It's absolutely fine for an expert to travel 300 meters in 10 minutes and reach you. And if that 300 meters can actually reduce to 200 meters and she reaches in 5 minutes, that's great for everyone. That's great for the customer because they're getting services quicker. That's great for the expert because she's having to travel 100 meters lesser. So as long as the operating system or the business model that you have actually allows for faster delivery or faster access, it's a win-win.
You're right about the fact that nobody's saying we don't want 10-minute delivery. The question is that model viable in itself? And I think we've seen the regulatory pushback. We've seen the government coming out and saying, at least don't advertise 10-minute delivery anymore. And whether or not we're now going to see the government push back and say a minimum wage is going to have to be part of the model and so on and so forth, we don't know. But those are, I would imagine, issues that you're working to preempt.
Yes. So I think all those concerns are very fair. I think the 10-minute delivery comes into question from a safety point of view, right? And as I said, 98% of our experts are traveling and they're traversing a distance of 300 meters between two jobs, which actually makes it perfectly safe and convenient for these experts to travel. We have already started building a lot of the a lot of the social security measures that may or may not come into force.
Okay.
But we do feel that for our experts, it's the right thing to do. So whether it is insurance for the experts and their family members, whether it is access to loans, whether it is the access to early salary at the click of a button, we've already built in these features which are live for our experts, and they're actually making use of it. So in a lot of ways, we've actually disbursed 100 crores till date to experts. And for almost 70% of them, this is the first formal source of income that they've ever had. So we're bringing these women who for years have operated in the informal sector, we're actually bringing them into the formal fold. We're empowering them with like insurances, not just for them, but even their families. We're ensuring them with access at the, like in 2 minutes, you can avail a loan of 50,000 rupees. So in a lot of ways, they're actually becoming a part of the financial fold and the formal fold of the ecosystem.
In your words, you said, we assume that the supply is scarce when it's not. But if that were to change and the payouts were to be higher, how will your business model survive that stress test?
Yeah. So I think the first thing around supply scarcity is that India has probably one of the lowest workforce participation among women.
Yeah.
These women don't have easy lives, right? They have to take care of the home, they have to take care of the kids, probably in-laws, which means that it's not easy for them to do a 6-day work week anywhere else. So the fact that they can actually be working somewhere where they could do a shift which is as short as 4 hours, or work for
and they can decide that.
And they can decide that, and they can do days which would be just probably 20 out of 30 and still.
But once they're on that shift, if they sign up for whether it's 4 hours or 8 hours or 12 hours, once they sign up for that shift, then they cannot reject work that comes their way.
Once they show up and once they're at the location and they've logged in, then they're expected to accept jobs. Even then, they are given certain amount of leeway in the number of jobs that they could reject per week. So we obviously build for exigencies that could happen, but it's not a given that every job that comes to them, they have to accept it. The other part is that they could just show up 20 days a week and still 20 days a month and still it works. So that flexibility in shorter shifts and choosing which days you want to work.
Okay.
It actually allows them to lead a very comfortable life and actually start earning, something they might not have been able to do in the absence of a platform like Snabit.
So what is the average earning of an expert on Snabit today?
The average earning of an expert depends on the number of hours she works.
Yeah. So assuming they do 4 hours.
If they're doing 4 hours, it's roughly around 10,000.
Okay.
If they're doing 12 hours, it could go up as high as 40,000.
So let's talk about this volume of work that is going up at this point in time. You've just done a milestone for March, where you've done your highest number so far. What is that?
That's 1.1 million jobs.
1.1 million jobs. Now, what are the kind of people that are actually using Snabit? Who is coming to Snabit at this point in time?
So I will talk about 4 use cases, four different types of people. Our core user that we go after is a mother. She needs to manage 10 things at home. She has a house help. The house help doesn't show up twice or thrice a month. She has so many other things to take care of. Snabit becomes her go-to default. The second user is a working couple, right? Is a double income, no kid family. They actually prefer convenience and flexibility more as opposed to predictability and rigidity. The third kind of customer that we're going after has full-time house help, lives in a 3 or a 4 BHK, and has all the needs. But even for them, they want to supplement the work that their house help needs to do. So I call it help needs help. That's what they end up using us for. And the fourth and the most interesting part is that for a lot of homes and lower income households, it's not always possible for them to have a house help for the entire month. So that's the fourth kind of cohort which is actually starting to use these services.
$100, 150 rupees an hour is not even minimum wage. And that's where I'm pressing you on, that if you were to move down the road of minimum wage, will this be viable for the customer and for you?
The maths works out in a way that if you're basically paying 150 rupees, I am able to make profits at a certain utilization number, and the expert's earnings need not be sacrificed. So the expert probably is paid roughly between 80 to 100 rupees an hour. So think of an expert doing 12 hours, that's roughly around 1,200 rupees a day. 30 days, that's roughly around 36,000. So it's well above minimum wages.
I would imagine that this also requires a whole ecosystem to sort of come together, right? Between law enforcement, RWAs and so on and so forth. And a whole bunch of them have their own set of rules. They're operating as independent nation states almost. What has that experience been like for you, actually on ground in the trenches of being able to roll this out over the last 2 years?
So I think, again, the 1 year in Powai really helped, because at that point, I was the one who was talking to all those RWS secretaries, going into their homes, seeking permissions. And at the end of the day, they're looking for safety for their residents, right? So I think those learnings around what are customers really seeking for, what are the questions that they have in their mind, knowing them and proactively addressing them has basically allowed us to go from roughly 20 micro markets in June to 120 micro markets today, and not face any significant difficulties.
You know, when you talk about micro markets, and again, these are so local. I mean, this is as hyper local as it gets. What has been the challenge of being able to operate at scale from a Chembur to, you know, a Noida, and what have been some of the differences that you've had to incorporate as you go along, as you've expanded nationwide?
There are core playbooks which don't change, which is like, you know, what are we really solving for? How does the operating system work? How does the network design work? And then there are things which change with the kind of customers there are. For example, if you're launching in South Mumbai, you cannot really do RW activities. You have a lot of flatbed over there. So the way in which you reach out to your customer or the way in which you market to your customer is very different in South Mumbai versus what you would do in Noida, where you can probably, like, you know, collaborate with RWAs and actually have activities. We actually divide our micro markets into nano markets, and operate in, like, you know, even
what's
smaller.
the density when we differentiate between a micro market and a nano market?
A micro market has 25,000 households at least. A nano market has at least 2,500 households. So sometimes a nano market could just be a large society. And again, this is important for us because our experts are on foot. So they actually operate within nano markets, which is even a condensed version of what a micro market is for other businesses.
What are the kinds of chores that you know, a Snabbit expert is doing in the household today?
So I'm going to give the interesting answer and the plain Jane answer. The plain Jane answer is that, you know, you
everything,
right? Like cleaning, dishwashing, laundry, anything you need for. But the interesting answer is that there are customers who are frequent travelers who call our experts very frequently to unpack their suitcases. There are a lot of people in NCR who basically call our experts every time the winter's getting over, then they want to peel peas and store it in a container, because that's a tradition of sorts, right? That happens in every household. Micro tasks which you would never imagine being outsourced, watering plants, right? All of these are now a part of what's.
So you had a Mali so that's being outsourced to Snabbit as well.
Everything and everything that people feel that they might want to just outsource to someone reliable, Snabbit is an answer to that.
Are there limits? Are there boundaries to what Snabbit can do or will not do?
So we basically want to disrupt high frequency services. If you look at an Indian household, the second highest wallet share of discretionary income is on services. That is roughly 50,000 a year, right? The only category which has the highest wallet share is groceries. And if you look at online food ordering, if you look at logistics, etc., these are at least 50% lower. So this is basically a 5 lakh crore market where 98% of the transactions are still happening offline. It's a phenomenal category to build in. And what we think is the category of the decade. So we want to, and the way in which all of this service consumption happens is through high frequency services. In India, consumers really, like if you look at grocery, if you look at the 100 rupee rides on Rapido, consumers are going for everything that's very high frequency and low AOV. And that's the predominant way of consumption in services as well. And we're basically building right at the heart of it. So Snabbit will expand into other high frequency services.
Like what?
Cooking, childcare, elderly care, drivers, health and fitness, anything where you can imagine someone to show up in like 10-15 minutes, help you out. It could be with a yoga class, it could be with a meal, it could be with just taking care of your kid, anything.
And how soon will we see some of these new launches?
We're launching our second category in this very month. So Cokes goes live in Bangalore this month, which we've piloted over the last 6 months. The outcome was exactly the same. An average customer was using us roughly 3.5 times a month. There were primary and secondary cases emerging. Retention was extremely strong. The NPS was very high. We ran it for 6 months within a micro market, scaled it to roughly 200 jobs a day. And now we've decided to fold it into our platform.
You've raised raised a significant amount of money. You're in the market looking to raise another round at this point in time. What are you using the money for?
So I think, as I said, right, when in January we were doing 100 jobs a day. Today we're doing 40,000 jobs a day. We think that this category can grow from 40,000 jobs to 1 million jobs a day in the next couple of years. And that will mean that, we need to invest in building the right infrastructure, getting the right team, and educating customers, onboarding experts.
So you're using the money to on your real line, which is the experts, or are you using it to acquire customers?
So I think the part about building a marketplace is acquiring the expert and acquiring the customer. So that's obviously the right investment to make, and that's predominantly where I would say roughly 50% of what we spend every month goes towards. Obviously, a lot of it is to solve for runway and to solve for the fact that we're always incredibly well capitalized.
How much runway do you have today?
A few years. So yes, it's safe enough. But I think the growth trajectory that we're on, the fact that we want to launch more cities, more categories, we think that it's always good to have enough, a strong balance sheet. And I think that's why we're raising capital.
What is the expansion plan now? You said you're in 120 cities. How
120 micro markets.
120 micro markets. Yes. So how many more micro markets do you intend to add?
Our plan is to go deep into micro markets as opposed to expanding into more. So while we might continue to increase to 200 by the end of the year, a lot of our focus will be on generating more throughput for every micro market. As I said, driving density within a micro market solves for the customer because they get faster, reliable services. It solves for the expert because they get to earn more because there are more jobs. And it solves for the marketplace because it gets closer to being profitable. So that's where our focus is today.
So back to the funding, how much money are you looking to raise, and what's the investor response?
So I think, we were the ones who created this category. Back in 2024, the leap of faith that investors had to take was that, is this working? Is this going to work? I think that answer has been answered. So the fact that this really has very, very deep product market fit is something that investors are very clear on. Another thing that investors are extremely clear on is how big this category is. And I think the only question that investors currently have is around the economics of the model.
Yeah.
Which I think to a large part we've solved for. But yes, having said that, there's a lot more work to do because it's not just about few micro markets, it's about making more and more micro markets profitable as they become mature. And I think that's the one thing that will play out in the next couple of quarters for us. But overall, I think investors really understand this category. They're very excited. Given that I call it urban India's last offline habit, because when it comes to consumer internet, it's most of the large wallet shares have already moved online, and billions of dollars have been created in terms of market cap by internet first companies.
Yes.
So the kind of opportunity that we're sitting on here with instant high frequency services does not exist in consumer internet, in our opinion. So I think investors are really piqued and interested about it. It's just that as economics get proven out, this category will get more and more interesting.
Consolidation. You've just done the Pink deal. Do you see more of that?
I think this market should consolidate because as we've seen, most of the consumer internet categories have 2 or 3 players. And I think the acqui-hire that we did of Pink has been really helpful. The team has actually folded into the Snapit ecosystem and is helping us massively. I don't know if there'll be any further consolidation, given that all players have enough pools of capital. But we do see this as a very execution heavy business, and we do see probably a couple of players emerging out of this.
What is the moat to your business? What is the moat for Snapit that you're working for?
When you think of a moat, you basically, in a marketplace business, one of the biggest strengths is network effects. Those network effects are basically what we term as density, right? If you're a hyperlocal business, you need to win every hyperlocal market that you operate in. And you can only win it by being the most reliable platform, because if you're reliable, that's when customers opt for you first. And that is a function of just driving more and more density. So for us, the entire business or the entire playbook today is geared towards driving density in our existing micro markets, as opposed to going wide, opening multiple micro markets. It's very easy to get the first 100 jobs in any of the top 1,000 micro markets in India. It's very difficult to scale a micro market to 1,500 jobs, which we have for multiple micro markets. I think we're taking the tough task because that's the only way to building a sustainable, reliable business which works for all 3 stakeholders: the customer, faster, reliable services; the expert, higher earnings; the platform, higher utilization, hence profitability.
What gave you the bigger high, the first 100 jobs or the million number that you've just crossed?
I think it was the first 50 jobs. I still remember it was our first weekend, and we got to 50 in that number at that point. And then it took us a long time to get to 100, very honestly. But when I hit that 50, I think I've never looked back from there. Today, we're really not obsessing about those milestones. We're obsessing about like the core fundamentals of the business.
So if I would ask you to lay out for me the vision statement that you have over the next decade, because you believe that this is going to be the category of the decade, what would that be?
The top 50 million households in India use us every month. Like we're basically changed the way in which services operate in the country.
Okay, that's Snabit for you.
And the second thing is that I think people start recognizing house help as a term. So I think what in the previous decade was a maid or a bai or a didi is now an expert, is a house help, is a professional. I think that's the journey we want to have in this decade.
Thanks very much, Ayush, for joining us here on Young Turks Reloaded. We wish you the very best of luck with Snabit, and we look forward to hearing much more from you on your growth plans, as well as making Snabit a habit for a large part of India and Indians. Thanks very much for being here on the podcast. With that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, if you enjoyed our conversation, send us your feedback. We always like to hear from you. Till next week, from all of us here on the team, goodbye and many thanks for watching.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
I don't know how to start this without being a fanboy of all the products that you have to offer, be it, some of the Ginger hotels because Taj I can't afford. Leela's you see from outside, take pictures of. District is where you open the app and, you look at the tickets which are all sold out. So I'm a disgruntled customer, aspirational customer, and maybe an analyst of the space as well. We can't start this without addressing the elephant in the room. The conversation that came from the Prime Minister, asking people to exercise restraint when it comes to consumption, travel, extravagance, all these things to save on Forex. Where do you all stand on that? Do you all benefit from it because domestic tourism gets a boost? Or do you all not benefit from it because people are now in saving mode? Let's start with you, Puneet.
With me, firstly, I have to say, God helps those who help themselves, so please help yourself. If you can't afford a ginger, I'm sure you cannot afford garlic either. So.
No, I can afford a ginger, not the Taj.
Okay, so now on the, I don't know the names you use, I cannot use that name, but given the latest, what you're referring to, I don't know, it could be very good for the experience economy. It could be very good under the aspect of Dekho Apna Desh. It could also turn out to be very good to add Make in India, Heal in India to Wed in India. Not only for Indians, but also for foreigners coming into India. So I think it could be positive. On the other hand, I think we are all a bit speechless thinking, is there more to it? Is there something that we need to know? Should we be more careful? Should we be, cautious or thinking about what else to expect, what is coming our way? So I think at the moment, at least I am trying to digest the news and see how things pan out day after day. We are also living in a geopolitical world where a statement made in the morning may not hold true, forget afternoon or even, no. Even late morning the statement is false. So I think we need to get through that over the next week or a few weeks, and by the end of the month or early next month, we'll know more.
Right. Anurag, what do you think about this?
I'll just add on to what Puneet said. I agree with him. It's a bit early stage for us to know what's going to be the full impact of Honorable Prime Minister's statement yesterday. But typically, if you see India's context, the months of May, June, and July are holiday seasons, school vacations, a very strong domestic uptake any which ways. So that is going to get further amplified, what we believe. And if you take a step back and look at India's overall outbound, the number of affluent Indians who take international trips is nearly 3x of the inbound. The inbound to India, the international tourists that come to India, is pretty submissive compared to anywhere else in the world. So in that sense, in the long run, it will provide a deeper opportunity for us, but it's early stages to see how specifically it will pan out in the next few months.
You know, before we go to Rahul, I have to ask you this, because you said it's a little early to digest the impact of this news. I can tell you from the stock market standpoint, 12 lakh crore of market cap erased. And the wealth effect obviously has an impact on how luxury products sold by you guys are consumed. Do you think that could be a bigger worry than what the Prime Minister has said? Because the underperformance of the stock market, the underperformance of portfolios, could that have an impact on consumption of your products?
You know, if we take a pessimistic view, we have a lot to worry about. If we take a realistic view of what we know and what we think we know, then there is nothing to worry about. So I think what we don't know. That's what I said. So at the moment, things are fine. May, Anurag and I were chatting outside. May is off to a very good start. Of course, the first 15 days of April were not as good. June, the business on books looks good. I hope it stays that way, but also it's a bit unfair comparison because I mentioned it on your channel. You know, we had Pahalgam in April and we had Operation Sindoor in May and we had the airline accident in June. So a lot went wrong in the first 3 months of the same quarter last year. So at the moment, the way we see things is fine. And more importantly, I think we tend to underestimate the safety and security. I think the safety, security of people, our customers, etc. today is very good. And including in places like Middle East where we have an operation, we can say we've not even had a very small incident that could have impacted us. So I think that's the way we are thinking at the moment. The business goes up and down, and it will come back with a big bang.
All right, business goes up and down, come back with a big bang. You know, what connects the three of y'all is, it's a very interesting thread where, say, for instance, District is something that started from an organization that always believed in giving comfort to people in their houses, right? And now you are suddenly asking people to get out and the opportunity that there is. So I'd like your thoughts on, you know, what were those initial pitch meetings like which said, oh, there is a TAM, or total addressable market, in this experience economy? What were those qualitative and quantitative parameters that you all discussed before actually jumping headlong?
First of all, thanks for having me, and starting with a softball about the PM speech. But yeah, I think, see, the way we look at it at Eternal is that we build for convenience. So the common threads across all our businesses is what can we do to make urban lives smoother, friction-free? And this seemed like a large segment out there which nobody's addressed the way we are thinking about it. And so we are just about, removing that friction and helping more people consume outside of their homes. And we know directionally it's a larger TAM than at-home consumption. So.
Right. And the reason I call it a common thread is because all of them actually had to get out of their skins to do something and succeed at that. And that's exactly what Titans stand for as well. Anurag, you know, when the Leela was taken over by a private equity firm, obviously the brand that stood, there was a fair amount of headroom for growth out there. But there were other brands that were offering similar services and experiences as well. What do you think made Leela the attractive bet that you all made on? And what differentiates your quality of service from, say, some of your peers?
Thank you, Mangam. That's a great question. So Leela has been in existence as a brand for the last 4 decades.
40 years.
40 years, that's right. We celebrate 40 years of Leela this year. When legendary Captain Nair founded this brand, the moat was very clear, the finest asset quality, the finest level of service. And this is something that we have singularly preserved all throughout this journey and continue to do so. What really enabled us with post the acquisition of Brookfield in 2019 was the scale, the access to capital, a disciplined asset management approach, and our ability to put all things together to grow mindfully and deliberately whilst keeping the singular focus on luxury. So we have further fine-tuned our services, our programming, our experiences, which is evident from the results that we are doing quarter on quarter. And we believe, because in this particular space, there is a lot of runway ahead, and there are tailwinds at a macroeconomic indicators to support this focus on luxury from experiences, because that's where the new consumer is moving, and that's what they want to experience.
Right, and that brings me to Puneet now, because again, something that is not of extreme comfort to a group that was earlier known as the Taj Group and now known as the IHCL Group, largely because you wanted to diversify your revenue coming out from Taj, get into products which are not more luxurious than Taj, but more affordable, accessible to people like me, say something like a ginger and all these things as well. So what was the call that you took out there when he's saying that there is a lot of headroom for growth in luxury? You're also seeking something at below the luxury pyramid as against above.
Wow. Is this working? Yeah.
Yes.
So I think, firstly, we have to take a step back. The evolution of the nation was reflected in a group getting called Taj Group, which was never the name. The name given by the founder was Indian Hotels Company, and that is going to have its 125th AGM this year in June. So it's not a name founded.
We have 40, 125, and 2024. Yeah, so 1.5 years.
So now that's the starting point. The philosophy behind calling it the Indian Hotels Company was to give an answer to the society where it was written on the hotel's doors, dogs and Indians not allowed. So
Yes.
it was, for that time, a hotel for the Indians. Now, since then, 1903, when Taj opened, fast forward, 2026, India is 1.5 billion people. And even if 50% of that population is your TAM, total addressable market, and that includes people like Mangalam, we need a product for each of the Indians.
Thank you so much.
And
for
that's
considering
what
us.
we did in trying to leverage the strength of the Taj, all that the Taj had created, almost over 100+ years of legacy, and then obviously make it evolve into upper upscale, mid-scale, homestays, home delivery, and you name it, and catering units. And we became a very well-diversified portfolio, which is today very distinct by brand, by geography, and by contract type.
Got that. So diversification has been your journey. Deeper penetration into the luxury market has been yours, and obviously seeking further, formalization as the experience
By the
economy
way,
grows.
sorry to interrupt you, but at the same time, Taj has grown into the top 3 luxury brands in the world in terms of scale. It's getting close to 150 hotels portfolio, and still rated in the last 5 years as the world's strongest hotel brand and India's strongest brand across sectors. So that doesn't mean one thing does not exclude the other. So that just because we are doing more things does not mean we are not focusing on the Taj. That was, is, and remains the backbone. More importantly, the core values of Taj, what Taj stands for, I don't know anybody knows in the audience or not. The T of the Taj stands for the trust of all our stakeholders, A for the awareness of the communities we live in, act in, and J for the joy that I'm having right now in doing whatever we do.
Do you have a full form for Leela?
We have a caption though, true Indian luxury, but not a full form for Leela to that level. But I think adding on to what Puneet just said, I think if you look at brands from India, whether it's the Taj or us or anybody in the luxury space, they've always been considered as one of the finest amongst the top brands in the world globally. If you look at the voice of the customer and the customer love in terms of extremely well-accredited and well-known publications and Reader's Choice Awards and the gold list everywhere, you will always find a brand from India appearing in the top 3 or top 5, if not in the top first 2 positions.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe. Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Rahul, I have to ask you, the emerging economy around experiences, which is concerts, people traveling for meals, people actually going out of their comfort zones and perhaps spending a little more than what their pockets would allow for experiences more than things. Have you all put a number to how big this market could be, the rate at which it is growing, and the opportunities where the next $1 billion of revenue come?
So yeah, I think, almost every prediction that we make about numbers, every report gets it wrong. So we don't want to hazard a...
Gets it wrong on the downside.
Gets it wrong in terms of how big the market and how quickly it'll get there. So without hazarding a guess on what that number is, that we know that there are behavioral shifts driving this consumption, right? So today it's not, I think the value system and the trade-off that the next generation is making about how they want to spend their time is different from ours. And we see it play out, every day in the data that we see. So moving from products to experiences, living in the moment, not really bothered about how life will be 5 years, 10 years from now. But, if you have money to spend, go get that experience. That's why we see a lot of outbound tourism just for concerts today. There is, for large concerts, almost 40% of the crowd that we get is out of the city. So there's a lot of data that suggests that, this behavior shift is kind of happening and it's real. And we are kind of here to participate for that.
You guys are targeting, I'm looking at some numbers, 10,000 crore GOV by the end of FY26 was your last stated number, with 4 to 5% EBITDA, which obviously you're investing back in this business. Live event spends just on tickets was close to 21,000 crore in the previous financial year. And people spend 2.5 times more on travel to that concert and F&B around it. So if you double that, it's roughly 50,000 crores. What are the challenges? I have to ask you this, because for every great live concert that happens, there are a bunch of disgruntled people who say that we never got tickets because maybe the organizers gate-kept those, or we didn't get a good experience because the road to the concert wasn't as good, and all these factors. So what are the challenges while the opportunities are here for us on the numbers?
Yeah, that's a good question. I think there are a lot of people are curious about the industry now, and they are looking at the great outcomes. There are concerts that are full, they're selling out, even cricket stadiums are full and so on. But I think for us to be consistently delivering that kind of experience, the limiting factor becomes the physical infrastructure today. That's why we are kind of investing heavily on venues, because that's where the experience comes together. On the technology side, I think India is as good as the world, like our apps experience, how you manage, there are events where there are 2 lakh people in the queue and there are 5,000 tickets to sell. So you'll always have a large population who didn't get the tickets feel disgruntled. So that's a problem that you can't solve. But I think in your product flows, can you be transparent? Can you tell them okay, this is your number, this is the likelihood of you not getting a ticket, and so on and so forth. So I think there's a lot we have done to kind of safeguard that experience. So on the tech side, on the production quality side, India is at par with anywhere in the world. Where it gets challenging today is around the physical. And we don't have a lot of purpose-built arenas where you can, put up a show in a day. So for the P&Ls also to be viable, that has to happen, because we spend a lot of money and time just building infrastructure for 3 days and then destroying it the next day. So that's where the kind of bottleneck is today.
And that's exactly where I believe that perhaps could be a challenge for someone in your industry as well. Because as the average room rates go up, as the overall cost of a holiday in India goes up, immediately you're not comparing it with other Indian destinations, but you're comparing the overall cost of the holiday to nearby destinations from India as well, where the experience for the same amount of money is a lot better, largely because of the infrastructure. So a lot of the experience is outside of the controllable of the hospitality industry. Could that be a challenge?
I agree with you. I think as far as the hospitality space is concerned, like I said earlier, we are right at the top in terms of the warm, gracious, Indian style of luxury service that we provide, almost intuitive service that we provide generally in the sector. But outside, you see, your luxury journey is not just about the hotel. It's like about frictionless travel.
Exactly.
So that's something that needs to be worked upon. Things are improving now on the infrastructure side, but if you look at the whole experience bubble from the time the guest arrives at the airport to the time when he takes off back to his country, the destination management, the key tourism spots, all that can be managed better. So there is a lot of work to be done on that side.
No, I think Anurag is right. I don't want to repeat what he said, but one thing is there with the train systems improving and the highways improving. I think a lot is changing. I can only say a few sectors like Delhi, Jaipur, or Jaipur, Savai, Madhepur, going to Ranthambore is a highway par excellence. I mean, it's nothing better than that. I did once Lucknow to Agra 6-8 months ago. I think that was also phenomenal. So I think a lot is changing and a lot is in evolution. And things take time. We are a very large country and very diversified, so nothing will happen overnight. But what has happened in the last 10 years is commendable and just gives us a lot more optimism to build hotels in these new destinations because they are more accessible and easily reachable.
Wonderful. Just as we have 2 minutes to wrap, I'll go forward with some of the, ribbing each other sort of questions here. When you go to, say, Leela, what is the first thing that you notice?
Wow. Shall we do it in a lighter way? Anurag, is it okay with you? Go ahead. When I first enter, let's say, a Leela in Chanakyapuri in Delhi, I see a combination of Taj Palace and Taj Mansingh.
Why would you say that?
The architecture is such, the arrival experience is such, but
it's twice as good.
And because they came 80 years later, so many things are improved upon, like our highways. But then comes the next challenge. I see a lot of people walk up to me, like here in Geo, and it seems all of them have been trained by Taj. Then, fortunately, I've not had to go through the menu, but some of my friends said that when they went to the menu, especially the Japanese or other Asian, Pan-Asian cuisine, it looks very much like Taj, but doesn't taste like that.
He's not holding anything back.
Thanks, Puneet. Hi, thanks, Puneet, for the lovely endorsement. So we've been able to attract some good talent as well.
When you go to one of the Taj hotels, what is it that you see?
Well, I have to be very careful because my wife spent a very significant part of her life in Taj under Puneet's
So next time you go to Leela, you'll also see...
No, but I think what really strikes me about Taj is the warmth that comes across, the level of service that every associate is able to take a decision that every associate in anywhere, and I've stayed in many Taj hotels as a guest. So that really strikes out.
I'll just add one sentence to it, but whenever I go to his house, I find the Taj because the wife is there.
And if both the Leela and Taj were to list on District, what differentiated user experience would you provide the guys who are looking for that sort of luxury?
Oh, wow.
I'm making a business deal for you here.
No, I think, all the feedback that we get from consumers today is that we are trying to disrupt in category where not a lot of product innovation has happened over the last 20 years. So I think that's a great kind of endorsement for how we've kind of tackled this category. And if these giants of consumer brands in India, they have to list on District, I think the credit
would go to CNBC TV 18 for this.
Yes, and I think it'll be happy.
And a commission.
And we already did, right? For Rolling Loud last year, we as I was saying, 40% of people were out of town from Bombay, and we sold hotel packages, and I think they sold out along with the tickets. So I think there's a lot of synergy there. So I'm also doing a sell here. So.
All right, we'll allow you all to explore the synergies back in the WeWork lounge out there. But this is all about the experience economy, emerging headroom for growth and challenges, and a lot of leg pulling between the legends as well.
WeWork India presents CNBC TV 18, The Titans. Co-presented by PhonePe. Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The market has continued to be volatile and the war in West Asia, at least as of now, is not showing any signs of abating. Now, throughout the volatility, one thing is clear, that mutual fund investors have kept their faith. They have kept plowing money back into equity funds across categories, especially the flexi cap category. And believe it or not, in this correction, mid and small cap funds have also received a fair amount of money. Now, while we talk about a lot of different mutual fund categories, we rarely speak about the multi-cap category. This is a category where rules mandate, that is SEBI rules mandate, that a minimum investment of 25% must be made, the fund's corpus that is, 25% each in large, mid and small cap. So does this category actually make sense for us investors? Have we been overlooking it? Should we start thinking about integrating the multi-cap fund category in our portfolios? To talk about some of these very interesting trends, we have with us Vandana Trivedi of Axis Mutual Fund. Vandana, thank you so much for coming back on the show, and it's great to have you with us right here in the studio.
Likewise, Surabhi.
So Vandana, I want to start from the beginning, because even before we talk about the subject at hand, it's been a difficult market, right? To say the least.
Absolutely.
Vandana is smiling. See, that's what market men and women do. They brave all the volatility with a smile.
Actually, our investors have braved this more than we have, I must say. You just said, right, the flows have been fairly strong. Yes, markets have been very difficult. It's very difficult to predict which way the markets will head. I think world over, we are grappling with a lot of uncertainties or developing trends which are beyond our understanding or our ability to respond to. And this is not just about money managers, right, Surabhi? This is also about governments. The emerging trends suggest that even governments are at a loss to figure out how to deal with them. So yes, that uncertainty is like a dark cloud over the markets. But like you rightly said, the mutual fund flows have held. To me, it amplifies the belief that we've been having and all of the work that we've been doing over the last few decades, in that maybe the mutual fund investor has actually evolved to seek mutual funds as a wealth, and especially equity mutual funds, as a wealth building medium. And look at such opportunities as these volatile phases to only add up to their equity allocations.
The only difference is that I think especially the younger investors who've come in after COVID, they're very used to V-shaped recoveries in the market. Everybody's learned the lesson that when the market is collapsing, that's where you invest the money and that's where you get the best returns.
True.
But it's the shape of that recovery. And COVID was a V. Now, we don't know how this is going to play out. It's already been 12 months of sort of consolidation. Before we talk about the nuts and bolts of multi-cap funds, what's the in-house view when you talk to your fund managers? Because the reason I'm asking this question, that everything changed since the Prime Minister's appeal to the nation, right? Before that, I think the market was like, Acha, theek hai, it's getting sorted, there's a ceasefire, eventually this war gets over, and then India really takes off. But the Prime Minister reminded us just how serious the economic problem at hand really is now.
Yes. So, obviously I'll walk your audience through how we are looking at the markets from a broader perspective. But before that, just a word on geopolitics. Obviously, you may not have an interest in politics, but politics ends up having an interest in you, like some Greek philosopher said in some 400 BC. So, essentially, if this continues the way it is, with no resolution still yet in sight, it's going to inflict a lot of pain, especially for an energy importing country like ours. So that's definitely there on the table, no question about that. So be prepared, like the Prime Minister guided, to a lot more of belt tightening, so to speak. But having said that, the way we are looking at the markets, Surabhi, is that we believe that the market breadth itself has increased. So what I mean by that is that, even 5 years back, our market had a very narrow leadership kind of a framework. So there was just a set of large cap stocks which was leading the market growth, which was dominating earnings flows, etc. So which was also evidenced in how market capitalization looked. Overall market capitalization, large cap dominated the overall market capitalization. However, over the last 5 years, what has happened is that large cap has lost some share to mid and small cap.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
I don't know how to start this without being a fanboy of all the products that you have to offer, be it, some of the Ginger hotels because Taj I can't afford. Leela's you see from outside, take pictures of. District is where you open the app and, you look at the tickets which are all sold out. So I'm a disgruntled customer, aspirational customer, and maybe an analyst of the space as well. We can't start this without addressing the elephant in the room. The conversation that came from the Prime Minister, asking people to exercise restraint when it comes to consumption, travel, extravagance, all these things to save on Forex. Where do you all stand on that? Do you all benefit from it because domestic tourism gets a boost? Or do you all not benefit from it because people are now in saving mode? Let's start with you, Puneet.
With me, firstly, I have to say, God helps those who help themselves, so please help yourself. If you can't afford a ginger, I'm sure you cannot afford garlic either. So.
No, I can afford a ginger, not the Taj.
Okay, so now on the, I don't know the names you use, I cannot use that name, but given the latest, what you're referring to, I don't know, it could be very good for the experience economy. It could be very good under the aspect of Dekho Apna Desh. It could also turn out to be very good to add Make in India, Heal in India to Wed in India. Not only for Indians, but also for foreigners coming into India. So I think it could be positive. On the other hand, I think we are all a bit speechless thinking, is there more to it? Is there something that we need to know? Should we be more careful? Should we be, cautious or thinking about what else to expect, what is coming our way? So I think at the moment, at least I am trying to digest the news and see how things pan out day after day. We are also living in a geopolitical world where a statement made in the morning may not hold true, forget afternoon or even, no. Even late morning the statement is false. So I think we need to get through that over the next week or a few weeks, and by the end of the month or early next month, we'll know more.
Right. Anurag, what do you think about this?
I just add on to what Puneet said. I agree with him. It's a bit early stage for us to know what's going to be the full impact of Honorable Prime Minister's statement yesterday. But typically, if you see India's context, the months of May, June, and July are holiday seasons, school vacations, a very strong domestic uptake any which ways. So that is going to get further amplified, what we believe. And if you take a step back and look at India's overall outbound, the number of affluent Indians who take international trips is nearly 3x of the inbound. The inbound to India, the international tourists that come to India, is pretty submissive compared to anywhere else in the world. So in that sense, in the long run, it will provide a deeper opportunity for us, but it's early stages to see how specifically it will pan out in the next few months.
Before we go to Rahul, I have to ask you this, because you said it's a little early to digest the impact of this news. I can tell you from the stock market standpoint, 12 lakh crore of market cap erased. And the wealth effect obviously has an impact on how luxury products sold by you guys are consumed. Do you think that could be a bigger worry than what the Prime Minister has said? Because the underperformance of the stock market, the underperformance of portfolios, could that have an impact on consumption of your products?
If we take a pessimistic view, we have a lot to worry about. If we take a realistic view of what we know and what we think we know, then there is nothing to worry about. So I think what we don't know, that's what I said. So at the moment, things are fine. May, Anurag and I were chatting outside. May is off to a very good start. Of course, the first 15 days of April were not as good. June, the business on books looks good. I hope it stays that way, but also it's a bit unfair comparison because I mentioned it on your channel. We had Pahalgam in April and we had Operation Sindoor in May and we had the airline accident in June. So a lot went wrong in the first 3 months of the same quarter last year. So at the moment, the way we see things is fine. And more importantly, I think we tend to underestimate the safety and security. I think the safety, security of people, our customers, etc. today is very good, and including in places like Middle East where we have an operation, we can say we've not even had a very small incident that could have impacted us. So I think that's the way we are thinking at the moment. The business goes up and down, and it will come back with a big bang.
All right, business goes up and down, come back with a big bang. You know, what connects the three of y'all is, it's a very interesting thread where, say, for instance, District is something that started from an organization that always believed in giving comfort to people in their houses, right? And now you are suddenly asking people to get out and the opportunity that there is. So I'd like your thoughts on, you know, what were those initial pitch meetings like which said, oh, there is a TAM, or total addressable market, in this experience economy? What were those qualitative and quantitative parameters that you all discussed before actually jumping headlong?
First of all, thanks for having me, and starting with a softball about the PM speech. But yeah, I think, the way we look at it at Eternal is that we build for convenience. So the common threads across all our businesses is what can we do to make urban lives smoother, friction-free? And this seemed like a large segment out there which nobody's addressed the way we are thinking about it. And so we are just about, removing that friction and helping more people consume outside of their homes. And we know directionally it's a larger TAM than at-home consumption. So.
Right, and the reason I call it a common thread is because all of them actually had to get out of their skins to do something and succeed at that, and that's exactly what Titans stand for as well. Anurag, you know, when the Leela was taken over by a private equity firm, obviously the brand that stood, there was a fair amount of headroom for growth out there, but there were other brands that were offering similar services and experiences as well. What do you think made Leela the attractive bet that you all made on? And what differentiates your quality of service from, say, some of your peers?
Thank you, Mangam. That's a great question. So Leela has been in existence as a brand for the last 4 decades.
40 years.
40 years, that's right. We celebrate 40 years of Leela this year. When legendary Captain Nair founded this brand, the moat was very clear, the finest asset quality, the finest level of service. And this is something that we have singularly preserved all throughout this journey and continue to do so. What really enabled us, post the acquisition of Brookfield in 2019, was the scale, the access to capital, a disciplined asset management approach, and our ability to put all things together to grow mindfully and deliberately whilst keeping the singular focus on luxury. So we have further fine-tuned our services, our programming, our experiences, which is evident from the results that we are doing quarter on quarter. And we believe, because in this particular space, there is a lot of runway ahead, and there are tailwinds at a macroeconomic indicators to support this focus on luxury from experiences, because that's where the new consumer is moving, and that's what they want to experience.
Right, and that brings me to Puneet now, because again, something that is not of extreme comfort to a group that was earlier known as the Taj Group and now known as the IHCL Group, largely because you wanted to diversify your revenue coming out from Taj, get into products which are not more luxurious than Taj, but more affordable, accessible to people like me, say something like a Ginger and all these things as well. So what was the call that you took out there when he's saying that there is a lot of headroom for growth in luxury? You're also seeking something at below the luxury pyramid as against above.
Wow. Is this working? Yeah.
Yes.
So I think, firstly, we have to take a step back. The evolution of the nation was reflected in a group getting called Taj Group, which was never the name. The name given by the founder was Indian Hotels Company, and that is going to have its 125th AGM this year in June. So it's not a name founded.
We have 40, 125, and 2024. Yeah, so 1.5 years.
So now that's the starting point. The philosophy behind calling it the Indian Hotels Company was to give an answer to the society where it was written on the hotel's doors, dogs and Indians not allowed. So
Yes.
it was, for that time, a hotel for the Indians. Now, since then, 1903, when Taj opened, fast forward 2026, India is 1.5 billion people. And even if 50% of that population is your TAM, total addressable market, and that includes people like Mangalam, we need a product for each of the Indians.
Thank you so much.
And that's what we did in trying to leverage the strength of the Taj, all that the Taj had created, almost over 100+ years of legacy, and then obviously make it evolve into upper upscale, mid-scale, homestays, home delivery, and you name it, in catering units. And we became a very well-diversified portfolio, which is today very distinct by brand, by geography, and by contract type.
Got that. So diversification has been your journey. Deeper penetration into the luxury market has been yours. And obviously seeking further formalization as the experience economy grows.
Sorry to interrupt you, but at the same time, Taj has grown into the top 3 luxury brands in the world in terms of scale. It's getting close to 150 hotels portfolio and still rated in the last 5 years as the world's strongest hotel brand and India's strongest brand across sectors. So that doesn't mean one thing does not exclude the other. So that just because we are doing more things does not mean we are not focusing on the Taj. That was, is, and remains the backbone. More importantly, the core values of Taj, what Taj stands for, I don't know anybody knows in the audience or not. The T of the Taj stands for the trust of all our stakeholders, A for the awareness of the communities we live in, act in, and J for the joy that I'm having right now in doing whatever we do.
Do you have a full form for Leela?
We have a caption though, true Indian luxury, but not a full form for Leela to that level. But I think adding on to what Puneet just said, I think if you look at brands from India, whether it's the Taj or us or anybody in the luxury space, they've always been considered as one of the finest amongst the top brands in the world globally. If you look at the voice of the customer and the customer love in terms of extremely well-accredited and well-known publications and Reader's Choice Awards and the gold list everywhere, you will always find a brand from India appearing in the top 3 or top 5, if not in the top first 2 positions.
We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe. We Work India presents CNBC TV 18, The Titans. Co-presented by PhonePe.
Rahul, I have to ask you, the emerging economy around experiences, which is concerts, people traveling for meals, people actually going out of their comfort zones and perhaps spending a little more than what their pockets would allow for experiences more than things. Have y'all put a number to how big this market could be, the rate at which it is growing, and the opportunities where the next $1 billion of revenue come?
So yeah, I think, almost every prediction that we make about numbers, every report gets it wrong. So we don't want to hazard a...
Gets it wrong on the downside.
Gets it wrong in terms of how big the market and how quickly it'll get there. So without hazarding a guess on what that number is, that we know that there are behavioral shifts driving this consumption, right? So today it's not, I think the value system and the trade-off that the next generation is making about how they want to spend their time is different from ours. And we see it play out, every day in the data that we see. So moving from products to experiences, living in the moment, not really bothered about how life will be 5 years, 10 years from now. But, if you have money to spend, go get that experience. That's why we see a lot of outbound tourism just for concerts today. There is, for large concerts, almost 40% of the crowd that we get is out of the city. So there's a lot of data that suggests that, this behavior shift is kind of happening and it's real. And we are kind of here to participate for that.
You guys are targeting, I'm looking at some numbers, 10,000 crore GOV by the end of FY26 was your last stated number, with 4 to 5% EBITDA, which obviously you're investing back in this business. Live event spends just on tickets was close to 21,000 crore in the previous financial year. And people spend 2.5 times more on travel to that concert and F&B around it. So if you double that, it's roughly 50,000 crores. What are the challenges? I have to ask you this, because for every great live concert that happens, there are a bunch of disgruntled people who say that we never got tickets because maybe the organizers gate-kept those, or we didn't get a good experience because the road to the concert wasn't as good, and all these factors. So what are the challenges while the opportunities are here for us on the numbers?
Yeah, that's a good question. I think there are a lot of people are curious about the industry now, and they are looking at the great outcomes. There are concerts that are full, they're selling out, even cricket stadiums are full and so on. But I think for us to be consistently delivering that kind of experience, the limiting factor becomes the physical infrastructure today. That's why we are kind of investing heavily on venues, because that's where the experience comes together. On the technology side, I think India is as good as the world, like our apps experience, how you manage, there are events where there are 2 lakh people in the queue and there are 5,000 tickets to sell. So you'll always have a large population who didn't get the tickets feel disgruntled. So that's a problem that you can't solve. But I think in your product flows, can you be transparent? Can you tell them okay, this is your number, this is the likelihood of you not getting a ticket, and so on and so forth. So I think there's a lot we have done to kind of safeguard that experience. So on the tech side, on the production quality side, India is at par with anywhere in the world. Where it gets challenging today is around the physical. And we don't have a lot of purpose-built arenas where you can, put up a show in a day. So for the P&Ls also to be viable, that has to happen, because we spend a lot of money and time just building infrastructure for 3 days and then destroying it the next day. So that's where the kind of bottleneck is today.
And that's exactly where I believe that perhaps could be a challenge for someone in your industry as well. Because as the average room rates go up, as the overall cost of a holiday in India goes up, immediately you're not comparing it with other Indian destinations, but you're comparing the overall cost of the holiday to nearby destinations from India as well, where the experience for the same amount of money is a lot better, largely because of the infrastructure. So a lot of the experience is outside of the controllable of the hospitality industry. Could that be a challenge?
I agree with you. I think as far as the hospitality space is concerned, like I said earlier, we are right at the top in terms of the warm, gracious, Indian style of luxury service that we provide, almost intuitive service that we provide generally in the sector. But outside, you see, your luxury journey is not just about the hotel. It's like about frictionless travel.
Exactly.
So that's something that needs to be worked upon. Things are improving now on the infrastructure side, but if you look at the whole experience bubble from the time the guest arrives at the airport to the time when he takes off back to his country, the destination management, the key tourism spots, all that can be managed better. So there is a lot of work to be done on that side.
No, I think Anurag is right. I don't want to repeat what he said, but one thing is there with the train systems improving and the highways improving. I think a lot is changing. I can only say a few sectors like Delhi-Jaipur or Jaipur-Savai Madhepur, going to Ranthambore is a highway par excellence. I mean, it's nothing better than that. I did once Lucknow to Agra 6-8 months ago. I think that was also phenomenal. So I think a lot is changing and a lot is in evolution. And things take time. We are a very large country and very diversified, so nothing will happen overnight. But what has happened in the last 10 years is commendable and just gives us a lot more optimism to build hotels in these new destinations because they are more accessible and easily reachable.
Wonderful. Just as we have 2 minutes to wrap, I'll go forward with some of the, ribbing each other sort of questions here. When you go to, say, Leela, what is the first thing that you notice?
Wow. Shall we do it in a lighter way? Anurag, is it okay with you? Go ahead. When I first enter, let's say, a Leela in Chanakyapuri in Delhi, I see a combination of Taj Palace and Taj Mansingh.
Why would you say that?
The architecture is such, the arrival experience is such, but
it's twice as good.
And because they came 80 years later, so many things are improved upon, like our highways. But then comes the next challenge. I see a lot of people walk up to me, like here in Geo, and it seems all of them have been trained by Taj. Then, fortunately, I've not had to go through the menu, but some of my friends said that when they went to the menu, especially the Japanese or other Asian, Pan-Asian cuisine, it looks very much like Taj, but doesn't taste like that.
He's not holding anything back.
Thanks, Puneet. Hi, thanks, Puneet, for the lovely endorsement. So we've been able to attract some good talent as well.
When you go to one of the Taj hotels, what is it that you see?
Well, I have to be very careful because my wife spent a very significant part of her life in Taj under Puneet's
So next
leadership.
time you go to Leela, you'll also see...
No, but I think what really strikes me about Taj is the warmth that comes across, the level of service that every associate is able to take, a decision that every associate in anywhere, and I've stayed in many Taj hotels as a guest. So that really strikes out.
I'll just add one sentence to it, but whenever I go to his house, I find the Taj because the wife is there.
And if both the Leela and Taj were to list on district, what differentiates